Russian oil flows, it would add to the oversupply in that market. So mind the energy stocks and watch the automakers as well. We've had the red headline that the EU's to abandon its 2035 combustion engine ban, a win for the car makers. So a keen eye on the likes of Stellantis and Mercedes at the open, Anna.
OK, so defence, automakers, oil, all in focus this Tuesday morning as we head towards the start of the European trading day. Of course, we could all be on pause waiting for the jobs report out of the United States a little bit later on. That is going to be the big data print of the day. But ahead of that, we have the start of trade then here in Europe, and the FTSE 100 just into the green, really not by much. But that's not bad considering our expectations for weakness at the start of the trading day here in Europe. We've got the Stock 600 as a whole just dropping into negative territory. These moves are extremely small, Lizzie, and they're coming through pretty slowly, which tells me something perhaps about volume or attentiveness to the markets at this time of the day this morning. But the FTSE 100 then pretty flat. The CAC 40 opening to the downside, the IBEX opening to the downside just by 1 or 0.2%. So a little bit of weakness there. A number of sectors, though, that we certainly keep in focus: the defence space, the oil sector, the auto sector. Some substantial news flow around those sectors, and I wonder how they're trading at the start.
Well, we're waiting for Rheinmetall to open, but in the meantime, we've got other defence names like Hensoldt down 3.3%, Leonardo 2.7% lower. Same move for Saab, Indra Sistemas down 2.3%. Gains actually for Safran up 0.3%. So that's defence. We also flagged autos. You've got relief for Mercedes-Benz up 0.6%, but actually Stellantis down 0.1%, and a lot of red across the screen for that sector. So let's look at the broader sectoral picture. You've got about half. It's about half and half. You've got half in negative territory. Tech at the bottom of the basket. Industrial goods and services second to bottom, and that comes back to that defence story. And energy down 0.5% because we were flagging the oil price lower on the Ukraine story, and that dragging energy down as a sector down 0.5%.
Yeah, it is interesting to see that weakness in tech, and we have Nasdaq futures down by 0.8%. So there's clearly a bit of a tech theme in today's session. Yes, industrial goods and services then and energy, as indicated, they look pretty weak, don't they? To the upside, it is one of those kind of days. To the upside, the best performing sector is healthcare. That tells you something about the mentality of these markets right now. Real estate and personal consumer discretionary and grocery stores, those are the sectors that are performing okay today. But yes, fairly evenly split between sectors going higher and lower. And just as the European equity markets are almost at full complement, we don't have the DAX just open yet, but most of them are open, only down 0.1%, which perhaps is a better performance than we had anticipated.
Are we just holding our breath, the NFP number?
It feels like we might be. Let's get into a conversation about these markets. Giulio Renzi-Ricci joins us, Global Head of Asset Allocation Research over at Vanguard. Giulio, very nice to speak to you this morning. So a few sectors in focus today. We've had news flow around autos. We've also had quite substantial developments around Ukraine over the last few days, which seems to be impacting oil prices lower, taking defence names lower. We've been talking this morning about possibly a disconnect between the short-term trajectory for defence stocks versus the longer term. It makes sense that defence names pull back right now because of the good news for the peace in Ukraine, but there could still be reasons to own defence. I mean, how are you looking at the defence space? It's been so topical this year in Europe.
Yes, absolutely. I think it does make sense also in the picture of moving away from some of the hyper concentration on the US Max 7 and super concentration. That is one of the key themes that we bring with the economic outlook and asset allocation that we have been working on. It doesn't change too much from how we were positioned already. For us, is what some investors would call a barbell strategy. So looking into value stock, developed markets ex-US, and when we're looking, for instance, at Europe, Euro area, that makes sense, right? If you look at some of where that growth might be and the tailwind, especially in terms of fiscal policy, well, it's probably going to be more on those value stocks, small to mid-cap stock, for instance, that would take most of that benefit because it will be very concentrated and localized in the region.
So do you think that there is still more to play for on the fiscal impulse in Germany, or is it all in the price? Is there still more positivity to come on that?
I think there's still more positive to come in the sense that a lot of that flows that you would expect over the medium term to move away in terms of asset reallocation and risk management of the portfolio has to come moving away from that Mag 7. At least that's our focus, our base case. There has been, of course, headwinds coming from the tariffs impact. We think that that will be mostly offset by the fiscal spending. The fiscal spending was a theme for 2025, but not as much. We always said that it would have been more like something to pan out in 2026 and beyond. So we're looking for that to be realized more on this year.
So on that AI theme, you said that it could push US growth toward 3%, but your baseline is for 2.25% for 2026. So what has to go right for that 3% to materialize?
Absolutely. So that is really the bet over the longer term. Right. So here is not so much about there is this, how can I say, double story to a large extent. We do think that AI will be revolutionary for growth, productivity in particular, especially in the US over the longer term. And that's why we see that real rate of GDP growth to be around 3%. For this year, we're thinking more about 2.25%. The reason for that is because some of the, what I would call more supply side elements are more uncertain at this point. What I mean by that is like there is a lot of hype associated with how revenue growth will be brought by the Mag 7. How are we going to see the infrastructure around that in order to be materialized, panning out over the short term? I'm thinking about energy, I'm thinking about electricity, I'm thinking about logistics more in general. I think that is one element of risk, especially on the downside risk, that is, it has to be taken into account for the asset allocation.
Yeah, what's your framework for working out what of the CapEx is going to be a waste?
Well, exactly. So that is the big bet, right? So the situation is not so much about our valuation, especially on the Mag 7, too high. They're very high. The question is more associated, do we believe that revenue growth and earnings growth that right now for, let's say, most of the Mag 7 is around 15%, let's say ballpark, some of them are higher, some of them are lower. In perpetuity, that's something that people forget a little bit. We are expecting that number to stay there over the longer term. And the risk is that you might not see that over the shorter term because that expenditure that we're seeing in CapEx, in AI scalers, will have to take some of that revenue over the shorter term more, and will impact it negatively. That is one risk. We're not saying that that's necessarily what we're hoping for and what we're expecting, but it's a risk that has to take into account. And I think that from that perspective, asset allocation right now is way more about risk mitigation and allocating risk rather than having pointed views on specific securities, sectors, or asset classes.
And how narrow or broad do you think the beneficiaries of AI will be in 2026? Will it be the year where other sectors start to benefit from AI, or is it much too early for that? Actually, this is it is a multi-year activity, I'm sure, delivering what AI can deliver. Will it be this coming year, or will it be in years ahead?
That's a great question. We do believe that over more probably like the medium term, and that's why that, again, barbell strategy, there is more upside for sectors, industry, and regions that are less exposed to just the tech stocks. Because if AI is truly revolutionary, as we think it would be, it will impact marginally more other sectors and other regions. Whether that will be in 2026 or not, and whether that trend, in terms of from a momentum perspective, will still be very focused and localized in tech sectors and tech stocks, that is probably a harder call.
Who is that then? Is it industrials? Is it financials? Where gets the benefit first?
Yes, it's industrial, financials, value stocks more in general, developed market ex-US. So, for instance, if you look at Europe, I think that the most valued companies there, Europe, including UK, you mentioned it, some of it, right? It's automotive, industrial, pharmaceutical. I think those are the sectors that would benefit over the longer term.
Okay. I've just noticed, or well, I've just been told, in fact, that the Brent price has just dropped below 60. We were flagging earlier, we were watching for that. Seems to be at 59.97. Obviously, the story, Julia, around oil prices has been a concern about a glut. A concern if you're upset by lower oil prices, I suppose. Concern around a glut, and we see data out the US and data out the Middle East suggesting that is still the narrative that is pretty much intact. And then, of course, the news flow surrounding Ukraine perhaps causes us to think about slightly lower oil prices. I mean, does this remove some of the inflation risk, do you think, for global markets? The fact that oil prices are a little bit weaker?
For sure, that is one element, is one side of the equation. I wouldn't say that our base case is for revamp of inflation, especially in the US, but inflation in the US is still sticky, has been sticky. So I think there is a risk associated also with fiscal sustainability and the Fed easing, and whether what we might be calling like a policy mistake, again, not our base case, but I think that there is some downside risk of inflation being stickier for longer or coming back from that side of the equation.
So the only argument for Fed cuts is political?
I wouldn't say so. I think there is more than that. It's very data dependent. There is a lot of that. But I think there are pressures on the Fed for having that easing. And that is something that they're going to monitor, of course, very, very carefully over the course of the year. On average, we expect for 2026 the Fed to have only one cut, just to give you an idea.
Okay, just one cut next year. And what's at stake in the jobs data that we get out today, Giulio? I mean, we've talked often about how it's very backward-looking now. Yeah. It's sort of 1.5 jobs prints, isn't it, because of the nature of the data we get over 2 months. I mean, what's at stake for you? What's at stake for markets?
I think that the major risk there is something that we might have seen earlier this year, right? I think it was around the summer, where there might have been correction coming out of the print that we see later today, on how that might be corrected over the next weeks or months. I think that would bring back some of the uncertainty to the markets that we have seen earlier on, and that might create additional pressure on the valuations.
Giulio, thank you very much. Thanks for joining us. Giulio Renzi-Ricci, Global Head of Asset Allocation Research at Vanguard. Let's have a quick check on the core six here in Europe, some heavyweight stocks that we like to keep an eye on every day. For the thematic reasons, Schneider Electric down by 0.9%, thinking about the benefits of AI being spread more broadly than tech. Tech is weak this morning, so we're down by 1.9% on ASML. I've mentioned NASDAQ futures, which is down by 0.7%. Weakness in defence names, that's clearly a theme. Rheinmetall is down by just over 4%. And LVMH and Novo Nordisk, the only areas of green. Let's check in on the individual stock movers then. Chloe Melly has a rundown for us. Chloe.
Good morning, Anna. So as you just mentioned, defence is going much lower this morning, with Rheinmetall, as you just mentioned, down more than 4% after Donald Trump said that the end to the war in Ukraine was closer than ever, and there are security guarantees that will be provided by the US to Kiev. And so this is something that we saw already yesterday, defence moving lower because of those potential security guarantees provided by Europe and US, but then we are seeing that continuing today with Donald Trump's comments being really taken to heart by investors. And so we are really seeing red across the screen this morning, and quite big downward moves as well across Hensoldt, Leonardo and Thales as well. Moving on to Magnum, which is also lower this morning after the FT reported the company is moving, trying to remove Ben & Jerry, the chair of Ben & Jerry's board. So the Magnum ice cream company has inherited the very tense, complicated relationship that Unilever had with Ben & Jerry's, and this is a tension that is apparently set to continue underneath this new structure, this new spin-off of Magnum ice cream. And so we are seeing that really driving those shares down this morning, after the shares had actually been up quite significantly since the debut last week. Moving on to IG Group, which is an online trading company, which is up quite significantly this morning, up 4.5% after saying it will be able to hit its medium-term targets ahead of schedule in 2026. It's also extended its buyback. There's clearly quite a lot of momentum in this company, and so we are up quite strongly. And finally, we're ending on another positive move with UniCredit. The Italian bank is also up this morning after being upgraded at KBW, and we are up 1.4% on the back of that upgrade.
Chloe, thank you. Chloe Melly from our equities team. Coming up on the programme, Brent crude has dropped below $60 a barrel for the first time since May. We'll talk about what's going on in the oil market. That conversation coming up next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jemana Bersetchi. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
That allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back, everybody. Just breaking across the terminal, we have the latest French PMIs for December, and the expectation had been for a higher read on manufacturing, but a lower read on services, and that's exactly what we've got. The moves as expected, but by more than expected on both fronts. So the read now for manufacturing is 50.6, and for services 50.2. The composite read is 50.1, so all still in expansion territory, Anna. None of it really likely to move the dial for the ECB, and it hasn't indeed moved the dial for euro dollar. Still flat to the upside at 170.
Although interesting to see manufacturing back above 50, because the underperformance of manufacturing globally has been such a story for such a long time. If this were to signal just the early signs of something more positive, because being above 50 obviously is growth, as opposed to where it was before, prior, which was 47.8, which would be contraction. So are we seeing a resurgence in European manufacturing? We don't have to wait long for the German numbers, do we? They're coming in just 13 minutes or so. So we'll see whether that is carried on across the continent. But that's what we're watching here. We're also waiting for the non-farm payrolls number out of the United States, which of course will be the big data print of the day. Joining us now to talk about the markets in more breadth is our Markets Live executive editor, Mark Cudmore. Mark, very good morning to you. So we're busy waiting for non-farm payrolls. 1.5 non-farm payrolls. Looking at US futures a little bit weaker, weighing on sentiment for tech here in Europe as well. What do you make of the price action heading into the important data print?
It's been very disappointing price action, and I think this kind of choppy price action with a negative bent is going to be the dynamic for the festive period. I don't think it's so much about the jobs data. I think the jobs data today is a great one for short-term traders, but it's one we'll quickly move on from. The dynamic here is that, on one hand, Powell has emphasized that he thinks that the prior jobs data has overstated the health of the jobs market, therefore increasing the scrutiny and in the importance of these numbers given the data vacuum before. On the flip side, he also warned that this one's vulnerable to some kind of technical distortions, which means people will get very excited in the short term, and then a week later, if it doesn't suit their view, they'll move on from it. The price action is very negative out there, and I think that's going to remain the case until we see the full pain play through on the digital asset treasury companies, which are really at the lows. And that's what's really weighing on the crypto sector, and in turn, That's weighing on the retail sentiment, which is then hurting the big AI names or the more meme-focused AI names as well.
So, Mark, putting the possibility of a Santa rally aside for now, are we going to see more record highs for stocks in 2026?
Absolutely. I mean, I remain very bullish for 2026. I think, we've got everything in the mix for stocks to make significant more gains in the first part of the year. I think we've got the Fed providing easy monetary policy. We've got fiscal stimulus coming from the US, from China, from Japan, from Europe, kind of in all directions. We've got growth still holding up largely okay. We've got just a massive AI bubble, but we're in the inflation stage of the bubble. So that's a positive factor at the moment. It won't be forever, but it is very much so at the moment. Earnings still holding up good. And because that AI CapEx spending, that's helping the economy, even though it's a K economy, it's helping that kind of spending out there. So I think global stocks go much higher in the first half of next year. But I think it's too early to get excited about looking at that just yet. I think we've got some choppiness for the next couple of weeks.
Okay, and thinking about that choppiness, Mark, might some of that come from shifting expectations about rate cuts? I mean, how convinced are you we get more rate cuts from the Fed? The market sometimes pricing in one, sometimes two. But this is into an AI boom, and it's in the context of much more of a hawkish tilt coming through from other global central banks.
Yeah, absolutely. I think one of the themes of the last month or two is the idea that most central banks are kind of at the end of their cutting cycle and going to be shifting towards hikes. And we're seeing that all around the world. And that's kind of changing the dynamic everywhere. We're in a world where people have a nagging feeling. It's not the dominant theme, but a nagging feeling that there are fiscal threats everywhere. And too many developed market economies are over-indebted. And therefore, that creep higher in yields from these central banks moving more hawkish, the idea that inflation is sticky, it's a global theme. And that's why, even though we've seen 175 basis points of rate cuts in the last couple of years, we see 10-year yields higher than they were 2 years ago. And I think that's the dynamic we've got for 2026.
Okay, Bloomberg Markets Live, Executive Editor Mark Cudmore, we thank you as always. And remember, you can get up-to-date analysis and insight from Mark and the team by going to MLIV Go on your terminal. Well, there are big moves in the oil market today. Brent's falling below $60 a barrel for the first time since May. The market facing surplus concerns, but also, of course, watching events in Ukraine and in Venezuela too. Let's get more with Bloomberg's Paul Wallace now. Paul, 60 clearly not the floor. Is the floor 50, where are analysts saying that it could be now?
Yeah, we're looking at quite a rough end to the year if you're an oil bull, that's for sure. Brent below 60 for the first time since May, looking at heading for its lowest close this year. WTI now below $57 a barrel. I think the focus for oil traders right now is on the talks between U.S. officials and Ukrainian officials. And there is a sense that while there's probably still a way to go before we get a ceasefire in Ukraine, we are closer, and there's a sense that Donald Trump is really pushing for a ceasefire or some kind of peace deal before Christmas, and that is weighing on oil prices.
And what would, good morning to you, Paul, what difference would it make to the oil markets? Because to make the assumption that that means more supply and lower prices, do you have to assume fewer sanctions on Russia? And how convinced can we be at this point that that's what's going to come?
Yeah, it's a tricky one because if you look at what's happened since Russia's invasion of Ukraine in early 2022, there hasn't, if you take the whole period since then, the sort of 3.5 years since then, there hasn't really been a big drop in Russian exports anymore. But nonetheless, there has been a bit of a geopolitical risk premium in the oil market. And recently, of course, you've had Ukraine stepping up attacks on Russian refineries and now even Russian oil tankers as well. So it would certainly reduce geopolitical tensions a lot. And of course, this is all coming at the time we've got a big oversupply in the market. Several million barrels a day by some counts. So that include that, and you add onto that the potential prospect of a ceasefire in Ukraine is really weighing on prices.
Yeah, I don't want to put a pin in the optimism, but I feel like we've heard this before, the president announcing a deadline and really trying to put pressure on both sides to come to the peace table. But maybe, and we're hearing it from many leaders, that Putin is stalling. And if the talks keep dragging out like this, then what happens to oil?
Yeah, and I think most traders, the sort of consensus as well, that the continuation of the war, let's say for another 6 months or more, was already priced into the market. And there wasn't really a feeling that things would get that much worse, or you would really see a situation where Russian crude exports were being curtailed because of Ukrainian attacks or something else. The feeling was, well, that, you know, the continuation was already priced in. So if there's a chance of it ending sooner, even if it's a small chance in the eyes of many people still, well, then that will bring down prices. But of course, there's plenty of other potential bouts of geopolitical risk elsewhere in the world, the Middle East for one, that could make prices go the other way fairly rapidly.
Yeah, let me ask you about Venezuela, actually, because there's been a lot of focus on what the U.S. administration is doing. And what's at stake with Venezuela? Because this, again, is a sanctioned country, but there do seem to be carve-outs for certain U.S. energy businesses to operate there.
Yeah.
So what's the read across from any tension that we're already seeing, any escalation in tension, into what this means for global energy markets?
I mean, in the short term, it could be bullish for oil prices if Trump decided to go about trying to, remove Nicolas Maduro from power, or to bring about some kind of regime change, because it is exporting oil, Venezuela, but it's a small producer. It's only exporting less than 1 million barrels a day, I think about 700,000 barrels a day. So that's not going to make a massive difference to the global oil market, even if it suddenly went to zero. And in the longer term, I think there are actually a lot of people in the oil market who are, they're thinking that if there is some kind of regime change or Maduro's removed from power, that give or take 2 or 3 years or something like that, Venezuela will be able to produce much more than what it is doing today. So in some senses, that's also a sort of a bearish factor on oil.
We'll just briefly pull another part of the oversupply story is, of course, the US Gulf Coast market. How much is that a kind of canary in the coal mine for the oversupply story?
Yeah, we're seeing signs in the Middle Eastern physical markets, in the Middle East Dubai benchmark of oversupply now. So I think that's a real sign. And of course, most of the Middle East oil goes to Asia, primarily China, and that's also another key thing that oil traders are watching is demand in China. There's a bit of division, amongst oil traders and analysts about what will happen with Chinese demand in the next year or so. But there's a bit of a consensus that there are a lot of signals that demand there is sort of waning, and a lot of what we've seen from China in the last 18 months has been China actually building its stockpiles rather than importing for real demand.
Paul, thank you very much. Thanks so much. Nice to see you in London. Bloomberg's Paul Wallace joining us to talk about everything that's happening with oil, down by 1.1% now on the Brent price. Coming up, we talk about the European economy. Ludovic Subran joins us, CIO at Allianz. We'll get German PMIs in just a moment. This is Bloomberg.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Key
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg. We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You said they ask interesting questions.
Bloomberg Television. Top experts, great questions.
This is the opening trade 30 minutes into today's session this Tuesday morning. Let's have a look at where we are with 30 minutes under our belts. We're down by 0.1% on the stocks here at 600, and that's actually a little more positive than maybe the futures picture had led us to believe, so maybe eking out slightly more gains. Certainly on the CAC 40, we are just a touch higher this morning. The Xetra DAX down by 0.4%, but maybe for good reason, if that's possible. I mean, we've got defence names, of course, in focus because of the developments that are happening around Ukraine, and as a result, some of those defence names are a little bit weaker. Some of those sit in Germany, of course. The FTSE 100 is down by 0.2%. The other development that is also Ukraine-linked, as we were just discussing with the oil team, is around energy prices. So oil prices dropping $60, below $60 on the Brent price. That could be weighing on some of those energy companies that are very heavily weighted, Lizzie, around Europe.
Well, of course, the main highlight of the day for data is the non-farm payrolls number that's coming out of the US, Anna, and it seems like traders are sitting on their hands in anticipation of that. We've got a pretty even split of members of the Stock 600 higher and lower this morning. Volume slightly higher today. But if we flip the board over, you can see who the leaders are today. If you want to dip your toe in the water of the stock market, probably best to do it in a safe place, hence gains for healthcare stocks this morning. Also UBS up 1.5%. But if we flip the board over to the laggards, you mentioned defence, and indeed we're seeing that weakness for Rheinmetall, down 3.7% because, as you say, there is the prospect of a ceasefire for Ukraine, so the defence names suffering off the back of that. Tech is the worst performing sector today across the European continent, and we have some of the big tech names down, like SAP down 1.3%. Nasdaq futures also lower this morning, so not a good day for tech so far, Anna.
Yes, Lizzie, let's think about some of the other stories that we're covering this morning, and this one is tech related. The Nasdaq is looking for US regulatory approval to extend trading hours on its stock venues to 23 hours during the work week. According to a filing, the firm asked the SEC for permission to add an additional trading session. That would be from 9 p.m. to 4 a.m. New York time. If approved, the change could take effect as soon as the third quarter of 2026. President Trump is suing the BBC for $10 billion over a misleading edit in a documentary last year. The clip gave the impression he had made a direct call for violence in a speech leading up to the January 6, 2021 attack on the U.S. Capitol. The BBC previously apologized for the edit, but has rejected Trump's demand for compensation. President Donald Trump says a negotiated end to the war is closer than ever. The comments come after U.S. negotiators offered more significant security guarantees to Kyiv as part of Trump's renewed push to end the Russia-Ukraine war. Territorial concessions remain an issue with European allies and Ukrainian President Volodymyr Zelensky insisting on a ceasefire along the current line of contact. That's some of the geopolitics then, Lizzie. Back to some of the breaking data.
Yeah, we have German PMIs just crossing the terminal. This is for December. And manufacturing's down. We were expecting a gain. 47.7 is the reading. Services also down by more than expected. Services at 52.6. So still in expansion territory for services at least. And then the composite number is 51.5. So the expectation had been for a drop, for it to hold steady. And indeed what we're seeing is a drop. So in terms of the reaction in the markets, euro dollar not doing anything, actually, still holding at 170.
Well, I wonder if that, I mean, we were asking after the French number dropped whether we were, was this the early sign of some sort of pivot back toward manufacturing in Europe, slightly away from services? Well, no, seems to be the answer to that question. That was a short-lived question for European markets.
All right, well, there's a lot more eco data still to come in 2025. Plenty to discuss then with Ludovic Soubrand, CIO for Allianz, and he joins us now. Good morning, Ludo. Always a pleasure to see you. I wonder what you make of the PMIs this morning and whether they move the needle at all, whether now or in the years to come for the ECB.
Well, look, it was a pre-Christmas macro gift for all of us here trying to make sense of numbers. We have another salvo coming out this afternoon with the US jobs market. Everybody is looking at this softening numbers happening or not. Look, I was happy this morning because French numbers were going up, especially in manufacturing, and then the German numbers were the reality check that we all expected a bit. Look, I do think this is a confirmation that whatever fear were on the market last week about a potential re-hike by the ECB towards the end of 2026 is a bit of a myth, right? I think the European economy is cooling down. And so I think if risks are tilted to one side, they're rather tilted to the dovish side for the rates, right? So we expect the ECB to potentially cut towards the end of the year if the numbers are actually bad, right? So we are still a bit below the consensus on this one. On the euro dollar, it's quite interesting also. I think it's very interesting what's happening now because we've seen a bit of a steepening on the yield curve in Europe. And so a lot of people are wondering whether there are flows from the US coming to Europe, whether there is something happening, but the euro dollar is not budging. So I guess we still, look, 2026 look like a very much of a continuation, pushing a bit through the limits, right? Europe is cooling down, but not too much. I think the US uncertainties are high, but again, we're going to get more data now to see. I don't think it's going to dramatically change the picture, and the next 2 weeks are going to confirm a bit what we were expecting in terms of continuity when it comes to the central bank keeping course, and whatever can derail is political. You mentioned manufacturing. I think the manufacturing numbers in Germany, by the way, are an epitome of what's happening a bit on the political side, where there is a bit of uncertainty on whether this coalition could hold on topics like reforms, right? I think that's also what is affecting a bit the sector and especially the industrialists in this country.
Well, yeah, staying on Germany, part of the reason that Isabel Schnabel is convinced that the next move for the ECB will be a hike is because she is more convinced than others on the Governing Council that this fiscal stimulus from Germany will come through. She's also, of course, confident that tariffs aren't hitting as hard as expected. What do you make of those views of hers?
Look, on the tariff, we agree to disagree. I don't think U.S. tariffs are inflationary for Europe. They are recessionary. So this is a bit of a disagreement between friendly economists. On the fiscal stimulus in Germany, I would like to be as hopeful on this fiscal stimulus actually happening and on German growth to actually be hitting 1% in 2026. What we see right now is that there is a pickup in the public, the government contribution to GDP, but it's compensated by even more savings on the private side. So I'm a bit more cautious on the growth and therefore on the tension on the supply chains, right? So that's where maybe we have not so much of a pickup of inflation, which is what this fiscal stimulus would mean, I think, for the ECB to hike again in 2026. So that's where I guess there is a bit of a disagreement. But it caused a bit of chaos on markets last week, right? Because a lot of people think, okay, that's really a possibility, when in the US we know more or less where the direction of the rates is. Yeah.
Yes, so you have a different view then, Ludovic, more dovish. Good morning to you, nice to see you. I want to ask a bit more detail about the transmission mechanism for this fiscal stimulus in Germany and how that will get into the real economy. I understand you're sort of downplaying maybe either the speed or the extent to which this will boost the German economy. But what are you watching in particular to give you a sense of how that is working its way through?
The job market. Look, it's all about the job market. The real tension that we could see in Germany, the scarcity is on labor. So if we expect that there's going to be a fiscal stimulus that are going to create so much demand that is going to create scarcity on the labor market, we need to see whether we expect that some other firms are not hiring or even are looking at potentially letting go because of, tons of factors. Fewer order books, maybe AI adoption, maybe also more productivity gains, which I think everybody's obsessed with. That's why, for me, there is not so much tension on the labor market in Germany as there used to be once, especially because a lot of the companies are now looking again at productivity gains with the adoption of AI. That's for the services industry, but also in terms of manufacturing. We see also some of these companies thinking twice about optimizing their value chains, right? So I'm not too worried that on that front. Yeah, I would say that would be the mechanism that should worry us. So job market, job market, job market. Okay. That's what we should be looking at.
Okay, so all about the jobs. We'll keep that under review. Now, interesting, sticking with your view on the ECB then, Ludovic, and you take a slightly more dovish position on where the ECB goes. And I was interested in your notes, you talk about the reasons behind that, and you say because of some of the battles that Europe faces, for example, on geopolitics, on demography, on competition with China, and they all make sense, but they're also very long-term stories. So, I mean, what does that mean for the European economy, the fact that these are very long-term threats?
Well, I think these are very present threats. On quite the contrary, there are silent wars, but they are kicking us in right now, right? If I think about the need for defense, someone needs to finance defense. And to be fair, right now, apart from Germany, there is no balance sheet that can finance defense. So we're going to have a conversation in Europe on whether we want to restart defense bonds, Euro bonds. Because otherwise, I don't see how this is going to happen if we really want to pump up, GDP spending to defense to 3.5% of GDP. And the window of opportunity is now. So what do you think is going to happen then in terms of, how do you see this playing with very stretched fiscal position from some of the government in Europe, right? So, for me, these are pressures that we're feeling now. Similarly, on demography, we have one of the worst year when it comes to natality. And I do think this is going to create some tensions on the labor market. And again, I was just mentioning what type of labor market tension we should be monitoring to understand where the ECB is going, right? So I think there is a diffusion of these pressures into the decision-making of the central bank. And of course, we can try to ignore them because the ECB is supposed to be focused on its mandate. I do think we are at a bit of a situation where these coalesce in a way into the decision-making in the short term.
Okay, so these are very present concerns rather than the long-term, as I was suggesting, in your view. Now, we are seeing in the very short term, we're seeing some weakness in defence names, Ludovic. Defence stocks are weaker as a result of the very good news, perhaps progress, at least, coming out of the Ukraine talks. We'll see if that comes to pass. But you talk about the need for defence bonds. I wonder if you see appetite for that. Would that be some kind of shared debt? And given what Germany is able to do with its own balance sheet, would you see a movement in direction, a movement in that direction of defence bonds? Do you see that coming to pass?
I think if there is a window of opportunity, it's now, yeah. I mean, there are several discussions now on a French-German DARPA. There are discussions on how we should finance, our common goods, and peace is one of our common goods. So I think there are discussions happening between governments across the Rhine. There are also discussions beyond France and Germany on defense bonds. I think we should be very clear. We have a mechanism now, which is Next Generation EU, and we need to think whether we want to have a form of different financing structure for something that is a stretch on everybody's public finances and something that is by construction. Something that benefits everybody, because they're always free riding in this defense spending, right? And the literature is very clear on this. So we need to find a way to have everybody commit to it. Because you mentioned about the richness of the stocks in the defense sector that have been correcting. It's also because there are so few companies, that of course it's all dependent on the balance sheet. And we know that German money on defense won't be subsidizing the French companies on defense. That doesn't hold for the taxpayers in Germany that will have to ramp up to finance this effort of security. So at one point, we need to decide whether we want to do it as a pan-European decision, and that goes mostly through the debt market, and certainly also the capital markets union that could help a bit on financing the equity of these companies. But most of the story now is a bit on how we get a bit of a push to some of these companies and some of these efforts, especially the government and then the public orders in that sector. All of that has to be thought through at the European level, yes. And I think there are good discussions happening on this, right? The problem is the weakness of some of the political leaders in their home country, and of course, the tension, the very visible tension with the Commission as we speak, where we have a bit of disagreement on what Europe should be focusing on. But I do think there is a discussion, and I do think there is a high probability that we see some movements on that space in the coming quarters, yes.
Okay, so massive questions to ask in the coming quarters when it comes to defence funding. But just bringing it back to this week, Ludovic, and the central banking story, of course, you're dovish when it comes to the ECB. You're also dovish when it comes to the Bank of England. The expectation is for a cut, but you see a dovish cut. What if it's a hawkish cut? What would that do to markets, especially the pound against the euro?
Well, we haven't got the composite PMI for the UK, but I expect the economy is clearly cooling, yeah. And so I do think that unfortunately we have a bit of a situation that is very difficult in the UK today. So that is going to be permeating into the decision of the Bank of England. This being said, yes, there is stickiness on the inflation that is very problematic in the UK. So I also understand if the Bank of England decides to hold put. I'm just a bit concerned about the uncertainty diffusing into the decision of consumers, of families to spend and invest in the UK. And I think the Bank of England will have to be cognizant of that stuff. So that's why we're talking about a cut in the Bank of England that will be more dovish, because we think the numbers are ahead, are a bit cooling, including the jobs market, by the way, looking at the jobs market in the UK right now.
Which we saw this morning. Ludovic, thank you very much. Thank you for your time this morning. Ludovic Soubrand, the Allianz CIO, thank you for being with us. 8:43 here in London. Coming up, US negotiators offer Ukraine, quote, Article 5-like security guarantees as part of a deal to end the war. We'll have details next. This is Bloomberg.
The game here is understanding. These digital assets have the ability to change the payment landscape of the world, and we need to be ready. We, the regulators, the world needs to be ready for a new wave of technology.
Stablecoins are almost entirely used in the mechanisms of trading in cryptocurrencies. What we saw is the opportunity for digital assets broadly, stablecoins in particular, to be used as a medium of exchange outside of the crypto world, what is today the fiat currency world. At some point, I think these digital asset wallets will be big enough and people will be comfortable enough using them. I think we'll have a flip from conventional payment mechanisms into stablecoin-based mechanisms.
Does that mean banks such as yourselves issuing stablecoin?
We could. We are issuing Hong Kong dollar stablecoins today. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need, because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of them.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Welcome back to the opening trade. We're 47 minutes into today's session, and as you can see, it is red across the screen. The Stock 600 only down 0.1%, but we are holding our breath for that US non-farm payrolls report later on in the day. US futures also pointing lower, much more lower actually. S&P E-minis down 0.4%. But let's focus on the geopolitics now, because after 2 days of intense talks in Berlin, negotiators suggest that major progress has been made in finding an agreement that would end Russia's war in Ukraine.
I think we're closer now, and they will tell you that they're closer now. We had numerous conversations with President Putin of Russia, and I think we're closer now than we have been ever.
Well, the steps forward centred around US-backed security guarantees for Ukraine. While President Volodymyr Zelensky praised the progress, he also underlined the distance that still remains on one crucial issue.
Of course, not all aspects are simple. There are complicated things, in particular the topic of territories. Undoubtedly, everyone is raising this topic, and it's important that we all work to ensure that things like that are absolutely fair. We had enough of dialogue about territories. I think that so far we have different positions. I'll be honest, but I think that American colleagues have heard my personal position, and I'm very happy that I was able to personally convey this position.
Bloomberg's chief Europe correspondent Oliver Crook joins us now for analysis. Ollie, we've heard a lot of positive rhetoric there. What gives negotiators that degree of confidence? Is it all just talk?
It all seems to center around these security guarantees that the United States has been talking more and more explicitly about, really getting behind. This is something that, we know that the Ukrainians have wanted from the very beginning, because what good is a peace deal if you're going to get reinvaded in 2 or 3 or 5 years without the security guarantees? And that has been one of the crucial issues for Zelensky, something he's pushed from the very beginning, but it's only really been recently that the U.S. has been talking explicitly about it, and to the point now that they say that they're satisfied that they're going to potentially move forward with security guarantees that are backed from the United States, the Article 5-like guarantees. Now, we have not defined quite what is like a security, an Article 5 guarantee without being one. So we have to speculate a little bit. Of course, Article 5, the whole premise is an invasion on one is an invasion on all, an attack on one is an attack on all. So the idea would be that if there is an attack in the future on Ukraine, that the sort of NATO infrastructure and architecture would come to the support of Ukraine very immediately. There would be triggers that would make that happen. Now, I suspect it wouldn't extend to American troops, for example, ever being deployed, or American aircraft, for example, over Ukraine. It wouldn't give Ukraine a seat at the table at NATO, which would be a sort of red line, I suspect, for the Russians. And it probably would put some restrictions on how NATO troops could move into Ukraine and what kind of sort of NATO military hardware could be put in Ukraine. So that potentially is a way to sort of fudge that and that discussion around the security guarantees. For Zelensky, it's very important that this be ratified by the U.S. Congress. He was burned by the Budapest Memorandum back in 1994, where there were a lot of agreements made, but they were not necessarily obviously honored with the invasion of Ukraine by the Russians. That sort of memorandum was supposed to guarantee Ukrainian sovereignty, and it of course didn't. That does leave still the very thorny issue of territory. We do not have a resolution there. We've heard the Russians before say that they're not really even willing to engage on any question of ceasefire until they get the entire Donbass region, so that still is a fairly substantial sticking point.
Yes, and talk to us about what else we know about the plan that is on the table, away from these NATO-like, possibly, security guarantees, Ollie. The Europeans talking about quite a lot of detail around the size of the Ukrainian army, how they'd verify the ceasefire. Quite a bit of detail, then, being gone into here.
Yeah, and it's some of the first detail that we've got ever since we got the 28-point plan, which was seen as the kind of Russian wish list. That was all sort of delivered, and then the negotiations went underground. And I'll just read directly from the statement that we got from a number of European leaders, about almost a dozen of them, talking about the Ukrainian armed forces, that they should be at a resting rate of about 800,000. You'll remember that initial document wanted to cut back the size of the Ukrainian military to about 600,000, that there would be a multinational force Ukraine, which would include operations within Ukraine that would be sort of backed by the so-called coalition of the willing, a U.S.-led ceasefire monitoring system, so that if ever there is an imminent attack by the Russians, that would be very much forewarned, and legally binding commitments to take measures to restore peace in the case of any future armed attack, which would, again, would include armed forces. This is close to the security guarantees, but also making major resources available for Ukraine for reconstruction and recovery. This is where the Russian assets sort of come into play, and that, of course, is going to be a very active discussion this week here in Brussels as the European leaders try to decide what to do with those assets. And we should say, another thing that will probably come up at this summit on Thursday is the Ukraine's sort of ascension into the EU. That's also seen as a fundamental part of these agreements and the Ukrainian survival and its economic recovery in the future.
Okay, Oliver, we'll see where these talks go, what Russia has to say about them, and what it means to these European leaders as they gather later on this week. Bloomberg's Oliver Crook, thank you very much for that. Let's take a quick look at some of the data points that are still ahead. We've got European PMI, the overall Eurozone picture. That's out in around, 7 minutes' time, in fact. 9:30 a.m. UK time, we get the PMIs out of the UK, and then a little bit later we move on to US data, of course, with the US non-farm payrolls and, crucially, US retail sales, which we probably haven't mentioned yet today. And we also get US PMIs a little bit later. Let's get to Valerie Teitel, who has thoughts on all of this, of course. Valerie, we've got the we've got the data out of the US around jobs. That's going to be the focus, I suppose, although maybe retail sales worth a mention.
Look, I do think retail sales will be important given how big consumption is a big part of U.S. GDP. However, this payroll report is essentially a double payroll report. Not only are we going to get the payroll number for November, we're also going to get a number for October. So keep an eye on the prior reading for the month of November when that drops. So essentially 2 months of data coming together. Now, Bloomberg consensus is really surprising on this one. Anna Wong is calling for 130K. That would be the most jobs added since the Liberation Day, essentially all the way back going to April. So she's very bullish on this. However, Wall Street's whisper number is around 20K. The consensus on the terminal is around 50K. So there's a wide dispersion of what we can get here. And I think it's really interesting also to talk about the unemployment rate. The BLS actually posted a press release on their website yesterday warning of statistical errors that are higher than usual in this November household release coming today. So the household release, that's the unemployment rate. So again, we could get a lot of noise around this data point. Powell has mentioned, at least last week in the press conference, that he expects the unemployment rate to tick up another 1 or 2 tenths in this cycle. The market is expecting we do get a 1/10 tick up to 4.5%. But that really could be the wild card reading if we get an unexpected rise in the unemployment rate, could get the Fed and the market start worrying that we could have an accelerated loosening of the labor market.
So there could be surprises, but it's imperfect data. The BLS already warning us that it's imperfect data. How much do you think the data will be important compared to all the drama out of the Fed? Like the Fed speak, we heard from Myron, kind of Myron being a dove, and then both Kevins back in the race.
Yeah, exactly. So it was interesting to see yesterday the odds of who the next Fed chair is have really flipped, at least when it comes to the Polymarket betting website. We have Kevin Warsh now in the front running, taking a backseat now to Kevin Hassett. So still a lot to play when it comes to the Fed chair race. On the Fed speak, though, I do want to mention what we heard from New York Fed President John Williams yesterday. He did say that he thinks that monetary policy is in a good place for 2026, but he does expect some gradual loosening still in the labor market. So again, this is a Fed who is maybe trying to prepare us for the fact that we could still get labor market weakening alongside some pretty decent growth numbers for 2026. Therein lays the conundrum. Yeah. Which one are they going to save here? Are they going to be more worried about the labor market or the fact that the decent growth in the U.S. could keep inflation sticky?
Briefly, Valerie, are you excited or horrified at the idea of a 23-hour trading day?
I think it's a bit terrifying. NASDAQ, the single stock trading on the NASDAQ will only be closed for 1 hour a day if this goes through. But again, a lot of questions on whether they're really going to find this kind of liquidity in overnight trading, or really going to get a lot of nice liquid marks from these biggest stocks like NVIDIA. But again, Anna, I think what this is really is U.S. equity market really posing a challenge to global equity markets in terms of moving listings from other parts of the world to access the better liquid markets in the U.S. I feel like that is going to be the key theme coming out of the NASDAQ.
I feel like this is Valerie's Christmas, all come at once. Two payroll reports.
It's all over after the 16th of December. Oh, no, then there's central banks.
We've got plenty of conversations coming up. Danny Berger speaks to Citadel CEO Ken Griffin. Stay with us. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
President Zelensky says he has a deal with the U.S. to make security guarantees legally binding through Congress. This, as Donald Trump says, an agreement to end the war in Ukraine is closer than ever. The EU is set to propose softening emission rules for new cars, scrapping an effective ban on combustion engines following months of pressure from the automotive industry. And in the UK, unemployment climbs to the highest level in almost 5 years, with wage growth easing ahead of the Bank of England rate decision this week. So happy Tuesday, everyone. There's quite a lot going on. Stocks actually declining. If you look at dollar, probably hovering near a 2-month low. Investors seem to be reining in a lot of risk ahead of a key U.S. economic data. That should offer clues on the path for interest rates. Now, Bitcoin also sinking more than 1%, trimming the loss to trade around 86,000. Then Brent 59.84, dropping below $60 a barrel for the first time since May. Gold pulling back after 5 days of gain. Now, the November U.S. jobs report on Tuesday really shaping up to be the main event for markets in the last full trading week of 2025. We're also getting a little bit of data out of the Eurozone. December composite PMI falling to 51.9. Anything above 50 is expansionary, and the forecast was 52.6. So let's also take a look at the European markets map, although the main story, of course, will be what's happening in the U.S. In Europe, actually, German bond yields dipping after manufacturing and services PMIs seem to have missed estimates. The pound trading a little changed after that unemployment data. You can see the CAC 40 on the rise, but a bit of pressure on the DAX. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua in the French capital for the Conférence de Paris, which aims to nurture international trade between Europe and the Americas. Now, we'll bring you top interviews, including Ken Griffin, the chief executive of Citadel, and Patrick Pouyanné, the chief executive of Total Energies. But first, after 2 days of intense talks in Berlin, negotiators suggest major progress has been made in finding an agreement that would end Russia's war in Ukraine.
I think we're closer now, and they will tell you that they're closer now. We had numerous conversations with President Putin of Russia, and I think we're closer now than we have been ever.
Well, the progress centered around U.S.-backed security guarantees for Ukraine. The president, Volodymyr Zelensky, says he has an agreement with the U.S. to make the guarantees legally binding through a vote in Congress as part of a deal. Now, the Ukrainian leader also underlined the distance that still remains between Moscow and Kyiv on one crucial issue.
Народ України. Звісно, не всі питання прості.
Of course, not all aspects are simple. There are complicated things, in particular the topic of territories. Undoubtedly, everyone is raising this topic, and it's important that we all work to ensure that things like that are absolutely fair. We had enough of dialogue about territories. I think that so far we have different positions. I'll be honest, but I think that American colleagues have heard my personal position, and I'm very happy that I was able to personally convey this position.
Well, we're joined by Oliver Crook, our chief Europe correspondent. Ollie, a lot of positive rhetoric, but what gives negotiators this degree of confidence?
I think it's because the United States, and Donald Trump specifically, has really for the first time in the last couple of days and weeks really got behind this idea that the United States will join in guaranteeing the future security of Ukraine. This has, of course, been a very top priority for the president of Ukraine, Volodymyr Zelensky, who, the country having been burned by the Budapest Memorandum back in 1994, really wants these commitments to be ironclad, wants them to be voted by Congress. And this is something we understand that the Ukrainians have managed to get from the United States, to say that basically there is an architecture in place. There is an Article 5-like guarantee that guarantees Ukrainian sovereignty in the event of a Russian invasion in the future. That would mean that NATO would come in some capacity. Now, we have not defined what an Article 5-like actually looks like, would come to the rescue of Ukraine if there were an invasion in the future. Now, that sorts one of the most complicated issues, one of the most important issues to the Ukrainians. What it still leaves on the table, Francine, is this question of territorial integrity, namely within the Donbass. We've heard previously from the Russians that they are really only interested in having a discussion about peace and a ceasefire if the entirety of the Donbass is relinquished by Ukraine and given to Russia, and that is still very much a sticking point. So we'll have to hear what the Russian position on that is, if it's evolved at all, or what the U.S. resolution to it could be.
Outside of security guarantees, Ollie, what more do we know about the 20-point plan?
So that plan was the plan, and the discussions yesterday really emerged from this meeting with all these European leaders and the Ukrainians and the U.S. delegation. And there was a statement put out by the European side of those negotiations that was signed by almost 10 countries, almost a dozen countries that were participated in these. And they went through a little bit line by line some of the issues within the 20-point plan, which we haven't really seen since we originally saw that 28-point plan. And I'll just read a couple of them. One of them stipulates that the Ukrainian military should stay at about 800,000 troops after there is a peace agreement. Now, you'll remember the first plan stipulated that actually the Ukrainian needed to reduce its army to about 600,000, that there would be a multinational force in Ukraine, including a sort of military force that is composed by the so-called coalition of willing that could be operating within Ukraine in order to preserve peace, a U.S.-led ceasefire monitoring system, and a legally binding commitment that could involve, of course, this is the security guarantee, military action in the event of a further invasion in the future. There were also some points about making major resources available to Ukraine. This is where the conversation on Russian assets comes into the picture. And remember, we're going to have a much more heated conversation about that on Thursday when the Europeans decide whether or not to move on that. And then, of course, the last point, and this is something the Europeans have been pushing, for the Ukrainians, their eventual ascension and joining of the European Union is seen as absolutely crucial, and one of the things that the Europeans can put on the table and have done so.
Oliver, thanks so much. Ollie Crook there, our chief Europe correspondent, joining us from Brussels. Now, all of the data out this week, today's delayed U.S. jobs report, of course, the most closely watched. Our next guest says the global economy and financial markets are being transformed by mega forces, especially AI. Well, joining us now is Wei Li, global chief investment strategist at BlackRock. Wei, thank you for joining us. I love your 2026 outlook because, of course, it hits the right spot, which is AI and valuations. The other big thing we're watching is the Fed. What are you expecting from the jobs report today and then into 2026?
Our view heading into next year is a continuation of this year, which is that actually micro is now macro. And in fact, AI trumps macro to the extent that a lot of the characteristics shaping the economy is very much driven by AI spend, right? So specifically around kind of the job report out later today, there is going to be a lot of noise. October, November data out, but we're only going to have one unemployment rate that is consensus forecast to be at 4.5%, which will be the highest since 2021. So the big picture when it comes to the job market in the U.S. is still slowing demand, slowing supply, no firing, no hiring, and that actually gives the Fed enough cover to lean towards a dovish, which is our assessment coming out of the FOMC meeting recently, and that actually sets up a very interesting stage because we see a bit of a policy divergence between the Fed and other central banks within developed markets.
You still remain pro-risk and also say the AI theme as being supported for U.S. equities. Do you worry about valuations? Is there still going to be volatility?
Well, actually, I think this last few days gives us a little bit of a flavor of what to expect in 2026, which is, on the one hand, big tech companies are coming under significant scrutiny in terms of their leverage, in terms of their valuation, in terms of their capex spend. On the other hand, central banks are facing very tough trade-offs. But for as long as the AI transformation powers on, and also for as long as the fundamental picture look okay, and they do right now, we continue to stay risk on. So yes, we are watching valuation, but we're also in an environment of transformation where the mean in the future may well be different from the mean in the past. So mean revert valuation framework is not the be-all and end-all when it comes to AI transformation. We actually think that it makes more sense to try to understand what we need to believe in order to justify this unprecedented speed of capex spend. That is more important than just looking at valuation alone. So our outlook is themed pushing limit, and it's really about making sense of large numbers. You know, some of the credible estimates out there, Francine, in terms of the big tech capex spend, takes us to $8 trillion of spend by 2030. What do we need to believe to justify those numbers? Well, we need to see unprecedented growth breakout, which is possible, but it's unprecedented. And also we need to see these big tech companies capturing a lot of the new revenues being created. It will be new, but it is possible given the scarcity of compute at this current juncture. So all of that just to say, we're talking about a almost unprecedented transformational environment. The old playbook doesn't apply. We need to make sense of the big numbers, understand what we need to believe to support those numbers, and having a framework is more important than just being fixated on valuation alone.
But wait, what does it mean in terms of energy constraints? And actually, how do you construct a portfolio around what you've just beautifully explained?
That actually are two very important questions. So as we think about AI ambitions running up against constraint, it can come from the physical space, energy being one. It can come from the financing space. Think about leverage going higher. And it can also come from the political space. Think about the impact of AI on labor force and what that means in terms of the political policy, regulatory feedback loop. And at the current juncture, I would observe that energy constraint is actually binding. The supply of energy is not looking like they can meet the significant demand increase that our investors are expecting, which is potentially curtailing the scope of AI build out and then subsequently the potential productivity boost. So that is definitely a consideration, and that is binding right now. In terms of what it means for portfolio construction, so here one of the themes in our outlook is diversification mirage, because AI as a theme has done so well for so long that many investors won't diversify from AI. But what we're saying is that actually, given how concentrated the economy is, given how concentrated markets are, you know, we may hold a mix of assets and thinking that it looks diversified, but that may be misleading because a lot of things are just being driven by a very small handful of principal drivers, including AI. So investment decisions made in the guise of diversification may well be very big active bets. So we need to make those active bets very proactively and intentionally and not accidentally. And we need to think about more allocation towards the private market, hedge funds, so because of the idiosyncratic drivers.
Yeah, I was going to ask, in terms of weighting, actually, how much do you focus on private markets, but also private credit?
We think that there is a bigger allocation and bigger role for private market to play generally in this environment where we don't have the typical diversifiers working as well as before. So specifically, I'm looking at long duration treasuries. They used to provide portfolio balance. They are less reliable right now. So we're seeking assets with idiosyncratic, unique drivers to supplement that overall portfolio construction, and private market and macro hedge fund play a bigger role, and private credit, specifically thinking about the need to fund financing to bridge the gap, because we're talking about an environment where AI spend happens first, and it takes a while for revenue to be created and for revenues to come through. And in order to bridge that gap, leverage is inevitable, and private credit will have to play a bigger role in this environment.
Oh, wait, I think you're underweight long-term U.S. Treasuries. Why?
Well, we see the potential for fiscal trajectory and concern in the U.S. to push term premium higher over the 12-month horizon. We're seeing a bit of a divergence right now, which is very, very interesting. If you look at even just 2025, so looking back rather than looking forward, you look at bonds, 10-year bonds, German government bond yields went up by almost 50 basis points. 10-year Japanese bonds yields went up by almost 80 basis points, but actually 10-year U.S. government bonds came down on a year-to-date basis by 40 basis points because of the expectation for central bank policy to diverge. Now, heading into next year, this divergence theme is likely going to play out, but we actually think that markets are underappreciating how much term premium needs to come back in the U.S., which is why we are actually underweight U.S. Treasuries heading into next year. We upgraded long duration treasuries in Q3, Q4 this year because we see the potential for the Fed cutting rates to bring near term, at least over the near term, long yields in the U.S. lower. But over the 12-month horizon, we do think that fundamentals like like fiscal trajectory would play a bigger role, which is why we're now going back to being underweight U.S. long duration bonds.
Oh, wait, thanks so much. Wei Li, their Global Chief Investment Strategist at BlackRock. Now, NASDAQ looking for U.S. regulatory approval to extend trading hours on its stock venues to 23 hours during the work week. Well, according to a filing, the firm has asked the Securities and Exchange Commission for permission to add an additional trading session from 9 p.m. to 4 a.m. New York time. If approved, the change could take effect as soon as the third quarter of 2026. Coming up, car makers on the continent receive a boost after EU rules banning combustion engine vehicles are scrapped. We'll discuss what that means for the future of the transport sector next. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility. There's still room to maneuver. We do see opportunities. It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's Jobs Day, and Bloomberg has the report under surveillance.
How do we understand whether inflation is the bigger problem or whether it's the labor market?
That is a key question, and it's going to be challenging.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
We've actually seen the most layoff announcements since 2009.
The weakening is happening, but the overall structure is pretty sound.
The November Jobs Report, today on Bloomberg.
The conversations that matter, the insights you need. This is A Pulse, and I'm Francine Lacqua here in Paris. Now, the OECD Secretary General, Matthias Cormann, joined us from the organization's annual conference in Paris to discuss the impact of tariffs and the global economy, also AI spending.
The global economy has been remarkably resilient this year, and I mean there's several reasons for that. First, I mean there was a level of elevated trade activity earlier in the year in anticipation of announced tariffs, and that had a clear impact. There was increased investment, in particular in the United States, in relation to AI, and indeed there was a level of elevated level of macroeconomic support that we saw in countries around the world. So we see global growth this year about 3.2%. Which is below the historical trend, but it's still a very strong performance in all of the circumstances. Though we do see a softening, we expect a softening to 2.9% next year, and we do see quite a level of downside risk. I mean, there is certainly, the fact that tariffs, the impact of tariffs are yet to be fully felt. There is a continued level of trade tension and policy uncertainty, and of course there's a whole range of other structural pressures that continue to rise, such as the structural economic and fiscal impact of population aging, and indeed the level of pressure that applies to growth moving forward.
Okay, and can I ask you about upside and downside risks to your forecast from what we're seeing developing around Ukraine? On the one hand, prolonged conflict, I imagine, would be, well, maybe that is your base case. On the other hand, do we see an upside risk to the forecast if we see an end to the violence in Ukraine, an end to Russia's war there?
Well, peace is always better for business and better for growth. I mean, of course, leaving, we would want to see a just and lasting peace for the people of Ukraine as soon as possible. I mean, that clearly, would be good for Ukraine. It would be good for the people in Russia, and it would be good for the global economy. That is just one of the areas of tensions and conflict around the world that it would be good to resolve on an ongoing and sustained basis indeed.
Matthias, let me ask you about AI investment, because you said in your latest outlook that that's helped offset the drag on the world economy from trade tariffs. I wonder how long can that last?
We do expect that the level of investment in relation to AI will continue to increase for some time, and of course, over the medium to long term, we do expect, a significant beneficial impact when it comes to productivity growth from the accelerating diffusion and adoption of AI across the economy. We do think that there's still a lot of opportunity in the AI space.
But are you worried about valuations and them posing a significant risk to financial markets? I wonder how, if there was sudden repricing, that would affect the global economy.
Well, look, I mean, there certainly is. I mean, one of the downside risks for the economy right now is, the whole issue of potentially high asset, overvalued assets, and in particular in relation to the AI space. But we will have to see. We have to see how that continues to evolve, and we'll have to monitor that very carefully. But I mean, that is a risk. But whether that risk will eventuate, we will have to see.
Well, that was Matthias Cormann, the OECD Secretary General. Also, do not miss our other interviews from Paris, including a panel discussion with Ken Griffin, the Chief Executive of Citadel. Tomorrow, we'll bring you our interview with Patrick Pouyanné, the Chief Executive of Total Energy. Now, a win for European car makers after intense lobbying. The EU is scrapping an effective ban on new combustion engine vehicles from 2035. Let's bring in Craig Trudell, Bloomberg's Global Autos editor. Craig, thank you for joining us. This feels actually very significant. How critical is this as a moment for the continent's transport sector?
Well, it's really important bit of relief for the industry, and yet I think it's also a case of kind of having to sort of accept reality just on the part of policymakers that this transition is turning out to be much more difficult than was reckoned years ago when this effective combustion engine ban was put into place. I think at that time we were seeing this real momentum in the transition to fully electric vehicles. That momentum has slowed substantially. And it's also a really patchy one where certain markets we're seeing, in Norway, for example, it's, on the verge of going fully electric in terms of new vehicle sales. In other parts of Europe, you're seeing, way behind that level of adoption. I think it's a mix of, just sort of the realities of where the consumer is. And I think we do have to sort of, point the finger, at least to some degree, at industry and some failures on their part to really sort of bring to market compelling electric vehicles at affordable prices that, people are inclined to buy, as opposed to sticking with, the combustion cars that they're used to.
But, Craig, for example, this comes as Ford reverses its EV strategy. So what does it mean for who the big losers and winners will be?
Yeah, I mean, I think with Ford, they, of course, are highly dependent on the North American market. And I think, this is a similar issue of yes, there's some failures on the part of the company. I think, the F-150 Lightning, for example, was, hyped as Ford's answer to Tesla and really big bet on their part to fully electrify their most important vehicle. That has really sort of fallen flat on its face as a project. I think you also, though, have to look at the policy changes in Washington and this really dramatic oscillating, from one direction to the other, from Obama to Trump 1 to Biden to Trump 2. We were slamming the accelerator and slamming the brakes on whether or not we wanted, in the U.S. to go electric. And we're now back in that position of really having no interest from this administration in pushing that change. And Ford is sort of responding in part to the consumer, but also to, what the priorities are in Washington, which electric vehicles are just not on the agenda.
So interesting. Craig, thank you. Bloomberg's global auto editor, Craig Trudell. Now, coming up, President Trump says a deal to end the war in Ukraine is closer than ever. We'll be speaking with Wolfgang Ischinger, the Munich Security Conference chair and former German ambassador to the U.S., about the peace plans. That's coming up next, and this is Bloomberg.
phone is, what's great about it is it's a well-developed gaming ecosystem, right? So it, you know, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is, you know, social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, you know, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, you know, basically are going to like unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua in Paris, and these are your top stories. President Zelensky says he has a deal with the U.S. to make security guarantees legally binding through Congress. This, as Donald Trump says an agreement to end the war in Ukraine is closer than ever. The EU is set to propose softening emission rules for new cars, scrapping an effective ban on combustion engines following months of pressure from the automotive industry. And in the UK, unemployment climbs to the highest in almost 5 years, with wage growth easing ahead of the Bank of England rate decision this week. Now, we're, of course, focusing on unemployment in the UK, but we're also getting some PMI's December composite coming in at 52.1. The forecast was 51.5, so it's a touch above expectations. It's also anything above 50 is expansionary. And you can see the services coming in at 52.1. That's also a little bit better than the 51.6 expected. Now, President Volodymyr Zelensky visits the Netherlands today. The Ukrainian leader says he has a deal with the U.S. to make security guarantees legally binding through Congress after 2 days of talks in Berlin. Well, joining us now is Wolfgang Ischinger. He's chair of the Munich Security Conference and former German ambassador to the U.S., serving from 2001 to 2006. Ambassador Ischinger, thank you so much for joining us on Bloomberg today. First of all, are you comfortable with the fact there's quite a lot of optimism? Do you think Vladimir Putin is ready to sign some kind of ceasefire?
Well, Francine, it's a pleasure to be on your show. Let's start with the good news. The good news is obviously that for the first time, we're now having a meaningful diplomatic convergence between the Ukrainians, the Europeans, and the Trump administration. My view has been we should have done that beginning in 2014 or certainly in 22. But it's certainly not too late. It's a little late in the game, but I'm very happy that we've come so far and that we've had this really interesting meeting. Does that open the path toward a ceasefire or toward peace in Ukraine? Let me be slightly more skeptical on that score, because, of course, the one party that was not participating in Berlin is the Russian side. And I think it would be almost a miracle if the Russian side would not now find reasons to yet again say no to whatever comes out of this combined package deal that has obviously emerged from the Berlin meeting over the last 2 days.
But Ambassador, what sort of security guarantees does actually Ukraine need from the U.S. in order for Ukraine and its allies to feel comfortable and confident that it will be enough of a deterrent to avoid a third invasion?
Well, of course, the best security guarantee that a country can have if it is confronted with a potential renewed aggression is the presence of foreign troops in the country. I think we have more or less ruled that out with the decision that NATO membership is most likely not in the cards, has been ruled out also by the Trump administration, as I understand it. So the question really is, can we help, we, the Europeans, we together with the United States, to create a situation where Ukraine is sufficiently supported and armed to the teeth in such a way that even the Russian army will not dare to start a renewed attack. I think that is the first step towards a comprehensive security guarantee. If we have, in addition to that, on paper, assurances by the United States, by the Europeans, maybe even with a congressional mandate in the case of the United States, that will certainly strengthen and enhance this. But the basis of any meaningful security guarantee is what is actually in Ukraine to deter Russia from attacking again. And that is why I'm a subscriber to what they call the porcupine strategy, equipping Ukraine in such a way that it looks, in military terms, like a porcupine. Attacking a porcupine, even if it is a tiger that attacks a porcupine, turns out to be very painful, and you try that only once if you are the attacking tiger. That's the idea.
But Ambassador, what's on the table at the moment is actually the promise of U.S. action. So do you think that is insufficient, given what we've heard from the Trump administration so far, that they seem to monthly, if not weekly, sometimes change their minds?
Well, again, let me say it would be almost a miracle if we were to hear from Russia on the basis of what has been discussed over the last couple of days, that could be a meaningful, pathway toward the ceasefire, et cetera, et cetera. My concern is that we will probably need to provide a lot more to Ukraine in terms of military and financial support. We will probably need a lot more pressure on Russia to bring President Putin and his team to the level of awareness that the continued deployment of the Russian army in Ukraine will not produce any meaningful additional benefits for Russia. On the contrary, that the price is going to be too high. Are we there at this moment? I have my doubts. In other words, I don't think we are today really on the verge of a peace. I think that the road ahead is long and difficult, and it will require more combined and collective action to put more pressure on Russia by all of us together, including by the United States. I hope that's going to happen.
So, Ambassador, so do you think in terms of his political position, President Zelensky, if he wanted to concede territory to Russia, do you think he could? Would that be accepted by the Ukrainians?
Well, I think the territorial question is really for a country that is being asked to actually give up territory that is under its own control. That's what we're talking about here in parts of Donbass, where Russia has demanded that Ukraine not only accepts the current occupation of a major part of Donbass by Russia, but that Ukraine actually relinquishes additional parts of the territory to Russia. That is a massive demand. And I believe that President Zelensky and his parliament, which would need to agree to that, and the people of Ukraine, who would need to agree to that, I think they will only be in a position to even discuss that and come to a decision about it if they are 100% certain that that particular major concession, which is expected of them, will actually end this conflict for good, in a sustained fashion, which is why I think this particular question is the one that will be resolved at the very last moment. They're not going to give it up right now. They will hold on to it until all the other elements of a settlement are in place.
Regardless of what happens with the ceasefire, how do you think this conflict has changed Europe?
Oh, it has changed Europe in a major way. I mean, look, I mean, my own country, until a couple of years ago, actually did not believe that we needed a strong military. Why would we? We had peace in Europe. We continued to harbor the illusion that there was going to be eternal peace and that Russia could be brought back to a meaningful relationship. We lived on the basis of massive illusions. I have to admit, self-critical as I am, and we're now rediscovering the fact that if you are defenseless, you're going to be at the mercy of people who will want to exploit that a defenseless situation. In other words, we are now spending, as I'm sure you know, as I'm sure many of your viewers know, we're spending literally many hundreds of billions over the next several years in rebuilding our own military and that of our partners. In other words, Europe is now restarting to be a meaningful and a substantial military actor. That is a massive change from what we had over the last 30 years.
But Jerry Schinger, I was actually at the Munich Security Conference in the room in February of last year when the Vice President of the United States gave that speech, which shocked many people about the alliance and this administration, U.S. administration's thoughts on Europe. Then 10 days ago, we had that paper from the White House. Is there a realization of Europe that something profoundly has changed, or will it take a lot more time for leaders in Europe to come together and understand what they're facing?
Francine, I think there are two ways of looking at this. The confrontational view is the United States has actually decided to give up on Europe. The Europeans are weak, they're woke, they are doing all the wrong things on migration, et cetera, et cetera. The other more benign interpretation, which would be my interpretation, is that the United States knows very well that we Europeans are America's best and most reliable long-term allies and partners, and that the United States is worried about and wishes to encourage Europe to adapt policies that would strengthen Europe as a meaningful partner of the United States. So I hope that as we continue this transatlantic discussion, this second, less confrontational and more benign interpretation will prevail, and we can have a meaningful transatlantic discussion without accusing each other of ignoring fundamental values or interpreting transatlantic relationships.
Thank you so much.
To be so important.
Yes. And it's only, I mean, when you look at diplomacy, it's only through constructive working together that something gets done. Wolfgang Ischinger, thank you for joining us, the chair of the Munich Security Conference, and of course, former German ambassador to the U.S. Now, moments ago, we also had UK PMI data coming in slightly better than expected. Numbers out earlier this morning showed UK unemployment hit the highest in almost 5 years. Wage growth eased. Let's bring in Marwena Konyam from Bloomberg's Markets Live team. Good morning, first of all, Marwena. What's the UK PMI reaction been to pound?
Good morning. Yes, so for the pound, we've seen it rise to session highs, now trading above $1.34 again. And that, I think, really does come down to what people are seeing in terms of expectations from the Bank of England. This data today from the PMIs does show that output was better than expected for the private sector and across all of the industries, that report. So that was probably quite reassuring for the government. Particularly, it really reflects an easing of those budget uncertainties, which has really been hanging over industry for several months or more. And that sort of eased off. We've seen orders coming back in and really a revival. You know, all areas were in expansion territory. So that's quite reassuring. And it's given a boost to the pound. But we've also seen gilt yields rising because it does suggest that perhaps there will be less need for the Bank of England to cut rates further going into next year.
Marwena, we also had UK unemployment and wage growth data earlier. What's it all mean for the BOE?
Yeah, so that paints quite a mixed picture because wage inflation did cool. That was also after last month's figure was revised higher, however. But it still came in hotter than economists had been expecting. We also saw unemployment rising, as you mentioned, to the highest in 5 years. So there is a general picture of a weak labour market, but with wages still rising. That particularly coming from the public sector, which is partly due to pay rises coming earlier, so perhaps some base effects there that we can be looking past. The overall reaction, I think, from bets on Bank of England rate cuts has been fairly small changes, but a slight reduction in expectations into next year. Very little has changed in terms of what people are expecting on Thursday. We've still almost got a quarter-point rate cut fully priced in, with about 22 basis points of easing expected. So I don't think that there's going to be much of a shift there, but it does really underline the difficulty for the Bank of England's Monetary Policy Committee in terms of weighing up a weakening, labour market, plus still hot inflation and wage growth, although there are some signs that perhaps that is cooling and that higher output from industry today does make it perhaps move slightly more to a hawkish position. Of course, we will be watching very closely CPI data due tomorrow to really get a further picture of what inflation looks like, and that is what the bank will be looking at very closely when they're making their decision on Thursday.
Marwena, thank you. Marwena Konyam there from Bloomberg's Markets Live team. Coming up, oil falls to its lowest level since 2021. We break down the reasons and discuss the outlook with the chief executive of the oldest private oil and gas company in the Middle East. That's next, and this is Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
In
Insight with Haslinda Amin, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
One of Saudi Arabia's most powerful business dynasties is stepping further onto the global stage. Well, today's Bloomberg Big Take looks inside the Al Rayyan empire, which has been transformed into a $50 billion force with influence stretching from Wall Street to Riyadh. Now, for more, we're joined by our very own Abir Abu Omar in Dubai. Abir, this is a highly respected family. How significant is the influence from the Al Rayyans?
Hi, Francine. So yes, today's Big Take, we take a deep dive into the Al Rayyan group, which is headed by Lubna and Hatham Al Rayyan, a very prominent Saudi family. And just to show you a little bit of their influence as women at the helm of a major conglomerate in Saudi Arabia, perhaps the way we set out the story, which is Lubna sat next to the world's richest man, Elon Musk, at the U.S. banquet dinner that U.S. President Donald Trump had hosted when Crown Prince Mohammed bin Salman was in Washington in November. She was one of a select group of women that were attending in the official delegation. Let me run you through some of the numbers, Francine, and perhaps those tell the story of their influence. So they own a $1 billion stake in BlackRock, a $1.5 billion stake in JP Morgan, some stocks in Alphabet, Microsoft, and others in the U.S. Domestically, they bottle Coca-Cola. They're involved in Oreo and Colgate, and they also service oil fields in Saudi Arabia. So the two sisters, we know that Lubna is now the chair of Al Rayyan Group, while her sister Hatham is the chairperson for the shareholders group. So quite influential domestically, but also in their involvement in PE-listed firms across the board, whether it's in the Middle East, the U.S., or in Europe.
Abir, thank you so much, Abir Abu Omar in Dubai. Now, oil prices sliding below $60 a barrel as traders weigh the outlook for a ceasefire in Ukraine. It could pave the way for fewer curbs on Russian supplies into the market. Let's discuss the outlook with Majid Jafar, the chief executive of Crescent Petroleum, the Middle East's oldest private oil and gas company. Thank you for joining us, Majid. I'm sorry I couldn't be in London today. When you look at the price of oil and what we're expecting for 2026, there's many confluences and things that we need to look at. But what's your base case of what oil does next year?
Yeah, so, I mean, despite what you mentioned about the lowest price for some years, and there's a lot of talk about a glut, we still have backwardation in the market. We still have a lot of unknowns. There are geopolitical unknowns. You mentioned Ukraine, also Venezuela. Production came off suddenly in Iraq. It's been declining in Brazil. But we did see the IEA revise its figures and actually expecting slightly tighter market than had been the case. I think OPEC Plus has kept the price in this $60 to $80 band very successfully, very stably for some years now. And despite the projected increase by 8 member countries, we've only seen less than a third of that. So I think we'll remain in that range. And for us as an investor in the upstream with a long-term perspective, that price stability has been key, as it has for markets as well.
How much of an oil supply glut do you see building in markets going into next year?
Yeah, so personally, I don't see much of an oil supply glut. And in fact, again, I'm looking more to the medium to the long term. I'm seeing still underinvestment in the upstream. And particularly with natural gas, an area that we're very focused on. We've now seen in the U.S., on an energy equivalent basis, natural gas is more expensive than oil, and some of that is driven by the AI demand, also by LNG exports from the U.S. So we're seeing Henry Hub well above $5 now, and that's a new trend.
Are we already seeing that buildup of oil in storage?
So you see some, Chinese build up and strategic petroleum reserve, but overall, I look at what's driving energy demand growth, and it's very much developing markets, notwithstanding question marks over China. And on top of that, so that long-term trend is still very much in place, and then we are adding to that now the new demand growth from AI, which I think is significant impact. I mean, in the US, we're going to see half of the electricity demand growth from now till the end of the decade is going to come from AI, and by that point, it's going to consume more than all the other energy-intensive industries in the United States. It's quite staggering. When you're at a typical data center using the power of 100,000 homes, and some of the ones currently under construction up to 20 times that, the numbers are quite staggering. What we're seeing now is not just incremental growth. We are seeing the type of energy-intensive infrastructure investment that we haven't really seen since the Industrial Revolution.
How quickly do you see Iraq actually forming a government after the recent elections? And what do you think they need to put in place now to have a stable government and therefore stable oil revenue going forward?
So for Iraq, I think the fact that the elections were free and largely fair, as was internationally certified and attested, and they took place on time and were successful, is a very good step and a sign of stability. And all the talk among all the leading political factions, now that the results have been formally certified, is for fairly rapid formation of the new government. So we're talking, within a few months, not a year or more, as used to be the case in the past. The Prime Minister Soudani won the highest number of seats, but obviously it's not a majority, and therefore there'll have to be coalitions formed. I think Iraq has seen many positive trends in the budget increases in recent years, in the increased stability, and in managing to remain outside of the conflicts in the region, whether it was Syria, Iran and Israel, and having good relations with all member states. So this is an important backdrop. We're heavily invested. We've invested over $4 billion in the country. We've recently completed a $1.1 billion gas expansion project in the Kurdistan region in the north, which is enabling soon 24/7 electricity across not just the Kurdistan region, but neighboring governorates as well. And we're invested in other parts of Iraq, in Diyala and in the south in Basra. So we're very committed to the country and the outlook, which we see as positive.
Majid Jafar, thank you so much for joining us on Bloomberg, as ever, the Chief Executive there of Crescent Petroleum. Now, don't miss our other interviews from Paris, including Ken Griffin, the Chief Executive of Citadel. Tomorrow, we'll also bring you our interview with Patrick Pouyanné, the Chief Executive of Total Energy. Coming up, we'll have a full roundup of the market news. Stocks declining. The dollar, I guess, hovering near a 2-month low as investors seem to be reining in risk ahead of key U.S. economic data. Yes, it's the November U.S. jobs report a little bit later on, and this is Bloomberg.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there
use the film cameras. The lens that I look at it through is essentially how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
It is 5 a.m. in New York City. Good morning. I'm Matt Miller in for Vonnie Quinn with your Bloomberg Brief. Here's what you need to know. Data catch-up. Stocks fall as investors await the release of the November payrolls data. The whisper number is only 21,000 jobs were added last month. And closer than ever, President Trump shows optimism in ending the war on Ukraine. President Zelensky says the U.S. has vowed a congressional vote for security guarantees. And softening the rules, the EU is set to propose scrapping a ban on combustion engines for new cars after months of pressure from the autos industry as well as consumers. Let's take a look at what's going on in terms of the markets right now. The S&P 500 futures are down about 0.5%. We fell again in yesterday's session, and the close were just above 6,800. NASDAQ futures down more, about 2/3%. The small caps down 0.5%. Take a look at what's going on with treasuries. Not a lot of movement there. You can see the 10-year yield almost exactly unchanged at 4.1704. The 2-year trading at just under 350, and the 30-year at 485. In terms of commodities, we're watching the oils this morning. New York crude is down 1.8%, $55.78 a barrel on the NYMEX. Brent crude down just about the same at $59.55, so just under $60 a barrel. And Bitcoin at 86,305. Let's get a look at some of the individual stock stories. For the stocks you need to watch, let's bring in Valerie Titel from London. Good morning, Valerie.
Good morning, Matt. Let's start with a check on Ford after announcing that near $20 billion charge in a sweeping unwind of its EV program. We're seeing shares of Ford up around 0.4%, so outperforming the broader market by near 1% off the back of this. Ford is going to be reassessing how it's using these battery plants and pivoting a bit more towards hybrid vehicles and away from these larger format EVs, and also announced a essentially scrapping of their Ford F-150 electric vehicle model. Ford does expect their EV platform now to be profitable in 2029, and it boosted its 2026 guidance off the back of this. So Ford enjoying somewhat of a jubilant reaction to this $20 billion charge. Next, let's move over to the streaming platform Roku. Matt, there's been a lot of excitement in this stock recently. It got more excited overnight by a upgrade from Morgan Stanley. The share is up 4.3% in pre-market trade. Morgan Stanley previously had concerns around competition, but those are no longer. They see its dominant place in the streaming services in the U.S. is going to give it a key edge in the market next year. Lastly, I do want to touch on European defense. We're seeing a big slide across the sector in Europe this morning. Rheinmetall down 4.5%. This comes after more positive comments for a move for peace in the Russia-Ukraine war. Now, defense stocks have been on a back foot since their highs back in September. Rheinmetall is down around 25% since those year-to-date highs at the end of September. But note, Matt, it's still up around 140% year-to-date, and defense stocks rank among many of the top 10 performers across Europe still for 2025. Matt?
All right, Valerie, thanks very much. Valerie Teitel there with some of your pre-market movers. Coming up in this hour, we're going to count down to the jobs report with Henry Allen. He'll join us as macro strategist from Deutsche Bank. That's at 5:30 a.m. New York time. Back to our top story, though. President Trump staying optimistic on reaching the end of the Russia-Ukraine war.
I think we're closer now, and they will tell you that they're closer now. We had numerous conversations with President Putin of Russia, and I think we're closer now than we have been ever.
President Zelensky now says he has an agreement with the U.S. to make security guarantees through a congressional vote as part of this deal. Joining us now is Bloomberg's Oliver Crook. So, Oliver, how optimistic are people on the European side?
I think they're very sort of encouraged by what they've heard from the President of the United States and the talks that we've had for the last 2 days that have been held in Berlin with Steve Witkoff, Jared Kushner, and a number of European leaders who were also in attendance. And it all comes down to this idea of U.S.-backed security guarantees. From the Ukrainian perspective, they're absolutely essential to any kind of peace deal, because what is a peace deal worth, really, if you're going to get reinvaded in 2 or 3 to 5 years' time? These security agreements, particularly backed by the United States, are seen as a way to really prevent that from happening. Now, what they actually include is less clear. These Article 5-like guarantees, no one has yet defined what Article 5-like means, other than the Article 5 within the NATO treaty, which means an attack on one is an attack on all. So it basically would create a security architecture that if Ukraine were ever to be reinvaded, there would be some degree of backing from the NATO architecture, from the United States, unlikely to be boots on the ground from the U.S., but it would mean that there is actually a formula and a recipe in place if ever there was renewed conflict within Ukraine. That being said, that is progress on the sort of security guarantee side. There's still the territorial side, which has got to be still the thorniest issue. The Russians have said from the very beginning they don't even want to talk about a ceasefire or get a temporary ceasefire in place until there is a settlement with the rest of the Donbass resting with the Russians. That is something that the Ukrainians have not yet agreed to, though they have shown a little bit of movement in that direction. That being said, it'll be up to the United States to try to square that circle and sending this proposal back to the Russians, from whom we have not yet heard on what they have to say about what the Europeans and the U.S. have come up with.
It does seem that the Ukrainians are backing down on a number of different issues, and surely President Zelensky wants to end this war, but has Russia given up any ground in these months of negotiations?
I mean, not so far that we've seen. I mean, this is the main point here. I mean, in the last couple of weeks, though, Matt, we should say that this is something that the U.S. administration and Trump has not really advertised a great deal, but there are those significant sanctions that were put in place a couple of weeks ago, both on Rosneft and Lukoil. This is a sort of major way to constrain some of the revenue that the Russians are still taking in and getting paid for in order to sort of fund this war. From the American perspective, I think at a certain point, again, Trump has really been focused on targeting the Ukrainians as the sort of weak point in the negotiation, and they've put up a lot of pressure there. There is still possible pressure they could exert on the Russians if they feel the Russians are being unreasonable. At the moment, we still have pretty maximalist demands from the Russians. We have not yet had a confrontation between the U.S. and the Russians, but as you'll remember, sitting with Congress right now, waiting for the go-ahead from President Trump, are those so-called bone-crushing sanctions that Lindsey Graham has put forward. That has wide bipartisan support within the United States. If they wanted to move on that, that would put tariffs basically on any country that is buying Russian crude oil. That could have a major effect, and that could drive them to the table if the United States wants to pull that trigger.
All right, Oliver, thanks very much. Oliver Crook there joining us live from Brussels on this optimism in the Russia-Ukraine war. Now, the NASDAQ is asking the SEC for permission to extend its trading hours to 23 hours on weekdays. The exchange joins its peers as demand grows for U.S. stocks outside of traditional market hours. Joining us now is Bloomberg's Justina Lee. Justina, let me ask first what this would look like. Surely it wouldn't be a cash session for 23 hours? Is it an extended pre-market and aftermarket that the NASDAQ wants to put into place?
Yeah, NASDAQ has kind of gone to the SEC to apply for kind of adding this session that will be kind of coming after the aftermarket session, sort of like an aftermarket session, I guess. So it will kind of like go from 9 p.m. Eastern to 4 a.m. Eastern the following day, taking the trading hours to 23 hours a day. And of course, this is coming after the New York Stock Exchange is also making similar moves to extend trading hours to 22 hours for every weekday.
So is there really that much demand to trade on those hours? Are we going to see, volumes boosted as a result of this?
I think that really is the big question here. Now, for a few years, we've seen a push in this direction, partly because of, I think, a lot of retail investors getting used to the 24/7 schedule of crypto trading. And of course, there's also a lot of interest in trading U.S. stocks, outside of the U.S. And so I think for, a trade in Australia or something, they might kind of welcome a bit more overlap with their working hours. But, I think there's still kind of a big question. When I talk to a lot of traders, you hear nothing but groans about this plan. I think a lot of people like having that break at 9 p.m. Eastern, some time to digest, 4 p.m. Eastern, some time to digest, the aftermarket news. And of course, if you don't get enough volumes in these after hours, you might actually get a lot of price swings that don't really mean anything because there isn't enough liquidity. And so I think a lot of people still have kind of a lot of doubt over this plan.
All right, Justina, thanks very much. This is something I'm sure we'll be talking with you about more and more. Justina Lee there out of London on the NASDAQ request to extend trading hours. Let's get to the other top stories trending. On the terminal this morning, President Trump is suing the BBC for $10 billion over a misleading edit in a documentary last year. The clip gave the impression he had made a direct call for violence in a speech leading up to the January 6, 2021 attack on the Capitol. The BBC previously apologized for the edit, but Trump deemed the apology inadequate and now is seeking massive amounts of compensation. China's Xi Jinping is facing calls for a stronger yuan in a rare public currency debate. Chinese economists and former central bank officials are arguing a stronger currency is needed to rebalance the economy away from exports and boost consumer demand. The calls are fueling speculation. Policymakers will allow broader appreciation in the managed currency. And UK unemployment climbed to its highest level in almost 5 years. Wage growth eased, cementing the case for a widely expected Bank of England rate cut on Thursday. The jobless rate rose to 5.1% in the 3 months through October. Wage growth, excluding bonuses, edged down to 4.6% from 4.7%. Of course, we'll get our own jobs numbers today here in New York. Coming up, a win for car makers. The EU waters down its effective ban on sales of new combustion engine cars from 2035. More on that next. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life.
I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Matt Miller in New York City. European automakers are rising, as with the exception of BMW, I guess, as the EU is set to propose easing emissions rules for new cars, which would abandon an effective ban on combustion engines following months of pressure from the industry, and I've got to imagine some consumers as well. Bloomberg's Eric Fanner joins us for more. So, Eric, what do we know about the rules as it stood? I think 100% tailpipe emissions reductions were demanded by 2035, and now that'll just change about 10%.
Yeah, that's right. I mean, that's how it looks on the surface. This was quite a rigid ban. In effect, would have ruled out sales of combustion engines after 2035. So there wasn't a whole lot of wiggle room there. What they've done now is it looks like they will introduce some wiggle room there and reduce the emissions targets to 90% reduction. Now that sounds kind of incremental on the surface, but is actually a lot more sweeping than it sounds potentially, in part because the emissions targets for hybrid vehicles are often a lot higher in theory than they are actually in practice. So if they stick with those kind of theoretical emissions for the hybrid vehicles, you could actually see a pretty high continued sale of hybrids, making up a big portion of the automakers' mix down the road beyond 2035.
Eric, yesterday we got news from Ford. They're going to take almost $20 billion in charges tied to a pivot away from essentially the same story, right? 100% BEV to hybrids and what are called E-revs, which is essentially an electric vehicle with a gas generator on board. Is this the trend that every place is going? Because we're talking about the EU specifically, but here in the U.S. we're also going to see much more lax regulation.
Yeah, exactly, Matt. It's a global thing, really, or at least a broader thing beyond China, which has had pretty broad EV adoption. Although even there in China, there's a growing use of what you mentioned, the range extenders, which are the small gas-powered engines that help fuel an EV and extend the range. So we're seeing this really globally. We've had a bunch of car makers, and Ford is the latest and one of the most dramatic announcements, announcing a big write-down there, $19.5 billion, and canceling some models, switching over some plants to back away from battery electric vehicle production. So it's a broader thing. Consumers are not taking up EVs as quickly as hoped. That's obviously a transatlantic trend, and certainly not without incentives. And the incentives just aren't forthcoming necessarily the way they were, either in the U.S. or the EU, across Europe, and so we're seeing that kind of broader pullback.
All right, Eric, thanks very much. Bloomberg's Eric Fanner talking to us about the EU regulation story. And as we were talking about, of course, there was the Ford news yesterday, one of the biggest write-downs in automotive history. We spoke with the CEO of Ford, Jim Farley, yesterday on the overhaul of the car maker's electric vehicle business after it struggled to make a profit for years. Take a listen.
We saw hybrids really take off the last couple of years, like, last month we had 30% increase in our hybrid sales. We're now number 3 I think we're 80% hybrid market share in trucks. So we saw this happening. We also saw the more expensive EVs, really suffer in the market, and the more affordable EVs to do better. And then the last couple months really was remarkable. The EV market in the U.S. went from 12% in the industry to only 5%. And that really, in the end, was the big decider for us. But look, we're going to 50% electric. It's going to be hybrids and e-revs and electric. It won't be just pure electrics.
So, every good trader knows you got to cut your losses when you recognize there's an issue. You're doing that in this sense with the F-150 Lightning as we now know it, and the T3 project, the next generation truck that would have been built in Tennessee. But you're able to, I guess, salvage some assets, and as a result, you've raised your profitability forecast from $6 to $6.5 billion for this year in terms of EBIT to $7 billion. Where are you gaining an opportunity from this, Jim?
Well, great question. This year, in the short term, it's really our cost of our company. Our quality is getting better, and so our costs are much more competitive. In fact, the Novelis aluminum has cost us more like $2 billion, but we're still raising guidance. Look, for this announcement, Matt, it's really about moving to more profitable vehicles. We're going to make in Tennessee now an affordable pickup truck. I think it's going to really surprise the market. These are customers we know. Not a lot of guesswork in terms of the revenue, the cost we need to get at, and a more affordable van in Ohio. So these are going to be better investments for the company profit. And all those hybrid sales, those are really profitable vehicles for us as we basically deploy hybrid across our lineup. But we're also going into the energy storage business to 20 gigawatt hour. That's a big move. We're going to convert our battery plants from automotive batteries to energy storage batteries using LFP. That's also a big pivot that is profit positive for the company.
Jim, with regard to that pivot and the energy storage side of it, do you anticipate any concerns by the White House, by the administration here in the U.S., that you are partnering effectively with the Chinese company in order to do that?
Well, look, it's our plant, it's our people, and we designed it that way. We have a licensing agreement, but we feel like it's better to build these batteries in the United States with American workers, with our own Ford workers, and understand the IP than to import them like they're being done today. The best way to compete with the Chinese is to get close to the IP and then run the plants at Ford. When Ford knows how to build things, we know how to do this. So I think this is much better than for America. We're talking about thousands of incremental jobs versus importing batteries like we say today. Much better for America.
And that was Ford CEO Jim Farley speaking with Romaine Bostick and myself. Coming up, an overhaul at the Pentagon. Secretary Hegseth's team reportedly planning major power shifts. And a look at what else is making headlines in your front page news next. This is Bloomberg.
In case you missed it, on Bloomberg Crypto.
There's a debate going on right now in DC that I think folks need to start paying more attention to, and that is the yield. And the question really is, who is going to keep the yield? Who makes money off stablecoins? Well, right now, in the case of some of the large stablecoin issuers, there's a yield on those deposits. So when there's a dollar, for example, deposited in a bank account, there's interest paid on that dollar. And so who's capturing that yield? And I think one of the really interesting things about the Genius Act is that it bans so-called yield-bearing stablecoins from giving that yield directly back to consumers. Now, that's not true everywhere. And I think if consumers have a choice, why would a consumer want an institution to keep that yield? Or would there be sharing of that yield? So right now, one of the debates going on is, will rewards be allowed? And I think these are really important questions.
Don't miss Bloomberg Crypto live Tuesdays.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
It's Jobs Day, and Bloomberg has the report under surveillance.
How do we understand whether inflation is the bigger problem or whether it's the labor market? That is a key question, and it's going to be challenging.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
We've actually seen the most layoff announcements since 2009.
The weakening is happening, but the overall structure is pretty sound.
The November Jobs Report, today on Bloomberg.
This is Bloomberg Brief. I'm Matt Miller in New York. Time now for your front page news. First up on the Washington Post. Sources say senior Pentagon officials are developing a plan to downgrade several of the U.S. military headquarters and shift the balance of power among top generals. The plan would include cutting the number of four-star generals and admirals reporting directly to Secretary Hegseth. The move would complement other efforts by the administration to move resources away from the Middle East and Europe. Secretary Hegseth's team declined to comment. Next up, the Wall Street Journal reports that CoreWeave's $33 billion fall highlights AI bubble fears. Its problem began with a low-tech challenge, summer rainstorms in North Texas that delayed construction of a major AI data center. That data center is meant to be leased to OpenAI. And on the Financial Times, companies are looking for private equity partners to save their business in China. Companies like Häagen-Dazs, Peet's Coffee, and GE Healthcare are weighing options such as selling part or all of their China operations. The rethink comes from the rocky relationship with the U.S., a slowing economy, and a rise in local rivals. In terms of the markets, we are looking at futures that are down ahead of the non-farm payrolls report coming out at 8:30. The delayed report from November, S&P futures off 0.33%. The dollar really little changed, as is the 10-year yield at 4.1743. Coming up, we'll push ahead to the payrolls report with Henry Allen of Deutsche Bank. This is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It is 5:30 a.m. in New York City. Good morning. I'm Matt Miller in for Vonnie Quinn with your Bloomberg Brief. Here's what you need to know. We'll get a data catch-up today. Stocks are down as investors await the release of the November payrolls data, the delayed data. The whisper number is for only 21,000 jobs added last month. And we're closer than ever. Well, at least President Trump is showing optimism in ending the war in Ukraine. President Zelensky says the U.S. has vowed a congressional vote on security guarantees. Plus, the ever-softening rules. The EU is set to propose scrapping a ban on combustion engines for new cars after months of pressure from the autos industry and I imagine at least some consumers as well. Take a look at what's going on in futures this morning after a drop yesterday, an even bigger drop on Friday. We're down again today with S&P futures off about 0.3%, NASDAQ futures about 0.4. In terms of treasuries, there's very little change, at least on the 10-year, still looking at 417.43, so not even up a quarter of a basis point there. And we do have oil falling this morning after a drop in Bitcoin as well. So NYMEX crude down 1.7%, Brent about the same, and Bitcoin had come down, now bouncing back a little bit, but still at 86,378. I don't know why I'm tying the two together. They're just both in the same board here. For some of the stocks to watch, let's get out to Valerie Teitel in London. Valerie?
Good morning, Matt. Let's start with a check on Ford announcing that near $20 billion charge related to a sweeping unwind of its EV program. We're seeing shares of Ford in the green, up around 0.4%, so outperforming the broader market by around 1% on this announcement, which essentially is really saying to the market that they were going down a dead end with these large format EVs. They have totally scrapped now their electric Ford F-150s and are pivoting the business closer or towards more hybrid vehicles. Gas and hybrid vehicles will be their new focus. Now, off the back of this, they did say that their EV business will be profitable by 2029, and they did raise their near-term guidance for this year. So Ford slightly in the green off the back of this announcement. Let's move over to the streaming market. A lot of excitement about this stock, Matt. It's Roku. They've gotten a lot of upgrades from the street recently. The latest one now coming overnight from Morgan Stanley. We're seeing shares of Roku up 4.5%. Morgan Stanley was previously concerned about competition among these streaming platforms, but they are no longer concerned about that and are excited about their dominant position within the U.S. market and what that means for their possible advertising revenue next year. Lastly, I do want to touch on European defense. A big slide across the European market today. Rheinmetall in the red, down 4.6%, on a back foot as there's more positive comments for peace in the Russia-Ukraine war. But these defense stocks have really been battered in the fourth quarter. Rheinmetall is down some 25% since the end of September, but alas, it is up 140% year to date, and many of these European defense companies rank among Europe's top performers for 2025.
All right, Valerie, thanks very much. Valerie Teitel. They're looking at some of the individual movers ahead of the cash trade. Less than 3 hours to go until the release of the delayed November jobs report. Bloomberg's Michael McKee joins us here on set, our international policy and economics correspondent. Mike, what are we expecting? I pointed out the whisper number is quite low, but the survey is a little bit higher.
And neither one of them really has a lot of grounding in fact at this point, because we don't even have the October numbers, which we'll get part of today. And that's part of the problem, is we get 2 months wrapped into one, and I could bore the pants off you and talk about the statistical problems with trying to put this together. But let's just say the Labor Department has already suggested that the error bands are going to be wide around these numbers, wider than usual. It's going to be hard to know exactly what they are telling us. We will get the average, we will get the payrolls numbers for October and November, but we don't really know what October is going to give us because we don't know how much data they got. We'll get average hourly earnings, but we're going to only get the unemployment rate for November, and the unemployment rate is expected to tick up, but that's based on what? We don't know. It went up in September, but what happened in October? There's no data, so we don't have an idea. Same story with average hourly earnings, and the same story with overall payrolls and whisper numbers and everything like that. It's just going to take a little while to figure all this out.
So, you know, historically, 4.5% is the estimate for the unemployment rate, and that's a fairly low number historically, although it's getting to a lot for, you know, kids today. At what point does the Fed really start to worry, or what point do policymakers really start to worry about U.S. unemployment?
Well, that's a good question, because they had been saying into the summer that they would start worrying if we moved quickly to 4.5%. Now, we've moved to 4.5%, if these numbers are correct, but how quickly has it been, and why did we? Because more people came into the labor force, or because fewer people got jobs? Those are the questions that are not answered, and they haven't really given us an answer in terms of a number, but they have said that what they're worried about is that unemployment could start accelerating, and that's why they have been cutting rates. So we'll get some idea of where we are, but we don't know where we're going.
We are getting, I mean, we're getting a ton of, more than a full Bloomberg screen of data today. What else are you going to be paying close attention to? I guess we've got retail sales coming out. We've got some PMIs coming out.
Well, retail sales will get some attention because we haven't gotten that either since the September numbers, and they are expected on a headline basis to slow. The core is expected to rise some from the September numbers, but remember, retail sales are always heavily revised, and so we don't have a lot of basis for this either because we don't know what October was. We'll get those numbers, but this is also in between back to school time and Black Friday, Thanksgiving, the kickoff to the holiday season. So I'm not sure how much relevance they will have other than filling a hole. Maybe the S&Ps, because they are not government data. They have been released every month, and they'll tell us something about where we are with manufacturing and service industries.
All right, Mike, we're going to continue speaking with you as this data comes out. Michael McKee, our international policy and economics correspondent. Now, joining us to talk about what to expect and how the Fed may deal with that, Henry Allen, macro strategist at Deutsche Bank. And before I get your take on the numbers we're looking at, I mean, just give me generally your take on the U.S. economy and how the labor market looks with all of the other data that we've, the alternative data that we've been following more closely of late.
So I think, as you've just alluded to in your conversation, the labour market is certainly showing signs of weakening, and I think that this payrolls report is definitely going to be a very, very choppy one. So we're going to have to abstract and stand out from some of the data, given that it's going to be so choppy following the government shutdown. But I think in terms of the US economy more broadly, there's actually a story of big resilience. I mean, if you told us at the start of the year that we'd have the huge tariff shock that we did, yet risk assets would do really well and the economy would keep growing at a decent clip, that would have been seen as remarkable. But to be honest, that just continues the trend we've seen over recent years, where similarly in 22, 23, the US economy weathered the fastest rate hikes in a generation really, really well. The soft landing was achieved. And I think that speaks to a broader resilience that even as we are seeing some signs of labor market weakness, that actually the big picture story of the US economy remains a very strong one.
So I wonder if these cuts that we've seen so far, I think since last November, 125 basis points for the Fed, is that really going to help slow down the weakness in the U.S. labor market?
I think that will certainly help, and indeed, of course, that's why the Fed have been so quick to react. I mean, even if you just look at the last 6 weeks, it's worth bearing in mind that at the time they did the October cut, the second cut this year, Powell was saying at the press conference that a December cut was not a foregone conclusion. Yet we then had the delayed September jobs report. That came in weaker than expected. Unemployment ticked up. And then suddenly a cut was priced back in for December, which they then delivered. So this is a Fed that, even with inflation above target thanks to the tariffs, are still very, very sensitive to any signs of labor market weakness, and hence they're going to be stepping in. And then I think the other thing that will certainly be supportive looking into 2026 is actually, alongside this monetary stimulus, we've also got pretty big fiscal stimulus. So as well as the mechanical bounce back from the shutdown, we've also got lots of the big beautiful bill taking effect in Q1 2026. And actually Q1 next year is going to be one of the biggest positive fiscal impulses we've seen since the pandemic stimulus under Joe Biden. So actually there are a lot of positive tailwinds going to hit the economy next year.
Well, I mean, I wonder if that worries you at all, Henry. We've got monetary stimulus, we've got fiscal stimulus, we've got the tariffs. I mean, tie these things together with inflation already 50% above the Fed's target rate. Is there any way that it cools down inflation, or do you see it actually picking up in 26?
Well, I think that's the risk and where markets could be caught offside, because if we look at even the last couple of weeks, US inflation swaps have trended down quite a bit, and obviously that opens up the risk that the surprise goes the other way. As you say, tariffs are still filtering through. We have monetary and fiscal stimulus, which is not unprecedented, but is particularly unusual that we're getting that outside of a recession. Normally when we get kind of rate cuts, we've had 175 bips in the last 15 months. Normally when we're getting big fiscal stimulus as well, that's happening in a recession. So it's an unusual framework, an unusual regime that we're getting that in a soft landing where the economy is seeing continuous growth. And that's where I think there's a need to be cautious about any reacceleration or overheating, because when we have seen that dual monetary and fiscal stimulus outside a recession, we saw it in the US in the mid to late 1960s, actually the risk is that then sets the stage for inflation to accelerate. So that's really going to be something I think the Fed are going to have to be very cautious of. And indeed, I think a lot of speakers are, which is why you're seeing growing numbers of dissent on the hawkish side.
By the way, we got, some news on Ford yesterday, which to me was exciting because I love, the world of automakers. But it strikes me that, tied together with what we're hearing from the EU, we have loosening regulations really globally. And policymakers with that are trying to support growth, which is understandable. But as you point out, we're not in a recession. Is this just another piece of policy that risks, supporting growth, but also stoking the kind of inflation that is going to require slamming on the brakes later?
Well, I think we should distinguish when we talk about change in regulation or changes in fiscal monetary policy. We should distinguish between demand-side policies and supply-side policies. Clearly, if we've got demand-side stimulus like rate cuts or tax cuts, then clearly that's the sort of thing that will lead to overheating. If we can get deregulation that opens up support on the supply side, then actually that sort of thing, as we're seeing also with the AI productivity increases, then that sort of thing that can help the economy grow faster in a non-inflationary way. I mean, the idea would be a bit like what happened in the mid to late 90s, where Alan Greenspan was able to cut rates successfully, even as the economy was running at a decent clip, because we had such positive growth on the supply side as well as the demand side. So that's the holy grail, really. I guess the question is that demand side stimulus that we're seeing, which is historically pretty unusual to see that much outside a recession that we're going to get next year, is that going to help? And the problem is that isn't just a US story. We're focusing on the US, of course, but here in Europe, we've also had the ECB cut by 200 bips between mid-24 and mid-25. Next year is going to be the German fiscal stimulus takes effect. That's more than going to outweigh any tightening we get in France and Italy. So Europe's also seeing that dual combination of monetary plus fiscal stimulus. So I think this is really going to be a global story into next year.
Henry, great to get some time with you. Really fascinating comments. Henry Allen there joining us from Deutsche Bank on the macro picture ahead of the jobs numbers. Let's get to some of the other stories trending on the terminal this morning. Australian authorities say homemade Islamic State flags were found in a vehicle registered to one of the gunmen that attacked a Bondi Beach Hanukkah celebration on Sunday. At least 15 people were killed in the terror attack. As more details on the father and son gunmen emerge, officials in Manila say the pair traveled last month to an area of the Philippines where Islamic State-aligned groups have operated. Amazon is expected to cut jobs in its European headquarters in Luxembourg. The cuts represent about 8.5% of its workforce there. The layoffs are particularly challenging for foreign employees who must find new jobs in 3 months to continue living in Luxembourg. And the European Union is set to propose softening emissions rules for new cars, scrapping an effective ban on combustion engines. As I was just talking about with Henry, the proposal will allow car makers to slow down the rollout of 100% battery electric vehicles in Europe, though they'll be selling hybrids and e-revs. This follows months of pressure from the auto industry on the EU. Coming up, Ukraine peace talks ongoing. President Zelensky says the U.S. has vowed a congressional vote to back security guarantees. More on that next. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Anand, only on Bloomberg.
I think we're closer now, and they will tell you that they're closer now. We had numerous conversations with President Putin of Russia, and I think we're closer now than we have been ever.
Washington offering Article 5-like security guarantees to Kiev. Reportedly, President Zelensky says the U.S. has pledged a congressional vote to make it legally binding. Let's bring in Mika Solner of Bloomberg Government. Mika, it's interesting that the U.S. would make a pledge like that, because obviously we can't know what Congress will do. How does this all work out?
Yeah, absolutely. This is, an initial step, I think, for the U.S. to really take into these considerations for Ukraine. I know that President Trump has been really adamant that the U.S. is really focused on both sides, both what Russia and Ukraine want. So this would be a significant step for Ukraine. This will essentially ensure those protections are codified through Congress. And a lot of members of Congress, Democrats especially, but a lot of the Republican conference, despite some voices that have said that they don't want to aid Ukraine anymore in this war effort, are still highly supportive of Ukraine and the war, ending this war effort.
All right, so what would this entail, and when are we going to find out more details? Because so far we're relying on really just President Trump's optimism and President Zelensky's reporting.
Yeah, I would say that President Zelensky has been very outspoken in terms of the process of these negotiations. The White House has been a little bit less transparent in them. I think that they're still working out a lot of details, which continue to be fluid. And I think that's one thing the White House doesn't really want to get ahead of themselves when it comes to negotiating this very difficult and complex peace deal that the U.S. is handling with European allies. And, I think that we're going to see more in the coming weeks. The administration has had a really hefty timeline on this. Initially, it was supposed to be Thanksgiving Day. They wanted this to be all worked out. So I think we're going to trickle into the new year potentially.
Let's talk about healthcare for a moment. Affordability has been really the mantra of Democrats and picked up essentially by Republicans. But is either one of them going to be able to solve this crisis as we see Obamacare premiums skyrocket?
Yeah, Matt, I mean, time is really running out here. We only have a few more weeks. I think Congress actually is only in session for about another week before they all leave for the holiday break. But House Republicans have a bill that they're going to try and put up on the floor this week, but that does not include the ACA subsidies extension. So that can definitely be amended in a way. I know that there are moderate Republicans who are very adamant on this issue that want to include that in this bill. But as of right now, we're not seeing that. We're going to have to see what happens this week. The Rules Committee is set to meet on this, and then we're going to potentially see a vote later this week.
All right, Mika, thanks so much for joining us. Mika Solner there out of Washington, D.C. from Bloomberg Government. Now, the NASDAQ is asking for approval from the SEC to add an extra session from 9 p.m. to 4 a.m. Eastern Time, making the trading day 24 hours long during the week. Bloomberg's Justina Lee joins us from London. And Justina, why exactly do they want to do this? Some of us need a rest.
I know, right? I think we've kind of seen a push in this direction for a while. The New York Stock Exchange has been planning a similar extension. I think one factor is, retail investors, they're already used to trading 24/7 on Robinhood and, on crypto exchanges. And another factor that, the NASDAQ statement pointed to is kind of global investors who kind of really want to be able to trade U.S. stocks, even outside of the regular trading hours, with more overlap with kind of a lot of overseas investors' working hours. And so I think these two factors are really kind of intersecting here for this push for, kind of close to 24-hour trading on work days.
So how would this look? I mean, it's not going to be a 23-hour cash trade. It would just extend, the after-hours session?
Yes, so the NASDAQ has gone to the SEC to ask for permission to add a session that's coming after, the after market hours. And, we kind of still need to untangle kind of a few operational issues, with the clearing and also with the data feeds and all that. And I think, the question here really is how much liquidity are we going to see in this kind of newly added session? Because if the liquidity is not that strong, it could be that we're kind of just going to get a lot of swings that won't really mean a lot to many investors.
All right, so we could, I guess we're inevitably going this direction. Are those swings really a concern? Because this could be low volume trading, and then we're going to be reporting on massive moves that don't really mean as much.
Right, exactly. I think that's a lot of people's concern right now. I mean, one thing that I find interesting is that if you actually look at what's happening during the regular trading hours right now, there's been an increasing percentage that's just happening, in the closing auction. So if anything, among a lot of institutional investors, they actually kind of increasingly just want to trade in those couple of minutes near the close. A lot of that is because of passive. And so I think there's a lot of question as to like how much demand there really is among kind of a lot of professional traders, or whether really this is just like a retail-driven push.
All right, Justina, thanks very much. Bloomberg's Justina Lee talking to us about this NASDAQ story, asking the SEC to extend trading hours to 23 a day. Coming up, payrolls report on deck. In your day ahead next, this is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
This is Bloomberg Brief. I'm Matt Miller in New York. Let's take a look at what's ahead today, because there is a lot. Starting with the main event, delayed November jobs report out at 8:30 a.m. Eastern. We're going to be combing through that. Also, we're getting retail sales data that was delayed at 8:30 as well. Following that, we'll get manufacturing and services PMIs at 9:45. In terms of the stocks that we're watching, Intel, Samsung's foundry division, Intel and Samsung's foundry division, I guess, are close to beginning mass production of Intel's platform controller hub chips. That's according to Korea Economic Daily. Roku has been raised to an overweight at Morgan Stanley with the price target at $135 following an upgrade from Jefferies and a lifted price target from Wedbush last week. And Accenture upgraded to overweight at Morgan Stanley, which cites compelling valuation following this year's pullback in the shares, a price target there of $320. Taking a look at futures ahead of right now, about 4 hours ahead of the opening bell, 3.5. S&P futures down 0.3%. The dollar and the 10-year yield little change, but oil down 1.7. That's it for the Bloomberg Brief. Surveillance is next.
what some of these generative AI models look like they're going to do is they're going to reduce the cost of producing content to basically zero. So that will be a multiplier effect on the things that we're already seeing, which is that there's more people producing more content and reaching more people. And there's a lot of good and bad that comes downstream from that.
I don't know if you can break down what the average person is seeing right now in terms of stuff that's AI generated versus, you know, maybe more traditional human generated, but what's that going to look like in a year or in 5 years?
There's actually a lot of hybrid content, and too often we talk about synthetic content and organic content, and never the two shall meet. But there's a lot of content where AI is part of the workflow, right? Like you might not even know it. It might be whatever app you're using to do color correction might be using models to do so. You know, stamp tool in Photoshop in the old days to get rid of a pimple, those types of things. But that line is going to be more and more blurred. So it's going to be a little bit less like what is organic content and what is AI synthetic content and what the percentages are. I think there's going to be actually more in the middle than pure synthetic content for a while. But you will also see experiences that are purely AI, right? You see this in the last 2 weeks with Vibes in the Meta AI app and with Sora 2 from OpenAI. So I think you're going to see both.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Payrolls we think are weak, and we think the risk is on the downside.
Our own forecast has the labor market looking quite resilient in 2026.
The Fed's mandate is not what headline GDP is doing. The Fed's mandate is the labor market.
If the labor market is clearly weak, the Fed's cutting a lot more than what's priced in.
The Fed is not going to solve the labor market.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome to Bloomberg Surveillance on Jobs Tuesday. It doesn't really sound right. Stocks struggling to hold on to gains with traders focused squarely on that data. Questions swirling about the strength of the economy as we await the November payrolls report and retail sales from October, which maybe doesn't matter at all. Optimism still abounding, with investors surveyed by Bank of America looking for brighter times in 2026. Damian Sassower, I'm so glad to say, is going to be joining me for the next 3 hours. Damian, it seems like there's this dissonance between the optimism in surveys and a lack of real enthusiasm, at least in market pricing.
I think you're right. Economic expectations are finally catching up to the market. And look, recession risk is non-existent. Pro-cyclical positioning in equities and commodities is certainly on the rise.
Yeah, and this is a reason why people are looking at what could be the next catalyst. I was really struck by Bank of America's fund manager survey, the fact that cash allocations fell to the lowest level on record. At the same time that everyone seems to think that things are going to be rosy and golden in 2026, yet we're still seeing some sort of dip in markets right now.
Yeah, but I think the tail risk measures tell a lot, right? Private credit and AI tech bubble. I mean, those are some of the tail risks that investors are sort of trying to position against. And it'll be interesting to see how investors kind of, do that in the year ahead. I think there's a lot of different ways, a lot of different mechanisms they can do to take advantage of where we are in the markets.
Well, right now, people are in a show me kind of story, and what you are seeing is a failure for the Santa Claus rally that everyone's been hoping for. After yesterday really falling into the close, we're seeing a continuation of that sort of negative sentiment down to 0.1% on S&P futures. That dollar weakness continuing. Watch for the 118 mark on euro-dollar cross, and yields continuing to eke higher. 10-year yields close to that 4.18%. Ahead of that jobs report, watch the unemployment rate. Crude falling to the lowest this year as people look to Ukraine and any kind of potential resolution there. Coming up this hour, don't miss this. Paul Quincy of JP Morgan Asset Management with stocks on track for a third day of losses. Elias Galou of Bank of America, as we were talking about with that investor sentiment, at its most bullish in more than 3 years. And Stephanie Roth of Wolfe Research, counting down to that payrolls report. We begin this hour with stocks just edging lower as markets await the latest jobs print. Paul Quincy, global head of equities at JP Morgan Asset Management, writing, many of our investors have become somewhat more cautious. We suggest diversifying from recent winners and focusing strongly on quality stocks, especially in the small cap space. Paul joins us now. Paul, a lot of mixed messages this morning. Can you square the idea that people are feeling cautious, at least right now, but very optimistic into 2026?
Yeah, I think, so the surveys are interesting. To me, the real survey starts at 9:30 every morning, right? We can look at the market and see what, that really expresses what investors are thinking. Investors are feeling pretty good right now. So the earnings growth has been terrific, and I think everyone, including us, expects that to continue into next year, but it has not gone unnoticed. So this year has been, again, triumph for the optimists in terms of fundamentals. Think how different things feel now to April. But when you look at how that's expressed in market pricing, it's the triumph of the very optimistic. So we've got an S&P 500 trading at 23 times next year's solid-looking earnings numbers. That's one of the highest levels we've seen, as we all know. You've really got to go back to 2000 to find a much higher multiple. And then within the market, you've seen this tremendous appetite for some of the most risky, most aggressive stocks, particularly in the small cap space. So investors are feeling pretty good about just about everything.
So this raises this question. How can you be so optimistic if you've got cash levels falling to the lowest levels in the history of the Bank of America Fund Manager Survey? I realize you're global head of equities for JP Morgan Asset Management. I'm not going to ask you to talk about the sharks and the jets, but I am curious about how much that's a contrarian signal to you at a time when there still are a number of concerns out there.
Yeah, so as always, in the end, the fundamentals will dominate, right? The fundamentals will drive stocks. As we look into next year, we see pretty good earnings growth in the US. We see pretty good earnings growth in other places as well. So emerging markets, for example, where we have not seen, at least until recently, anything like this kind of level of excitement. The 15-year return on emerging markets is a miserable 5% a year. So it's been a long time kind of in the shadows. But this year, they're up a lot. And that's for good reason. Earnings in emerging markets growing 15, 16% this year. We're pretty confident that continues into next year too. So there are places where you can invest into strong earnings growth and not have to pay record valuations and buying everything at record highs.
Yeah, but Paul, emerging markets, they don't have nearly as much liquidity. It's a much smaller market. Just how much of the $17 trillion that foreign investors have currently parked in the U.S. equity market, just how much of that $17 trillion can be shifted into emerging market, or for that matter, international equities?
Yeah, so, well, if you get there first, then you'll benefit from that money moving, right? I mean, I think certainly as we look at how investors around the world are positioned, they are more concentrated than ever in large cap US stocks. That's been the place to be, right? And the large cap US index makes up 2/3 of the world's total market capitalization. If you go back 20 years, it was roughly half that number. So you've had this tremendous concentration in the US. And look, it's happened for the right reasons. It's been driven by better earnings growth. America, on average, has the best companies in the best industries, and it's attracted a tremendous amount of capital. But it's also now comes with high valuations. And again, when you look forward at where returns are going to come from, I'm not so sure you want to be looking just at where they've come from in the last 10 years.
Well, Paul, back in late October, you and your colleague, Anuj Arora, I believe, talked about the 50% valuation gap between Asian tech stocks and those here in the U.S. That hasn't really gone away just yet. Are you still professing that Asian tech stocks, the AI play, has legs to it?
Yeah, no, I think that's definitely part of the attraction of emerging markets. You can buy technology at much lower prices. And these are great companies, too. These are central to the whole AI story. Their businesses are booming, and yet you're not paying anything like the kind of valuations you have to in the US. When you look at emerging markets overall, about 20% of the earnings come from tech. And they're driving about half the growth this year, and we think that continues into next year, too. But there's also a lot of other things going on. So it's not just a tech story.
So how much does the U.S. data matter, given the fact that we haven't gotten it? We're about to get it. It's going to be messy. We're not even sure what to do with it. We're not even sure how to read it. People are worried that there's going to be an unemployment rate of 4.5%. That might be okay. How are you sort of using this to factor into how to be aggressive and how to be active next year?
Yeah, so the data we're most focused on, as always, is the earnings. Of course, we get those on a regular basis. We're about to get a whole bunch more of them. And they've just been so reassuring all through the year.
But hold on a second, and I'm sorry to stop you, but there is a sort of K-shaped economy that people talk about, and there sort of is a sense that these earnings can't continue unless you get ongoing participation from a broader economic groundswell up. So at what point are you looking for that to really justify this sense that the Fed will be cutting, you'll get fiscal stimulus, and you'll get an economy that doesn't fall off a cliff that can support those earnings that are the ultimate data that you're watching?
No, we certainly want to see earnings growth broadening out in the stock market, right? We know we've been very, very reliant on a handful of companies, the greatest companies the world has ever seen in terms of their profitability, but there's only so much you can expect from that. So when we think about next year, we're looking for most of the extra earnings we see in the S&P 500 to come from the 493. So we think earnings will be up around $40 next year, and about $25, $26 of that increase has to come from that that 493, all the other companies in corporate America. But we're seeing that, right? And we're seeing our earnings number. When you look at forecasts, it's not just about where the forecast is now, it's about where the forecast is going. And we're seeing those numbers edging up across a whole wide range of companies, and you're starting to see that in the market too, right? It isn't just about AI and tech so far in the fourth quarter.
Well, I mean, you talk about the earnings growth kind of, spreading into other sectors called healthcare, energy, financials. I know you like those three, but let's talk about by market cap, small caps. When I think of small caps, the Russell 2000, I think of Bitcoin mining and quantum computing. I mean, some of these companies represent roughly 10% of the index, drone flying, taxi companies. When are those companies going to generate some positive earnings growth?
Well, if you thought about those companies this year, you'd made a lot of money because we call them the memes and the themes, right? Those stocks are 10% now of the market, as you point out. They've more than doubled this year on average. Some of them are up 3, 4, 5 times. That's a very tough place to invest. And when I talk about the triumph of the optimists and the very optimistic, that's perhaps the place where you see the greatest amount of optimism. Typically, we're focused on long-term fundamentals, long-term cash flow generation. In the end, we think that's what drives stock prices. So if those companies can deliver great revenues and cash flows, then they'll be great investments. We think many of them are going to really struggle to do that, and that's one of the places where we will worry most about the kind of investor over-optimism that you referred to and that showed up in some of these surveys.
Well, Paul, I mean, I know it's the dead of winter, December, so sorry to steal a baseball analogy here, but where are we? What inning are we in the earnings cycle?
We're watching it carefully, but it still feels to us like things, if anything, are getting better, not worse. So just because things are good now doesn't mean they're going to stay good, but the momentum going into next year looks pretty good. And you sort of outlined the backdrop. We've got an accommodative Fed. We've got a tremendous amount of fiscal spending, and that extends as far as the eye can see. We've got an AI-driven investment boom. These are pretty good times. So you've always got to be worried, always got to be watching, but the data points that we're looking at and the earnings that we're seeing from companies, if anything, they're getting a little bit better.
Paul Quincy of JP Morgan Asset Management, you'll be sticking with us. And Damien, good try. I think that was an incredible punt away from the baseball analogy of which inning. It's just getting better, so maybe the first inning.
Yeah, I mean, look, we need some bears in the room here. I mean, this is just way too bullish for me on a sleepy Tuesday morning ahead of payrolls. But I mean, look, your guess is anyone's. I mean, we do have payrolls coming up, but it's just going to be so noisy. I mean, it looks like the markets have already looked past it.
Well, I just wonder how much this is predicated on the idea of both fiscal and monetary stimulus. This Goldilocks backdrop that people see, and how much that needs to persist. In other words, are we in for potentially some sort of offsides move in response to this jobs report that might mean nothing? People don't know how to read it, and that's why I think people are really watching it to understand how much people are waiting for the Fed to have to participate in this ongoing sentiment shift.
Yeah, well, I mean, this spread out to international equities, to emerging market equities, to unloved sectors, well, not less loved sectors, anything other than IT, right? I'm talking healthcare, energy, and financials. I mean, those are themes that we have yet to really see take hold. It'll be interesting to see if there's any longevity there.
Yeah, right now people don't know exactly what to do with all of this, especially because we have seen a real kind of hiccup in the AI story. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira on Yahira.
Good morning, Lisa. Australian authorities say Islamic State flags and explosives were found in a vehicle registered to one of the gunmen that attacked a Bondi Beach Hanukkah celebration. At least 15 people were killed in the terror attack on Sunday, allegedly carried out by a father and son. The Sydney Opera House was illuminated with a giant image of a Hanukkah menorah, as you can see there, on Monday night as thousands gathered to mourn the victims. Meanwhile, President Donald Trump filed a defamation suit against the BBC over an edit of his January 6, 2021 speech in a Panorama documentary. The edit gave the impression he had made a direct call for violence in his speech leading up to the attack on the Capitol. Trump is requesting $10 billion in damages, according to court documents filed in Florida. And NASDAQ is looking to extend its trading hours. The exchange wants to increase its hours from 16 to 23 per day. In a filing, the firm asked the SEC for permission to add the additional trading session. If approved, the change would take effect in the second half of 2026. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Is it a good idea to extend it, to make it so that you can never leave? So you always have to be in the office? You always have to be trading?
Well, Lisa, I haven't slept since 1987, so it really doesn't matter for me. But all my friends who do actually get a decent night's sleep, I'm talking 5 to 6 hours, yeah, it probably does matter quite a bit to them if they want to see their families again.
I think that everyone's going to be watching this to see how you perform on No Sleep Since 1986. Up next, ending the war in Ukraine.
I think we're closer now, and they will tell you that they're closer now.
numerous conversations with President Putin of Russia, and I think we're closer now than we have been ever.
Bloomberg's Tyler Kendall and Oliver Cook join us for group coverage coming up next from New York City. This is Bloomberg Surveillance.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Rotation underway as we end the year. This really has been the story. Even though you see that soggy headline figure in equities, you do see the equal weight S&P continuing to outperform and actually eke out gains. Right now what you see across the board, yes, about a 30% decline in both the S&P and Russell 2000 futures, NASDAQ doing a little bit worse. But if in the equal weight, it has been a lot more stable, which raises this question, how much can you see a broadening out without the participation of the U.S. economic data? Flip up the board, 210s and 30s, you get the sense that people are concerned that there won't be enough weakness to cause the Fed to cut rates, but just enough weakness to maybe keep things on some sort of tilt. Right now you're seeing just barely moving, but 350 on the 2-year, that long end of the curve all rising up to 4.85% on the 30-year. Damien, to me, this is really the question. Why this yield curve steepening if you think that truly this is the right move to be cutting more aggressively here?
Well, I mean, shouldn't that be good for financials, for banks, right? A steeper curve, higher net interest margins. But, you know, you're right to point out that, I mean, industrials, utilities, these boring, stodgy sectors, companies like GE, Caterpillar are up big this year. So, you know, I do think we've already seen a bit of that rotation out of tech and into the broader S&P. But again, just how much further can this go?
You have an Oura ring, and you haven't slept since 1986. Is it screaming at you?
Well, my wife wants to grade my sleep now. I got a 46 last night, which is beautiful. Beautiful for me.
Great, good to know, duly noted. Meanwhile, our focus very much international as we try to gauge the latest in Europe under surveillance this morning, ending the war in Ukraine.
I think we're closer now, and they will tell you that they're closer now. We had numerous conversations with President Putin of Russia, and I think we're closer now than we have been ever. We're having tremendous support from European leaders that want to get it ended also. And at this moment, Russia wants to get it ended.
Here's the latest. Ukraine's President Volodymyr Zelensky saying he's secured a deal with the United States to make security guarantees legally binding. Talks toward ending the war between Russia and Ukraine are expected to continue today. Our team coverage starts right now with Bloomberg's Tyler Kendall in Washington and Oliver Crook in Brussels. Tyler, I want to get your sense. We've heard a shift in tone from President Trump. He's talked before about how there's been progress made. Why is this time different and reading differently internationally?
Yeah, hey, Lisa, good morning. Well, we should say that a U.S. official did tell reporters that the security guarantees on the table would be Article 5-like in reference to NATO's Mutual Defense Clause, and that is really what is making this different this time around, because though it is short on the exact specifics and details, this is the type of security guarantee that Ukraine has long asked the U.S. for and has long said it would be difficult to reach any sort of deal without that type of firmer commitment, because as you're referencing here, we've really seen this ebb and flow with the administration. Just for context, the U.S. had for months suggested that any sort of guarantees would be implicit because the U.S. would have this vested economic interest in in Ukraine. We then saw that sort of shift to signal that the U.S. could provide intelligence or air cover. So the fact that this is on the table now really marks the strongest pledge that we've seen from the U.S. so far. As you mentioned, it's going to be really important that Zelensky says that he has these assurances that this could be codified and made legally bounding by Congress, because that signals that this could endure past the Trump presidency. Now, at the end of the day, we have to keep in mind U.S. officials are telling us that these guarantees are only on the table for so long as the White House is really trying to mount that pressure to get a deal done. The thing is, there's still big questions here, including will the Kremlin really come to the negotiating table on this? And we know that territory remains one of those huge sticking points, as President Trump yesterday did suggest that Ukraine should indeed cede land. Lisa, at this point, we are seeing these talks ramp up. The U.S. re-engage. This latest round of diplomacy was led by Special Envoy Steve Witkoff, as well as the president's son-in-law, Jared Kushner. Our understanding is the U.S. is going to next engage with Russia on what the potential next steps could look like.
Yeah, Ollie, this really is the question, and Tyler kept referencing it, and you heard that skepticism in President Trump's commentary. At this moment, Russia wants to get it ended. What are the concessions being made on the Ukrainian side, and how feasible does the whole deal that is currently emerging seem to European allies of Ukraine?
Well, the European allies have been much more positive, and in fact, they gave a pretty detailed readout of some of the other aspects of the 20-point plan from yesterday's meeting, which also included things like keeping the Ukrainian military up to 800,000 troops. You'll remember that first 28-point plan had asked for a reduction of the Ukrainian army down to 600,000, but also going into more detail of what those security guarantees could actually compose of. They could be a coalition of the willing, which we're talking about foreign troops potentially being within the Ukrainian borders, talking about maybe seizing some of those Russian assets, bringing forward those recovery funds to try to reconstruct Ukraine. Another thing that the Europeans are bringing to the table is this potentially accelerated path for the Ukrainians to join the European Union. So trying to get their foot in the door and trying to get their sort of voices heard at the table, which they seem to have succeeded in a little bit. But as you were saying here, the sort of Europeans being very positive about this deal and the Ukrainians being very positive at this deal, I think suggests, how is Russia going to feel? The more positive these two sides are going to be, presumably the more negative Russia is going to be. And there's still that key issue of territorial concessions. The Ukrainians have softened a little bit on that. We heard from Zelensky saying there could be a referendum in Ukraine about surrendering those parts of the Donbass, or maybe finding another sort of bridging concept by the United States. But the Russians have said pretty explicitly from the beginning that there is no peace agreement. There's not even a ceasefire agreement until there is an agreement to get the rest of the Donbass under Russian control in some way or another. And that still has not been settled as of today.
Oliver Crook, Tyler Kendall, both of you, thank you so much for the comprehensive look at what's going on. Paul Quincy, Global Head of Equities at JP Morgan Asset Management, still with us. And Paul, how much does this ongoing negotiation affect your view on Europe right now, based on the idea that a rebuild effort could be really positive, an ongoing war really negative?
Yeah, so it's all part of the mosaic for European equities. Obviously, it means a lot to the world, and everyone wants to see peace. In terms of the markets themselves, it's probably not the major driving factor. We do think, though, that German fiscal spending next year really starts to kick in, and that probably happens whether or not the peace talks are successful. And that's going to be one of the drivers that we think leads to a better year for European corporates. They need it. Europe, the perennial problem in Europe, of course, is earnings growth. The main reason why European equities have lagged for so long is that the earnings have not been as good. And this year really wasn't that much of an exception. The markets have done quite well, but earnings this year in Europe are kind of roughly flat, up a little bit. So again, kind of lagging behind what we see in the US and Asia. So if the recovery in Europe is going to continue in terms of the market, we do need earnings growth to come through. We think it will, but we've got to watch that pretty carefully.
Yeah, Paul, no, I take your point. I just don't know how likely it is Ukraine's going to cede land in the south and the east that Russia has failed to occupy for more than a decade, right? We'll see how that works out. But to your point on geopolitical risk and the fact that the markets have completely ignored it for the better part of not just the last year, but the last 3 to 5, talk to us about how you as an investor position defensively for some of these potential VAR shocks that may very well occur in 2026.
So, as a rule, geopolitical risk tends to get kind of over-focused on, I think, in markets, and it's hard to find examples in which geopolitics have had a sort of really lasting impact on investor returns. There have been a few. So obviously, the war in the 70s and the oil price crisis that followed that, that was a real economic event and a market event, not just a political event. And then if you had invested in Russia, then the invasion of Ukraine also was a big deal. You were essentially, wiped out overnight. A medium-sized market effectively disappeared. But those are the exceptions, and typically geopolitics attracts a lot of attention in markets for a few days, and then investors go back to worrying about the fundamentals that tend to drive things. So that's how we try to see it. It's not to dismiss geopolitics as a real event, but in general, those things tend to get overplayed.
Paul, you mentioned tech is expensive and that you're kind of pseudo-recommending a sort of value-oriented shift into healthcare, financials, and energy. I wonder if you could expand a little bit about the commodity complex, basic materials, mining. Talk to us a little bit about this pro-cyclical shift and whether or not it can really extend into some of these Newmont, some of these names that have really, only this year begun to wake up to the reality that, yeah, there might be some demand for their product.
Yeah, absolutely. Look, I think the big picture for us is you want to be looking for good opportunities across all the markets and not just get attracted to the bright, shiny thing that everyone wants to talk about all day, but may not give you the best future returns. We had a great example of that recently, by the way. So a lot of people put out pieces on, what's happened since ChatGPT. You made 10 times your money in NVIDIA and stuff like that. But if you look at the other end of the list, over that time period, you've lost 80 or 90% of your money in the COVID stocks. They were once the bright, shiny thing, and of course, the fundamentals didn't follow through, attention moved elsewhere. So that's just a reminder to always be looking forward, thinking about fundamentals. And as you do that, we think you see, there's lots of opportunities still in tech, of course, but it's not the only thing. And we can find great companies at reasonable prices in lots of different parts of the market. Specifically in commodities, yes, you've got the demand dynamics. One of the sort of longer-term positives there, too, is that commodity companies, including many in the energy sector, too, have in recent years been paying much more attention to their shareholders and perhaps been less focused on kind of aggressive capex and expansion at all costs. So buybacks, dividends, better balance sheets, all of those give you a much sounder basis to make an investment in those companies. And when the macro does come in your favor, then of course you make a lot more money and you've got more chance of keeping it as well.
Paul Quincy of JP Morgan Asset Management, thank you so much for being with us this morning. Happy holidays. Have a great break. Really interesting. The commodity is definitely going to get a boost. Shiny new thing.
Yeah, no, all that glitters is gold.
Yeah, well, evidently. Coming up, we're going to be talking about with Elias Galou of Bank of America with investor sentiment at its highest level in over 4 years. Plus, Yahira Anand with your morning movers. This is Bloomberg Surveillance.
The key issue right now for us in the diamond space is the declared divestment of Anglo from DBS. And as you know, Anglo holds 85% stake in DBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in DBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Seeing a bit of softness ahead of the open, ahead of that key economic data that we've had to wait quite a bit for. We were supposed to get this before the previous Fed meeting last week. Instead, it is Jobs Tuesday. We do have right now a little bit of a soggy feel ahead of the open, down 0.2% on S&P futures. That dollar weakness continuing with euro at 117.55. Yields just slightly higher, although really not much action in the yield space. A real question about if you do get some sort of dovish tilt on the heels of this jobs report from the Fed, is that going to be good or bad for long-term bond yields, Damien?
Well, I think you're talking about global central bank activity and whether or not all central banks follow the Fed. And really, the answer is no this time around. I mean, we still see a number of central banks cutting rates. We're going to see another 5 this week, like Chile, Mexico. I mean, the UK is going to be cutting rates. But, you know, a lot of central banks that have been actively easing policy are now on hold, and they're kind of shifting to more of a hawkish bias. That's very different than what we're seeing here in the U.S.
Yeah, and part of this is because in the U.S. we're fueled also by the idea of oil prices coming down, which we see today with oil prices coming to the lowest levels going back to May. 3 hours away from the cash open, here are your morning movers with Yahira on Yahira.
Hi, Lisa. We have some sell-side action moving stocks this morning. We start with Roku. Shares are up 4.6% on a double upgrade by analysts over at Morgan Stanley from underweight to overweight and setting the price target at $135. And the call is all about advertising. They're saying that 2026 will be a strong year for ads in the U.S. and that connected TV stands to benefit the most. Meanwhile, moving on to Southwest, the airline shares are up 2.5%. Barclays raising the stock to overweight and setting a price target of $56. The upgrade follows comments from the CEO just last week talking about Southwest pursuing airport lounges, echoing what JetBlue is doing with their first ever lounge. So this just showing us how these more economic carriers continue to double down on the premium travel. And we end on B. Riley Financial. The stock is soaring 26% in the pre-market after it filed a long overdue earnings report in an important step that will keep the stock from getting delisted from the NASDAQ. The filing follows months of pressure tied to soured investments and flaws in its financial reporting, but it's not in the clear just yet with another looming deadline in January. Lisa?
Thank you so much, Yahira. On our radar this morning, President Donald Trump signaling the end of the war in Ukraine is closer than ever after negotiators offered Kyiv significant security guarantees that will be legally binding once voted on by Congress. Meanwhile, over in the auto space, Ford taking a $19.5 billion charge as they pivot away from electric trucks to focus on gas and hybrid models. This comes as the European Union is softening emissions rules, scrapping an effective ban on combustion engines. And it kind of goes to this question, Damien, how much is this because the subsidies were withdrawn from the United States? How much is this because the mood has shifted, and it shifted away from EVs and back to the combustion engine?
Well, Ford 5-year CDS is down just 30 bips from its mid-October peak. And look, the reality is, yeah, this should get its EV operations profitable by 2029. So I guess from a operator standpoint, it is a good thing. But canceling its electric F-Series, I mean, I'm heartbroken about that. You know, I was really looking forward to getting in one of those at some point in my life, but looks like I'm not going to make it.
It seems like it wasn't going to be profitable, and it certainly wasn't going to be without the subsidies. And it definitely speaks to what is the future for some of these more renewable energies at a time when some of the previous investments really just are not affordable anymore.
And the EU is abandoning its emissions ban, right, for new cars, right? I mean, so it's softening the rules, right? So yeah, I mean, look, it looks like all clean energy things are going in a different direction, at least today.
Yeah. Meanwhile, on the smartphone side of things, global smartphone shipments expected to take a major hit next year. According to Counterpoint Research, output could decline by over 2% as a shortage of memory chips is expected to drive costs higher. So pause. Because of AI and the build-out, all the chips are going to data centers. They are prioritizing that type of technological advancement over what you have in your pocket every single day. I just wonder how much this is going to increase costs and how much this really speaks to a mismatch in demand and supply when it comes to some of the new technology.
Well, I mean, I don't think that the overall rise in the cost of components is really going to impact the majors like Apple and Samsung. But, you know, these smaller phone makers, some like Chinese phone makers, for example, like Honor Device and Oppo, are certainly at risk here if they can't get their hands on chips and the components they need to increase their revenue.
Meanwhile, people are still all optimistic. Turning to markets, Bank of America releasing its December Global Fund Manager Survey, showing macro optimism at its highest going back to 2021. Joining us now is Elias Galou of Bank of America. Elias, great to see you. Thank you so much for being with us. Let's start on the cash holdings. The idea that cash allocations fell to 3.3%, the lowest in Bank of America's Global Fund Manager Survey. How much of a contrarian indicator do you see this as?
This is a very contrarian indicator, Lisa. Look, I mean, just a bit of context on the FMS cash levels, which fell to a record low 3.3% today. This series is one of the most important of the Fund Manager Survey. It has been around since 1999, so we are able to track several cycles through this series, and even at the height of the internet bubble, at the height of the subprime bubble, and during the bond bubble of the post-GFC era, the FMS cash level did not drop to the level it did today, 3.3%, which is just strictly speaking and focusing on this metric, this is a very bearish contrarian signal. And we backtested this series since over the past 25 years, whenever the cash level fell to 3.6% or below, the average 4-week return for global equities has been minus 2%. And over 8 weeks, it's been global equities were flat.
Elias, how do you square with this with the idea that people are really optimistic about 2026 returns? Is it consistent, given the fact that we might see sort of meandering stock returns heading into year-end, kind of what we're seeing this morning, but next year people will see that fiscal stimulus come in, that monetary stimulus come in, and it will really support this sort of broader story that people seem to be leaning into?
I think if we had to define the December 2025 Fund Manager Survey, it would be the most bullish survey of this AI-led bull market. And the culprit of this palpable bullishness is the expectation of run-it-hot policies. FMS investors look at the Fed, they know and are convinced that the Fed under the next chairman will be much more accommodative than in the past few years. They know that there is a big election in the US on November the 3rd next year, and they expect the administration to push a bit further in terms of fiscal policy. And they also know last week's announcement from the Fed in terms of the liquidity backstop, I think has clearly emboldened FMS investors to increase allocation to risk assets. Because another important metric that was extreme in this survey was the fact that liquidity conditions were rated as the most positive since 2021. And in fact, over the past 20 years, the liquidity conditions have only been greater than today at the peak of the COVID boom in mid-2021.
Elias, long Mag 7 and long gold have been the most crowded trades for the past 3 months in a row, yet at the margin, a small handful of investors now believe that being short JGBs and long global bank stocks are the most crowded trades. So I'm curious, it's notable given the impending BOJ rate hike at the end of this week, the near universal belief that yield curves are going to steepen across the globe. I mean, can you provide just a bit more color on these newly referenced pain trades?
Sure. I think if you look at in the details of the fund manager survey, the one challenge where it's actually tough to square institutional investor bullishness is on expectations for bond yields. There is this big conviction that bond yields will be higher in 12 months' time, this huge conviction. Net 75% see an even steeper yield curve, and then investors are very bullish risk assets. So, at the end of the day, it's important to take a step back and look at the big picture. And the most important question here, Damien, is can risk assets, global equities, US equities that are very rich in terms of valuation withstand 5% plus bond yields? And I think, at this level of positioning, at this level of valuation, risk assets will be struggling if the 30-year Treasury exceed 5%, which has been a line in the sand for US policymakers. But for now, investors prefer to focus on AI, the productivity gains that AI adoption will deliver, and in terms of EPS growth. And this is what they prefer to focus on, and is also driving their bullishness in 2026.
Elias, despite the pro-cyclical rotation into equities and commodities, allocation to the energy sector is nearly 2 standard deviations below the 20-year average, according to your FMS. Yet with Brent crude now dipping below $60 this morning, and most analysts calling for it to stay there, is there any benefit in fading that call?
It's one of the big contrarian trades of 2026, really. The energy sector has seen a continuous underweight of FMS investors, and rightly so. Now, I think it's quite interesting to see the dichotomy between an increasing allocation to commodities. The net overweight on commodities is the highest since September 2022, but at the same time, a very big underweight on energy. And that dichotomy is explained by the divergence between metals and energy. I think in 2026, if growth surprises to the upside as investors expect, I think clearly there is a lot of value in the energy sectors, and probably the stronger growth will push the oil price higher.
On the flip side, Elias, how much do you see a potential contrarian trade in bonds, in particular long bonds? This idea that maybe people are over their skis with how much growth could increase, and something's got to give. Either it's stock valuations or it's where bond yields are, and maybe it's the bond yields leading to a risk-off moves, something that people are sort of not positioned for at all.
Sure. I mean, what you saw this month, Lisa, is a very big rotation out of bonds, and also a big underweight when it comes to bonds, the biggest underweight since October 2022, when the MOVE index was above 160, i.e. rates volatility was a lot higher than it is today. And look, what is happening in this morning in the US, there is big macro news, the November jobs report, and if that report surprises on the downside with a very weak payroll or even a negative payroll, I think that's the pain trade of the day. It's going to see bond yields sharply lower, and what I think is the biggest pain trade of macro investors, a flattening of the yield curve.
Yeah.
Elias Kalu of Bank of America, thank you so much for being with us this morning. Really interesting, that survey, especially in light of sort of tepid enthusiasm right now, at least in futures, at the same time paired with unbelievable raging optimism for 2026.
Well, I mean, what we didn't ask, Elias, was that the AI tech bubble now for 3 months in a row has been the biggest risk facing investors. But the biggest jump this last month was private credit, right? So, what about private credit? What about, these continuation funds? What about all the issues that are going on in that less transparent, more opaque, universe? And I think that's a tail risk that a lot of investors should be focused on here.
Elias's partner, Michael Hartnett, said that you've only seen this level of optimism in this survey 8 other times in this century. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. The manhunt for the shooter who killed 2 students at Brown University is entering its 4th day. Rhode Island Governor Daniel McKee and other officials have said there's no clear security camera footage from the building where the shooting took place, which has hampered the search. The FBI is offering a $50,000 reward for information that leads to an arrest and conviction. Meanwhile, OpenAI's deal to license characters from Disney for its Sora video app is entirely in stock warrants rather than a cash licensing fee. That's according to people familiar. Last week, Disney announced it would let OpenAI pull from its library of more than 200 characters and creatures while agreeing to take a $1 billion stake in the company. And PayPal has applied to become a bank in the U.S. The payments firm is looking to take advantage of the Trump administration's openness to fintech companies entering the banking system. The company says if approved, a PayPal bank would help strengthen its lending to small businesses. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, counting down to the jobs report.
Payrolls we think are weak, and we think the risk is on the downside. Chair Powell is warning us, don't pay too much attention to the unemployment rate.
Stephanie Roth of Wolf Research joins us next to tell us just how much attention to pay to the unemployment rate and other aspects of this report that could be potentially telling, given the fact that it's going to be messy and it is late. This is Bloomberg Surveillance.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal, with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world, right here on Bloomberg. Context changes everything.
A soft tone to start the week, start the last week of the trading year. And we're continuing that this morning with futures lower pretty much across the board. 0.2% decline on the S&P futures. You're seeing a similar decline on the Russell 2000. The NASDAQ underperformance ongoing, down 0.3%. When you take a look at the bond space, not getting a reprieve here. And this is sort of the key. The idea of this incredibly accommodative backdrop that Elias Galou was talking about. This morning, some questions about how persistent that can be with the 30-year up toward that 5% level. As he was saying, 4.85%, even with the 2-year at 3.5%. One thing that's notable, and Damien, I'd love your thoughts on this, the idea that when we started this rate cutting cycle by the Federal Reserve in September of 2024, 10-year and 30-year bond yields were lower when they are right now. Is there an indication in what that's saying?
Well, I think, it really, for me, it comes down to broad dollar weakness, right? I mean, look, as the carry trade, as we rightly point out, we were talking about offline, with the U.S. yields now coming off, is the U.S. still an investment currency, or now is it a funding currency? And I think that remains to be seen. We got some weak data out of Germany last night. I think euro-dollar, that cross rate is going to be absolutely critical, and the data out of Europe is going to be absolutely key to the direction of the dollar and the durability of this dollar weakness over the course of the next year.
The data out of the U.S. also would have been important had we gotten it. We're finally going to be getting some of it under surveillance this morning, counting down to the jobs report.
Payrolls we think are weak, and we think the risk is on the downside. Chair Powell's warning us, don't pay too much attention to the unemployment rate. I think once we get the December data, we'll get a better reading. The risk is the labor market, though. So there you could see a little bit of weakness persisting.
Here's the latest. November payrolls due out in just under 2 hours. The median estimate in our survey calling for 50,000 jobs added. What this means, though, pick 5 people, you get 5 different answers. Stephanie Roth of Wolf Research expecting a higher number, 70,000. Stephanie joining us now. Stephanie, great to see you. Thank you so much for being with us.
Thanks for having me.
So what are we focused on? Is it the unemployment rate, even though Jay Powell said, please ignore the unemployment rate?
It's probably going to be the private payrolls numbers, because the unemployment rate might be complicated, because if you think about the household survey this time, part of the survey week, it was still the government shutdown. Some people might say they were unemployed, even though they shouldn't have, given they worked for part of the week. So there might just be some unusual amount of noise, and BLS had flagged that there's going to be a little bit more error just given some of the complications with the shutdown. So the private payrolls is going to be a thing to watch. Government payrolls is going to distract from the headline number. So we have to watch for the private number for both October and November will be interesting.
Do you think that this market could be caught off sides, or do you think that this number is so messy as to be rendered useless once people digest it, trade around it, freak out, and then by the end of the day, things kind of go back to where they were before?
Yeah, I think the ultimate reality might be it's not so important, but there's going to be a lot of key details that we're going to learn about. The private numbers is going to be critical. We're going to be watching the cyclical hiring within the service sector, because that's what's been notably weak. Retail we're going to have to watch closely, because that might face some seasonal issues just around this holiday season might not be as strong for hiring as it typically is, just because retailers are a little bit more cautious. So there's going to be a lot of details to sort of parse through, but there's going to be a lot of information. We're going to be watching that quite closely to gauge to what extent the hiring might actually be starting to pick up.
Stephanie, I caught you on the real yield a few weeks back with Scarlet Fu, and you seemed relatively bullish on the U.S. consumer as we turn into 2026. I'm curious, consumer sentiment is now hovering near its lowest level since 2009. American households' view of their own personal finances are at near all-time lows. How bullish are you on the U.S. consumer here?
I'm actually pretty optimistic. This is an affordability issue, not necessarily a rate of growth issue. So inflation has slowed down. Of course, it's not 2%, but it's running around 3%. It's not growing as high as it was in 2022 and 2023. This is an affordability issue. Price levels are high, and that's something that people aren't happy about. However, they're able to largely afford, at least the middle to upper end consumers, largely able to afford most things, even though they're unhappy about the level of prices. And on top of that, we're going to have a decent amount of stimulus hitting the consumer in the first part of the year. If you think about the stimulus from One Big Beautiful Bill, it's going to hit around tax season, no tax on tips, no tax on overtime. That's going to be some decent amount of tax returns hitting the consumer.
In last week's Fed survey of economic projections, they increased their 2026 GDP by, I think, 0.8% without increasing their projection for the unemployment rate, which means it's all about productivity gains next year. Talk to us about that. Do you think that the Fed is a little bit too rose-colored glasses about the impact of productivity gains on GDP in the new year?
Yeah, so you have to knock off 20 basis points from their upward revisions on GDP for the government shutdown. But even beyond that, they did upgrade their GDP numbers, unemployment rate the same. I think that they're a little optimistic on productivity. I'm not quite as optimistic on productivity. I think what we'll see, though, is an economy that's growing fairly well. They'll just need to be a little bit more job gains to get there. And our sense is that adoption rates in terms of AI won't be as strong as maybe many people are thinking about. It'll happen a little bit more slowly, such that we'll actually see just a pickup in hiring, which is not such a bad thing.
We were just speaking with Elias Kalu of Bank of America, and he said that there's a real dissonance here between yields in the long end. They're close to 5%, and this bullish feeling that people have about the economy and how fast it can grow. Do you see the same thing, that there seems to be some sort of mismatch between the level of benchmark yields and how fast the economy can grow when people are talking about stimulus, despite the fact that long end yields have risen?
Yeah, so that is good. That is a bit of a challenge for next year. One of the pieces of our outlook when the 10-year yield was closer to 4% was an easing in financial conditions should help to support the economy. That's largely faded to some extent now that you've seen yields back up.
Our sense is that we'll get, that will sort of take a little bit of the shine off of next year, but I don't think it will be that massive because there are a lot of tailwinds supporting the economy for next year. On top of the fiscal stimulus that will start to hit, you have investment that will start to hit, FDI pledges.
Core inflation.
Exactly. So there are a lot of different tailwinds that sort of support the economy, even though you have seen a bit of a backup in rates. So the more cyclical, interest rate sensitive parts of the economy might still struggle, housing in particular.
How much is a sort of bullish feeling predicated on the idea that there is going to be, I want to say, a political tilt to the Federal Reserve and some of its actions with respect to supporting valuations? I'm thinking about how the balance sheet might be deployed, not just for T-bills, but also on the long end of the yield curve. This idea that if yields rise to enough, well, there is the ultimate Fed put, especially in 2026.
Yeah, I mean, I think that was some of the excitement after the FOMC. For me, that is not a fundamental reason for why I'm optimistic for next year. That, to me, is actually kind of concerning, and depending on how this all plays out, it could result in just upward pressure on the long end of the yield curve, which is not a good scenario. I don't think that they will end up really driving the backdrop that much. I think what we'll see is, let's say it ends up being a chair Hassett. At the margin, maybe that ends up being one more cut than would otherwise be the case. I don't think it will be that dramatic in terms of what the Fed end up doing. The key drivers of a strong growth backdrop is less tied to the Fed and more about a gradual cyclical pickup in the economy, tariff uncertainty starting to fade, the fiscal starting to play out in the beginning part of next year, and less about the Fed.
Stephanie, do you still believe that the reflation concerns that are currently gripping the market are overdone? I mean, do you still expect core inflation to decline in the new year? And if you still do, what are the drivers of that?
Yeah, I do. I think we're going to see inflation start to cool down. So housing is a big one. We'll see, rent and OER. They might bounce a little bit in this week's CPI, but our sense is it will gradually move slower throughout the course of next year. On top of that, goods inflation should start to cool a little bit. That has been held up by tariffs. Maybe not in Q1, but maybe throughout the course of next year. There's just a number of sort of components within the CPI that are just starting to normalize, in which case we'll end up in a growth backdrop where CPI is 2.7 by the end of the year, and then slowing below 2.5% by 2027.
Stephanie Roth of Wolfe Research, thank you so much for being with us. Have a wonderful holiday season. And this disinflation is the reason why people are looking at the Fed and seeing them completely, not completely, but largely dismiss inflation as the preeminent concern and overweight the labor market.
Healthcare costs, I mean, that's going to be a big one if the Obamacare gets repealed. I think auto. I think shelter costs are still going to have pressure to the upside. I'm actually taking the other side of that trade, but that's just me.
I think there are a lot of people who would agree, and I think that your point about Obamacare is actually a significant one. How much does that eat into some of the candy that you're getting from the One Big Beautiful Bill and some of the stimulus payments? This is something people are parsing through right now, and will continue doing so as markets try to find their footing ahead of next year. A lot of optimistic feelings, not necessarily playing out in markets right now. Coming up next, Lucy Baldwin of Citigroup, Terry Haynes of Pangea Policy, Anu Iyengar of JP Morgan, and Mike Pyle of BlackRock as we head toward that jobs report. Payrolls Tuesday just doesn't have the same ring as Payrolls Friday. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Game here is understanding. These digital assets have the ability to change the payment landscape of the world. And we need to be ready. We, the regulators, the world needs to be ready for a new wave of technology.
Stablecoins are almost entirely used in the mechanisms of trading cryptocurrencies. What we saw is the opportunity for digital assets broadly, stablecoins in particular, to be used as a medium of exchange outside of the crypto world, what is today the fiat currency world. At some point, I think these digital asset wallets will be big enough and people will be comfortable enough using them. I think we'll have a flip from conventional payment mechanisms into stablecoin-based mechanisms.
Does that mean banks such as yourselves issuing stablecoin?
We could. We are issuing Hong Kong dollar stablecoins today. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need. Because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of them.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Anand, only on Bloomberg.
Next year, there's more of a reason that we could see more boarding.
I think 26 is going to be more of a year where you're going to have to really think about stock selection.
Valuations coming down will be a reflection of a wider uncertainty.
This huge run in margin expansion could come to an end.
The pessimism gets wildly bad and then it gets wildly fantastic again.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Everyone's optimistic for 2026. This, according to the Bank of America Fund Manager Survey. Stocks, however, not keeping up, failing to keep the momentum into year-end as investors look for reasons to get more bullish maybe in the next 12 months. Perhaps they'll find some reasons with the release of data. Finally, it's Jobs Day Tuesday. Of course, before that, we get ADP employment. Then, of course, we do get October retail sales. What do you look into that, given the fact that it's dated? And then on Thursday, CPI. Damien, we're finally getting the deluge that we've been hoping for.
Yeah, no, I mean, we needed some data to kind of lean into here. But again, you know, there's a lot of noise surrounding all of it. I mean, today's payroll data, I think the market's completely looked through it. I think actually retail sales might actually be a more important driver of people's models in terms of trying to gauge where U.S. yields are going to be in the new year.
People always say this. They say the data's not going to be that important this time. Then it comes out and markets go haywire.
4.7 on unemployment. Here we go.
I mean, right, exactly. Which is the bigger potential downside surprise to markets? If you get an upside surprise to the unemployment rate or a downside surprise that raises the question of just how much the Fed can actually cut again, if at all?
As I said, as we opened up today, good news is bad news for equities, right? Good economic data is bad news for the equity market and vice versa. And I think that theme is really playing through. It's really shown through in the last few weeks.
And that's what Mike Wilson of Morgan Stanley has been saying. Meanwhile, in the dollar space, you have seen the weakening trend reassert itself. And we saw this violent trend after Liberation Day in April. Now you're seeing a sort of a question about whether we can see a similar first half of 2026, raising questions about some of the most popular trades, AI, namely in the United States, and how much that is put at risk based on this move.
Yeah, no, exactly. I mean, look, the Bloomberg Dollar Spot Index is down 8%. DXY is down 9.5% this year. I mean, these are huge moves, but, you know, most of those losses are concentrated in Europe and Asia. I'm sorry, Europe and Latin America. Asia is only up 2.5%, the Asia Dollar Index. So, you know, you have to really pick your spots, and it's all in the eye of the beholder. If you're a European-denominated, a Euro-denominated investor, it just hasn't worked that well for you investing in emerging markets and international equities. but it has if you're a dollar investor.
And this is a reason why people are looking ahead potentially to other pastures heading into 2026 if this dollar weakness does continue. Right now, it is on the margins continuing, at least versus the euro, at that 117 to 118 mark on the euro-dollar cross. S&P futures lower now just by 0.1%. Maybe people getting more enthusiastic as they hear Elias Galut talk about the low cash holdings of all these fund managers. 10-year yields inflected just marginally higher. Still notable to see they're almost back to that 420 mark that we were at before the press conference by Fed Chair Jay Powell, 417.63, and crude falling to the lowest levels going back to earlier this year on expectations that maybe we can get some sort of peace deal with Ukraine and Russia. Coming up, we've got Lucy Baldwin of Citi as investors go just a touch risk off. Terry Haynes of Pangea Policy as the healthcare fight continues on Capitol Hill. And Mike Pyle of BlackRock as Wall Street eyes a fresh read on the U.S. labor market. We begin this hour with stocks edging just a touch lower ahead of today's jobs report. Lucy Baldwin, Citi Global Head of Research, is bullish heading into the new year, writing further upside is expected in 2026 as earnings growth broadens, but elevated valuations increase downside risk. Lucy joins us now. Lucy, this seems like kind of threading a needle, and thank you so much for being with us. And we keep hearing this, and it's sort of, diversify, be nimble. We're a little worried that everyone else is bullish, but we're bullish too. I mean, how do you sort of just frame your sentiment heading into next year, being bullish when you know how consensus that is?
Yeah, good morning. Thanks for having me. Absolutely. Look, after a couple of amazing years for the stock market, to be expecting another good year for US equities in particular does feel like it's a high bar. But ultimately, what we feel is that the earnings backdrop for the S&P 500 looks incredibly strong. We, like many others, expect to see the Fed cutting a couple more times in the new year. And we think that is really quite bullish, really, to be cutting into that recovery. We think you're going to see the economy do pretty well in the first half of next year, again fueled by that fiscal expansion, the one big beautiful bill coming through, really helping to see growth move forward. So it is a pretty good Goldilocks type scenario, we think, for the equities market. Our view is you've probably got about 10 to 12% of upside for the US S&P, which is pretty good. And I think, interestingly, we feel the tech leadership will continue to dominate, but alongside that, we believe you can see that broadening, both in terms of the US market itself, but also around the globe as well. We think you can have another good year for some of the other stock markets around the world as well as for the US.
Lucy, just because the Fed is cutting, do the policy rates ease, right? Do monetary conditions ease? And I ask this because even though we have had 175 basis points of rate cuts by the Federal Reserve, you've seen 10-year yields actually rise by more than 50 basis points in that period of time. You've seen 30-year yields rise by almost 100 basis points. So at a certain point, are we seeing tighter financial conditions on the margin the more that some of these central banks ease, kind of creating a little bit of a fly in the ointment here?
Well, at some stage, you're right. There is a risk that, for example, the fiscal situation, if you've got lots of questions around Fed independence, again, coming back on the radar next year, you could see that bear steepening start to be problematic for risk assets. But we think they're kind of like threading the needle at the moment, really, in the sense that you've got this sort of Goldilocks backdrop of good growth, inflation that's largely under control. Basically, you've got, that right mix of drivers. I mean, clearly, everybody's going to be watching certain things incredibly closely in terms of risks for next year. But I think if you can see that growth continue to be strong, corporate earnings continue to power on, it's really that ideal scenario where you're able to actually cut into a boom. Now, it is obviously a bit of a jobless boom, which I guess is the big question mark, right? And it's the job side of the equation that is ultimately allowing the Fed to be easing into what we think is actually possibly going to be this re-accelerating growth picture in the first half of next year, which of course is really rather unusual. And of course, let's not forget, this year's been pretty unusual too. It's been the everything boom to have had things like the US equity market up strongly, credit go up strongly, but then also you've seen ultimately things like gold have a phenomenal year, up 60%. So it's been an unusual year this year, and we do think it's going to be a delicate path, but one where you can see that continued risk on momentum, certainly into the beginning part of 2026.
Lucy, I'd love to talk about gold with you and precious metals because I know you recently had Max Layton, Citi's Global Head of Commodity Research, on your podcast, and he was talking about the firm's out of consensus view on gold in 2026, i.e. he's a bit more bearish than the street. I was listening to you, and you didn't seem quite so convinced. I'm curious, the structural drivers that are underpinning the gold bull trade, I'm talking central bank buying, et cetera, do you expect that to continue, or do you see there room for downside in gold in the year ahead?
Yeah, look, I think, Max and the team have got some great calls going into next year, right? And one of those calls, as you say, is this view that actually the debasement trade has largely played out at these levels, right? And yes, you've got the structural central bank buying story, but ultimately, there's probably going to be more upside in some of the base metals. Things like copper, that's the sort of perfect, clean, cyclical play, if you like, or aluminium, which is ultimately competing alongside the data centers for power. So you're going to probably see some positive price momentum there. So we just think there's more upside in those base metals rather than precious metals, and gold is obviously in that equation. So for us, that debasement story has obviously seen a lot of momentum this year, but we think, our core view is ultimately that the central bank remains independent and very data dependent. So even if you have a more dovish backdrop for the Fed next year, we don't think that debasement trade runs on materially more. I think you will see that sort of slow, steady re-diversification continuing for central banks, but I don't think it's necessarily enough to give gold from here significant legs as we go into the first half of next year. So I would be with Max and the team in terms of looking for other metals to really drive some momentum in the first part of the new year.
Lucy, you and the team at Citi have been a proponent of the carry trade, the FX carry trade, for a while now. I think you're still an advocate of it. Talk to us a little bit about buying the high-yielding currencies versus the low-yielders. I mean, I think 9 out of 11 months this year, the carry trade has worked out well. Can this continue? I mean, talk to us about rate differentials. Talk to us about, currency investing, and what funding currencies stand out to you in the current environment.
Yeah, look, I think this is a big question after such a strong year, as you say, for sort of EM, FX and the carry trade. I think the conundrum we're all trying to grapple with is the dollar, right? We've had lots of debates on this. Dan Tobin, who's our FX strategist at Citi Research, he's got a really out of consensus call for the dollar, right? So that's quite interesting. He's much more bullish, the dollar, than pretty much the rest of the street. And it's quite interesting when our US chief economist, Andrew Hollenhorst, has still got 2 cuts for the Fed. So, what I think is quite a useful way of framing this is looking at what our macro strategy team says. So Adam Pickett, Dirk Willer, they talk about the dollar possibly going into next year, almost having a year of 3/3, right? So some risk that you get some weakness in the early part of the year as you're going into those continued cuts that we think you're going to get out of the Fed, 2 more cuts. And then they think, in that middle part of the year, you're going to see the dollar strength come back. And then maybe, to your earlier question, you get some risks later on in the year on the back of some of the steepening risk in terms of the back end of the US curve. So what does that then mean for EMFX? Well, I think, as we all know, right, it's very difficult for emerging market currencies to do well when the dollar is incredibly strong. So we're looking for those moments of opportunity, really, around that dollar backdrop, I think, when you're considering all the different options for different emerging markets.
Lucy, just quickly here, what's your black swan event that you're sort of gaming out that is an outlier case but could potentially be incredibly counter to consensus?
Well, I think the big events that we're all watching for is around the AI boom. There's the debate, is it a boom? Is it a bubble? Look, we're in the category that we think, even if you categorize it as a bubble because of the moves we've seen so far, you still want to own it. It's still got legs. If you look at the valuations of the leaders of this boom, we don't think they look stretched, right? The earnings upgrades we've seen have been significant. If anything, people have underestimated the earnings power of these companies. And I think even up until very, very recently, it's all largely been funded out of operating cash flow from the big hyperscalers. I know we've sort of entered a new paradigm in terms of potential risk because we've shifted from the fiscal boom post-COVID into more of a credit expansion, and everybody's watching to see where the leverage is building in the system. But we still feel this has got legs to run for sure, and a lot of growth. We obviously also think long-term structurally huge productivity gains that can be unleashed by AI as well. So we're bullish about it, but we're cautious. And we know that obviously there is risk as other areas of that ecosystem take on leverage and take on risk. Some of the smaller names that don't have the operating cash flows of the big hyperscalers. So that's obviously an area where we're watching for risks to emerge very, very carefully and very closely. But generally, I think, we're pretty constructive next year. The other big macro risks, of course, we're watching for are around fiscal. We've just written a piece looking at the US debt that position, an updated piece on the sustainability of that, because again, you know, that's something that's going to be very important for markets as we go through 2026.
Lucy Baldwin of Citigroup, thank you so much for being with us. And that last point that you were making, a real salient one, and we'll get to that in just a moment. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Rob Reiner's son has been arrested for allegedly killing his parents in their Los Angeles home. 32-year-old Nick Reiner is being held without bail. President Trump saying Reiner and his wife died of a, quote, mind-crippling disease known as Trump derangement syndrome. The comments drew wide criticism. Meanwhile, the U.S. military attacking 3 more alleged drug boats, killing a total of 8 people. The U.S. Southern Command saying the strikes were carried out in the Eastern Pacific at the direction of Defense Secretary Pete Hegseth. The operation raising questions about whether the strikes violate international law and whether the boats were actually carrying fentanyl. And Ford is taking a $19.5 billion in charges as it pulls back from electric vehicles.
The EV market in the U.S. went from 12% in the industry to only 5%. And that really, in the end, was the big decider for us. But look, we're going to 50% electric. It's going to be hybrids and E-revs and electric. It won't be just pure electrics.
Ford is also raising its profit outlook, saying cost cuts and a shift to more profitable vehicles are paying off. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahaira. Up next, a new fight on affordability.
The Republican legislation that will be on the floor this week does nothing to keep health care affordable for everyday Americans, and they know it.
Terry Haynes of Pangea Policy joins us next as we look toward the beginning of 2026. Which subsidies are coming, which aren't? This is Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
A bit of softness to start the day, but really pulling back from some of the earlier lows. Futures just indicated a touch lower after yesterday really having a whipsaw session. Although as the session grows older, really, you can't keep a good stock market down. It seems like it's the story every single day. Almost flat now on futures. Seeing that dollar weakness continue close to that 118 mark. Euro dollar 117.64. Yield is marginally higher, although really stable here around the 417 level. Let's take a look at crude. Traded on the NYMEX. We have seen crude prices absolutely tumble on a glut of supply coming from OPEC, coming from the United States. We see a new low since May for New York crude traded on the NYMEX down at $55.98. And a real question here about how much this is supporting, Damien, the idea that costs are lower, that at the pump you've got $1.99, as President Trump was saying, kind of supporting the disinflation narrative.
Well, more supply is coming online, Lisa. If you look at LATAM, offshore drilling off of Brazil, shale in Argentina, I mean, you can quantify this, and our friends at JP Morgan have. And if you look at the average price for Brent crude in 2022, which was about $100, it's now down to this year $65. And if you listen to them, it's going to be $50 to $55 range next year. So, you know, build that into your models. And what does that mean for inflation, specifically in emerging markets? I mean, there's your growth stimulus.
Right, and that's the reason why people keep watching what organizations like the International Energy Agency, what they say. They said recently that the size of the surplus in the oil market will be a new record next year. So really giving a sense that this could persist. Meanwhile, real question here about affordability more broadly. Under surveillance this morning, a new fight on affordability.
In just 2 weeks, tens of millions of Americans are going to experience dramatically increased health insurance premiums because of the Republican refusal to extend the Affordable Care Act tax credits. The Republican legislation that will be on the floor this week does nothing to keep health care affordable for everyday Americans, and they know it.
Here's the latest. Lawmakers scrambling to reach a health care solution with enhanced subsidies set to expire on New Year's Eve. The House preparing to vote on a slimmed-down health plan this week. Bloomberg's Tyler Kendall joins us now from the nation's capital. Tyler, do we have a sense of what the ramifications will be should these subsidies not be extended as widely expected?
Yeah, hey, Lisa, good morning. Well, our Bloomberg News estimates puts it at about 20 million Americans that could see their premiums spike if we do go over this so-called Obamacare cliff and the subsidies do expire. And at this point, it does appear increasingly likely that's going to happen as this White House has faced political pressure when it comes to the issue of affordability. This is really only going to compound it for Republicans as we head into the midterms. And that's why we're seeing right now two efforts brewing on Capitol Hill to address what many have said is going to be a healthcare crisis for millions of Americans. On one end, we're watching this vote that's going to happen in the House, this Republican-led package that does not include an extension of those expiring tax credits, despite demands from moderates that one should be included. Instead, we've heard repeatedly from Republican leadership that the plan put forward doesn't have those necessary pay-fors to offset the spending. So instead, they're pushing a separate proposal that does include plans to lower healthcare costs through other initiatives such as regulations on pharmacy benefit managers. The thing is, that's not actually expected to pass. It's likely going to fail, which means that the conversation continues, which actually leads us to this last-minute meeting that we saw last night on Capitol Hill among a bipartisan group of senators. And this is going to be a really important one to watch because senators came out and they said that their goal is to get a plan out this week, but likely not hold a vote until next year. The proposal on the table would be a 2-year, essentially retroactive extension to these expiring tax credits. I spoke to one aide who told me that maybe this could happen through some sort of rebate. We're still waiting on details there, but it would include those structural changes that Republicans want to see, such as an income cap or anti-fraud protections. Lisa, the thing is, though, the White House, we know, would probably like to see something different. President Trump has often said he wants more money going directly to American consumers. The thing is, he hasn't weighed in directly on any of these plans or thrown his real-hearted support among any of them, which means that this debate is going to continue to drag on. This is the last legislative session of the year. Lawmakers aren't expected to come back here to Washington until at least January 5th.
Tyler Kendall, thank you so much for that. Joining us now, Terry Haynes of Pangea Policy. Terry, how much are people counting on the idea that subsidies are going to fall away and healthcare costs are going to increase when they talk about stimulus coming down the pike in 2026?
Well, a couple of things, Lisa. One is that, work expands the time allotted to fill, and they've got a few more days here at least, or maybe into next week. So legislatively speaking, that's a lot of time. The mishmash of everything that's in front of them suggests a solution of a small bump in the current subsidies, bump forward into 2026, combined with a number of other things. But what markets ought to understand is that this is one step in a two-step game. There's almost certainly going to be a big, beautiful bill 2.0 next year, I think as early as the first quarter. Senate Budget Chair Graham's already been talking about it and already been talking about the need to do some more on Obamacare subsidies and on Medicaid next year. So what you're going to see here is a very interim Band-Aid solution, I think a little bit more likely than not, combined with the more likely 2.0 solution coming early next year. So there's going to be a lot of volatility in healthcare stocks as a result of that, but that can't be helped.
Terry, in yesterday's Wall Street Journal interview, Trump stated that he's not sure if his handling of the economy is going to, cause the Republicans to win the midterms. He's all but conceded defeat there. And I'm curious to hear your thoughts about this big, beautiful bill 2.0. What type of reforms, what type of legislation can we expect to find in that?
Well, a couple of things, Damien. First, I'd suggest that the jobs report may play a role in deciding what happens in the Congress this week. If the economy looks weak going into the holidays, I think there's probably a greater desire to do something to push back against that on healthcare precisely for affordability reasons. Secondly, what you have here, and there's already been some discussion on your program this morning about this, is you're going to have a lot of stimulus happening early in 2026. On top of that comes from the 2025 bill. On top of that comes 2026, which Graham describes as a little more of everything, a little more entitlement reform outside of Social Security, other than Social Security, a little more on Medicaid, a little more on tax, including expensing, a little more money for the military, probably something, if Graham has his druthers, on a minimum tariff, and I would suggest a lot more on onshoring manufacturing incentives, because that is key to speeding a more robust U.S. defense industrial base.
Terry, Polymarket currently assigns just a 27% probability that the Supreme Court is going to vote in favor of Trump's tariffs. This is down from a high of 53% just a few months back. What's the timeline here for SCOTUS, to give us any color? How do you believe the market's going to react if Trump's tariffs are voted down?
Well, I think, Damien, a couple of things. One is I wouldn't rely on Polymarket too much. That's if you're sitting around a roulette table, that's a bunch of people kibitzing behind you. So fundamentally, so would you rely on them for your results or for your advice? I'm not sure. But beyond that, firstly, I always push back against the idea that the court presumptively rules against Trump's tariffs. I think that's based on a flawed assumption that the court doesn't take the economic emergency seriously. So I think what happens is, at the very worst for the administration, they say they can't put the tariffs in place using that IEEPA authority, but there's plenty of other tariff authorities. Secondly, I think they probably give the Congress some time to fix the statute, and that's something you can do also in that 2.0 reconciliation bill.
Terry Haynes of Pangea Policy, thank you so much for being with us. And Merry Christmas. I see the stockings hanging behind you. Do you trust the people kibitzing behind you? Polymarket?
Well, I'll tell you this about Polymarket. People are risking capital there. So whether they're right or wrong remains to be seen. Maybe Terry should take the other side of that trade on Polymarket. Maybe 27% is too low.
Coming up, we'll be talking about M&A. We'll be speaking with the head of advisory and M&A for JP Morgan. This is Bloomberg.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Lizzie Burden outside Windsor Castle, England, and this is Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
A little bit of softness, although throughout the session we've seen a bit more optimism bleed in. Perhaps they read the Bank of America Global Fund Manager Survey that showed that cash holdings were down to an allocation of 3.3%, the lowest on record. What you are seeing is S&P futures barely lower, less than 0.1%. Similar declines in the NASDAQ and Russell 2000, so really pulling back from some of the earlier lows in the 2s, 10s, and 30s space. Real question about what the ramification, bigger risk scenario is from the non-farm payrolls report that we don't get on Friday. We get today at 8:30 a.m. Eastern. Right now, a real expectation that any kind of increase in the unemployment rate or decrease in the private payrolls figure could increase the chance of a Fed rate cut in January. 350 on the 2-year, been pegged around there. We have seen that 30-year yield continue to climb up just day by day, 4.85%. And if you take a look at crude, falling to the lowest since earlier this year, falling significantly this year, 22%, as we look toward oversupply. The idea that the IEA is saying that next year the glut in the oil market is going to be the most on record. 2 hours away from the cash open, here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. Ford is ripping up its EV playbook and refocusing on gas and hybrids, and investors are buying the story this morning with the shares up 1.1% in the pre-market. That's despite the company taking a $19.5 billion hit as part of the overhaul, which will include it scrapping a planned electric truck and repurposing a battery plant. Meanwhile, moving on to Zillow shares, they had their worst drop in 10 months yesterday and are still falling today, down about 1%. On this report that Google is testing a new real estate advertising format that could compete with Zillow. The report says that Google is putting listings directly in search results and putting full property details along with it. Meanwhile, we end on Gap shares. They are rising 2.2% on some sell-side action, with Wells Fargo upgrading the stock to overweight and setting a $30 price target. They're saying that they're seeing real momentum at Old Navy and Gap, and there could be extra upside if tariffs are repealed. They're also saying that Gap is one of their favorite long ideas. Lisa?
Thank you so much, Yahira. On our radar this morning, NASDAQ looking to extend its trading hours to 23 hours a day. The firm asking the SEC for permission to add a trading session from 9 p.m. to 4 a.m. Eastern. Damian Sasser will be awake. NASDAQ expecting to be ready for extended trading in the second half of 2026. Not a huge surprise. I mean, this is the modern age. Everyone needs to be doing everything all at once.
Well, the New York Stock Exchange is going to be doing it also. They're all following in the heels of Robinhood and Interactive Brokers. But what's interesting is, will the DTCC be ready to clear those trades in time for this to actually go live in 2026? I mean, we're talking clearing. This is not easy. This is hardcore settlement of huge block trades. It's going to be more complicated than that.
Yeah, and if you open, will they come? Because people maybe are going to be asleep and then you won't have the liquidity. Meanwhile, PayPal applying to become a bank in the United States. Approval would help the firm bolster its small business lending capabilities. The company has provided more than $30 billion in loans and capital since 2013. PayPal also looking to offer interest-bearing savings accounts. I remember when people looked to intermediate the banking sector. Now they're joining it.
Well, this comes on the heels of those preliminary approvals for those crypto firms, right, like Ripple and Circle getting applications last week. And I think earlier this year, Sony and Nissan Motor also applied for it and received the banking license in the U.S. So legislation is becoming a little looser, allowing some of these entities to list as a bank here in the U.S.
Yeah, my oldest son tried to apply to me to list as a bank, and it was rejected. OpenAI's deal to license Disney characters for its Sora video app is entirely in stock warrants rather than a cash licensing fee. The terms aiming to align both companies' financial incentives. Disney is taking a $1 billion stake in OpenAI, and we want to stick with the deal picture because we've got the person who really has the best handle on this space that is going to be incredibly active in 2026. Global M&A transactions rising about 40% to $4.5 trillion this year, and the mega merger landscape could grow even larger in 2026. Anu Iyengar is JP Morgan's global head of advisory and M&A, and she joins us now to discuss this inflection point in deal making. Anu, thank you so much for being here.
Happy to be here, Lisa.
So let's start with just how much more space there is for the likes of some of the mega deals that we've heard announced, how much more appetite there is in capital markets, and how many potential contenders there are still out there.
Yeah, it has been a bit of a roller coaster ride. Sitting here today, it looks like a fantastic M&A market. But if we were having this conversation even 6 months earlier, I think the picture would have looked dramatically different. We've seen an increasing trend. Really, the conversations in the boardroom kind of picked up in May, and you saw the printing of the deals happen August onwards. And every month has been bigger than the previous month, to now 70 what we call mega deals, right, rather than $10 billion deals, which is an all-time high. But yet, while the volumes are 40% up, the number of deals itself has actually been down, right? So because of this mega deal trend that you see. Having said that, what is driving that? Why are people focusing on scale? The equity markets have really given a premium to scale. The size of a company to join the S&P 500 has tripled. The size of a company to join S&P 600 has doubled in the last 5 years. So that's a pretty dramatic focus on scale. And people are not just chasing size for the size sake, because it's not any type of scale. It's strategic scale, focused scale. Because at the same time that you've seen these scale transactions, the market has also wanted corporate clarity. You've seen spins, splits, reverse mortgage trust transactions. So sometimes it can be a bit confusing, right? Okay, you want scale, but at the same time you want focus. Like, how does the two things come together?
What's fascinating is a lot of people have taken a look at the M&A schedule and said this indicates CEOs feeling confident about the economy, feeling confident about capital markets. The way you're framing it sounds slightly different. It's the idea of an opening to get in on a scale game at a time when that indicates resilience. Post-pandemic, post-tariffs, the more scale you have, the more ability you have to negotiate and be nimble. How is that different than just screaming confidence about the economic cycle?
No, you're exactly right, in that the driver of it is not, I feel good about the world, let me go do M&A. The driver here is very different. The driver is that scale allows you to have more control over your supply chain, allows you to get synergies and invest more in tech capabilities. The amount of AI infrastructure investment that the economy has needed these are big numbers. So to make this type of capital investments, companies need synergies from this combination to do that. And when the external environment is so volatile, there's a lot of uncertainty. That hasn't gone away. Larger companies are able to withstand the risk in the system better and navigate it better. So there's a reason why the market is giving a premium to scale. And that's what people are chasing. So most of these deals are not, people thought of this deal today. These deals have been, there are files and binders put together over 5 years where CEOs have said, this is a company that we should buy, but I don't know whether they are open. I don't know whether other people will look at it. Is it the right time? Will my investors support it? And these are finally happening now because there's also an expectation that in addition to the market rewarding scale, the regulatory environment may be, in certain cases, easier to navigate. So you take kind of the combination of all three factors, right? External market risk allows you to navigate better when you have the scale, and market values scale and gives you a valuation premium, which has been an all-time high, the scale-related valuation premium, and a regulatory environment that may be more favorable for M&A, put all of those things, and that's the perfect recipe for the market that we are in.
Anu, JP Morgan Chief Interest Rate Strategist Jay Barry is calling for the Fed to cut rates again in Jan before pausing to take stock of the economic outlook, right?
Yeah.
And I'm just curious, how are interest rate expectations shaping the boardroom when you're having conversations with JP Morgan's corporate clients?
Yes, I think this has a bit more of a focus on the private equity community and sponsor activity. For most of the strategic deal activity that is happening, there is no dearth of financing, or that is not a big consideration, that interest rates are going to be 25 basis points here or there, because people are taking a long-term view on what is going to happen in my industry sector. How do I become an endgame winner? What are the chessboard moves? On the private equity side, there has been a little bit of, you've seen that we haven't had as many monetizations in 23 and 24, and there's a lot of pent-up assets waiting to find monetizations. Even though, at the same time, you also see take-private activity, right?
Yeah.
And you may wonder, how does it make sense to do take-privates? Because every day you're talking about S&P at record highs and NASDAQ at record highs. Having said that, there are some companies which are at record highs, but there's a significant part of the market which is not. They are trading at a deep discount to the 52-week high. And the scale issue, if you're a sub $5 billion market cap company, there's a lot of companies in that space whose public market valuation doesn't reflect their true value.
Well, Anu, you mentioned financial sponsors, and I hear you. They are sitting on record levels of dry powder.
Yes.
But private credit is consolidating, and private equity fundraising has been sluggish, to say the least. So talk to us about which sectors are going to drive the deal cycle as we look ahead to 2026.
So these mispriced public securities are still an opportunity. And then another interesting trend you've seen is the partial monetization and continued ownership, and every version of that. We were talking earlier about continuation funds being one element. So this year, 20% of the sponsor monetization has been through continuation funds.
That's right.
And the secondary market has increased significantly to now you have several GPs who are raising secondary funds. So that's going to be a pretty interesting dynamic, right? Because earlier, there was a sense that, oh, an asset that I cannot take public or I cannot sell, I may put in a continuation fund. Right. Whereas now the dynamic has shifted to some people saying, look, this is my best asset. Why is it that I'm selling that one and keeping the rest? Maybe this is the one that I should put into a continuation fund. And the amount of money that is available in the liquidity in the secondary market is extremely high. So some very interesting dynamics happening in the broader private equity space. At the same time, when many of the private equity companies itself are transforming. They're all now alternative asset managers, right? They are not just in the LBO activity. In fact, for some of the large funds, LBO activity is a small slice of what it is they do, and they play across the capital structure as well. So that has changed the flavor of both deployment and monetizations.
Just quickly here, Anu, next year, do you think it's going to be as great as people think in terms of so much more M&A volume than it was this year, incredible deals activity, and a broadening out beyond the mega deals?
So the momentum is very high, and when we look at our pipelines, both on the strategic side as well as the sponsor side with the number of companies that need to monetize, it's very high. Having said that, there are risks, right? We are still in the middle of several geopolitical conflicts. There has been a favorable environment, interest rate cuts, all of this that people are expecting and pricing into the market. And there is also this question of what happens with the amount of money that is going into AI. I read a very nice quote from somebody which said, AI's New Year resolution is ROI. And I was like, that's about time, right? You think about what is the return on all this money that you're putting in? What should the KPIs be? How should I measure the impact and result? So there are some things that you have to watch to see if this trend will continue, but the appetite is there, interest is there, and the financing markets are there.
Anu Iyengar, thank you so much for being here. Hopefully we can do this again. JP Morgan's Global Head of Advisory and Mergers and Acquisitions here in New York. Right now, let's get you an update on stories elsewhere. Here is Yahira Anand with your Bloomberg Brief.
Hi, Lisa. President Trump is classifying fentanyl as a weapon of mass destruction in his latest push to ramp up pressure on Latin America over drug trafficking. Trump allies saying such a move can open up access to funds appropriated for detecting and eliminating weapons of mass destruction. Meanwhile, Kraft Heinz announcing a shakeup to its C-suite, tapping former Kellanova boss Steve Cahillane to take over as CEO on January 1st. He's stepping in to navigate the company's massive plan to split into two separate entities. The move comes as the food giant struggles to win back shoppers who are ditching processed staples for healthier options and cheaper brands. And in sports, the Pittsburgh Steelers beat the Miami Dolphins on Monday Night Football 28-15. Quarterback Aaron Rodgers had one of his best games of the season, throwing for 224 yards and 2 touchdowns. The Steelers improved to 8-6 and remain atop the AFC North, while the Dolphins are eliminated from the playoffs. The Steelers haven't lost a Monday night game at home since 1991. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the labor market mandate.
They will have to keep cutting interest rates if we don't see any strength. We expect the October payroll to show contraction of 60K, which then rebounds into November, but that does not paint a very good picture of the labor market.
Mike Pyle of BlackRock joins next. This is Bloomberg Surveillance.
In case you missed it, on Bloomberg Crypto.
There's a debate going on right now in DC that I think folks need to start paying more attention to, and that is the yield. And the question really is, who is going to keep the yield? Who makes money off stablecoins? Well, right now, in the case of some of the large stablecoin issuers, there's a yield that on those deposits. So when there's a dollar, for example, deposited in a bank account, there's interest paid on that dollar. And so who's capturing that yield? And I think one of the really interesting things about the Genius Act is that it bans so-called yield-bearing stablecoins from giving that yield directly back to consumers. Now, that's not true everywhere. And I think if consumers have a choice, why would a consumer want an institution to keep that yield? Or would there be sharing of that yield? So right now, one of the debates going on is, will rewards be allowed? And I think these are really important questions.
Don't miss Bloomberg Crypto live Tuesdays.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Well, the longer the session grows, the more people take a look at stocks and say, well, maybe we still will get a Santa Claus rally. Right now, futures had been lower by as much as 2 or 3 tenths of a percent. Right now, less than a 1/10% on S&P futures. Dollar weakness continuing and building close to that 118 mark on the euro-dollar cross, and 10-year yields actually now getting a bid, 4.16% lower by almost a basis point. Under surveillance this morning, the labor market mandate.
The Fed's mandate is not what headline GDP is doing because of all of the CapEx investment we're seeing. The Fed's mandate at the end of the day is labor market. They will have to keep cutting interest rates if we don't see any strength. We expect the October payroll to show contraction of 60K, which then rebounds into November, but that does not paint a very good picture of the labor market.
Here's the latest. Investors looking to gain clarity on the Fed's direction in 2026 from the November payrolls report. Mike Pyle of BlackRock saying continued softness in some of the labor indicators could bring another 25 basis point cut into the mix for January. Mike joins us now for more. Mike, great to see you. Thank you so much for being here.
Great to see you.
So I hate to do this, but is bad news good news for markets if we do get potentially a 25 basis point cut in January? I'm sorry, and I'm sorry, Stuart Kaiser.
So, I mean, I think what I'd say is, listen, there is definitely a world where activity continues to be relatively on the firm side, where the labor market is comparatively soft, and that opens the door to additional easing from the Fed and financial conditions. And that mix of relatively firm activity and relatively easy financial conditions historically has been positive for markets. Not that that's going to occur, but there's definitely a clear pathway to that kind of outcome as we look forward the next 1, 2, 3 months.
Mike, in late October, you made the case for buying a basket of hedge funds or hedge fund strategies to build ballast into diversified portfolios. And you and I both know the difficulty with investing in hedge funds. I'm talking lockups, gates, subscription fee, everything. Talk to us about how you would go about doing it. Are there ETFs? Are there index funds? Are there easier, less expensive ways for a high net worth or even a retail investor to get access to the asset class?
Yeah, so I think the key point is to say diversification is hard in this environment, and on balance, market neutral strategies can be a key way of building diversification in portfolios in a world where traditional diversifiers like long-dated government bonds may be less reliable looking ahead. There are a range of ways of doing that. There are liquid alternative portfolios. There are kind of more traditional hedge fund portfolios. But the key point is there are a range of access points to finding strategies that are more market neutral, more geared to this moment in macro. And I think that that's an important element of what investors should be looking for.
Mike, dollar weakness. I mean, you travel all over the world. I mean, you speak to some of the biggest, largest institutional investors. We know what happened post-Liberation Day about the FX hedging. All the foreign investors in the U.S. equity market started hedging their portfolios again. How are they doing that? Are they using non-deliverable forwards? Are they using options? Are they doing it in a conditional way? If you're a foreign investor and they come to BlackRock and they say, we need to hedge our exposure, how do you recommend they do that?
Yeah, so I mean, I think the theme is exactly right. And I think what we consistently hear from investors around the world is we want to maintain our exposure to U.S. equity markets. We think that there's something unique that U.S. equity markets are providing that we can't source elsewhere globally, in particular a set of technology and AI exposures. But, we're more cautious on the dollar. And, I think oftentimes that means that, they've let their hedge ratios kind of run with the market run up in the U.S. And it's more just a matter of kind of getting back to home base with their traditional hedging programs rather than necessarily doing something kind of meaningfully new or different. I would offer one additional point, which is, I think it's noteworthy that 2025 has been a year of dollar softness, but most of that dollar softness was built into the first few months of the year. It's really been steady as she goes since the summer, and steady as she goes even in the face of the Fed being kind of more aggressively priced into markets. And I think that's noteworthy. It's suggestive of something else we've been saying all along, which is, yeah, the dollar has been softer, but we shouldn't overread that. The bid for U.S. assets, including the dollar, on balance continues.
Well, how much does this really raise a risk, though, heading into 2026? The idea that people have put that story aside of the dollar debasement trade and really look toward the AI growth, some of the strength that we could see in the economy and the stimulus as being a positive. Do you think that that is the trade to follow, or do you think that's the trade to lean against?
So I'd say it's both and. Simultaneously, you know, a key driver of returns in 2025 and likely in 2026 and beyond is going to be that core technology exposure, that core AI exposure, which again, rooted in U.S. equity markets. At the same time, you know, particularly with U.S. equity markets and global equity markets becoming more and more concentrated, it's important to be really intentional about how to size that exposure and build diversification. And that's why, you know, to your earlier question, Damien, that balance between sourcing that core driver of returns around AI, but balancing that and diversifying that in an intentional way, including through things like market neutral strategies, we think is the right way to be building a portfolio as you go into 2026.
It seems like right now investors think that you can have your cake and eat it too, with the idea of stimulus coming down the pike, fiscal, monetary, as well as just a better than expected backdrop for GDP. Scott Besson talking about 3.5% GDP growth by the end of next year. At the same time that people don't think that inflation is going to be a problem. What has to give, or is this actually a correct way of looking at the universe, that you can have growth, you can have rates at this level without seeing inflation kick off or some potential pushback to monetary policy easing?
So, you know, what I would point attention to, which is something we've been drawing attention to, is, you know, just how unusually wide the potential range of outcomes is on the macro side. And you need to look no further than the dot plot at last week's Fed to see how true that is. I mean, there's always, you know, some divergence of opinion among members of the FOMC, but if you looked at the dot plot last week, whether it's 2026, 2027, or the longer run, really historically wide kind of variance in terms of where members of the FOMC think the Fed might go. That is reflective, I think, of just a broader theme, which is the macro environment is unusually uncertain. The traditional macro anchors that have undergirded macro asset allocation are more unstable than they have been for some time. And that's why this kind of approach of, you know, identifying those core sources of return like AI, but also taking a pretty intentional approach about where to source diversification in an unusually uncertain backdrop is, we think, both new and different and hard, but also the right way to go about it.
Mike Pyle, wonderful to see you. Thank you so much for being with us this morning. Mike Pyle of BlackRock joining us here, and that diversification we keep hearing time and again. Paul Quincy of JP Morgan saying the same thing, looking for new sources to try to counterbalance some of the overweights.
But staying mindful of liquidity, right? Because, I mean, it's one thing to say I'm just going to invest in anything, but the liquidity of that asset class and building sort of a liquidity profile, I think, is absolutely critical given just how volatility has come off in this year and probably will remain low next year.
Right now, visibility hasn't been exactly great, especially without data. We get some data coming up. We do get that payrolls report in about 35 minutes time. Coming up, we got Mandy Zhu of CBO, Michael Collins of PGIM Fixed Income, Francis Donald of RBC, Jeff Rosenberg of BlackRock, all responding to the economic data that we have been waiting for. From New York, this is Bloomberg Surveillance. Good morning.
In such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bringing you up to them in the news whenever and wherever it happens. I'm Sherian in Seoul, and this is Bloomberg.
Payrolls we think are weak, and we think the risk is on the downside.
Our own forecast has the labor market looking quite resilient in 2026.
The Fed's mandate is not what headline GDP is doing. The Fed's mandate is the labor market.
If the labor market is clearly weak, the Fed's cutting a lot more than what's priced in.
The Fed is not going to solve the labor market.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
30 minutes to go until we get the data that we've been waiting for more than a week. Good morning. Welcome back to Bloomberg Surveillance. Everyone's optimistic for next year. This according to the Bank of America Fund Manager Survey. Stocks haven't been keeping up. They're sort of flirting with momentum this morning into year end as investors look for a show me moment. Perhaps they'll find a show me moment in the data. Finally, we are going to be getting that non-farm payrolls report. Of course, we're also going to be getting October retail sales. All of this incredibly dated. Nonetheless, Damian Sassower, who has been alongside me for this ride, honestly, at least we get something, and I think that's what a lot of people are looking for.
Yeah, I think the markets have looked right through it. I mean, if you check my Aura ring, it's probably, I've been sleeping through most of today. I mean, I think it's really about options, it's about volume, it's about volatility, and we've got some great guests who are going to tell us all about what the market's telling us.
Yeah, right now the market's telling us that it wants to see some action. It is basically range bound as we head into that key question. Right now we see just a little bit of a decline in the S&P futures, lower by less than 0.1%. Meanwhile, dollar weakness continues and builds almost at that 118 level. A bid into bonds, 416, and crude at the lowest levels going back to May. A key round of data on deck today, as we were just talking about. Francis Donald of RBC writing, we expect that 93,000 jobs were added to the U.S. economy in October. For November, we expect that an additional 89,000 jobs were added. We anticipate that the unemployment rate will hold steady. Francis is our guest host for the hour. Francis, thank you so much for being here with us.
Thanks for having me.
Great to see you. So just to start off, I mean, what is sort of your expectation and what are the details that are most important in today's report?
Look, there are two jobs for economists right now. What is non-farm payrolls going to print on our screens, and then what's happening in the underlying economy? So our estimates might sound really bullish. They're not effectively. We know that these numbers are probably overstating to a certain extent. They will get revised downwards, and we know that a lot of the job creation is structural sides. Healthcare, for example, that are adding. If we get a big number today, it's not necessarily a reflection that this economy is firing on all cylinders. And so there's two jobs. There's, of course, what the number will say. We say 90,000. And what's actually happening, which is probably the labor market is weakening under the surface. And what we look at today is going to be the sum of so much information from retail sales to non-farm payrolls to try to give us a sense of just how much it's weakening under the surface.
I just wonder how much people are going to look at the data and say, hold on a second. Yes, okay, we get 50K if that's what we get. We get this idea of an unemployment rate rising to 4.5%, but it's so messy that it doesn't really change anything based on the other information that we're getting. Do you think that that's going to be the narrative coming out of this?
Well, it certainly keeps economists employed, and the number that I keep thinking about is 40,000. 40,000 is our estimate of break-even employment, which is effectively how many jobs does this economy need to create, and are we creating more or less than that 40,000? So every time I see a non-farm payroll estimate, my guess is it going to be above or low? That's going to actually determine where the unemployment rate is on a go-forward basis. That's what will matter to Americans, to the Federal Reserve, and ultimately to markets.
And what about inflation? What about CPI? We get that print at the end of the week. And look, I mean, we do get another payrolls print before the next Fed meeting. I mean, talk to us about the importance of those two kind of events between now and middle of January.
I'm more focused on CPI because of what it will tell us as to where we're going next. But the story with inflation is really an uncomfortable one, not because it's too high or too low, but because it's kind of stuck in that middle. We see inflation really navigating around 3%, a little above in the first half of the year, a little below in the second half. What do we do with that? Well, it depends how the Federal Reserve responds to it, and how do consumers respond to it? Well, it depends where that inflation is. Is it going to be in food prices? Is it going to be in electricity? Well, that's going to be more painful for this consumer base in the U.S. than, let's say, if it's in autos or purchases that we make every once in a while. So the composition of inflation, I think, is going to become even more important on a go forward.
And a real question here about what markets are pricing for. Francis Donald of RBC, you're going to be sticking with us for the hour. Coming up this hour, Mandy Zhu of SIBO Global Markets with stocks just edging a touch lower. Michael Collins of PGIM Fixed Income as investors await that November payrolls report. And Jeff Rosenberg of BlackRock and what the latest data means for interest rates for the Federal Reserve. We begin this hour with stocks looking to avoid a third straight day of losses. Mandy Zhu of SIBO Global Markets saying, despite the recent slide, AI fears are subsiding within the options market. She writes, even on Friday's pullback, most of the flow we saw was investors stepping in to sell volatility. Mandy joins us now. Mandy, great to see you. Thank you for being here.
Good to be here.
So before we get into the AI trade and the broader sort of markets, I'm just wondering how the market is positioned right now from a derivative standpoint heading into this labor market report. What would the bigger surprise be?
I think with how they're positioned is not expecting a whole lot from this number. So if you look, for example, at our VIX one-day index, which tells you how much volatility is being priced in for the next 24 hours, it closed at around 12 yesterday. So that's pricing about a 75 basis point move for today. That's not a lot compared to how markets historically have reacted to payrolls, how they have reacted this year. So I think that what the options market is telling you is that regardless of what the number says, it's not really going to change the pricing for the Fed. It's not really going to change the overall narrative too much, given that part of this data is stale. And I think the Fed's going to wait for more data before the next meeting.
What's interesting to me is this idea that markets are looking much more to earnings and less to the economy. And we see that increasingly. This is a market driven on AI investment and efficiencies. And honestly, if you get a jobless recovery, it's not a problem. At what point does that change, or is that really the new market dynamic?
I do think it will eventually change. So one of the key themes that we've noted for this year is people really underpricing kind of the macro risks. If you look at implied correlations in the market, it's at historic low levels. Basically, that's the market telling you that this year it's all about single stocks. It's all about earnings, fundamentals. It's all about thematic trade AI. But I think, and it kind of depends on where the AI trade goes. But I do think next year, if, as we know, labor market is weakening, depending on how much it weakens, could we see more correlation being priced into stocks? That will boost index volatility. That will give, a higher floor to the VIX. So that's something that we're watching to see how much macro risk is being priced into the market versus idiosyncratic risk.
Mandy, we began the conversation by talking about today's event risk, and you referenced the zero-day options market, which, by the way, is a $2 trillion market, up 70% year over year.
Yeah.
who are the marginal risk takers in that market? Is it retail? Is it institutional? Talk to us a little bit about the read-through in terms of who's actually taking advantage of that market and what it's telling us.
Sure. It's actually fairly balanced. So from what we see, about 50 to 60% of the flow is actually coming from what we think are retail investors and 40 to 50% from institutional investors. And that, I think, surprises a lot of people because index options and options generally historically have been more thought of as sophisticated institutional tools, but one trend that we've seen over the past 3-4 years is retail getting more and more involved with options and more sophisticated in how they're trading options. I think a lot of people have this incorrect assumption that retail is just using options to speculate. They're buying options, take a view on the underlying market, but we actually see very, very diverse strategies being employed, both retail and institutional through, spreads, selling spreads for income. They do sometimes speculate, but it's very balanced, and people use it for hedging purposes as well.
Well, Mandy, you were taking me right to where I want to go. I mean, vol is at historical lows or near it in equities and rates and FX, you name it. But talk to me about the cost of putting these custom baskets, these hedge structures on. I mean, in your professional opinion, are they indeed getting less expensive, or are there just more option legs to the custom basket, which is basically keeping things inflated? I mean, if I'm an institutional investor and I come to you and I want to buy some recession hedge, has the cost for that really cheapened in this environment?
So if you look at the cost of hedges, they have cheapened because overall levels of volatility have gotten lower. Where we are seeing hedging demand is really kind of tactical hedging. So going into year end, we've seen really a pickup in hedging demand. But if you look longer out, like say 3 months, 6 months, really not seeing a ton of hedges being put on in this environment. And the cost of hedges actually fairly low by historical standards. And then when terms comes to custom basket, that is a theme that we've seen a lot of people looking to trade themes in the market in a more efficient way. Now, if you're an institutional investor, sure, you can go to a bank and get a custom basket on. But what we've gotten a lot of demand is a more effective way of trading that. So we actually recently launched last week our Magnificent 10 Index Options, which is an index of 10 tech and AI stocks that give people a more effective way of trading that theme. Now it's just one index, one underlying. And for retail who can't access, thematic baskets, I think that's also a great tool in order to really trade and hedge this tech AI theme that's kind of on everyone's minds.
Francis, I have to say, as I hear Mandy talk, all I think is no one's worried, no one's worried, no one's worried, at least not in markets. And then when I talk to an economist or someone who's looking at what's going on in the labor market, they say, we're concerned, we're concerned, we're concerned. Where's the difference here? Where does the gap get bridged?
Well, I think it's how you deal with uncertainty. So you mentioned earlier, our markets are looking to earnings, not the economy. I think it's because we have very little visibility on the economy. So what do you do when you don't have full information? Well, economists like to worry about the risks to one side or the other, but if you're trading, if you're taking a market position, then that tells you there's no big bets to be made in play. So it's the same state of play. It's not, in my opinion, that everyone is reading the information differently. It's what your job is and how to react to it and what your position in uncertainty really looks like.
And if it is a single stock based market, Mandy, just to finish here, is this a more stable market? One that's actually looking more at the fundamentals, or is it a meme stock craze market that's driven by what people are reading on Reddit?
So it's not meme stocks. I think where we're seeing the option activity, it's not pure speculative. But in terms of is this more constructive? Certainly, if it lasts, right? So the high dispersion, low correlation environment is dampening index volatility. It is one of the drivers of why the VIX is so low or has been so low this year, April notwithstanding. But as we saw with April, things can change very quickly. So what happened in April is we had a big catalyst, big shock. Markets repriced very quickly. We had significant increase in correlation levels, and that drove the VIX over 50. So as we head into next year, could that change? Could, as the economy starts to weaken, if it weakens, I would expect higher baseline volatility, higher demand for hedges, and higher levels of correlation that could all really keep the VIX elevated.
Mandy Zhu, great to see you. Thank you so much for being here. Mandy Zhu of SIBO Global Markets, thank you. And of course, Francis Donald will be staying with us through the hour. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. The manhunt for the shooter who killed 2 students at Brown University is entering its 4th day. Rhode Island Governor Daniel McKee and other officials have said there's no clear security camera footage from the building where the shooting took place, which has hampered the search. The FBI is offering a $50,000 reward for information that leads to an arrest and conviction. Meanwhile, the European Union will effectively end an upcoming ban on combustion engines. Sources telling us here at Bloomberg, the European Commission will lower requirements that would stop sales of new gasoline and diesel-fueled cars in 2035. The new rules will allow for plug-in hybrids and electric vehicles with fuel-powered range extenders. And PayPal has applied to become a bank in the U.S. The payments firm is looking to take advantage of the Trump administration's openness to fintech companies entering the banking system. The company says if approved, a PayPal bank would help strengthen its small business lending capabilities. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, the morning calls, plus the latest ADP employment data set to cross in about 2.5 minutes. Michael Collins of PGIM Fixed Income with us to break down those numbers and preview the payrolls report on deck in about 18 minutes' time. From New York City, this is Bloomberg Surveillance.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Astonishing day for U.S. technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
There might just be some unusual amount of noise. There's going to be a lot of information. We're going to be watching that quite closely to gauge to what extent the hiring might actually be starting to pick up. There are a lot of different tailwinds that sort of support the economy, even though you have seen a bit of a backup in rates. So the more cyclical, interest rate sensitive parts of the economy might still struggle, housing in particular.
That was Stephanie Roth of Wolfe Research as we await a key slate of economic data after waiting for so long for that information. The expectation for non-farm payrolls is 50,000 on the headline number. People are expecting the unemployment rate to rise to 4.5%. Meanwhile, we are seeing in markets a little bit of softness, at least in the equity space, a little bit of a bid into bonds as the session grows older. Not exactly an incredibly dramatic morning. A little bit of dollar weakness, but crude very much front and focus with prices down to the lowest levels going back to May, down 1.7%. Francis Donald's here with us for the hour. And Francis, we've been talking about how it's really a muddled moment, given the fact that the data is something you can choose your own adventure with, and it seems hard to get a clear narrative on.
Yeah, I think we're really used to in the past several decades having a clear business cycle. We go through a recession, we go through a boom, we go back into a recession, but we're not operating in that type of economy anymore. This is a supply side driven, less interest rate sensitive type of economy that is going through a myriad of cross currents, from mass retirements to tariff shocks. So if you're looking for a clean read, you're not gonna get one. You kind of have to work through lunch and realize that there's many sub themes. For investors, that's a good deal. It means that there are opportunities as well as risks in every headline number, but it means we probably can't put too much weight into anything, even an NFP, which of course will get a myriad of market reactions, but the data is going to tell us one story and the true economy economy is another one underneath the surface.
Yeah, and then another one is the corporate story. We do have some economic data. Before we get there, time now for the morning calls. First up, Bank of America upgrading UBS to buy, believing it is set to grow EPS at the fastest sequential pace of any bank. Those shares up at 2.5%. Next up, Morgan Stanley double upgrading Roku to overweight, predicting growth will accelerate in 2026, likely ahead of consensus. And finally, Mizuho raising its price target on Tesla to $530, seeing better investor sentiment on robo-taxis. Turning to the economy, as we were just saying, ADP just crossing with the latest number. And Bloomberg's Michael McKee here with the numbers. Mike, what do we see?
Well, perhaps the least anticipated number of the day, ADP's weekly job survey says that in the 4 weeks to November 29th, the economy added an average of 16,250 jobs. That's a significant increase over the 2,750 for the week before. But this is a new indicator, at least as far as releases, and it doesn't seem to have much of a track record in predicting anything. Of course, it's been mostly out since we haven't been getting government data. So it isn't clear that this is going to mean a whole lot, but that's the number for those of you who are tracking it.
Michael McKee, stick around for the other numbers that we get, including non-farm payrolls from November. But let's just stick with the labor market, especially ahead of that data. Michael Collins of PGIM Fixed Income joining us now. Mike, first of all, how do you handle this ADP weekly number? Do you just completely discount it, or is it something that increasingly you put into your dashboard?
No, it's great, Lisa, to have more concurrent data, more timely data, like the weekly jobless claims is something that, for 30 years I've always been analyzing. And yeah, you do maybe a 4-week moving average, but the more timely the data, the better. And obviously the market, there's been a dearth of timely data. So all the data is welcome. As you know, we and economists and the Fed kind of take the whole cacophony of data, put it together and try to come up with a direction for the economy, a direction for the labor market, a direction for inflation, right? And it just feels like the direction is very uncertain right now, even though, I kind of expect the labor market to show continued weakness, notwithstanding the ADP little pop we got this morning, and, inflation probably to continue to moderate a little bit, right? So those are generally good conditions for the Fed and for financial markets.
Well, Michael, given the noise surrounding the headline number today, talk to us. What are you focused on? Is it private payrolls? Is it average hourly earnings? Is it retail sales? What are you going to be really focused on here at 8:30?
Yes, yes, and yes, right? We have it's like a holiday parade of data, right? And the question is at the end, do you see Santa Claus or the Grinch? And, right now you have to look at all of it. The consumer is super important here. So all the retail sales data, and obviously, we have, hundreds of analysts who are parsing all the actual underlying bottom-up retailer reports every day. And, you're continuing to see actually probably an acceleration in this K-shaped economic behavior, right, where the wealth effect is driving half of GDP right now. The other half of GDP, for what it's worth, is driven by, tech and AI-related CapEx. So the U.S. economy is basically running on a pretty fragile two-legged stool, right? So those are really important factors that we're trying to assess and looking for cracks in. The weaker sectors of the consumer are really showing continued signs of weakness. So that's really important. The jobs data is really important because it's a reflection of the broad base of consumer demand. And it looks like, based on anecdotal evidence, you're seeing, layoffs announced every day by big companies and all this data that we're getting. It just looks like the labor market, job growth is going toward zero.
Michael, it seems everyone and their grandmother is calling for the U.S. Treasury curve to steepen in the year ahead. I'm just curious, a steeper yield curve, what does that mean for foreign investment? Do you think foreign investors are going to find value in the U.S. yield curve if it steepens or continues to steepen at the current pace?
Yeah, I always push back on this narrative that the yield curve is going to, steepen on its ear, right? That the front end will come down, and it has come down, right? The Fed has cut almost 200 basis points already. So you've had a pretty big steepening in the yield curve. 230s is actually very steep right now. But a lot of people think, oh, the Fed's going to keep cutting, especially if you get a newly, more dovish Fed FOMC committee. The front end maybe goes down. Instead of stopping at 3, it goes to 2.5, and that hurts the back end. That causes the back end to go up. And I push back on that for the reason you just stated. When the curve is that steep, now this is a little, inside the yield book baseball kind of stuff, but the roll down you get, the returns you get by owning those longer duration bonds as they turn into lower yielding bonds, they actually have capital appreciation. And those expected forward-looking returns become so big and powerful, and the bond market becomes a tailwind when you have a steep yield curve. It will bring in buyers, right? And we've already seen the last handful of auctions we've had have actually been, solid, if not outright strong, right? I mean, we still have some of the highest yields in the world in the U.S. relative to, China and Japan and Germany, or, their yields are half or less than half of ours, right? And those are the big bond markets in the world. So yes, it will bring in foreign buyers. It will bring in U.S. buyers. It will cause U.S. investors to add duration, to add interest rate risk, to go from a 1 and 2 duration bond portfolio, which is where a lot of high net worth and retail investors are kind of hunkered down right now, to extend on the yield curve. So I think the narrative that the back end of the curve is going to get killed and kind of flail around is really misguided.
And a lot of this also has to do with inflation and what we see there. And Francis, I'd love to bring you in here. We just saw from this ADP data that inflation did come in, that wages, bonuses, and benefits rose 0.8%. That's down from 0.9%. You're seeing this sort of very gradual disinflation and not a lot of wage pressure. How much does that fortify what we just heard there from Mike Collins, this idea that you can get a bid into bonds, that some of the concerns about price stability have been overplayed?
Well, inflation is going to be another one of these indicators that is neither here nor there. We see inflation floating around that 3% level. Now, is that going to be okay for the Fed? Well, they allowed sub 2% inflation on average for the decade before the pandemic. Maybe they'll be okay with slightly above. As we talked about earlier, it'll depend where that inflation is. But there's probably a floor under how weak wages can go here, because it's our view that America primarily needs workers, not jobs, that they're going to come up against labor shortages more than an excess of labor demand. And in our view, that's going to keep a lid under how far services inflation can fall. And of course, we still have tariff inflation coming through from goods. That'll be a Q1 story. So again, lots of cross currents in the inflation story, but where is it will matter most.
Mike, just quickly here before we get that non-farm payrolls report, what do you think the asymmetry right now is in markets, for a better than expected number or a worse than expected number?
We're certainly bracing and we're positioned for a worse than expected by being a little long duration and being very defensive in the credit exposure that we have, right? The markets, I don't know. I mean, the markets are really good at being two-sided here. I think if you got, an upside number, the front end would sell off potentially, but, you have a lot of, dovish aspects to the front end as well that are on the come. I mean, next 3 to 6 months, we expect interest rate volatility to increase, right, because of the uncertainty of the FOMC composition, et cetera, and a lot of new fresh data coming out. But, I mean, it'd be hard to see the market move a real lot either way unless it's a gigantically outsized number.
Michael Collins of PGIM Fixed Income, Francis Donald of RBC, both of you are sticking with us. And Damian, the idea of bond market volatility or interest rate volatility picking up from the floor, because ultimately there hasn't been that much so far this year.
Well, here's with Michael. I will say this, and I'll challenge him a little bit on 30-year buying and moving out and along the curve. This isn't just a U.S.-specific phenomenon. We're seeing 10s, 30s steepening across the whole of DM fixed income, right? So, steeper curves, moving out along the curve. Good luck for investors, right?
Yeah, how much is this a Japan story as much as it is a United States one?
Exactly
Coming up, we are about 4 minutes away from that key payrolls data set. We will get you the numbers on the other side. Right now, markets holding their breath, waiting for this key number. This is Bloomberg Surveillance.
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach within.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
25 seconds away from the data release that we have been waiting for more than a week. Right now, this is how the stage is set. A little bit of softness heading into this non-farm payrolls print, led by the NASDAQ. Futures lower by 0.2%, 2s, 10s, and 30s. A little bit of a motley picture in the bond space. On the front end, just slightly up. On the long end, yields bid, maybe because of Michael Collins with that 30-year yield down 2 basis points. Right now, heading over to Michael McKee. It is that moment for the data. Mike, what do you see?
Well, hang in with me, gang, because this is going to be very complicated. We get an unemployment rate for November of 4.6%. That's 2 ticks higher than it was in September, 4.4%, and it's higher than the 4.5% that we anticipated. Change in there's no October unemployment rate, of course. 64,000 is the change in non-farm payrolls for the month of November. In November, the unemployment rate 4.6%. Let me run through this a little bit here. What we want to find out is what happened in October. Loss of 162,000 jobs. Can that be right? In October, they're looking at a lot of federal jobs that went away. Maybe that's the 162,000. Let me just run through a couple other things here, then I'll check all of these numbers. Change in private payrolls November, 69,000 positive. Manufacturing payrolls down by 5,000. Average hourly earnings less than anticipated, up just 0.1% in November. 3.5% for year over year, and 34.3% for average weekly hours. I'm going to do a dumpster dive in a dumpster that's on fire, and I'll find out more for you and be back in just a second.
Please do that, Mike. So we'll hold tight on that. If you want to take a look at the response in markets, it is absolutely a green flag to a Fed rate cut in the near term. You do see across the board yields lower, particularly on the front end. What that means for stocks is higher. Right now, take a look at that bid into the 2-year yield, down almost 5 basis points after being slightly higher ahead of this release. You are seeing a little bit of pushback. Damien, you've taken a second to look through these numbers. The unemployment rate rising to 4.6% really got my attention, but a host of things that could lead to a more dovish response from the Federal Reserve.
I think that's what the markets are focused on, that unemployment rate. You know, that tick up is bad news for the economy, is good news for the market. But I mean, look at private payrolls. I mean, you know, that was a number that a lot of people wanted to focus on, given, you know, the noise surrounding, you know, the headline figure with government, you know, government employees coming off the grid. I mean, that was really, really strong too. So, you know, there's some good and bad. It just, again, to Francis's point, it depends on how you want to read the tea leaves here.
Well, Francis is still with us. So Francis Donald of RBC, how are you reading the tea leaves?
Slowly, because there's a lot of tea leaves here. But a couple things that jump out to me right away is the 3-month moving average now for non-farm payrolls is about 22,000. So if your break-even rate is maybe 30 to 40,000, then that means you're not creating enough jobs, and that's a enough to lift that unemployment rate higher. But let's just remember, if you make a chart of the unemployment rate going back to the 1970s, there are only 2 periods in history where the unemployment rate has been this low. This is still a very tight labor market. So in my mind, I'm wondering why we're not using words like normalizing as we see that unemployment rate move back towards levels that we're more accustomed to. But while everybody's talking about jobs, I'm looking at the retail sales number, which is very strong. And so the biggest question for an economist right now is not what is the direction of the labor market, because that's sort of fuzzy. It's what are the implications of a weaker job market for the economy. And if the job market is weakening for young folks, 20 to 24, which is what we've seen in the past, if it is less hiring and not so much firing or layoffs, then the implications for spending are less. And so my first read on this is that, yes, we have what we expected, ongoing softness in the labor market, but it isn't creating a pullback in the broad economy, and that's going to be a really key narrative moving into 2026.
Which is the reason why people are bidding up equities and risk assets, even with potentially a worse than expected number. Michael Collins of PGIM Fixed Income still with us. Mike, just congratulations, you were positioned correctly ahead of this. I'm just wondering whether this was the read you were looking for, if this is just bad enough to keep the Fed in play, but good enough to the point that Francis was making to keep risk assets potentially attractive.
Yeah, we haven't heard the Goldilocks economy phrase lately, but, as Francis said, this is actually not bad, right? An unemployment rate, ticking up slowly, job growth close to zero. She throws out that, 30 to 40,000 numbers, kind of the new normal, right? So don't be shocked by these really low job gains. I think they're just kind of standard given the population growth is really trending down in terms of immigration and births and deaths. I mean, fertility rates in this country have plummeted. And so this is the natural state, right? And it's not bad. It keeps the Fed in play. It keeps rates coming down a little bit. This is what we call the muddle through environment. And we have like a 50% base case probability on this muddle through, which is, growth, slow but okay, inflation, a little sticky, but not going up anymore, maybe even coming down a little bit. The Fed cutting rates a couple more times, rates staying in a nice range here. And corporate earnings have been really the star here. Corporations, the private sector has been the star, right? And they continue to figure out how to keep their margins up, which has really been surprisingly impressive to me.
Hold on one second. Michael and Francis, we'll get back to you one second. Michael McKee has some more information after diving into the dumpster fire. Mike, what do you see?
Well, it looks like October was a really terrible month. 105,000 jobs total lost, and that 162,000 I mentioned was the total loss of government jobs in the month of October. We also lost jobs in construction, about 1,000, and in manufacturing, 9,000 in the month of October. Just about everybody lost jobs somewhere during the month. Leisure and hospitality is a bit of a surprise because we lost about 9,000 jobs there in November, and that was lost 12,000 rather, and that was expected to be a sign of strength. Retail hiring, as Francis had pointed out, it's up. It's not extremely strong, but of course you've got seasonals working into this situation as well, but you got a 12,000 roughly gain there, 6,000 gain for the retail trade during the month of November. Speaking of retail, did not mention these numbers earlier. Retail sales for the month of October come in flat. The 0.2 gain in the month of September revised down to 0.1. And the retail sales control group, much better than anticipated, comes in up 0.8 after a negative 0.1 in September. So in October, people were still spending, got a rebound there, even though we lost a lot of jobs in the month of October, and it looks like there's a bit of a rebound in November. Not huge, but we are seeing a little more strength than we had.
Michael McKee, thank you so much. Damien, we do see the move in the markets kind of temper itself as people look at the details. Look at the fact that the response rate wasn't great, and look at the fact that there's a lot of strength despite some of the weakness that we see in the unemployment rate.
And in August and September, we saw revised down by another 33,000 as well. I mean, I'm just looking at the unemployment rate ticking up to 4.6%. The labor force participation rate also ticked up, so that could be fueling a little bit of that as well, which is, means it's not as bad as you would have otherwise thought. But yeah, I mean, you had some backward revisions, 33,000 jobs lost in August and September. That's just, feeding the bullish bond trade here.
Mike, how much do you look at this data, given the fact that we have gotten response rates come down significantly? How much do you look at this data as truly better quality than some of the other data points that we've been getting versus just as noisy, just as easy to discount?
Well, there's a lot more of it, right? We have months worth of data now trickling out, and I don't know if the quality of any of it is that great, Lisa, right? So I think you have to take all of it with a grain of salt, which probably explains the market reaction. You always see a big knee-jerk move when the numbers first come out, and then they kind of settle in, and many times actually reverse, right? So the Fed doesn't meet for almost 6 weeks, so they have a lot more data to come, and presumably the data they get over the next 6 weeks will be higher quality and, again, continue to paint a bigger picture of the direction of the labor market, direction of consumption, direction of inflation. So there's a lot more to come before the Fed meets. And, right now, as you know, the markets are pricing in basically the next cut, not really until June, and a second one by December. So really 2 next year, but really slowly throughout the year. And that makes sense to us, unless you get a big change in the direction of this data.
Michael, we mentioned this prior to the release. Manufacturing payrolls, they're now at their lowest level since March of 2022. Certainly not what the Trump administration would like to see. Talk to us a little bit about, your read from there.
Yeah, I mean, this whole manufacturing, renaissance that the administration is trying to engineer is pushing on a string to some extent, right? There's been lots of evidence and research done on the amount of manufacturing jobs and the desire for Americans to work in those manufacturing jobs, and the availability and education and skill level for Americans to work in those manufacturing jobs, right, does not bode well for this big jump in manufacturing employment. We are a service economy, we're a technology economy, we're a financial services economy. That's where, the jobs are. Those are the sectors that are doing the best, not surprisingly. So, yeah, I think you really have to, push back on that, the idea that we're going to have this giant manufacturing, labor market renaissance in this country.
So, Francis, I mean, equities are higher on this news, yields are down. What do you think the market's focused on right here?
Well, I'm focused on the fact that you called it, the big jump in the unemployment rate is coming from re-entrance into the labor market. And this is the big thing. We all want this number to give us a signal, up or down, but it's really the composition that matters. So what we do is we think about who is losing their job and who is actually being hired. And if people are falling into unemployment because they've started to look for a job and they haven't quite found one, they don't represent a permanent loss of income. They're actually starting the process again. So this is kind of bullish in the sense that it's enough for the Fed if they want to keep cutting. This is a green light for them, but it isn't enough to signal that there's a hockey-shaped weakness in the labor market. It isn't enough to signal that growth is going to materially slow down or there's any sort of nefarious economic activity under the surface. And what have we learned from the Fed? They have a range of opinions. If they want to cut, this is the data that allows them to do that. If you want to maintain a hawkish bias, there's enough under here to tell you, hey, the economy is fine, retail sales are up, the control group did really, really well, and there's still a lot of uncertainty around how much we should read into these numbers.
Right now, the market is just pricing in a slightly higher chance of a January Fed rate cut. Michael McKee has a final thought. Mike, what do you see?
Well, a couple of notes from the BLS. They're saying they cannot quantify the impact of the government shutdown in October and November in the data. They do have a household response rate, which is the unemployment rate survey for November, that's lower than usual, just 64%. They had a tough time getting a hold of people, and it took them an extra couple of days to do that data, and they still didn't get enough. But the payroll survey collection rate was higher than usual, so the numbers may be a little bit more trustworthy. We can note, in terms of the unemployment rate, it's an unrounded 4.564%. September was 4.444, so it was more than a percentage point increase in not a percentage point, but a 100 basis point move higher. Excuse me. lot going on here. And then the other thing I would point out is that we don't have any data from the household survey in terms of hiring and firing, but we can do the math. And from September to November, we added 323,000 people to the labor force. We don't know what happened to the labor force in October, but over the 2-month period, we've increased the labor force. So as Francis was talking about, if people are coming into the labor force, that may have had an impact on the unemployment rate. So where we are right now is waiting probably for the December numbers in January to get a really good sense of how the economy is performing. But job side of the mandate, not so great. Retail sales looks like it's okay.
Michael McKee, thank you so much for this morning. Mike Collins of PGIM Fixed Income, just quickly here, how much do you think this really does greenlight the potential for a rate cut, given the fact that the unemployment rate might give the ammunition that this Federal Reserve is looking for?
Yeah, I really think the Fed should pause here, take a breather, get another handful of months of data before they move again. Like I said, they've moved almost 200 basis points already. As Powell says, they're kind of getting toward the neutral or in the neutral range right now. The lack of consistency and consensus among the FOMC members is really remarkable. How you have a bunch of people who actually think they should hike rates from here, a bunch think they should keep rates the same, and a few think they should cut once, twice. I mean, it is a real scatter plot of views among the committee. So it feels like the general tendency is to just pause and wait. Like I said, the markets aren't pricing in a full cut until June, and that seems like the right path for the Fed at this point, unless things change dramatically between now and then.
Michael Collins of PGIM Fixed Income, thank you so much. It seems like markets have retraced a lot of where they were from before this release. Do you agree with that, Francis, that even though there's a lot of division, it seems like this is a Fed that may cut but probably shouldn't?
Well, it's jobs day, so it's the doves day. They get to focus on their side of the mandate. But in 2 days, 48 hours, you're going to be doing inflation day. And if consensus is right and CPI jumps to 3.1%, well, that'll be 56 months that inflation is above the 2% target, going in the wrong direction, and everybody and their mother knows that there's goods inflation still coming in the system. So on Thursday, it's going to be really easy for the hawks to argue their side of the mandate. And this is the problem when you have a dual mandate. You're in a stagflationary light type of environment. You have a Fed that is revealing its bias towards the employment side, but it will be easy to make the case that inflation is still problematic at the end of this week. So balancing those two will be important. Fed speak will be important going forward, but I'll continue to emphasize the details matter. 4.6% that is driven by new entrants, that has a lot of healthcare jobs, sticky healthcare jobs in it. That's a better type of weaker job number. Inflation that is broad-based or has services component inflation in it on Thursday will work on the other side. So let the doves have their day, but Thursdays I think will belong to the hawks.
And you can feel that tension in the yield curve, the 230s gap getting to the highest level going back to 2021. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Recapping the payrolls data we just got, the economy adding 64,000 jobs in November and the unemployment rate rising to the highest since 2021. October jobs data also coming out showing a decline of 105,000 jobs, the largest drop since the end of 2020. Meanwhile, Rob Reiner's son has been arrested for allegedly killing his parents in their Los Angeles home. 32-year-old Nick Reiner is being held without bail. The case will be presented to the Los Angeles County District Attorney for filing consideration today. Celebrities and politicians took to social media to mourn the star who directed classics, including The Princess Bride and This Is Spinal Tap. And OpenAI's deal to license characters from Disney for its Sora video app is entirely in stock warrants rather than a cash licensing fee. That's according to people familiar. Last week, Disney announced it would let OpenAI pull from its library of more than 200 characters while agreeing to take a $1 billion stake in the company. That's your Bloomberg Brief, Lisa.
Thank you so much, Yahira. And Yahira will be back with us in just a moment for your movers. Up next, Jeff Rosenberg of BlackRock breaking down the latest data. This is Bloomberg Surveillance.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The initial read isn't always the right read. Initially, there was this pop in bond price yields lower. There was a pop in stock futures. We have reversed that down 0.1% now on the S&P. We now see yields marginally higher for the 10-year, back up to 4.17, and marginally just a touch of dollar weakness. Under 1 hour away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. A lot of sell-side action to get through, and we start with Roku. Those shares are up nearly 5% in the pre-market after Morgan Stanley double upgraded the stock to overweight with a price target of $135. And the call is all about advertising, with the bank saying that 2026 will be a strong year for ads in the U.S. and connected TV will stand to benefit the most. Meanwhile, moving on to Southwest, those shares are higher by 2% after Barclays raised its rating to overweight and set a $56 price target. The upgrade follows comments from the CEO just last week talking about Southwest pursuing airport lounges, something that we've also seen with JetBlue. And Lisa, I know you're talking to the JetBlue CEO later this morning. And we end on Estée Lauder shares. Those are rising 2% in the pre-market after Bank of America raised its price target to a street high of $130. And they're citing a pickup in demand in China and the U.S., which represent about 40% of Estée Lauder's revenues. Bank of America also naming Estée Lauder its top beauty pick in the booming beauty market in 2026. Lisa.
Thank you so much, Yahaira. Let's turn back to that payrolls report. Jeffrey Rosenberg of BlackRock joins us for some response. Jeff, do you think that this really changes the needle in any way?
Well, Lisa, up the segment. The headline was what the markets were reacting to, the little bit higher than expected unemployment rate. I think you guys in the earlier segment decomposed that pretty well. The labor force participation rate going up, so it's not that bad. I don't really think, to answer your question, I don't really think this really moves the needle. If we look at the November number, 64,000, pretty close to expectations. And let's not forget that we're going to have another payroll report before the January meeting that's going to make these other two much less important. So I don't think it really moves the dial a lot. And I think what you're going to already seeing in the market is that retail sales control group number was pretty strong. And you look at the strong, and you look at the earnings part of this report, average hourly earnings, on a month-over-month, a little bit weaker 3.5%. That's still pretty high. Real incomes and the wealth effect here supporting consumption. So that's really, I think, the bigger story here for the market move.
At this point, Jeff, if the Fed does cut rates in January, but maybe in March, and you do get that fiscal impulse coming from the federal government, at what point is there a risk of some sort of increased sell-off at the long end, sort of the opposite of what Michael Collins was talking about?
Yeah, I mean, this is a little bit of a replay of what we saw happen last year when we had the Fed's cutting interest rates cycle. You look at last week and what was the market reaction, and it was a steepening in the yield curve. So there is a little bit of a message from the bond market here that, yeah, the Fed's going to control the short end, but the long end is reacting to better growth, sticky inflation, demand for capital that we're seeing everywhere that pushes up the term premium. And so I think that is more than a risk, Lisa. It's the reality of what we're seeing in the market right now.
Jeff, I take your point that average hourly earnings at 3.5% year over year is high, but it's still the slowest pace since May of 2021. And that leads us into CPI later this week, right? I mean, we're going to see some inflation data. What are you looking for there?
On the inflation data?
Yeah, CPI.
Yeah, and as the earlier commentator talked about, I love the framing. You know, today's the day for the doves, and inflation is the day for the hawks. And the pivot and the framing is correct. The inflation side is what's been the concern for the hawk side. I think the argument there is, yes, inflation is high and it's persistent, but it has been coming down. And I think the argument that the tariff-related components are really the drivers of that underlying inflation stickiness, and this is the key unknown, is tariff-related inflation a one-off, or is it an inflationary process? You've heard Powell talk about it. I think there's a pretty good consensus around the argument that tariff inflation should be a one-off rather than a process. And I think when you're looking for the process of inflation, look not to tariffs, but look back to what we were just talking about. It's really in wages and the stickiness of wages. But on the wage side, as you just pointed out, those two are also coming down. So, you know, there's a debate in terms of inflation. We're going to, have another data point.
I think we've lost Jeff Rosenberg of BlackRock. Thank you so much for that. Frances Donald, the queen of that way of describing things in terms of the days for the doves and the day for the hawks. Just what are your final thoughts? Your sort of read through of a motley slew of data that really paint a complicated and nuanced picture.
Well, if we put aside the path, we woke up this morning and I just said to you, Lisa, hey, there's a bunch of new people who joined the labor force. We still have wages that are running above inflation. There's half of jobs are coming to healthcare, which is what this economy really needs. And we have real wage growth underneath the surface. You probably wouldn't say, oh, the U.S. economy is collapsing and we're heading into a recession. And that's the story that we have today. Now, momentum matters. We do have a labor market that is slightly softening, but so does historical references. And as I said earlier, we still have one of the tightest labor markets that we've seen in 50, 60 years. Let's not get ahead of ourselves here.
Frances Donald, thank you so much for being with us this morning. Wonderful to get your thoughts. Coming up tomorrow, don't miss this, Stephen Auth of Federated Hermes, Veronica Clark of Citi, Republican Congressman French Hill, and Liz Thomas of SoFi. Damian Sasser also back. Thank you so much for being with us.
Thank you, Rob.
As always, this was Bloomberg Surveillance.
Morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Up in our zone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
All right, we are looking at a market that keeps changing its mind after a payrolls number showed us manufacturing jobs fell another 5,000. 30 minutes till the start of the cash trade. I'm Matt Miller. Danny Berger is on assignment, but she will join us in the next hour out of Paris with Citadel CEO Ken Griffin. Bloomberg Open Interest starts right now. Coming up, mixed messages on the labor market. Payrolls rose more than expected in November after falling more than expected in October. Also, Ford takes a $19.5 billion hit as it overhauls its EV business while the EU ditches plans to ban combustion engines. And NASDAQ is seeking the SEC's approval to extend its trading hours to 23 per day during the work week. In terms of the stocks that we want to watch trading the pre-market right now, Ford is one of those with a gain here after that huge write-down, nearly $20 billion in charges tied to a sweeping overhaul of its EV business. It also says it's going to make more money on the EBIT level this year, $7 billion instead of 6 to 6.5. Stellantis also putting up some gains, about 2/3 of 1%. The EU effectively ending a ban, or talking about effectively ending a ban on combustion engines that would have come into play in 2035. Tesla, you can see, actually down on the day, though Tesla did very well yesterday. A check on the broader markets following the jobs report. We are now looking at futures that are down. NASDAQ futures also down. As Mike Wilson has said, bad news is now firmly good news, and we did get a fair amount of bad news. The unemployment rate, 4.6%. So initially these futures were up and then came down. You can see the 2-year yield continues to fall, but right now only 2 basis points. I believe at one point it was down 5 basis points right at 8:30. So right now 347.86. Let's break down the jobs data with Mike McKee, Bloomberg's international economics and policy correspondent, joins me here at the desk. So Mike, bad news is good news right now because the market wants to see Fed cuts. Is this jobs report going to push the Fed to cut again in January?
I don't think so. I think basically at this point it's going to leave them cautious, but they're going to want to see the December numbers because it's very hard to make a lot out of this continuous narrative. What we got was a total of 64,000 jobs created in the month of November, and in the month of October, we lost 105,000, and 162,000 of those were government jobs. So we had a very bad October. If you look at the October jobs numbers, they just fall in just about every category. But then you get a rebound in November. Not a strong rebound, but you do get a rebound. So which direction are we going? We have no October unemployment rate, but for November, the unemployment rate rises up to an unrounded 5.64% from 4.44% in September. So we get a large rise in the unemployment rate over 2 months. But how fast is it moving? It's kind of hard to tell. We don't have some of the numbers that go into the calculation of the unemployment rate. We know the labor force over 2 months rose by 323,000. But how many of those people were hired and fired? Those numbers are missing. So right now, what we have to do is try to figure out where we are, right? Not we, but the Fed, where we are with the economy and where it's going to go from here. And that's a little bit harder to do with these numbers at this point because there's just not enough in there. Labor Department does say that there was a stronger than normal response on the establishment survey, the number of jobs created. So that's good news, but a weaker than normal response on the household survey for November, which is the unemployment rate. So you've got to figure in some error margin there too on that unemployment rate increase. So Matt, it all adds up to not a great trend, but not a terrible trend in the sense that we went down and came back up again. So where do we go from here? We're going to have to look at the December numbers.
Yeah, of course, the statistics are very messy. We had a big shutdown, so a lot to factor in there. Mike McKee, international policy and economics correspondent, on the numbers that just broke about 34 minutes ago. Joining us now is White House Council of Economic Advisors Acting Chair Pierre Yared. Pierre, great to get some time with you. Really appreciate you joining us. What is your interpretation of the statistics we got, of the jobs numbers and the unemployment numbers as well?
Thanks for having me here. Listen, this is a report for over 2 months. So if you look over the totality of those 2 months, you have the U.S. economy creating 121,000 private sector jobs and shedding 162,000 government jobs. Now, a lot of those government jobs went away because of the fork in the road efforts, the DOGE efforts, that meant that many people who were retired from the federal government basically went off of payroll in the month of October, and so that explains what happened there. If you look at the unemployment rate, it's true that the unemployment rate did tick up. That uptick, though, is statistically insignificant, and if you dig into the numbers and look at what caused it to go up, it's entirely driven by re-entry into the labor force, and that's consistent with the fact that when you look at the labor force participation rate, that labor force participation rate also went up.
What's driving that?
What's driving that is that, you know, real wages are up. So if you look at wages have been outpacing inflation, whatever measure you look at. And so when wages are going up, that's attractive for people to re-enter the labor force. And in our view, that suggests that, you know, the economy is doing extremely well. That's consistent with the fact that real GDP growth in the second quarter was very good. If you look at where GDP now, the Atlanta Fed's forecast is, that's very good. So that economic activity, combined with the fact that productivity growth is up, combined with the fact that nominal wages are outpacing inflation, so real wages are going up, that attracts a lot of people into the labor force. And attracting people into the labor force does mean that, you know, there is a process by which they eventually find jobs.
So that sounds like the economy is doing very well. It sounds like a hot situation, and Treasury Secretary Bessent was out this morning saying that growth is going to be gangbusters at the beginning of next year as well. Do you think the Fed is done with its job of cutting rates?
Listen, the Fed is going to do what it's going to do. It's got a hard job. It's got its dual mandate.
Well, let me ask like this: does the Fed need to cut rates if the economy is doing so well? Why would the Fed want to cut into that?
Listen, the Fed increased interest rates dramatically in order to deal with the enormous inflation that came after the pandemic. And what we are in the process of right now is a process of policy renormalization. Now, that means that on top of thinking about its dual mandate, the Fed has to think about where long-term interest rates should be, and that's the healthy debate that they are having in there internally. However, if I look at what we're doing, what this administration is doing, this administration is laying down the foundation for strong economic growth combined with that is driven entirely by supply, that's driven by a productivity boom, that's driven by a lot of investment, which is what we saw in Q2 of this year. And that investment is going to manifest itself in additional economic activity into the future. And as the Secretary stated, we should see a lot of that activity in the first half of 2026.
So, and I know it takes a while, it takes time to build a house on top of a well-laid foundation, but the manufacturing industry is still shedding jobs, and this administration's goal was to boost manufacturing jobs, to bring those jobs back to these shores. How do you think that process is going, and how long is it going to be until we really start to see manufacturing in America pick up?
Listen, if you look at manufacturing value added was very strong in the first half of the year. If I look at industrial production, we've seen an uptick in industrial production since this administration took office. So that's telling me that there's a lot of productivity gains in manufacturing, a lot of activity in manufacturing. And of course, that came along with a lot of investment over this time. Some of it was equipment investment that was imported from abroad. Once that investment is laid down, that creates a foundation for more manufacturing jobs into the future.
We did see a huge jump from September to November. Omar Sharif from Inflation Insights writes in people that are taking part-time jobs for economic reasons, just over 900,000. What is driving that? Why are people coming in and reporting that they could only find part-time work? I think about 600,000 people said that. Is this just noise in the survey?
Listen, it's true that over time there is noise in the survey. I'm not sure that that increase is statistically significant. What you do see is that there's been some upticks in unemployment rates, for example, in some demographic groups that have come back down over time. So I'm not sure that we should be reading too much into that.
We do have youth unemployment rising. I saw teen unemployment up above 16%. Can you talk about this in relation to the affordability crisis, in relation to the homeownership drop that we've seen, displacement from AI? How do you frame it?
So if I think about the affordability issues, there was excess inflation over the past 4 years. That's increased the price level relative to where it would have been had that extra inflation not happened. That price level has increased. It's going to be at a permanently higher level, and that's been a major driver of the affordability issues that have been brought up. What we're doing in this administration is ensuring that nominal wages continue to grow and that they continue to grow faster than inflation. And so that means that the spending power of families grows faster than prices, and that's the way in which we can resolve the affordability issues and the affordability challenges for families. If I look at real wages for all sorts of different professions, and if I cut it up, if I look at averages, or if I look at median wages, if I look at wages in manufacturing, construction in particular, you can see that there you see real wages accelerating. They're accelerating and they're rising faster than inflation, and that means that that's more spending power for families, and that's the way we deal with affordability. And that's entirely driven by the president's policies of unleashing supply and ensuring that we expand the supply side of the economy to ensure American prosperity.
Can I ask how you feel about inflation at these levels? We're looking at about 3% year over year in terms of CPI. Is that too much, or do we need to have higher inflation to deal with the extra $15 trillion we've added to the national debt over the last 2 administrations?
If you look at inflation since this administration has taken office, it's running at about 2.5%. So that's very close to normal ranges for the CPI of around 2 to 2.3 or so. So I think that it's pretty much the case that inflation is renormalizing back down to historic ranges.
Sorry, what is the 2.5%? I see 3% on CPI.
No, I'm saying since this administration took office. So if I look at the data starting from February, go all the way to the present, we've got 2.5% on CPI, which is within normal historic ranges.
All right, and you're happy with that? You don't want to see it any lower?
Inflation does what inflation does. We're not a centrally planned economy. We try to make sure that inflation is on target. The central bank, the Fed, does its job. What we do here is ensure that the supply side of the economy is expanded, and as the supply side of the economy expands, that ensures that inflation remains at sustainable long-run levels. Also, if you look at the fiscal side, that's another driver of inflation. The fiscal situation has dramatically improved relative to last year. As Secretary Bessent has stated, the deficit has come down, and it has come down for numerous reasons, including the fact that we are collecting more income tax revenue, we are collecting more tariff revenue, and also spending has declined.
Hey, thanks so much for your time. Really appreciate you joining us this morning. That is Pierre Yard there. He is the acting chair of the Council of Economic Advisors. Now, coming up, Ford announces sweeping changes to its EV strategy after struggling to dig out of billions and billions of dollars in losses there. We'll look at the company's pivot next. This is Open Interest.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
The key issue right now for us in the diamond space is the declared divestment of Anglo from DBS. And as you know, Anglo holds 85% stake in DBS. Botswana, the government of the Republic of Botswana holds 15%. We are resolute now, and we've communicated a firm intention to increase our stake in DBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Ford is taking a $19.5 billion charge as it radically reshapes its electric vehicle strategy. The company expects the moves will make its EV operations profitable by 2029 and has boosted its 2025 guidance, this year's guidance on an earnings before interest and tax level, to $7 billion from a lower end of $6 billion. I spoke with the CEO of Ford, Jim Farley, about the changes.
Look, for this announcement, Matt, it's really about moving to more profitable vehicles. You know, we're going to make in Tennessee now an affordable pickup truck. I think it's going to really surprise the market. These are customers we know, not a lot of guesswork in terms of the revenue, the cost we need to get at, and a more affordable van in Ohio. So these are going to be better investments for the company profit. And all those hybrid sales, you know, those are really profitable vehicles for us.
For more on Ford, we're joined by Steve Mann, Bloomberg Intelligence Global Autos Analyst. And Steve, before I get to the autos portion, the one thing that maybe could have been unexpected is that Ford's going to take its automotive battery plants in Kentucky, take over the joint venture there, and turn them into an energy storage production facility for basically AI data centers. What do you think about that move from a car maker?
I mean, it's a smart move. Tesla's doing it. You know, like a lot of the battery companies from China are doing it. There's huge demand on the energy side. Like energy in the U.S., distribution and generation is not really as efficient. So they do need these batteries, and they need a lot of them to power the AI, this huge AI move.
So what about the move away from full battery electric vehicles to hybrids and e-revs? I mean, a lot of hybrids will give you, 50 miles a gallon, plus it makes the car more powerful. It seems like the way forward. Are they just going to put hybrids across the line in all of their vehicles?
Yeah, I think, Ford just basically backed up the truck with charges. And, I think it's a right strategic move, especially in the U.S. market where Ford dominates on the commercial vehicle side. So, EV really doesn't work for commercial vehicles. The extended range EVs, the ER-EV does. F-150 Lightning is really a niche commercial consumer market, and it really hasn't really picked up. So, good move. I think, this is, it sets them up for, greater profitability in 26, 27. Especially with looser, MPG requirements.
Yeah, I can see that the Lightning was a niche market for probably mostly wealthy people to buy pickup trucks that they don't need for work, right? Because it's incredibly fast, it's luxurious, but it's not great at towing and difficult to repair, especially in your own shop. What do you think about a move back to a more classic pickup truck to be built in Tennessee, for example, with a steel body instead of an aluminum one?
Yeah, I think the fire at Novelis really taught them a lesson as well. They not only need to diversify into the hybrids and other propulsion system, even their supply chain needs to be diversified. But they lifted the guidance for 2025. Actually, it tells you a lot about Ford and their operations. It's improving, and they're managing some of the challenges that are facing. I really think 2026 and 2027 will be great years for Ford and also their Detroit rivals, because this looser MPG mileage requirement, it's a huge tailwind for earnings. These are high margin, profitable trucks. And without paying the penalties, it's going to really juice up their profits. Now, the question is, there's always questions about affordability for the average consumer. Is the automaker going to translate those savings from the penalties to consumers? I don't think so. But they're not going to go, and I don't think they're going to go and jack up the prices. I think the prices will stay where it is, but profits will improve for the automakers.
What do you think about, General Motors still has a pretty broad palette of EVs to choose from across its Chevy brand to the trucks to, the Hummer and Cadillacs, so luxury products as well as affordable products. Are they going to be scaling that back as well at GM?
Yeah, that's an interesting question, Matt. Look, GM took a very modest $1.6 billion charge on EVs when you compare to the $19.5 billion that Ford took. Look, they have, I think their GM strategy is to keep one foot on EVs and one foot out of it on ICE. They have invested a lot more. They have a lot more models like the ones you just mentioned. But I think more interestingly is that they're going to roll out the Chevrolet Bolt, which is a more affordable EV. And I think if you talk to Jim Farley and the rest and all the CEOs in the market these days, affordable EV is much more attractive for the average consumer. So I think they're more committed. GM is more committed to the EV. But look, you're right. I think EV pickup trucks really doesn't work. It's not a workhorse that people expect it to be. So I wouldn't be surprised, if down the road, GM revisits the Sierra and Silverado EV, and maybe there's more rationalization in their capacity, EV capacity in the future.
All right, Steve, great to get some time with you. Hoping to get you on again soon. Steve Mann of Bloomberg Intelligence. He covers the car makers for us. Coming up at the top of the hour, we head to Paris, where my co-host Danny Berger sits down with Citadel's Ken Griffin in an interview you don't want to miss. This is Bloomberg Open Interest.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Quick check on futures. They are still lower, just ahead of the opening bell. Got about 5 minutes to go, and S&P futures are down 0.2%. NASDAQ futures down 1/3 after a couple of down days in the cash trade. Let's take a look at some of the movers on our radar. This one's a gainer. PayPal up right now 1.4% in the pre-market. It has applied to become a U.S. bank in hopes of bolstering its small business lending reach. We've seen BitGo and other non-bank firms apply and be approved for this sort of thing in the recent days. Pfizer says this year's revenue will be on the lower end of previous guidance. It issued 2026 guidance that was mostly in line with expectations. The shares are unchanged for the day. The shares are unchanged for the year. And Zillow analysts are defending the stock as Google tests a new real estate advertising format. Analysts saying the reaction is overblown, but the reaction is absolutely nothing right now. Less than 4 minutes until the start of trading. Michael Aroney of State Street says the naughty list is shrinking as Wall Street hopes for a Santa Claus rally to close the year. This is Bloomberg Open Interest.
Court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Moments away from the start of trading on this Tuesday. It's Tuesday, right? Jobs Tuesday, that's right. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at S&P futures that are down after 2 days of drops in the cash trade. It looks like we're going in to the start of this session on a sour note as well. NASDAQ futures off a little bit more than 0.4%. Here at the New York Stock Exchange, we see Christoph Gleich from Harbor ringing the opening bell, celebrating a suite of ETFs there at the NYSE. And over at the NASDAQ, Newmark is ringing the opening bell. This stock has crushed it over the past 5 years with reinvested dividends up 137%. At the same time, the Russell 2000 is only up about 40%. And we're going to have the president of leasing from Newmark in the Americas, Liz Hart, is going to join us in just about 1 hour's time. In terms of the stocks that we're watching, I obviously have a very close eye on Ford, Stellantis, General Motors, Tesla. Anybody doing business in Europe, for one, is going to have to worry less about a ban of combustion engines in 2035. And then Ford had this massive write-down yesterday, throwing out the kitchen sink, $19.5 billion. But it is now boosting, as Steve Mann just told us from Bloomberg Intelligence, its EBIT forecast for 2025 from $6 to $6.5 billion to $7 billion. So it looks like investors are happy about this. Stock has doubled, by the way, Ford, over the last 5 years. So Jim Farley doing well in that leadership position. Joining me now is State Street Chief Investment Strategist Michael Aroney. And Michael, I want to ask first about the big jobs number that we had at the top of the program, or about a half hour before we came on live. Initially, we saw futures rising. Now we're seeing a drop in the cash trade here on the back of those numbers. How do you interpret the non-farm payrolls number, and what do you expect the Fed to do in reaction?
Matt, it looks like the market is having a tough time interpreting the jobs data this morning. I think that it continues to paint a picture of a labor market that continues to soften as we head into 2026. From my perspective, I'm a little surprised that the bond market hasn't reacted with yields falling more. And I'm a little surprised that the odds of a Fed rate cut haven't changed all that much in January. So to me, I take away that this suggests that the labor market continues to soften. Chairman Powell highlighted that this may happen, and here we are, and I think it continues to suggest some weakness in the labor market.
So you do expect then the Fed to cut rates. You don't think the market is pricing this, right? How much further do we need to go? We've already cut, I think, 175 basis points since September of last year.
I think you'll get at least another couple rate cuts next year, Matt. I think there's a couple things here. One, this morning's data suggests that the labor market continues to be in a bit of a tenuous situation. Certainly the October numbers are down. The unemployment rate has been ticking up. This is signaling weakness on that side. And when I look at this, when I look at the wage data this morning, the wage inflation just isn't there. So oil prices, I think WTI, Matt, is around 55 and change. Voluntary separations, the quit rate is small given the weakness in the labor market. And finally, rents are rolling over. It's really hard to envision that inflation will re-accelerate under those conditions. In fact, I expect it may surprise a bit on the downside, and this will give the Fed wiggle room to cut rates further in 2026.
So I guess that interpretation is what you think is going to feed into a Santa Claus rally into year end, gains again in 2026. Do we get a rotation of leadership? Do we get a broadening out?
It does appear that the Grinch is trying to steal the market's Santa Claus rally in the last few days, but I think the foundation for this bull market remains pretty strong. And in terms of fiscal stimulus, monetary stimulus, earnings are still pretty good. Add in some deregulation and continued AI spending, and I think that's enough ingredients to keep the rally going. But Matt, to your point, I do think we'll see a bit of a rotation. Now, we still like cyclical parts of the market where earnings are growing. So now I can buy small cap companies and financial companies that will have earnings growth equal to tech at far better rates and some tailwinds as it relates to fiscal policy, monetary policy. So we think some healthy rotation into other parts of the market is prudent at this time.
What do you expect could ruin the bull case? You know, what keeps you up at night or what makes you uncomfortable here, Michael?
So I do think an unexpected rise in long-term interest rates could cause a problem, but it's not necessarily what's in our forecast. So again, there's a few things. If in fact inflation remains stickier than anticipated, maybe growth expectations come in a little bit better. And of course, with these permanent fiscal deficits, the spending that's occurring, the supply of sovereign debt could result in rates keep creeping up. Of course, here in the last week or so, you have kind of long rates in Germany and Japan, and even here in the US had been creeping up, and that has caused some downward pressure on prices. So to me, of course, there's always those gray swans, those black swans, those unknown unknowns that we can't predict in advance. But I think the arbiter of this bull market rally will be long-term interest rates. Right now, they're range-bound. If they were to accelerate unexpectedly, that would likely result in a repricing of this rally.
I mean, we do see, I've been graphing the Fed funds rate against the 10-year over the last couple of days, and it's pretty astounding to see if you look back from September of 24, when we started this cutting cycle, the Fed has gone from 550 down to 375, right? And at the same time, the 10-year has gone from 350 up to 420. So what's going to turn that around? What's going to pull the 10-year yield down rather than letting it float up with global yields?
So Matt, our expectation is that long-term interest rates will remain higher and more volatile than the market expects. But as long as they remain in this comfortable range, markets should be able to continue to rally. I think where it gets problematic is typically if 10-year Treasury yields are pushing that 4.75 range, that 4.75% range, and higher is typically where some of the cracks start to form. We're nowhere near that today. I don't expect that we'll get there, but I think that that is ultimately kind of some of the challenge. What would cause it? Certainly investors who are demanding higher compensation for lending their money to governments, including the U.S., that'd be certainly part of it. Stickier than anticipated inflation would be part of it as well. And on the flip side here, Matt, I think that a fall in rates, an unexpected fall in rates, would suggest the economy's hurtling towards recession. Not our forecast, but that also would be equally concerning. So what we're hoping for is this range bound to continue, and I think it will.
Michael, great to get your intel. Great to get some time with you today. Thanks so much for joining us. State Street Chief Investment Strategist Michael Aroni on a Jobs Tuesday. Let's get a check on the stock market right now. We are still seeing losses here, but only less than 5 points on the S&P 500. You can see also that the breadth on this move screen is good. We have 283 stocks gaining, 221 are down. In terms of The balance here, Broadcom, Amazon, Oracle, all on the upside. Meta, I'm just looking at the hyperscalers here, but you see GE, Vernova, they are also long waiting lists for their gas turbines. On the downside, Apple, it's only down 0.7%, but that's good for 4 points off the index. And then Tesla, also on the downside, although Tesla had a banner day yesterday, getting ever closer to another record for Tesla. And are we going to show the rich go? I think at some point we're going to show you rich go so you can see what happened to Elon Musk's wealth yesterday. His one-day change is something like up $167 billion. The man is now worth like $400 billion. So Elon Musk is doing pretty well. In terms of the industry groups, thank you, Joe. Here we have a look at almost all of them on the downside. This is interesting considering the breadth. Only financials, utilities, and industrials are gaining today. Everything else, all the other GICS groups on the S&P 500 are falling. When we come back, indeed, we will talk about the latest SpaceX valuation, sending Elon Musk's net worth soaring. Actually, I underestimated, above the $500 billion mark, a $600 billion future fortune. We'll talk about that on Open Interest.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So it, folks know to find games there, but it's also a highly competitive gaming ecosystem. So its developedness gives you both that upside and the downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to like unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Time now for our top call. Some of the analyst action in focus this morning. First up is Barclays upgrading Southwest, arguing its shift to assigned seating, bag fees, and added legroom should boost revenue starting early next year. Next up, Morgan Stanley upgrading Accenture and says the stock's pullback makes it more attractive. The analyst argues that AI worries are largely priced in, and he says estimates have bottomed, supporting a more upbeat outlook ahead of its earnings on Thursday. And finally, Bank America upgrading UBS. The analyst calls UBS a highly attractive proposition with the fastest growth of any global bank, thanks to a strong Asian wealth trend and capital markets momentum. Let's turn now to tech, though all those things were tech as well. And let's take a look at the rich list, the Bloomberg Billionaires Index. You can find that on your terminal by typing RICHGO. Elon Musk is now worth $637 billion, nearly $400 billion more than the second richest person in the world, Larry Page. And you can see that the change in his one-day wealth is $167.2 billion. That's on the back of a new valuation for SpaceX. Let's discuss this with Bloomberg Tech's Carolyn Hyde, and just mind-boggling, eye-popping. I mean, the things I would buy, you know?
The world, everything in it.
But he's not that kind of dude, right? He's not into owning possessions, right? He just wants to lead. So how's this look?
This looks pretty phenomenal. This just speaks to the valuations they're getting on the private market. This is a man who could actually be worth $1 trillion next year if indeed he manages to IPO SpaceX at $1.5 trillion market cap, which is what they're currently aiming for. So he'd be flung even further in terms of the amount of money that he is currently worth. He's got a 42% stake in SpaceX, and if you discount for a bit of liquidity, that is why we've got such an eye-watering markup to his current overall valuation of the human being he is. But Tesla's done well as well, of course. It's near a record high. All of this just builds on itself. This is a guy that in 2020 was worth $100 billion. He's 6x that in less than 6 years. I mean, he only entered the rich list with a billionaire status back in 2013, so it speaks to the narratives with which he's moving in the area and the ferocious desire of private markets to be bidding up valuations. SpaceX worth $800 billion. Today, the news, Databricks is worth $134 billion. It's raising $4 billion in a Series L. Yeah. When does this sort of end in terms of its ability to go to these crossover funds, these BlackRocks, these other asset managers, JP Morgan Asset Management, we understand, is in that. When do we stop with the desire to get into these sorts of high-tech AI plays? Yeah, the Databricks, I mean, the fact that they can raise $4 billion privately, why on earth would they ever bother with an IPO? Well, he does. Ali Ghodsi has come on the show, the network, speaks to our own reporters plenty. And he said, look, I wouldn't have got cash flow positive if I didn't want to go to the public markets. So he is someone who eventually wants to do the democratization thing, allow everyone to be able to own his shares. And indeed, this is about liquidity for his own employees. The reason that he's raising this funds is he wants to be able to make secondary sale shares for them. But he also wants to hire more people. He's building up a lab. He's only got 100 people or so in the AI lab. This is a company that manages your data to make sure that you can run all of the AI agents and the future productivity gains were all promised in the future, but you've got to have the right data in the right place. He does that. He competes with Oracle and Snowflake, but phenomenal amount that he's able to raise in the private markets. Oracle, by the way, Chris Bryant out of Berlin writes these fantastic opinion pieces. Yeah, he does. And he points out that after the disappointing earnings news we got from Oracle, they put out a 10Q and stated that they have $248 billion in rent. $250 billion. Yeah. $250 billion in rent, in leases. This is like data center rent through like 2028, right? And you're hearing, and actually people who join your show plenty, I know you speak to some really interesting billionaires and people who are building out in Texas. They're coming on the show and the networks saying, why, if data centers is such a good business model, are people just leasing them and not actually buying and doing the picks and shovels? But this is Oracle's game plan, the way in which they want to. A lot of these hyperscalers want flexibility. They want to be able to tap in, tap out of these sorts of overall buildings in the ground and compute and GPUs. $250 billion to just slide that into a 10Q, it feels like, as Chris Bryant says, a massive bombshell. And again, it just speaks to the anxiety that we're getting is, will this productivity pay off? Will they be able to afford these leases? Will they get the demand? Will OpenAI be able to suck up all of the amount of compute that they're currently being built? Will we not make GPU innovations that mean all these companies have their own chips and maybe you don't need the expensive NVIDIA ones. Maybe you don't need to spend so much.
Well, that's why you lease, right? This is the same reason I would lease if I were buying an electric car today, because you know a better one's going to come, a much better one's going to come around in 2 or 3 years, and you want to be able to get out and get into the other one quickly.
And that's sort of why Microsoft came back. Remember when TD Cowen was doing all those sort of big reveals that Microsoft seems to be pulling out of leases more? Well, that's the whole point. You're able to have more flexibility, decide which countries make more sense, decide where the real end demand is. But still, this is a lot of money that they're having to promise to pay by 2028.
Yeah, fascinating stuff. And I look forward to your program.
Thanks.
Carolyn Hyde anchors Bloomberg Tech that kicks off at 11, and rest assured there will be enough to talk about. Coming up, PayPal shares rise as the firm looks to become a bank. More on that next. This is Bloomberg Open Interest.
Bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Burden in Florence, Italy, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We are risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
This is Bloomberg Open Interest. Check on stocks right now, and we do see S&P 500 little change, down 0.1%, even less change on the NASDAQ. It's totally unch right now. And you have really a push and pull, and markets still trying to figure out exactly what that non-farms payroll report means for the Fed. In terms of the movers today, NVIDIA right now is also very little changed. Google is also very little changed. So they're not swinging this market around. Such a great day when I get to look at some car makers here. Ford up 1.7%. So the market really applauding Jim Farley's pivot away from a money-losing 100% fully battery electric vehicle producer to focus on hybrids and E-revs. Those are vehicles that are electric but still have a gas engine to charge the battery. Stellantis also gaining today. You know, both of these are also moving, you would imagine, on the EU's shift away from a combustion engine ban, but that was pretty much expected, right? We know that Stellantis is going to come back with the big Hemi. Bitcoin right now, 87,646, so coming back a little bit, and PayPal up 2%. And we're going to talk a little bit more about that right now. Bloomberg Chief Wall Street correspondent Sri Natarajan joins me on the desk. And PayPal, I guess, looking to become a bank. A number of crypto firms have been doing the same thing. What's happening here?
Well, the environment is right. The Trump administration has been encouraging more firms and has signaled that it will be willing to consider more firms that do apply for a banking charter and potentially even approve them. And for a lot of these firms, it is an attractive time to consider this option because being a bank and sort of the punitive regulatory structure that comes with it had been keeping a lot of these folks away. And you knew under the Biden administration, even if you applied, the chances of getting approved were quite difficult, so many of them didn't even apply. So that interest has certainly skyrocketed, and it's important for a company like PayPal, which in the last few years, after having seen several years of double-digit revenue growth, in the last few years has seen its revenue growth flatline. In fact, in the last couple of years, it has been in the low single digits. So this could be an important step, and after having had a really tough year in the stock market, the stock's down almost 30% this year, I think investors are seeing this as a bit of a positive news that it could be a fillip for the company going forward.
I understand the drawbacks, the regulatory drawbacks that were stopping companies from applying for banking licenses previously. But what are the opportunities? Like, what can PayPal offer consumers or businesses as a bank that it couldn't offer as, just PayPal?
It can start to fund its loans with its own balance sheet. It doesn't have to rely on a third party. It can cut out the middleman, which in their case had to be a third-party bank, with which you also had to share your lending profits. Now it can fund those loans directly. It can start offering interest-bearing deposits, which will also be another low cost of funding to expand its lending activities. And that will ensure that it builds that full stack relationship with its customers and clients. It keeps them within that PayPal ecosystem, and that means more business for the company.
So do you expect this to happen a lot more over the next coming weeks?
Look, we've already, you talked about the crypto companies. We've already seen some of the auto companies and their financing arms look to apply charters like this. So you could see more companies explore this opportunity and see this as a real positive way to expand certain revenue streams.
Are the other banks, from Huntington Bank shares in Ohio to JP Morgan here in New York City, are they feeling a threat?
Perhaps Huntington Bank shares a little more so than JP Morgan.
What about, if the Republicans get hit hard in 2026, if we have another presidential election in 2028, if things swing the other direction, and, the Dodd-Franks of the world come back, do these companies all wrap it up?
That's $1 million question, and that question truly affects everyone from a potential PayPal bank to Huntington Bank share to JP Morgan, because there is a real risk of regulatory whiplash. The question is, which new administration comes into when there has been a lot of deregulation and look to throttle it, because they then run the risk of owning any slowdown. So the banks are perhaps operating with the assumption and the presumption that when there is a deregulatory environment, it doesn't immediately reverse, it doesn't immediately go the other way, but you cannot discount the risk, especially considering how far the pendulum has swung in the first year of the Trump presidency.
All right, Sri, great having you on the program. Thanks for joining us as usual. Sri Natarajan is our Wall Street correspondent who I guess now covers PayPal and BitGo as well. Coming up next, speaking of Wall Street, although we're going to go out to Paris for this, and he's normally in Miami, Citadel's Ken Griffin joins us, speaking with my co-host, Danny Berger. She's at a conference in France, and we'll bring you that full interview, one you don't want to miss, at the top of the hour. We're looking right now at markets that are really little changed after a jobs number that may have confused some people. S&P down a little, NASDAQ up a little, small caps doing better as maybe those jobs numbers paved the way for more rate cuts. More on the other side of this break. This is Bloomberg Open Interest.
incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Tuesday morning from the Bloomberg Interactive Brokers Studio in New York City. To our worldwide audience, we are streaming live on YouTube as well, so head over to youtube.com and search Bloomberg Podcast. That's where you'll find us. Coming up, we're going to listen in on a conversation. Citadel CEO Ken Griffin speaking on a panel with Bloomberg Television's anchor Danny Berger. We'll bring that to you when it starts here. We're going to talk to Ira Jersey, Bloomberg Intelligence Chief Interest Rate Strategist, get his thoughts on the economic data we got today. What does that mean here for the bond market? Right now, let's head over to Paris. Citadel CEO Ken Griffin speaking on a panel with Bloomberg Television's anchor Danny Berger. Let's listen in.
President Trump warning about end of civilization because of Europe's over-reliance on America. Jamie Dimon saying it's a region that's anti-business, that has a lack of innovation. Are those most dire of forecasts for Europe? Are they correct?
What a cheery way to start today. And I feel like I was just handed the hot potato question.
Yes, I'm sorry, Ken. You were indeed.
So first of all, President Trump is a bit prone to hyperbole. And having said that, there's no doubt that the Western world needs Europe to be more successful. We need to see higher economic growth in Europe. We need to see more innovation. We need to see more consumer demand for goods and services, because the Western world will only be strong and prosperous if we have a strong and prosperous Europe.
What does the road ahead to get that strong and prosperous Europe look like? How do we get there?
Look, I think Mario Draghi did a fantastic job putting forth a playbook for how to revitalize Europe. And I would say that, I'll agree with 80 or 90% of what he wrote, but rather than regurgitate what he wrote, and he wrote really thoughtfully, I think the salient points are Europe needs to create a culture of entrepreneurism, far too much of the world's innovation takes place in the United States and in China. And Europe, having such an incredibly well-educated population, should have far more entrepreneurial success stories than it does. So that's a really big issue that Europe needs to address. It's a cultural issue. And the second is that Europe's capital markets simply aren't deep and robust enough. The venture capital community in the United States, the depth of the private equity markets, the depth of the growth equity markets, the depth of the public markets makes it much easier to organize, to secure capital, and to grow a business than it is here in Europe.
Let's talk about leadership in the U.S. because it's also been a moment of questions. In the early elections, local elections, governor elections, the trend has been very clear. When Democrats run on affordability, they have been winning. 2026 is a midterm year. Do the Republicans risk losing the American public?
So, you know, it's quite ironic to see how the tables have turned, because just 12 months ago, President Trump and the Republicans swept into office on the issue of inflation. And the Democrats have rebranded the problem of inflation as the issue of affordability, and they are now well poised to return to control of the House. And there's even discussion of them retaking the Senate on the back of how the affordability issue strikes a chord with the American public. And the big picture is the American consumer is tired of the persistent and sticky inflation. They feel like they can't get ahead in a world where their savings and their wages are constantly deprecated by the impact of inflation.
Why aren't Republicans speaking to that?
We are listening in to a conversation between Danny Berger and Ken Griffin taking place in Paris. This is Bloomberg Radio. Let's go back.
Workforce, that's pro-inflation. And so the Republicans are grappling with tariffs, another case study. When you impose a tariff, it's a regressive tax on consumers. It's pro-inflation. So some of the very policies that the Republicans have put forth and have been successful in implementing are actually the very policies that tend to be pro-inflation. Some of the other policies, for example, deregulation, are just going to take longer to play out. And ultimately, deregulation, which should unleash productivity gains, will create a reduction in inflation, a very healthy reduction. But we need to get to that point in time.
It's a timing issue, and President Trump said something similar, not exactly what you're saying, Ken, but he had spoken to the Wall Street Journal just this week saying that the reason the American public hasn't realized his policies are working is just because they take time to take effect. And what Americans are experiencing now is Democrat-led inflation. It seems like you would maybe take issue with the latter, that maybe it's current policies leading to some of the stickiness?
Look, I think there's no doubt that the president inherited an environment that was still struggling with inflation, but the easiest parts of his agenda to implement were, unfortunately, when it comes to the issue of affordability or the issue of inflation, were those policy choices that actually most fuel inflation, right? The curtailing of the labor markets, the clear-cut inflationary pressure of tariffs, those were easy things for the president to implement, and unfortunately, they have continued to lead to this inflationary environment that we live in.
Well, you have seen the White House try to backtrack on some of it, be it tariffs on Brazil because of the impact on agricultural goods and the bills that Americans face in the groceries. We're looking at tariffs now making their way through the Supreme Court. Is it too late, though?
So I think it's going to be hard to roll back tariffs writ large unless the Supreme Court makes a pretty bold decision. And I only say that because the Supreme Court's going to face the challenge of does it want to take on the president with respect to one of his single most important policy wins from the perspective of the White House, right? Does the Supreme Court really want to take that issue on? As a matter of law, I hope they do, and I hope they take it on with a very thoughtful and reasoned opinion, but that's going to be a tough call for the Supreme Court to make. Now, having said that, we have seen the rollback of tariffs, in particular in products that consumers put in their grocery carts, right? The president's getting the message from the front lines, from the Congress people that serve our people, that the voters are angry about inflation, and they're looking for ways. They're looking for ways to help to address the issues of affordability. You know, it was very interesting. I was with a group of business executives and the president. He was very much listening for ideas on how to address the issues of affordability in America. He cares about this issue.
Maybe it's too late for some of the local elections, though, in getting to the American public. New York, a big change for the city with a Democratic Socialist. Miami, too, your hometown, Ken, where you had the first Democrat in 3 decades. You've praised the leadership of Florida many times. Does that change your outlook at all to have the local election in Florida also shift in terms of who's leading it?
Well, Miami-Dade County has had a Democratic mayor actually for quite a bit of time now. And Miami just recently elected a Democrat to be the mayor of the city of Miami. And I think there's a stark contrast between the Democratic leader-elect of Miami and the leader-elect of New York City. The leader-elect of New York City ran on a set of policies that will either be impossible to implement or that will come with a draconian long-term cost to the city of New York. You know, for example, if you want to address the issue of housing affordability, you need to build more homes. And when you're talking about rent control, all you're doing is telling developers in big neon lights, don't build in New York City. Now contrast that with the incoming mayor of Miami. She has a long history of being pragmatic with respect to policy choices that will improve the lives of the people who live in Miami. She very much wants to accelerate the permitting process for builders to create more housing stock. She wants to help release lands into the private market to help increase available housing. She wants to address the issue of housing affordability with thoughtful, time-tested, and proven policies, rather than the fantasy that's being espoused by Mayor-elect for New York City.
Are you confident that Americans will continue to elect in people of positions of power like you're describing with common sense policy, or do you look at New York as a red flag for 2026?
Look, I think that New York City is a red flag because people put aside good sense and common sense to elect somebody who is incredibly charismatic, who ran a really powerful campaign on social media, but who ultimately doesn't have the ability to deliver on the promises that he set forth. In contrast, I think the mayor-elect of Miami, she ran on a much less powerful set of campaign messages, but do you know what? She'll deliver on the promises that she made to the voters of Miami.
You still have a good chunk of your business in New York. Would you rethink just how much exposure you have to the city at the moment?
Look, I think every business executive is thinking through the magnitude of exposure they have to New York. And there is a very common talking point on this. We survived de Blasio.
Is that enough comfort?
Well, that's the talking point. And unfortunately, you know, I think there's some truth to that. New York took a big set back during the de Blasio days. And I hope that Mamdani starts to think about how to pivot to a more thoughtful set of policies that will allow New York City to maintain its position, not only as one of the greatest cities in America, but one of the greatest cities in the world.
You know, Ken, I'm struck that it's not just the American populace that's thinking about affordability or inflation. It's markets too. Since the Fed started its cutting cycle, cutting 75 basis points so far this year, 30-year bond yields are up 80 basis points. 10-year bond yields are up 30 basis points, or 50 rather. It's not the move that you would expect. Is there a signal in that?
Well, unfortunately, the bond markets are expressing their anxiety about inflation. And when you look at the 10-year yield point or the 30-year yield point, what you're really observing is how much risk premium, how much like insurance premium does the market demand for higher inflation? Because remember, you're lending the money to the U.S. government for 10 or 30 years at a time at a fixed rate. So you want to think very long and hard about what rate do you lend money to the U.S. government, which is running a staggering deficit, that is now running very, very easy monetary policy relative to the inflationary pressures that we're facing. What risk premium do you demand to do so? So although the Fed has brought short-term interest rates down, what it has really done, it has unnerved the bond market community that invests or commits capital for 10 years or 30 years at a time. And why does that matter? Because capital formation, building a new factory, is funded with 10 and 30-year debt. So the hope that we will stimulate the economy, that we will encourage the investments that we need in America that are all funded with long-term debt are actually being undermined by the easy monetary policy at the Fed today.
Markets are incredibly sanguine on this idea that we're going to run it hot, we're going to cut, we're going to get stimulus. Are you essentially saying that markets are underpricing a clear risk then?
Well, there's two markets. There's the fixed income market, which is anxious about this journey, and there's the equity market. The equity market loves an easy money story. So what we're seeing is a tale of two very different worlds from the perspective of two very different investor groups, right? Your fixed income investor doesn't participate directly in the easy money policies. In fact, they're adverse to that. They're anxious about that. How much will inflation erode the value of the dollar that I lend to the government today? The equity market thrives on this.
Who's going to be right?
Well, unfortunately, I think that the fixed income markets probably has its head screwed on better here. That we do have an issue with stickiness and inflation. Goods deflation, the story of our adult life, fueled by globalization, is over. It's over for now. Maybe in 10 years, as robotics continue to accelerate, we'll have another big wave of goods deflation. But the goods deflation that we've enjoyed from globalization is over. Supply chains are being re-architected. Manufacturing is being moved into higher cost jurisdictions. That's going to end the goods deflation that's been the theme of our lifetime. And with that, you have more pressure on services inflation and the cost of housing flowing through the inflationary picture that American households face.
So just to kind of paint the picture.
We are listening to a conversation between Citadel CEO Ken Griffin and Bloomberg Television anchor Danny Berger in Paris.
President Trump puts in place, who is loyal to him. The Fed continues to cut. You get this real pressure where bond yields go up. What does that look like? Does it look like risk markets crashing? Does the business environment, which America has enjoyed, does it get curtailed? Just how dramatic of an impact are we talking?
So I don't think we're actually looking at a scenario like that, all right? I think you're looking at higher bond yields as a possibility, but remember, the easy money will fuel the stock market boom, right? There's two different investor communities here, and the stock market investors, when they see lower interest rates, bid up for stocks. That's just the propensity of that community, is easy money means higher prices.
I mentioned the Fed may be playing a role in here, and about 3 months ago, you wrote an op-ed in the Wall Street Journal. I'd love to read a line from it, because it was really important and timely. You wrote that pressuring the central bank to adopt a more permissive stance toward inflation carries steep costs. Ken, since then, we've seen NEC Director Kevin Hassett emerge as the frontrunner from the Fed. There's reporting overnight that there's been some pushback in Trump's inner circle. Is that pushback warranted? Would you support a Kevin Hassett as leading the Fed, someone who's seen as very loyal to the president?
Look, I think the most important move the president and the incoming Fed chairman can make, or chairwoman as the case may be, is to separate, is to create distance between the White House and the Fed. Because the most difficult job the Fed has is the job of raising rates to combat inflation, which can result in higher unemployment. It's a politically unpopular decision to have to make. The White House having distance from the Fed gives the Fed more latitude to make the tough calls you need to make to protect the long-term stability of the dollar and to protect the long-term interests of the economy. And sometimes the long-term interest of the economy involves short-term pain and misery. Volcker experienced this back when he was Fed chairman. This is a real issue. And when the White House usurps control of the Fed, even if they don't actually have it as a practical matter, if they're perceived to control the Fed, then if inflation rears its ugly head, the president can't blame the chair of the Fed. Yeah. The buck stops on his desk. So I don't know why President Trump wants to take that risk in an environment where the outlook for inflation is so difficult to forecast or predict. And there is, again, a lot of pro-inflationary pressures that have been created by the changed labor markets, the high fiscal deficits, that is fiscal stimulus, and of course, right now, the relatively easy monetary policy.
Well, I mean, you started this with mentioning you had been in Washington, D.C. with some other business leaders with the Trump administration looking at solutions for affordability. Did you get a word in who your pick would be for Fed chair? You said perhaps the characteristics of who you don't want it to be. Who would make sense for this job?
Look, I think the president has a number of really good people to choose from for the role. I don't think throwing my sort of choice into the mix helps to add anything to the argument or decision at hand. I think the president will hopefully make a decision from the perspective of who will give the global markets and the American investing public and the American consumer the greatest peace of mind that we will manage inflation in America.
And someone not from the White House, ideally, is what you're saying.
I actually don't think that that's as important as the ability of that candidate to make it clear to the House of Representatives, or the Senate in this case, and the American people that they will make the decisions that need to be made to protect the long-term interests of the U.S. economy.
So, Ken, if reducing rates is one thing that's excited risk markets, we'd be remiss if we didn't talk about the other thing that's been talked about all day today, and that is in AI. In 2023, you said that there was a lot of hype, maybe too much hype in AI. In the past 2.5 years, we have seen advancements, better jobs at producing images, better voice recognition, and a whole slew of businesses, at least they say, that they're adopting AI. Have you reassessed in the past 2.5 years, or do you still think there's too much hype?
No, I think actually we've been pretty spot on with that forecast so far. Now, what has happened over the last 2 years is actually, though, a very important and powerful story. In the C-suite of corporate America is a greater focus on how do you use technology to increase productivity. It may not be generative AI, but there's a reawakening to the importance of using technology to empower business outcomes. I was with a group of international business executives about a year and change ago, and everybody was excited around the dinner table talking about AI. And I thought, you know what? Let's all share a story as to how we're using AI to make our businesses better. And I heard 5 or 6 really interesting stories of how corporations were transforming their businesses through the use of technology, but not one story involved generative AI.
If you are one of these players then that exists in this ecosystem where hyperscalers have spent $230 billion just in 2025, with projections to go somewhere near $3 trillion over the next decade, that seems a little bit worrying, Ken, that people aren't finding uses for AI, that they're instead just finding uses for other technology and maybe wrapping it in an AI bow.
Well, I mean, first of all, like I said, these corporate executives shared really great stories, like how they increased their ability to put 15% more cargo onto a train, onto a shipping vessel. I mean, that's just money right to the bottom line. Less environmental impact, higher margins, that's good business. So the upshot of this is that corporate America is securing gains from the use of technology again. I think they're just securing a greater share of those gains from the uses of more traditional technologies, optimization technology, long-standing machine learning technology, and less of their gains are coming from generative AI. Now, having said that, with the enormity of the investment that's being made in the field of artificial intelligence, I think there is some chance that we will see meaningful progress in this field that will change the calculus that I'm setting forth. Like, there are so many bright people in their 20s and 30s trying to unlock true intelligence, that this does create the environment in which a breakthrough may happen. But I think that generative AI as we know it today will have a very pointed but relatively limited impact on the broader economy. Call centers are being completely re-architected by generative AI. Translation of documents between languages, completely re-architected by generative AI. But most of the white-collar work, for example, that we do at Citadel, very modest impact so far. In fact, Harvard Business Review did a great piece on this, and it was called AI Work Slop, which basically you find that the younger generation tends to use AI to create work product that more seasoned professionals look at and go, that's just wrong. And the net productivity gain is therefore de minimis, because you go back and have to redo the work with more senior people. You know, I was with one of my partners and we were going through an interesting problem, and he handed me a report, and the first few sentences were very insightful. And then the rest was just gibberish. And I said, so how did this come to be? ChatGPT. And that was frightening, because if I did not have the domain expertise that I had, I probably would have accepted the totality of the product, right? Like I said, the first few sentences were really insightful, and then it just devolved into gibberish that the average person in the field would not necessarily have known or appreciated.
But again, it feels like there's this really tension between the promise of AI being priced into markets, a spending like the promise of AI is coming, and the actual reality. Does that end with pain for someone, the people who've been overspending, the folks and firms that have been investing in this?
Look, the internet bubble, just to go back to a time in our life that we all know well, saw some enormous misallocations of capital, and also a number of really important transformative changes for the economy. And again, I believe that this current revisiting of technology by corporate America is creating some incredible lasting value in our economy. It's just what will be the role of generative AI in that story. You know, one of the large firms, I'll leave them nameless, in their advertising campaign for AI, laid out 3 key principles for the successful implementation of generative AI in the workplace. And the very first point was, in essence, use this moment to rethink and re-architect your business processes. That's timeless advice. Every business has to episodically go back and re-underwrite how it does what it does to do things better.
We've seen a lot of that.
Right, we're listening to Citadel CEO Ken Griffin. He's speaking on a panel with Bloomberg Television's anchor Danny Berger in a conference in Paris. Let's listen in.
I think the AI-driven layoffs, if one may use that choice of words, number one is when businesses do go back and re-architect their processes, they realize often they can do things with fewer people, whether or not they use generative AI. You know, we've made a huge push in using technology at Citadel over the last several years to streamline and automate processes. Now, we haven't had to lay people off because of that. We're rapidly growing, so those people are put into other new areas of work for us. But we've taken a lot of labor out of what we do each and every day in our business. Corporate America is doing this everywhere. The second dynamic that's happening right now is some of the labor hoarding of the pandemic era is ending. And it's much easier to tell your employees, because of AI, we're reducing headcount, than to say, because we've maintained a fair number of people on our team that we really didn't have good work for, we're reducing our workforce, right? One depersonalizes a decision. It's a technological transformation that's out of my control, and I'm sorry this is happening. Whereas admitting that you hoarded labor for years is just a very different message, one that people don't want to make, state, or hear.
There have been plenty of surveys that younger people coming out of college feel a lot of anxiety, and maybe it's because the headlines that are driven by executives saying this. Ken, what advice would you give to someone who's newly graduating and considering pursuing a field in finance somewhere? Do they need to drastically rethink of what they study, how they enter the field, and what their jobs exactly will be because of changes in technology or because of the state of the labor market?
Look, I think the most important advice I can give is not to the person who just graduated. It's the person who's just starting college. Pursue a course of study where you will learn to be a good problem solver. Pursue a course of study in which you will have the toolkit, the mathematical skills, the statistics background, to really be highly employable in this global economy we live in today. There's still a huge deficit in the Western world of individuals with backgrounds in STEM degrees. It's really important that you think about your college years as doing 2 things. It creates for you the foundation to be a lifetime learner. Because whether you just graduate from college or you're just starting college, you're going to have to learn for the rest of your life, because what you learn in college or just learned in college will soon be antiquated. And if you're not a lifetime learner, you've got a really rough road ahead of you. And then number two is the world will always value people who can solve problems. If you can put your hand up and say, I will take that challenge on, you will always have a job in the Western economy.
Can we talk about a young Ken, entrepreneurial Ken in college, coming out of college? In 1987, when you started your first fund at 19 years of age, and you made an absolute killing because you were short the market going into Black Monday. Should you be in that scenario now? Do you think that there's something you could bet against in this market currently, that you could recreate the magic of what happened in that year?
You mean the good luck?
Hey, good luck. Anything you think would give you a little bit of skill in achieving that good luck?
So you know, it's funny. I look back at the crash of '87, and I was long a portfolio of convertible bonds, and the uncertainty in how that portfolio would behave in a bear market was high. So for choice, I was short a bit more stock than I should have been. Risk management's about trying to deal with the unknown when things go wrong, and because of that, I was a bit more short than one might mathematically have said would be optimal. So that was the good fortune of 1987. Look, I think that we really spend our time at Citadel playing offense. Where will value be created? And then, of course, we take the time to think about how do we risk manage the portfolio that we're building. But the success story of America is a success story written by optimists. And I think that in building a business or in building your career, it's really important that you bring optimism first and foremost each and every day to what you do in life. So we're always looking for how do you create value. And then having said that, survival is about having the realistic paranoia that the world will go through difficult times. And how do you create the risk management to get through those difficult times? But we come to work as optimists first, paranoid pessimists, making sure we can survive difficult times second.
Can I just quickly ask, because we're almost out of time, a lot of folks have expressed paranoia and that a lot of risk from public markets has shifted into private markets. Does that hit the list of your paranoia at all?
Look, I think there's a lot of virtues to the rise and depth of the private markets in the United States. You have a tremendous number of mid-sized companies or even large companies owned by private equity firms. And you have very tight agency between the owner of the business and the management of the business. That's been very instrumental in increasing American productivity. I think that's the great strength of the private equity system that we have in the United States. The downside in private markets, one of the downsides is you don't have good price discovery. And price discovery is one of the ways that you, as a management team, have an appreciation for how the world values what you're doing, and that investors are able to use as a metric or milestone in measuring their own skills as an investor. You know, one of my concerns with private credit, for example, the vast majority of companies will never default. You invest your money today in a company's credit, you won't know for 5 or 7 years if you made a good investment, which means that a substantial portion of your career will have slipped through your fingers before you learn whether or not you made a good underwriting decision. And as we go back to the start of the story, one of the distinguishing factors of the American success story is the depth and efficiency of our capital markets. And as we move more into the private realm, we take away some of the learning experiences that have driven the vitality and success of the American capital markets.
Well, there was a large undernote of optimism in that. So I think we have to end because I started very pessimistic. So we have to end on the optimistic note.
Sounds great.
Ken, thank you so much. I really appreciate your time today.
You are most welcome. And to everyone, it is such a pleasure to be here in Europe at this time of year. Enjoy the holidays and have a happy new year.
All right, that's Citadel CEO Ken Griffin speaking on a panel in Paris with Bloomberg Television anchor Danny Berger there. Talk about a wide range of issues here. Let's get a reset here down here at 10:32 a.m. Wall Street time. We'll do that with Lisa Mateo and a Bloomberg Business Flash. Lisa.
You got in this Bloomberg Business Flash brought to you by IBKR. Will the average global temperature in 2025 be greater than 2.45 degrees Fahrenheit, above the 20th century average? At IBKR Forecast Trader, the yes recently at 6%. Start predicting today at ibkr.com/forecast. The last trading day for this contract, January 9th, 2026. We've got stocks lower after some key economic data. We had non-farm payrolls increase 64,000 in November after declining 105,000 in October. The unemployment rate, 4.6% last month, up from 4.4% in September, and the highest since 2021. Now, at the same time, U.S. retail sales, they were little change in October. That was held back by a decline at auto dealers, also weaker gas receipts. Let's get to the markets right now. The NASDAQ down about 0.1%, 33 points. The Dow and the S&P 500 both down about 0.3%. In the yield space, the 2-year at 3.48%, that's down 1 basis point. The yield on the 10-year 4.16%, and that's down about 1 basis point. Brent crude dropping below $60 a barrel for the first time since May. It's now at $58 a barrel. WTI crude $55 a barrel. We have the Bloomberg Dollar Spot Index weakening by about 0.2%. Over to company news. Kraft Heinz replacing its chief executive. You have former Kellanova CEO Steve Cahillane. He's going to take over that top role from Carlos Abrams-Rivera on January 1st. Their shares up about 1%. And Pfizer forecasts little to no sales growth next year. Its shares are down about 4.5%. And Ford will take a $19.5 billion in charges that's tied to an overhaul of its EV business. After struggling for years to try and make it profitable, its shares are down about 0.1%. For on-demand news 24 hours a day, you can subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is your Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. EcoGo. Boy, you go and put that into your Bloomberg terminal. You get all the economic data being released. Today's a busy day. Non-farm payrolls, retail sales, all kinds of stuff coming out. We're going to get some CPI on Thursday. Let's break it down here. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, joins us live here in our Bloomberg Interactive Broker Studio, sporting some of the Bloomberg Intelligence swag, which I like. I always appreciate that. What'd you see in the economic data today, Ira, that got your attention?
Yeah, so a bit of a mixed bag, but I would focus on the wage data. A little bit weaker than expected. It's been slowing, lowest level of this cycle. So since COVID, this is the lowest year-on-year level that we've had, which, one of the things that's really been propping up retail sales and other things is the fact that even though job growth has slowed, the people with jobs have gotten decent pay raises, and that's starting to slow too, as you've seen payroll growth start to slow as well. So I think that it's a little bit weaker. It's not worrying, right? If we have 3.5% wage growth, that's not terrible, but it's something worth watching going forward.
Does it matter that it was at 3.7% in October and then slowed to 3.5% in November? I mean, there's some questions about the quality of the data that we are getting.
Yeah, and that's one of the reasons I think you haven't seen the Treasury market move very much. Because, in the face of it, if you had gotten data like this and everyone believed the data and that the quality was good, we'd probably have rallied a bit more and seen yields a little bit lower all throughout the yield curve. But you don't see that, and in particular because there people doubt what, trying to interpret what this data means and the quality of the data at the moment. There is a feeling, and some investors that I beat with this morning on the Bloomberg terminal, they're really waiting for like the December data, which seems that everyone's like, okay, look, that'll be cleaner. We should get most of that before the next Federal Reserve meeting at the end of January. So we're going to wait until the new year to make any decisions on how to readjust our portfolios until we see that new data. Yeah.
I was to say, just looking at the retail sales, I mean, I know the headline number at flat was a little bit weaker than expected, but the control group, which I'm told to look at the control group, that was better.
Yeah, so the reason for the control group, Paul, is because that's the input to GDP. Okay. So that those are the components of retail sales that flow into that personal consumption numbers that come out with the quarterly PCE data and the monthly PCE report as well. And that was pretty decent, right? Yep. Beat expectations, but had been weak in September, right? So remember that is a little bit older. So until we get the November retail sales data,
that's in October.
Yeah, we want to make sure that is that sustained, right? And if that is sustained, that means where's this money coming from, right? Because if you have slowing wage growth, then that money must be coming maybe from leverage. And we haven't seen the type of deleveraging of the household sector that we saw following the financial crisis, and now you have people borrowing more on credit cards and things like that. So Raj Chattohumbe, our ABS analyst, has been looking at that and how some some of the high yield, like more levered, lower credit quality people actually are starting to default a little bit. So there is this bifurcation in some of the lending standards.
Yeah, K-shaped economy, right? That's what we keep talking about. So how do you interpret Fed commentary from here until we get the December data in early January? I see that Austin Goolsbee will be speaking on CNN this evening. You've got Waller, you've got Williams speaking tomorrow along with Bostic. So there are going to be Fed speakers out there opining on this data.
Yeah, so Waller and Williams are going to be on the dovish side. I think Bostic is maybe a little bit more of a swing voter. So that'll be interesting to see how what he has to say about the recent data and about the path going forward, maybe which dot he is. Because if you look at the dot plot, there are two camps now, right? There's the somewhat more dovish camp, and then you have the hey, let's be on hold camp because we're worried that inflation might be a little bit more worrisome. So I think Jay Powell last week was really kind of interesting, saying, hey, we're going to, we have basically two camps, one that is a little bit more worried about inflation, one that is a little bit more worried about jobs. And if you look at today's data, again, both sides, I think, can take something positive away from today's data.
The CPI on Thursday, is that a good data, or is that we need to squishy data? How is that data?
The CPI data should be okay because it's we did reopen before they started to do the surveys. They do a lot of surveys and adjustments, but you have seen an uptick in estimates, right? And so there is a piece of the CPI data that says here's what we kind of estimated based on other things. So we'll be looking at that for a signal whether or not it's decent data. But it is going to be important for the rates market, right? We got the two big data points are CPI and the payrolls data. We got payrolls today, CPI on Thursday. If there's going to be something that's going to move the market before Christmas, it's going to be Thursday's data.
I've lost track, Ira, of when we're actually going to hear about who the next Fed chair nominee is going to be. There's different timelines being thrown around, but that feels like the next big thing because whatever forecast the Fed has given, it doesn't matter because it's all going to depend on who leads the FOMC.
Well, I think that's part of it. The chair is only one of many members of the Fed. President Trump has said now January, right, early January before the next Fed meeting. Presumably what President Trump would like to do is have that person nominated and then confirmed before the March meeting because Steve Mirren's term ends after the January meeting. So therefore, the new Fed chair nominee could potentially be a governor for the March and May meetings or late April. Now I don't remember exactly what date it is. I think it's late April.
Late April.
Yeah. And then so sit for those two meetings and then take over the chairmanship come the June meeting. So I suspect that that's kind of the cadence that we could expect over the next couple of months. Now the question is, if that person's on the Board of Governors but going to be the next chair, how does that interact around the table with Powell still being the chair? It could get a little interesting. It'll be 5 years from now when we get the actual transcripts of the meeting. It'll be an interesting read for some academics in that period of time.
All right, Ira, thank you so much. We appreciate that. Ira Jersey, he's the chief U.S. interest rate strategist for Bloomberg Intelligence, joining us live here in a Bloomberg Interactive Broker studio, which means somebody's buying him a meal today to pry him out of Princeton. All right, let's get a Bloomberg Business Flash. We do that with Lisa Mateo.
You got it. We have little movement in stocks right now. This is after the U.S. job market shows kind of signs of being sluggish, but not rapidly breaking down. Traders now anticipate at least 2 more quarter-point reductions in 2026 to support the economy, while Fed officials have a medium forecast of 1 cut. Let's get to the markets. The Nasdaq down 0.3%. Same for the Dow. The S&P 500 falling about 0.4%. The 2-year yield 3.48%. That's down 1 basis point. The yield on the 10-year 4.16%, and that is little change. Have to go to commodities. We have Brent crude below $60 a barrel at 58. WTI crude $55 a barrel. We'll go to COMEX gold $4,355 an ounce. The Bloomberg Dollar Spot Index weakening by about 0.2%. We have the Japanese yen strengthening by 0.4% at 154.51 against the dollar. In the news, Nasdaq it's looking for regulatory approval to extend trading hours of its stock venues to 23 hours during the work week. And then we go to PayPal. It's applied to become a bank in the U.S. It's really looking to take advantage of the Trump administration's openness to fintech companies that are entering the banking system. And Visa opening its U.S. network to stablecoin settlement. For on-demand news 24 hours a day, you can subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is your Bloomberg Business Flash. Starlet and Paul.
All right, good stuff. Thank you so much, Lisa Mateo. And this is Bloomberg Intelligence with Paul Sweeney and Scarlett Fu. And Paul, we got the long-awaited data today when it comes to jobs, and we have the inflation data coming out later on this week on Thursday. But it very much feels like, as Ira Jersey was telling us, a lot of investors aren't ready to make any big moves right now. Not until early January when there's cleaner data coming out.
I think so. And again, I'm just looking at the bond market here today. I got the 2-year coming in a couple of basis points on the news. The long end of the market, the 30 years up, just 1 basis point, so not a lot of big movement in the bond market. Big take story. You know, we love these big take stories. These are great topics. I don't know who thinks of them. Great topics. They're really well reported, deeply sourced, all that kind of good stuff. A lot of times they have fun graphics for me to look at. So this one is really cool. Saudi sisters wield $50 billion fortune as global power brokers. I had no idea about these people, but our next guest does. Devin Pendleton, she's a wealth reporter for Bloomberg News. She joins us live here in the Interactive Broker Studios. Who is the Olayan Group? Olayan Group?
Yeah, Olayan.
Olayan. Who are the two sisters behind this Saudi group?
So it is Lubna and her sister Hudam Olayan. They're both in their early 70s, and they have been at the helm of this family enterprise for decades, for more than 40 years.
Wow.
And they have fairly low profiles, too. That's the thing that is striking. They have these low profiles, but they are known as steely negotiators. Tell us what they've done.
Yeah, they've done an incredible job building this family business, which was started by their father, who was a really, unbelievable character. He basically worked his way up from nothing. He's not a royal, was not connected to the royals at a young age, but he built an oil servicing company, which he grew, striking deals with all sorts of consumer brand companies in the U.S., bringing them to Saudi Arabia, everything from Coca-Cola to Cheez-Its to Oreos. And he came over to the U.S. in the early 1960s, was very inspired by what he saw and bought some bank stocks. And basically his daughters took over that business, which was sprawling. I mean, it was in all sorts of sectors: real estate, oil field services, consumer goods, and hung on to those equity stakes, those banking stakes. So now they have this incredible portfolio of investments in the U.S. on Wall Street, as well as this, booming multi-sector business in Saudi Arabia.
So, but people in power know these two sisters. They were at the White House recently. Tell us about that. How do they subtly wield their influence?
They are not noisy people. I think it's one thing to do business and thrive in Saudi Arabia is you have to really sort of be quiet, be forceful, be a little bit deferential to, who's really in charge, which would be the government and the king and the crown prince. But they have had long-term ties with the U.S. I mean, you really saw that at the White House dinner you mentioned, Paul. She was sitting right next to Elon Musk, but, arguably one of the most important people in the room because she has these connections on Wall Street through their long-term equity investments. It's really important right now, especially because the kingdom is trying to bring in a lot of inbound investment to transform their economy past oil. It's a big deal for them to be bringing in money, and these Olayan sisters have had these connections for a long, long time, so they're more important than ever.
So they have the connections with the right people in Saudi Arabia. How does when I think about prominent investors in the kingdom, I think about Prince Abdullah bin Talal and how he's been very vocal about his positions. He's often seen on media networks. You don't hear about these Olayan sisters at all. And I wonder how much of that is part of their success story.
Totally. It's so important. I think they are extremely discreet. They are, like I said, they really know their role in the kingdom. They're important. They step in and help when they need to. For example, in Saudi Aramco IPO back in 2019, the kingdom was having trouble kind of getting people excited and really getting the investors they needed early to backstop this IPO. They asked some influential families, and the Olayans were one that, they really showed up. That matters for the kingdom, and it also gives them, license to really expand their business as much as they need to, and to be in a position of power to help out, but also, have favors in return.
And the Rich Go function lists their wealth of the family at approximately $50 billion US, right?
Yes, $50 billion US, but I can guarantee you that is a conservative estimate.
Is that right? Now, I understand that while they keep a low profile, these sisters, they have good relationships with some of the big folks on Wall Street, like Larry Fink at BlackRock and things like that. So
Yeah.
that's got to be useful.
Yeah, absolutely. I mean, just through one portfolio alone, they have they're big investors in BlackRock. The equity investors, they have a $1.5 billion stake in BlackRock. They own an almost $1 billion stake in JP Morgan. It's actually where Lubna Olayan first got her start. She was initially working as a low-level banker at JP Morgan right after college. So they're really worldly, very well-traveled, and just tough in this sort of very meaningful business sense, like negotiators. They're very involved in their investments. People really describe them as intense.
How hard was it to do the reporting on this story? I mean, these are people who intentionally want to keep a low profile. As you write, they came of age at a time when women weren't allowed to drive. They needed a male guardian's permission to even get a passport to leave the kingdom. So were people willing to open up about them?
No, Scarlett, it was so hard. In fact, me and my colleagues who worked on this story, we had been reporting on them for years, like just kind of keeping tabs on what they were doing and writing things down in our notebooks for years until we felt like we were at a point where we could put together a story. And people just did not want to talk about them because they respect how discreet they want to be. And especially when they found out that we were trying to give a sense of their influence by tabulating their wealth, they were like, no way, like, absolutely not. You know, they're very modest people.
Have you heard from anyone in the kingdom following the story?
Not yet.
And they did not, I'm guessing, did not participate in, like, give you comments and participate in the story?
No, they didn't.
They did not. Okay. All right. Well, it's out there, folks. The big take story. Saudi sisters wield $50 billion fortune. It's global power broker. So there you go. Devin Pendleton, one of the reporters on this great story, joining us here. She's a wealth reporter for Bloomberg News. And again, you could find these big take stories on the Bloomberg terminal and at Bloomberg.com/big take. So that's where you can find this story and all the other cool Bloomberg big take stories. So that's good stuff there. Looking at the markets, they're probably, it's interesting. There's a Saudi, power center that's not tied to oil.
I know. And I mean, but that's by design too,
Yes.
right? They're moving definitely in that direction. And you can look at sports as like one of the areas where they've really expanded aggressively into.
Absolutely right. So we'll have that S&P 500 off 23 points. This is Bloomberg. Good morning.
is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
This is Bloomberg Intelligence. It is Tuesday morning, and we have gotten the big jobs report, delayed jobs report, and we're moving ahead and taking a look at what else is going to be a potential catalyst for this market. The S&P down about 1/3 of 1%. Well, look no further than Medline. This is a company, it's a medical supply company. You might have seen its branding in hospitals if you have been in a hospital lately, and it's going public. It is going to price tonight and begin trading tomorrow. Anthony Hughes is one of our reporters who covers IPOs. He's the equity capital markets reporter here at Bloomberg News, and he joins us now with more. So Medline, this IPO is going to be massive. You talk about how in your story, this could be, well, at a minimum, will be the biggest U.S. IPO, but could be potentially the world's biggest this year.
Yes, I think that would probably surprise a few people given some of the big names that people have been throwing around recently. But yes, Medline is a large company that's been around for a long time, probably more than 50 years, and has very consistent, durable growth. And maybe not the most exciting investment in some respects, as you see sometimes with these large companies that are backed by private equity, where the growth rate is more sort of high single digit. But it's very it's a business that the investors seem to really like, and this IPO should be fairly solid. Without being necessarily spectacular.
And Bloomberg Intelligence analyst Jonathan Palmer has a research report out on Medline. So for the folks that are interested in this new company, this is the research. There's no other research out on Wall Street because it hasn't gone public yet. So the only research you can find on this with comparable valuations and financial forecasts is from Bloomberg Intelligence. So go to BI Go, and that's where you'll find it. Who's the owner of this company here? Is it private equity backed?
Well, in 21, the family which controlled the business, the Mills family, they sold a majority investment to a group of private equity funds, which included Blackstone, Carlyle, and Hellman and Friedman. So there's a couple of other investors as well. So basically, the sponsors are moving on from there. They're not selling in the IPO here, but obviously down the track here, they'd probably be looking to monetize their stake in over the next few years, assuming this trades well.
And almost half of the targeted raise is accounted for by cornerstone investors. Who are these cornerstone investors?
These are basically institutional investors, some big names like Bailey Gifford and Durable Capital Partners and a couple of names like that. Names you commonly see actually on the cover of IPOs, of large IPOs. And I think it was important for the syndicate, for the bankers behind this deal to get the cornerstone investors, not because they necessarily really need them, but this time of the year, this is unusual to do an IPO this late in the year. I mean, this is really the last hurrah for IPOs. So, you really want to de-risk them and because it makes sure you've locked in all the money, basically.
And we didn't, in my deals, we didn't do cornerstone. We just picked up the phone, made a lot of phone calls, and sold the deal. These cornerstone investors.
I know. I feel like the cornerstone investors definitely were a thing with CoreWeave as well because of NVIDIA and its relationship with that company. But you mentioned how it's late in the year for this IPO. This was supposed to happen a lot earlier.
Yeah, so I mean, as you probably noticed during this year, there was a number of disruptions that meant the IPO market had a pretty good year, a constructive year, but kind of had a few blips where sort of nothing happened, and it was probably ultimately a little bit unsatisfying in that sense. I think the other thing that happened in recent times is you had some IPOs that didn't perform very well, and obviously the banks will be hoping this one is a pretty steady, solid outcome for the rest to end the year on, and hopefully build up into next year and have some strong performances. But also important to note, this is a private equity-backed company. All the big names, some of the big names we're talking about next year, like SpaceX and OpenAI and stuff like that, that's not really they're not private equity-backed companies. So, but when you talk to bankers, they really want to talk about a lot of private equity really taking public a lot of their companies, which are not so much the sexy big private technology companies. They're more these sort of industrial companies, which are solid and steady. Maybe not as exciting as SpaceX or OpenAI, but this is sort of the heart and soul of some of the deal making that bankers do.
What do we know about the SpaceX IPO? I saw some reporting this week, but what's the status of that, valuation, timing, that kind of stuff?
Well, the company's basically confirmed that they do want to take the company public next year, and I mean it's going to be an amazing event because it's obviously we're talking about a potential 1.5 trillion valuation, which is in my experience is not something I've ever really dealt with before. So that's going to be quite stunning and almost hard to imagine in a sense. But I think it'll remain. It's when you're talking about an IPO that far out, there's always a chance, and I think even the company's admitting that there's some uncertainty about the exact timing. But clearly, next year is shaping as a potential real real watershed year for IPOs if you do get those companies go public, because they're going to be so much bigger than the IPOs we've seen before, and that's really going to be a bit of a frenzy and a big payday for the banks as well.
SpaceX, OpenAI, those are the big names, but Fannie Mae and Freddie Mac are supposedly also on the docket as well. And their shares do trade right now in the OTC market, right? It's just not on the exchanges in the same way.
Yeah, so I think this morning the Treasury Secretary was suggesting that that's not going to happen this year, which initially they were talking about doing those IPOs, or the IPO if it was going to be one company this year. But I think everyone pretty much knew that that was a very ambitious timetable. So it's really no surprise that it's not happening this year, and it cannot happen this year because we've run out of time, basically. But he's talking about doing it next year, and I think it remains to be seen. I think it's quite a complicated exercise for many, many reasons. So it's not necessarily one that a lot of bankers would pencil in as a certainty.
Right.
But there does seem a pretty strong intent by the government to do something there.
It sounds like 26 is going to be a pretty darn good year for IPOs if the market just kind of hangs in there, just steady. And maybe we get some good movement there. Anthony Hughes, thank you so much. Appreciate it. Anthony Hughes is equity capital markets reporter for Bloomberg News, joining us here in the Bloomberg Interactive Broker Studio. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now with the S&P down 17 points, the Dow minus 138, and the NASDAQ minus 4. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Tuesday morning from the Bloomberg Interactive Broker Studio here in Midtown Manhattan. This is Bloomberg Intelligence with Paul Sweeney and Scarlett Fu. A busy second hour of Bloomberg Intelligence coming up for you on the heels of that delayed jobs report. We're going to speak with Yelena Sholyacheva, the senior economist at the Conference Board, to get her take on the data and what it means for the Federal Reserve and what it does next. We also are speaking with Robert Sheehan. He is the Chief Investment Officer at Blank Sheehan Wealth Management, to get his take on the markets. We have investors pricing in 2 rate cuts for 2026. Tim Craighead is the Bloomberg Intelligence Global Chief Content Officer. He is going to give us his outlook on 50 companies to watch in the new year. And we will wrap things up with Steve Mann to talk a little bit about Ford's $19.5 billion move to idle EVs and bring truck profits. All right, we've got all of that coming up, but first, we're going to bring in Charlie Pellet for our Bloomberg Business Flash.
Hi, thank you very much, and here's what's going on. Jobs Tuesday, don't get to say that very often. Right now, we have got the Dow, the S&P, they are both declining. We got NASDAQ higher right now. A little change, that is the key takeaway on the NASDAQ Composite Index, up now by 1 point, barely advancing, up by under 0.1%. We got the S&P lower by 16, 6,800, big round number there, down 0.2%, round number to the downside today. We do have the Dow Industrials down 151, 48,264, drop there of just about 0.3%. Your 10-year, 4.17%, with the 2-year, 3.49%. Gold up $14 the ounce, 43.19 on the precious metal, up 0.3%. Silver down 0.7%, 63.60, drop there of just about 0.8%, down 50 cents. WTI with a $55 handle, 55.26. WTI down by 2.7%. Barrel of Brent below $59, down now by 2.7%. And Bitcoin up 1.8%, 87,800 on Bitcoin. Megan Horniman is Chief Investment Officer at Verdance Capital Advisors, and on surveillance this morning, she
going to look like. And this is what's the interest rate environment, going to be long in bond yields. Nobody's really talking about that. That's tended to take some of the steam out of PE expansion.
Megan Horniman of Verdon's Capital Advisors, and that is a Bloomberg Business Flash.
Charlie Powell, thank you so much. We appreciate that. Bloomberg Intelligence today is brought to you by Harvard Business School Executive Education, a world-class learning experience for aspiring and established changemakers. Prepare for the next elevation for your organization and for yourself. Learn more at hbs.me/breakthrough. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Scarlett Foon. We're joined by Bloomberg's Natalia Kenyan-Javich. Natalia, what are you looking at today?
Hi, guys. First, I'm looking at shares of Pfizer. The ticker is PFE. Shares are down by 5.4% as the company said it expects little to no sales growth next year. So revenue in 2026 is expected to be between $59.5 to $62.5 billion. Sales are expected to be at $62 billion. So basically, we do know that Pfizer shares are kind of struggling to gain momentum as demand for COVID-19 drugs is fading, and there is a lot of competition across other drugs. So we do also know that the company is executing or trying to execute a big cost-cutting effort. It targets more than $7 billion in savings by 2027, and most of which it expects to complete next year. On the bright side, however, we know that the company is trying to acquire more businesses, especially in obesity drug segment.
All right, second stock?
Yes. So the next stop is StubHub. The ticker is STUB. Shares are down by almost 6% today. Analysts from Citizens downgraded the stock. They cited competition and regulations. So first of all, they said that there is a big headwinds coming from competition with Vivid Seats for the market share, and then also regulation, guys. There is a push to restrict resold tickets. So, for example, the UK ministers plan to ban the resale of tickets for live events above the original cost. So the stock is down, by the way, by more than 40% since its IPO.
Not bueno. Okay, one more.
PayPal, the ticker is PYPL. The shares are up by almost 2%. Now, this comes as the company applied to become a bank in the United States. For some analysts, this move is logical because PayPal is already participating in the lending business, and some other analysts are just citing favorable regulatory environment. However, the timeline is uncertain, so to some analysts, it could take several years.
All right, very good. Natalia Kenyan-Javich, thank you so much for that. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Got some economic data today. Hey, for a start, that was good. The market has been starved for economic data. We had some jobs data. We had some retail sales number. We're going to get some inflation data on Thursday. Let's break it down with somebody who knows about this stuff. Yelena Shuliatieva, senior economist at the Conference Board. Yelena, let's start with the labor market. What did you make of some of the jobs numbers today?
Yes, happy Payrolls Tuesday, Paul. So I think we should look at the report, at the numbers through the prism of the Fed's dual mandate of maximum employment and price stability. And what were the developments here? So the unemployment rate increased and wage growth moderated. So what does it mean for the Fed? That means probably further easing in 2026. That's my first takeaway from this. So obviously, there are a lot of different details that could, we could look at this report with some skeptical eye, as Chair Powell suggested. We had a shutdown during the period for which these numbers are. We had deferred, layoffs from the federal government, which significantly distorted the October read. And, the response rate to the household survey was lower. So all these things could have distorted the unemployment rate number. So you do need to take it with a little bit of a grain of salt.
That's fair enough. We also know that Jay Powell, the Fed chair, had warned about how recent job data was probably overstating job growth as well. So how are you thinking about the non-farm payrolls numbers and the 2-month change in payrolls?
So what I look at is what a lot of economists do. So you need to compare supply and demand, and basically you need to look at the 3 months moving average number of 22,000 as it compares to the break-even payrolls rate, which is, according to the Dallas Fed, is around 32K. So job creation is currently running below what is needed to keep the unemployment rate steady. And that, to me, is a key risk going forward. So if that continues, we will continue to see increases in the unemployment rate, which is obviously not a great thing, next year. So I'd say that you really need to assess the how demand fares relative to supply in the labor market. And thus far, at least what the data shows is that the demand is running slightly weaker.
A year from now, where do you think the unemployment rate might be, Yelena?
So in our baseline projection, we have the unemployment rate rising to 4.7% early next year, as we continue to see some delayed tariff impact on the overall state of the economy, and uncertainty surrounding tariffs continuing to weigh on hiring decisions. I think the situation will improve as the year progresses. The Fed will continue to cut. We have 2 cuts at least scheduled in our baseline projection for 2026. That could help the economy at the margin. And I also think that the economy, the uncertainty will subside to some extent. And also we could see potentially some midterm election stimulus next year. So in the form of some unexpected checks or any other kind of stimulus that may boost consumer spending next year.
All right, Yelena, thank you so much. Yelena Shelyacheva is senior economist with the Conference Board, talking to us about the jobs report. And I mean, if you type EcoGo on your Bloomberg terminal, it is a long laundry list of items there.
Because for a lot of these things, we're getting data from the month of October and for the month of November there. So a little bit of a catch up. And as Ira Jersey mentioned to us earlier, the data gets much cleaner beginning with the December data.
Not to mention retail sales numbers, which came out, though they are a little bit dated. October retail sales, for the most part, rising about 0.4% when you back out autos for the month of October.
Yeah, and the control group up 0.8%. So pretty solid numbers there. Right now, let's go to JetBlue Airways CEO speaking with Bloomberg Television anchor Lisa Abramowitz live from John F. Kennedy Airport in New York.
New York City apartment from the 1940s, 30s, 70s, 30s. Okay, I think I got it right. Joanna, thank you so much for being here before the launch later this week. I want to start with just how this fits into the strategy of JetBlue right now to make the airline truly profitable for a sustainable period of time.
Yeah, thanks for the question. Great to be here and have you in Blue House, JetBlue's first foray into lounges. This is very much part of our Jet Forward strategy. We've been working very hard for the last several quarters on really turning towards premium and trying to make sure that we're offering more opportunities for customers who want to pay a little more. And the lounge is part of that. Our transition to a first-class product next year, a domestic first-class product, would be part of that. Our Premier card, our Even More as a cabin, and really excited to start seeing all of that come to life in 2026.
All of the big airlines have talked about loyalty and how important loyalty and premium offerings is to their profitability going forward. How is it different for JetBlue? Because there isn't this sort of obvious business customer that typically fuels the loyalty offering.
I mean, we're a leisure carrier. We tend to get, a nice share of business customers because they love the product. We're back at the top for Net Promoter Score, so really proud of that. But at the end of the day, this is really designed around trying to make sure that customers who travel for vacation have a reason to come back again and again, and providing a little oasis of peace, and really through our loyalty program. We want to reward people who choose JetBlue because they love the product, the service, and what we offer.
You have already offered Mint and other premium rollouts routes. How has it been going?
It's been great. Mint's been a very strong source of revenue for JetBlue for well over the last decade. And so we're not new to this. We have a brand that, definitely associates with more of a higher end leisure customer, providing more to customers at a very reasonable fare. We want to make sure that we offer something for everybody across the full spectrum, whether you want sort of a dialed down experience, still free Wi-Fi and great legroom and great snacks and drinks, TVs. But then if you want to pay a little more, you have the opportunity for a lounge, our Mint class for transatlantic. And then when we launch domestic first later this year, that's going to be a great product offering for customers who want a little more.
So I was shuttled into here through very long security lines and lots of people with screaming children trying to get to different destinations for their warm holidays. This is the busy season. How is it looking in terms of demand, given the fact that there were some hiccups in the past couple of months, but at this point, people are getting back to what they originally had?
Yeah, 2025 has been a very tough year, whether it was the macro setback or the government shutdown or the list goes on and on. We're really looking forward to the holiday season. Bookings are coming in strong. As we go into 2026, we're optimistic that the consumer is healthy and that we're going to start really ramping up the initiatives that we have been working really hard for the last year to execute to and seeing the benefit as we move through 2026.
How long do you think it'll take before you start to actually turn profitable and sustain that?
Our goal next year is to break even from an operating margin perspective, and that's the first step back to profitability. We have a great team here. Everybody's pulling for us. We're doing all the right things, whether it's our focus on operational reliability, net promoter score, all of the premium products that we're launching, our laser focus on costs, and really trying to make sure that we're delivering a great product offering for customers, because JetBlue has this wonderful brand and this sense of people want to love us and they want to see us succeed. And 2026 is going to be our year with everything we've put into place.
Because 2025 was not the year for a lot of airlines. There were a lot of issues. And you talk about the government shutdown. This has been a big discussion among a lot of the airline CEOs, where they've said we just can't make up that kind of revenue. So there will be some sort of hit. Have you disclosed any kind of revenue loss as a result of some of the shutdown?
We haven't disclosed any kind of revenue loss. We've said that we remain on track for Q4, and I think we're pleased with what we're seeing in terms of bookings coming in for the balance of the month. We definitely saw some softness, obviously, during the government shutdown, but we're recovering coming out of that. I think most have shared that, but it was definitely an impact, and unfortunate that the airlines were put right in the middle of that shutdown. All the great air traffic controllers and the TSA workers, they need to be cast as essential workers. We really need to make sure that, if anything, this industry is so essential to our economy. Think about all the people who were traveling for weddings and funerals or doctor's appointments that were displaced because we couldn't get on the same page in Washington, D.C. So we're really hopeful that, we've turned a page there and that we can move forward, looking at that end of January date with, a little bit of nervousness, but I'm confident that D.C. will pull it together and get us in the back end of that.
Yeah, you somehow, being an airline CEO probably wasn't in your bingo card that you'd be well focused on healthcare legislation with your fingers crossed heading into January. I'm wondering how much you're hoping to attract a new class of customers versus capitalize on the ones that you have that might be willing and able to pay a little bit more with some of the new offerings.
Yeah, it's a little bit of both. We know we have customers today that want our first class product, and so it's really offering that to them so that they can buy up when that opportunity presents it. But it's also making sure that we're competitive with the industry. Everybody's moved towards premium. We're going to continue to move towards premium because it is a resilient customer segment. But we're not going to forget the folks that fly in our coach product. They're just as important, and we want to make sure that JetBlue offers something to everyone.
It really does feel a little bit like the Sharks and the Jets when you speak to some of the airline industry CEOs, where they talk about, it's become a game of consolidation and it's become a game of the big fish really dominating the field in a lot of different ways. They say it's going to be very hard to be a more budget-focused airline. How do you fight back? How do you sort of create a viable business model at a time when you do see this consolidation of profitability and travel in the biggest airlines?
It's definitely hard. We talk about the need for a more level playing field. When 4 carriers have 80% of the domestic seats, that's a real problem. We fight very hard in D.C. to try to make sure that we're heard, that the challenges we face, whether it's cost pressures, the lack of scale, the lack of, consolidated purchasing, the, inability to get access to gates. We just bid on a gate, a Heathrow slot, and we were denied it. And so, while I maybe understand why it went to a legacy larger carrier, those are little things that add up over time. And the smaller carriers really need to be given a fair shot to win in this environment, and that's not happening right now. So we're focused on what we can control. We're focused on a whole series of initiatives under our Jet Forward program. It's getting us moving in the right direction. I'm excited about what it's going to bring, but we do need the government to kind of make that a more level playing field so smaller carriers can more effectively compete.
In the meantime, you do have this cooperation with United. You've been expanding in a host of different places. Is that the template going forward? Maybe not consolidation due to the recent issues, but in terms of the previous merger that was denied, but going forward, having some sort of partnership with major airlines to expand the routes.
Yeah, we've got 50 airline partners across the globe, and now we have the Blue Sky partnership with United. That is most certainly a part of trying to provide more utility to our loyalty program and providing a broader global network for our customers when eventually in Q1 they can book a JetBlue flight on United.com and vice versa through our interline agreement. And so we're excited about what it's going to bring. Does it solve the problem fully? No, it doesn't, but it's definitely a meaningful revenue initiative that gets us back moving in the right direction.
Do you anticipate consolidation at any point in your future, or is that sort of on the back burner?
That's on the back burner. We're really focused on Jet Forward. You know, I'm really excited with the progress we're making. We're seeing it. We're seeing improved operational reliability, improved customer scores. We have not let the grass grow under our feet in 2025. We've executed a whole series of revenue initiatives. We've kept our costs under control despite pulling a 1.5 capacity this year. So 2026 really is the year that we should reap the benefits of all these initiatives that we put into place in 2025.
Before I let you get back to celebrating the new lounge, I do want to just ask you about the recent incident with a pilot for a JetBlue plane that was in the route between Curacao and JFK. There was a close call with a U.S. Air Force jet. Do you have any more information about what happened there to make sure that it doesn't happen again?
Yeah, I'm really proud of our pilot. He reported the event, and we train them for situations like this. We reported the incident to the government. We're waiting to hear the results of their investigation, but just pleased with how our pilot handled it and how air traffic control handled it. There's a whole series of safety nets in place in the in the national airspace system, and the pilot is the last line of defense, and he absolutely did his job, did it well, and my hope is that doesn't happen again.
Joanna Garrity, thank you so much for being with us.
Thanks
Joanna
so
Garrity, the CEO of JetBlue. I'll send it back to you.
All right, thank you so much. Lisa Bromwitz, Bloomberg Television surveillance anchor, speaking with the CEO of JetBlue Airways live from John F. Kennedy Airport. Let's go now to Charlie Pellet and get an update on where things stand in the markets. Charlie.
Hi, thank you very much. Here's what's going on. Stocks lower. JetBlue shares, by the way, $5 even. We got the Dow, we got the S&P, we got NASDAQ, all in the red right now. S&P 500 index down 31, 67.84, drop now of just about 0.5%. Dow Industrials down 205, a decline there of 0.4%. NASDAQ down 69. The NASDAQ Composite Index down by about 0.3%. This Bloomberg Business Flash is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. goldencrestmetals.com/guide. 10-year 4.16% on this Jobs Tuesday, with a 2-year 3.49% CPI, by the way, on Thursday. Spot gold up $2.50 the ounce, 43.07, little change there. Silver down 0.9%, 63.48 on silver. West Texas Intermediate crude 55.34 a barrel, down 2.6%, and Bitcoin 87,700 on Bitcoin, up by 1.8%. Sources tell Bloomberg China's Luckin Coffee is considering making a bid for Nestlé's Blue Bottle Coffee to boost its brand profile and expand in the premium coffee segment. Luckin Coffee down today by 1.9%. Those are the ADRs. Nestle ADRs trading lower by 0.6%. Starbucks up by 0.7%. Recapping, stocks lower. S&P down 0.5% for on-demand news 24 hours a day. Subscribe to Bloomberg News now wherever you get your podcast. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio in New York City, streaming live on YouTube as well. Some news in the food business today. Kraft Heinz is replacing its chief executive officer, getting somebody new here starting January 1st. And this move follows a difficult period for the food company here. And I know they made some announcements about splitting up the company. So a lot going on at Kraft Heinz. Let's break it down with Christina Peterson, food industry reporter for Bloomberg News. She joins us live here in our Bloomberg Interactive Broker Studio. Talk to us first about the change at the CEO level. What's going on there?
Yeah, we had expected in September that the current CEO would lead one of the two new companies, specifically the one that is the grocery staples. They actually don't have official names yet, but that was a collection of the least profitable or less profitable food items there, including things like Lunchables and Oscar Mayer deli meats. The surprise came this morning that he is in fact not going to lead that company, and instead they are bringing in Steve Cahillane from Kellanova to lead the second company after the split has gone through that is being called the Global Taste Elevation Company. And that's going to have Heinz ketchup, Kraft mac and cheese, some of those beloved iconic products.
So that's the fast growing part of the company, and the other one is kind of the equivalent of CNN, TNT, and the leave it behind assets that are you're managing a decline in. What can you tell us about Steve Cahillane, the former Kellanova CEO? What is his approach, his philosophy?
Well, I just spoke with him, and he said that he's going to be focused on bringing organic growth to the company. We talked a little bit about focusing on some of the health and wellness trends that consumers are looking for, increasing offerings with protein, with fiber, with shorter ingredient lists, the so-called cleaner labels. Okay. So they'll definitely be leaning into that, it sounds like, a little bit more. He also led Kellogg through its split. The Kellogg company split into WK Kellogg and then Kellanova. Both of those companies were then separately acquired. I asked him if he thought that could be a path here, and he said it's hard to predict the future, so not ruling it out.
Just looking at the stock here, Kraft Heinz, compounded annual return over the last 5 years, -2% versus the consumer packaged good index up about 7-8%. Of course, the S&P up about 15%. So what's been the challenge for Kraft Heinz over the last number of years?
I mean, in general, the food companies are all struggling with this shift as consumers move towards healthier, less processed food. The company says that they just had too many brands and that splitting into two will help them focus on each component. I think that there is some analyst chatter that that's what companies say when they just need to, spin off some of their less profitable items, but they will tell you that they expect both companies will have better value when there's an ability to focus more on the condiments and boxed meals and then on some of the other foods.
Christina, put this all into context for us. When Paul talks about how, this group has been kind of struggling overall, we also saw that with PepsiCo, with Coca-Cola. I mean, they have had to rethink their strategy completely.
Yeah, there's just been a lot of movement in the food industry right now. PepsiCo announced some pretty dramatic changes last week. They're going to reduce the number of products they sell by 20% and lower prices in some of their key brands as part of an agreement with activist investor Elliott Investment Management. Coke has a new CEO. I think Coke is in pretty solid shape. They've been doing their shares have been doing really well compared to some of the other business companies. But yeah, in general, the companies that I think are really tapping into this health and wellness interest in consumers are often the smaller startup brands, and the big companies are playing catch up not only with them, but some of the private label companies too that are really nimble and able to get some of these new products to market really fast.
Well, I know, you mentioned a private label. I know when I go to the ShopRite in Belmar, New Jersey, we buy a lot more private label than we ever used to. That's got to be a bummer for somebody like Kraft Heinz who spent my lifetime getting me to, brand up with Cheese Whiz or something. I mean, now I'm going store brand. That's going to be a problem.
I mean, consumers are definitely under pressure. They still need to buy food, and one of the things they do is turn to more affordable food, and often private label is an enticing option. Interestingly, we are seeing that more on the food side than on the beverage side.
Yeah, that's true.
Yeah, I guess people are willing to pay for beverage, but I mean, I think about, especially on the food side, it's that move towards protein. Everyone is obsessed with ingesting protein and making sure that whatever they are eating, if they are on Ozempic or something else, that it's going to add to their, their healthfulness rather than, kind of take away from it. What are these companies doing in terms of competing better against those startup brands? Are they looking to acquire them, for instance?
Yeah, for sure. In some cases, we saw PepsiCo acquire Poppi, the prebiotic soda brand this year, and Siete grain-free chips. So they are, in certain instances, acquiring some of these companies, and I expect we'll see more of that in 2026 also.
I don't know why processed foods are getting such a bad rap.
We grew up on this stuff, Paul.
I know. I don't know. I guess We'll see.
Times have changed.
Yeah, times have changed. All right, Christina, thank you so much for joining us. Christina Peterson, food industry reporter for Bloomberg News, again joining us here in our studio, talking about Kraft Heinz getting a new CEO. Back to these markets here. We've got the sell-off. We've got the stocks trading pretty much at their session lows here. The S&P off a little more than 0.5%, and NASDAQ off about 0.4%. But it's been a heck of a year for folks that have had the courage to be in the market, as Tom Keene would like to say. But what do we do for 2026? Let's check in with Robert Schein. He is Chief Investment Officer at Blank Schein Wealth Management. Robert, again, stocks, mid to high teens returns, bonds, high single-digit returns for most of it. Boy, even, commodities been ripping, gold and silver and all that kind of stuff. What's the outlook for 2026? What's the conversation you're having with your clients these days?
It's been a great year for 2025. I believe that we will see the Santa Claus rally play out as year-end closes. And for 2026, we see it's all about earnings. Earnings continues. We could see earnings growth not only from technology, but we're also now welcoming the broadening out, and the other sectors, the other 11 sectors, basically 9x energy, are really a backdrop story where we're seeing double-digit earnings growth in some of those sectors. So that could lead into a quality year as long as earnings can stay consistent.
Robert, how much money is on the sidelines? We talk about this $7 trillion wall sitting in money market funds. And for a long time, it was like, oh, there's this dry powder. It's going to make its way into the market. But it hasn't necessarily, even with equity indexes up by double digits for a third straight year. Do you see that changing in 2026?
It's really impressive to see that the money markets have consistently exceeded 7 trillion, close to 8 trillion, still on the sidelines. And as we see yields and rates coming down, that's not going to be a place for investors to hide out moving forward. So that money is going to continue to find better places, if you will. The equity market will continue, but we're also seeing the reinflation trade, right? So we saw the precious metals led by gold and a few others trying to stay ahead of inflation. There's still an underlying effect of inflation out there, but the money market for 2028, you might want to look for better places for your money moving forward.
We've seen tech names be really the drivers for this market for the last number of years, particularly as the AI trade has really taken hold here. Can that still be a driver in 2026, or again, should people be looking for value elsewhere?
It's okay to see a lead change. I think that's what's welcoming for all of us as investors with regards to other sectors taking charge moving forward. Don't get me wrong, we're still going to see double-digit growth rates out of, let's say, the Mag 7, but there are 493 other companies in the S&P 500 that are now seeing some sort of wind in their sail. And next year, we have one big, beautiful bill that's going to put $150 billion of tax relief starting January 1 in the hands of the consumer, and that's going to lead to working its way through other sectors, not just technology in the economy.
Yeah, I mean, within equities, it can often feel like there is just one sector, and that's big cap tech. But you move away from that, and there's a lot of excitement, or there was a lot of excitement about crypto, about private credit. How are you thinking about the allocation to these alternative assets?
The alternative asset space and asset class, obviously crypto has taken a breather the last few months, as we've seen. But the alternative asset class, think, again, metals as well, is still catching a bid. There's still going to be a long-term play, a long-term growth behind it, essentially because everything costs more moving forward. And markets are now trying to find alternatives in private credit as well as the crypto and other asset classes. So this is also fueled by lower interest rate environment. So as the Federal Reserve continues its trajectory, which we believe in 2026 for lower rates, that's just going to fuel all these asset classes.
What is a reasonable, I guess, average for your client type of allocation to alternatives, generally speaking?
About a 10% asset allocation to alternatives. That is growing as we see alternatives and private markets expand their offerings out there. But right now, it's about 5 to 10%.
Are you based in Santee, California?
We are in Palm Desert, California.
All right.
You know about these places?
Yeah, it's east of San Diego.
Today I'm in New York. Yeah, so we're 2 hours from San Diego.
I mean, they're east of San Diego. High temperature today, 73 degrees.
Yeah.
Sunny.
I know.
I mean, that's just ridiculous.
It's like 20 degrees here, Robert. So
Well, he's in New York today. So,
New York freezing today for sure.
all right. So, in the fixed income market, Robert, I mean, if I was in the high yield market, that's where I made returns this year.
High yield, and one of the reasons why is if you look at high yield, it's getting better and stronger, meaning it's not as high yield as we thought it was back in 2 decades ago, where it was really a risk type play. The credit quality within high yields, because of private markets, are taking on some of that alternative risk outside the public markets. We're seeing that improve. So yes, also duration play. Again, as I mentioned, that as yields come down, you're going to want to go more in duration. You could take on a little bit more credit risk, if you will, in your portfolio and pick up some yield as a result.
Are all those concerns about cockroaches over for now? I mean, I haven't heard anyone talk about it in a couple of weeks. First Brands, Tricolor, no one's talking about it the way that they were just a month ago.
Yeah, that could be, who knows? Who really knows how this plays out? It could be just an isolated case or two. Everything that we're hearing from Wall Street is saying that it is contained, if you will, in one-off scenarios. But as that market grows and as that money builds up for these private equity firms to start placing, you're going to see more and more, of these maybe play out, but it might not take, might not be immediate. It could take a few years.
All right, Robert, thanks so much. Appreciate it. Robert Schein, Chief Investment Officer, Blake Schein Wealth Management, based in Santee, California. They have an In-N-Out burger there, I checked.
They all have In-N-Out burgers.
They do. The one near my house, like when we lived in Carmel, the only one was in Monterey.
So you had to drive there?
Yeah, it's only 10 minutes, no big deal.
For California, that's like around the corner.
Yes, exactly. Line out the door, cars backed up into the street, all day, all night.
Okay, someone's going to yell at me about this, but I am not a fan of In-N-Out.
Really?
Yeah, Shake Shack.
Shake Shack
is superior in every way.
They're both good. They're both good. But I'm like, I go in there one time and I was talking to the manager, like, build more. And the guy's like, no, that's the thing. We don't build, we keep it, so people kind of want more, and that's kind of
scarcity
value. So it worked. S&P 500 off 32 points, the Dow off 225, and the NASDAQ off 62 points. We're going to have more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. We've got stocks lower across the board. This Bloomberg Business Flash is brought to you by Harvard Business School Executive Education, a world-class learning experience for aspiring and established changemakers. Prepare for the next elevation for your organization and for yourself. Learn more at hbs.me/breakthrough. Stocks lower, signs that the jobs market is sluggish but not rapidly deteriorating. Saw traders refraining from adding bets that the Fed is going to keep cutting rates in the near term. S&P down 38 now, 67.77, down 0.6%. Dow Industrials also down 0.6%. NASDAQ down 0.4%. The NASDAQ 100 index down 0.4. Small cap shares selling off with the Russell 2000 index for small caps down by 0.6%. 10-year right now at 4.14%. The 2-year 3.48%. Gold down $12 the ounce, 42.92, down 0.3%. And West Texas Intermediate crude oil down 2.6%, 55.35 a barrel. Bitcoin up 1.4%. Bitcoin 87,418. JetBlue CEO Joanna Garrity says the airline's goal for 2026 is to break even on operating margin. And in an interview that aired moments ago with Bloomberg, she did talk about the current quarter and the impact of that government shutdown.
We haven't disclosed any kind of revenue loss. We've said that we remain on track for Q4, and I think we're pleased with what we're seeing in terms of bookings coming in for the balance of the month. We definitely saw some softness, obviously, during the government shutdown, but we're recovering coming out of that. I think most have shared that, but it was definitely an impact, and unfortunate that the airlines were put, right in the middle of that shutdown.
Joanna Garrity, CEO of JetBlue, speaking with Bloomberg as the airline opened its first lounge at JFK in a premium push. That lounge, by the way, called Blue House. Southwest Airlines shares higher after Barclays raised the recommendation on the stock to overweight from equal weight, citing a new commercial strategy that includes assigned seating and bag fees. Shares of Southwest up now by 2.4%. JetBlue, by the way, up by 1.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, thank you so much, Charlie Pellet. Oh, how times have changed for JetBlue and Southwest.
Yeah.
Just hearing about that is like, oh, remember JetBlue didn't used to have different classes. And
Yep.
Southwest, there was no assigned seating, but I guess there is now. So we want to take a look at the companies to watch for in 2026, but how do you shrink that universe of investable companies down into 50 that you really want to focus on? Well, thankfully, we have Bloomberg Intelligence and Tim Craighead, who is our Global Chief Content Officer, for doing just that. Tim is joining us right now. And Tim, you guys have really narrowed it down to companies to watch for better or for worse. And you have a couple of themes to keep in mind here. What are the companies, or what are the big themes that have the most companies that you really point us to?
Yeah, sure thing. So, and we can dive into some of those, but put a little bit of context. This group of 50 are all part of what we call focus ideas. It's a broader group of about 100. These are all high conviction ideas. They have high conviction ideas where we see something very different from what we think is embedded in market expectations. And there's catalysts ahead to change the market mindset. Those catalysts coming up in 2026, and that's where these 50 come into. And across the group this year, the biggest bucket are two. One is just simply new product innovation that is being ramped out into 2026. The other, no surprise, AI related, and in some of it's the tech companies, some of it are companies that are feeding into the process, and happy to get into some of those or other topics as well, such as cyclical pressures and competitive concerns on the negative side, and there's a couple of other things as well.
So on the new products, give us an example of a new product that you guys think might really be important for a company and a stock.
Yeah, so it's interesting because some of these can be quite technical, Paul. You think Anilin Pharma or Bridge Bio are two biotech companies that have new products coming. One of them relates to heart issues, another relates to dwarfism, but it's new products that will expand the market and drive, we think, significantly better revenue and earnings. On the other hand, there's some good old-fashioned names that you know and you love. Canada Goose has new product flow coming through that we think reinvigorates the top line. Brinker, think Chili's, the restaurant, are going through a whole new upgrade of their menu and upselling clients with good stuff like margaritas with Patron. So the new product idea can expand across a whole number of different segments. It's quite interesting.
Yeah, I'm looking at Deckers as one of the new products companies you highlight, and their UGG is introducing styles to stay relevant beyond the winter months. Let's talk a little bit about AI, because that's going to continue to be a big theme, even as investors are starting to make distinctions between companies that are in it for good and those that may be kind of faddish. What are some new names that surprised you in terms of their making the list?
Yeah, it's interesting. I'll give you the new names and the ones that aren't on here, and I'll do the latter first. There's none of the big LLMs this year that are on our list, or NVIDIA that's on the list, that's not on the list. What you find are either enabling technologies. So think Lam Research. It's a semi-cap equipment company that makes gear that you make the semiconductors with, that's quite well positioned. TSMC, the world's largest foundry, that's making the AI accelerator chips that feed into the LLMs. Or even back up in the channel of how do you build out AI, Constellation, which is the U.S.'s largest nuclear utility, that's quite important if you're going to generate the electricity to drive the data centers, to drive AI. ACS, interestingly, European construction company, they own Turner, which is the U.S.'s largest construction company. They've got the biggest order book for building out data centers. So there's a host of different kinds of ways you can think about leveraging AI beyond just simply the big LLMs like Google or OpenAI or things along those lines that you hear about.
Tim, on this list, you and the BI analysts also highlight stocks that might be have pressure on the downside, whether it's cyclical pressure, competition, M&A, project delay. Give us a name or two that might have some downside risk this year.
Yeah, it's interesting on that. Think about what's going on from the standpoint of you were just talking about airlines. From a European vantage point, we've got wage pressures that are rising, and for Air France KLM, a big chunk of their business is the transatlantic market, which is getting more and more competitive. And with both of those factors, we think that there's risks to estimates. China Railway Group, it's a big state-owned enterprise in China. It's one of the big four engineering companies. And to the degree that China is shifting towards more technology and innovation-driven investment and less away from bridges and roads and railroads and things along those lines, China Railway Group, we think, has downside risk. Couple little companies that are unusual but intriguing. Dino Polska, which you've never heard of, I'm sure, is a Polish supermarket company. But they've got two big European competitors that are coming into the Polish market. Again, downside risk to earnings. And the same thing can be said about Join Labs. We talked about a couple of positive healthcare companies. This is one of the contract research companies that helps a pharmaceutical do their drug development. And China is now looking to go broad and global with approvals on new pharmaceutical products. Join, who focuses in on China, is losing some of their business. So there's lots of ways we can think about this.
All right, Tim, great list as always every year. Tim Craighead, Global Chief Content Officer for Bloomberg Intelligence. He's based in London. 50 companies to watch for in 2026. This is a global list, global companies. You go to the BI Go on the Bloomberg terminal, and that's where you'll find this research. So some good stuff coming out of the global research team at Bloomberg Intelligence. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Well, yesterday, Ford announced it will take a $19.5 billion charge tied to an overhaul of its electric vehicle business after struggling to turn a profit. Speaking with Bloomberg's Romaine Bostick, Katie Greifeld, and Matt Miller, CEO Jim Farley says the overhaul is about moving towards more profitable vehicles.
Look, for this announcement, Matt, it's really about moving to more profitable vehicles. You know, we're going to make in Tennessee now an affordable pickup truck. I think it's going to really surprise the market. These are customers we know, not a lot of guesswork in terms of the revenue, the cost we need to get at, and a more affordable van in Ohio. So these are going to be better investments for the company profit. And all those hybrid sales, you know, those are really profitable vehicles for us.
All right, that was Ford CEO Jim Farley speaking with Bloomberg's Romaine Bostick, Katie Greifeld, and Matt Miller after that $19.5 billion charge. Let's break it down and what does it mean for the company and for the stock. We do that with Steve Mann, Global Autos and Industrials Research Analyst at Bloomberg Intelligence. He's based down there in Princeton. Steve, $19.5 billion, that is a massive number for Ford. What goes into that number? What does it mean about their commitment to EVs?
Yeah, it is a very big number. It pretty much backed up the truck on these charges. But the important thing is it's clearing the deck for next year, right? There is a couple of earnings tailwind for Ford and actually to their competitors in Detroit as well. So I think the biggest write-down, two biggest write-down is the writing down the losses on their Mustang Mach-E. They've been losing around $25,000 on the EBIT line per vehicle. So it's massive. The other is the charge is really on their joint venture with their battery supplier in Korea. So, they're going to repurpose one of those plants for energy storage. So, again, it's really clearing the deck. There's a couple of tailwinds for 2026, which includes, Trump's loosening the MPG miles per gallon rule.
Yeah, absolutely. Just looking at the stock, pretty much flat today, but the stock is at a 52-week high, up 37%. Does that reflect, Steve, investors want these auto companies to kind of back away or proceed more cautiously towards their move towards EVs?
Yeah, definitely, especially in the U.S. And look, Ford is not just pivoting in the U.S., but they're also pivoting in Europe. They just announced a joint venture with Renault to develop EVs over in Europe, and Ford doesn't really have a big presence in Europe, so they're taking that approach of partnership. GM is doing the same thing. Remember, they took a $1.6 billion charge, much more modest than the $19 billion that Ford is taking. But GM is dialing back, but keeping one foot on the EVs. I believe they still think that they still can succeed, especially when they introduce the Chevy Bolt in the new year.
So, Steve, we're many years into this transition to EVs, and I know there are European countries, Scandinavian countries, where it's almost 100% of their fleets are their new car sales are EVs. But that ain't the case here in the U.S. With some hindsight here, why haven't EVs taken a better hold here in this U.S. market?
Yeah, it definitely needs more, regulatory support for EV to take grow, because EV, there's three hurdles, right, that consumers have to get over, which is the price, the range, and the convenience, right, of charging infrastructure. Without government support to actually build that out, it's going to take some time for this electrification transition. I think a lot of people in the industry still feels that electrification, battery EV, maybe hybrids in between, is the way to go in the future. But I think there's a huge paradigm shift that consumers here have to get over, and it's really challenging to do that without government support here.
And it does not appear that this administration, at least, is willing to provide that support. How does the industry kind of view that?
Oh, it's very unfortunate. I think the gyration, the volatility that we're seeing in regulation is really not helping the industry. There's a lot of sunk costs that's been incurred with the shift to de-emphasize EVs. Many automakers around the globe have spent billions. With that $19.5 billion that Ford just written down, it's probably about half of what they've invested in EV already.
Wow.
So we do need more stable policy. You mentioned Europe earlier. Europe is in the same situation. I don't think the European regulators really know what they want to do in the future. They're still continuing to talk about, delaying going all EVs by 2035, and that's going to have, some negative as well as positive implication to the global auto industry.
All right. I went the hybrid route with the last vehicle I bought for the number 4 Offspring. It seems to be working out well. Maybe that's the future. Yeah. Steve Mann, Global Autos and Industrials Research Analyst for Bloomberg Intelligence, giving us the latest here. Again, Ford, $19.5 billion with a B, right down on their EV business. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio, on SiriusXM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories in global business headlines are coming up right now.
This is CBS News on the Hour, sponsored by Steel.
I'm Steve Kathan. There could be action in a matter of hours in the case against a son of Rob Reiner and wife Michelle, who were killed at their home. CBS's Adam Yamaguchi.
Investigators are expected to present their evidence to prosecutors later today, and the DA's office has until tomorrow to press formal charges. Now, two sources who attended a Christmas party on Saturday night have told CBS News that they observed some uncomfortable behavior between Rob and his son Nick at the party. Apparently, there had been a loud altercation that took place.
The manhunt continues for the Brown University shooter. In Washington, Democrat Ted Lieu is among the critics of FBI Director Kash Patel, who posted about a person of interest who was later released.
He wrongly identified a potential suspect in this case. There's literally no reason for the FBI director to have to be the first one to tweet something, to put out these things before verifying the facts. And when he does that, it ends up potentially ruining lives, putting the public at risk. And it's not something that FBI director needs to do. I asked him to just stop doing that.
Defense Secretary Hegseth indicated this morning that 2 congressional committees would get to see the attack video where survivors of an alleged drug boat were killed sometime tomorrow. Hegseth on Capitol Hill with Secretary of State Rubio.
Obviously, we had a classified hearing, so the details of which we can't discuss. It's, I believe, our 22nd or 23rd bipartisan engagement. We'll continue to engage with Congress on this. We're headed to the House now to do a similar briefing.
The government says the unemployment rate hit a 4-year high last month, up from 4.4 to 4.6%.
That 2-point jump in the jobless rate certainly raises eyebrows, and it's the number that the public most pays attention to.
Economist Constance Hunter, the report says 64,000 jobs were created last month. 105,000 were lost in October. White House advisor Kevin Hassett.
The job number has stayed strong, even though we're being really fiscally tight.
Officials in Washington state say a man who drove past warning signs has been found dead in a car submerged in floodwaters near Seattle. Some good news for people who want to take in the Grand Canyon, as we hear from CBS's Jim Krasula.
Popular hotels on the Grand Canyon National Park's South Rim are reopening after being closed for a week because of broken water lines. Some campground water sites will remain offline, and South Rim fire restrictions will continue. Most of those who visit the Grand Canyon do so at the South Rim.
And checking Wall Street, the Dow is down 230 points. This is CBS News. Scientists say there is something weight loss injectables can't do.
Researchers from Novo Nordisk have presented data that show Ozempic failed to slow the progression of early Alzheimer's in 2 clinical trials. Now they're trying to understand why. While scientists say GLP-1 drugs and other gut hormones have a positive effect on cognition, Dr. Daniel Drucker at Mount Sinai Hospital in Toronto tells the New York Times the new findings are a reason to tone down the wonder drug discussion. Studies have shown the drugs can improve liver, kidney, and heart health. Deborah Rodriguez, CBS News.
Retiring Georgia Congresswoman Marjorie Taylor Greene, at odds with President Trump, has announced her engagement to pro-Trump reporter Brian Glenn. No winning ticket in last night's Powerball drawing. Jackpot for tomorrow night will be an estimated $1.25 billion, sixth largest all time. Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
Unemployment marches higher. Welcome to the Tuesday edition as the government drops jobs data for November, reinforcing the Fed's decision to cut rates this month, as we'll discuss with Anna Wong, the chief economist at Bloomberg Economics. Ford announcing a sweeping overhaul of its electric vehicle lineup. And we're following, of course, the healthcare debate on Capitol Hill. We'll bring you to the Capitol for a live update here. And President Trump's chief of staff, Susie Wiles, raising eyebrows in town today, calling her interview now with Vanity Fair a hit piece. We'll get into it with our political panel, all after a look at Wall Street. Let's get up to date with the Tuesday trade. Now, Charlie Pellet has the latest on the markets live from New York. Charlie, how's it going?
Indeed, Jobs Tuesday, Joe Matthew. Right now we have got the Dow, the S&P, NASDAQ, all declining. If you come to me a minute earlier, I would have told you NASDAQ was higher. Right now wavering, down 7, lower, little change there, down under 0.1%. We've got the S&P down 22, drop there of just about 0.3%. And the Dow now down 220 on the Dow Industrials, a drop there of 0.5%. Interestingly, the Mag 7 index is advancing up by 0.2%. That, of course, the Bloomberg Mag 7 index, our 10-year 4.15% with a 2-year 3.48%. Gold up $3 the ounce, 43.08, up by about 0.1%. And a retreat for crude, now down 2.1%. West Texas Intermediate crude 55.62. Barrel of Brent, the global benchmark, 59.27. It too down by 2.1%. Bitcoin is advancing up 1.9%, 87,750 on Bitcoin. So the U.S. jobs market is sluggish, but not rapidly deteriorating. As for the next up for Wall Street, of course, the CPI report on Thursday. Christina Campmani is Senior Portfolio Manager at Invesco, and she was a guest this morning on surveillance.
It is a cleaner number, and then we go into 2026 and we say we're getting stimulus and we're getting all of the impact of the big, beautiful bill, which could have more inflationary pressure. And I think if you take a step back, the Fed obviously eased last week, but right. I think they have some underlying concerns about inflation, probably more than the market, which is more concerned about the labor market breaking down.
Christina Campmani of Invesco, interviewed on surveillance. Ford is going to be taking $19.5 billion in charges tied to a sweeping overhaul of its EV business after struggling for years to make it profitable. It's a topic we'll have a whole lot more on coming up here on Balance of Power. But let me tell you, Ford shares right now lower, little changed on the day. Rival GM down 0.3%. Stellantis, a parent of Jeep and Chrysler, down by 0.2%. Recapping the 10-year, 4.15%. S&P down 0.3. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And back we go to Washington. Once again, your host, Joe Matthew.
Okay, Charlie, many thanks. And we'll have more on the markets with Charlie Pellet in just about 15 minutes' time here on Balance of Power. Welcome to the Tuesday edition on Bloomberg Radio, streaming live on YouTube and always available on satellite radio, channel 121 if you've got Sirius XM dialed up for the holidays. Thank you for joining us. However, you might be finding us here in Washington, D.C. 16th of December as we count down to Christmas and the expiration of extended Obamacare subsidies. That's at the end of the month, just in time for the ball to drop. And there's going to be some motion today on Capitol Hill. We'll talk about this in a moment with Jonathan Tamari in the House of Representatives. The Rules Committee is going to get together, and that might help determine where the moderates go here if there is, in fact, a plan to vote on before this week is out. Hold your breath on that one as the Defense Secretary, the Secretary of State, and the Chair of the Joint Chiefs make their way to Capitol Hill to brief all members of Congress on what's going on in the Caribbean. We'll talk about that a bit later on as well, with the town waking up this morning to the Vanity Fair interview with Susie Wiles. If you haven't gotten your hands on it yet, we'll get into this with our political panel a little bit later on this hour. The Chief of Staff, said by many to be the second most powerful person in Washington, D.C., speaking in some cases out of school, although she said after this came out that It was a hit piece. We'll get into this a little bit later on. As we seize the economic news of the day, big expectations here. Did you see what happened? 8:30, the futures seem to like the news here. I don't know what's going on now, but payrolls rising after an October drop. Unemployment marching higher is the headline. A 4-year high. And the idea that bad news is good news once again plays into the Fed, of course. And we're going to talk to Anna Wong in just a moment about this. She seems to think that this really codified the idea of that justifying that December rate cut. We heard about it earlier from the administration, speaking on behalf of the president today, Pierre Yared, the Council of Economic Advisors, acting chair, and the way the White House wants us to look at the jobless rate. Listen.
If you look at the unemployment rate, it's true that the unemployment rate did tick up. That uptick, though, is statistically insignificant. And if you dig into the numbers and look at what caused it to go up, it's entirely driven by re-entry into the labor force. And that's consistent with the fact that when you look at the labor force participation rate, that labor force participation rate also went up.
Yes, re-entry, almost like a NASA astronaut, people jumping back into the workforce. The question is why? Are they running out of savings? Are prices going up too much to continue their current lifestyle? These are the questions that some economists are asking as we try to project where the market might be, the job market specifically, a couple of months from now. Anna Wong joins us to that end, Bloomberg Economics chief economist. We thought we'd go to the top. Anna knows what it's like to work in a Trump White House. She was an economic advisor in the first term and is bringing to bear her experience with us right now. Anna, welcome back to Balance of Power. Why are more people looking for work?
Well, first of all, let's assume that these re-entrants is not a statistical error, but for real. Well, most of these re-entrants are teenagers. And what we have seen earlier this year, you have to consider the participation trend since January, is that we have seen steady drop-off of teenagers and people in their early 20s from the labor market from April to most of the summer. So right now, this re-entrance is simply, a bounce back from, these people dropping off from the labor market. I think it's a good sign. Mm-hmm. It's a good sign that they're looking again, because we have seen 6 months ago that they were discouraged and they were not looking anymore. And I'm sure parents who are living with them are happy that their kids are looking again.
That's got to be true. Unemployment rate, 4.6%, as we just heard from Pierre Yared. If you look at the unemployment rate, it's true, it did tick up, but it is statistically insignificant. Do you agree?
Yes, it is statistically insignificant also because this survey is missing the October number because of the government shutdown. Mm-hmm. And with one missing month, that actually increased the standard error by a scale of 1.06. So so Pierre is correct that one shouldn't be taking this jump in unemployment rate at face value. And Powell himself also mentioned it last week. Literally, he said that one should look at this jobless rate number with skepticism. That said, I will also say that one other reason why the bond market probably dismissed this jump in unemployment rate was that another key factor is a rise in temporary layoff. So the temporary layoffs increased by 171,000, and these people are expected to return to the jobs within 6 months. So you could see that some of this jump in unemployment rate will revert in 6 months' time.
Mm-hmm. You write that the jobless rate rose briskly, and it's a possibility the SOM rule to identify a recession would have been triggered if October's household survey had been conducted. Does that make us worry about the next jobs report?
Well, so what one should take away from this triggering of SOM rule is that there's this idea that whenever people get so worried about the labor market that, when you talk to other people and other people start saying how they're, they feel insecure about their jobs, such insecurity will lead to caution in spending, and that will snowball into, non-linearities in the labor market, and the unemployment rate will keep rising. So that's the idea of Somme rule. It doesn't need to hold. I mean, last year it triggered also, but it came back down, and the unemployment rate was subsequently revised down after BLS updated the seasonal adjustment. So it could be that next year, in 2 months' time, we are going to see a revision to the household surveys seasonal adjustment, and that could also, lower the unemployment rate from 4.6 to 4.5, depending on the seasonal factors.
As we take a deep dive with Anna Wong, Bloomberg Economics chief economist, we'll turn to your take on the Fed, Anna, and you say it pretty straightforwardly today. The double jobs report vindicated the Fed's decision to cut rates in December. What does that mean about its meetings early next year?
Yeah, so, what alarmed me in this jobs report is that the November non-farm payrolls is half as large as what we anticipated. And we anticipated a number that's already weaker than a year ago. And I thought that this surprise was pretty sizable. And also, we are seeing that job gains are concentrated in pretty much only two sectors, the education and healthcare, as well as construction driven by AI data centers. And I think that going into the new year, we are going to see perhaps weaker payrolls because the birth and death model is going to get updated. And this 60,000 overstatement that Powell has mentioned that has been overstating printed non-farm payrolls, much of that is going to go away. And so the release data will look pretty weak in the new year. And so we think that that could catalyze the Fed in doing more.
I want to ask you about the statement that we received from Caroline Leavitt, the White House press secretary. After extolling the virtues of the job market here, she says in summation, workers' wages are rising, prices are falling, trillions of dollars in investments are pouring into our country. And Anna Wong, the American economy is primed to boom in 2026. Is it?
So I think what Carolina Leavitt is referring to in terms of the wages is real wages, so nominal wage adjusted by inflation. So that has been improving since 2022. However, you could see in the average hourly earnings today that, in fact, it's slowing. We saw from the employment cost index a week ago that nominal wage is basically running at 3.5%. So adjusted for inflation, basically the underlying pace of core inflation is running at about 2% right now, just at the Fed's target. In terms of the boom in 2026, I think most economists would agree that a lot of headwinds this year is turning into tailwinds.
Tailwinds, says Anna Wong. Take heart. Anna, thank you for your read on the jobs market today. Find her work on the terminal and online. Vindicating Jay Powell, Bloomberg Economics chief economist, getting us off the launch pad here on the Tuesday edition of Balance of Power. I'm glad you're along for the ride. I'm Joe Matthew in Washington. This is Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ all in the red right now with a 10-year 4.15%. Signs that the jobs market is sluggish, but not rapidly deteriorating. Saw traders refraining from boosting bets on near-term Federal Reserve rate cuts, sending stocks lower, and bonds wavered. Right now, the S&P's down 23, 67.93, down by 0.3%. The Dow Industrials down 229, down 0.5. The NASDAQ Composite Index down 11, a drop there of under 0.1%. The Bloomberg Mag 7 Index, though, holding on to a gain, up now by 0.2%. The 10-year at 4.15%, the 2-year 3.48%. Gold flat on the day, 43.05 the ounce. West Texas Intermediate crude down 2.4%, 55.44 a barrel on WTI. Brent 59.11, barrel of Brent down now by 2.4%. And Bitcoin up 1.6%, Bitcoin at 87,605 on Bitcoin. So bottom line here, the Dow, the S&P, NASDAQ are all declining. Oil is extending declines. Again, we've got the price of crude, West Texas Intermediate, down now by 2.4%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you. Charlie Pellet will have more on Wall Street in about 20 minutes' time here on Balance of Power as we keep our eyes always on stocks while we talk politics here in Washington. And boy, it must have been a meeting this morning. It's not every day the SecDef heads to Capitol Hill alongside the chairman of the Joint Chiefs of Staff and the Secretary of State. Big stuff happening with a briefing for all members of Congress. This is not just D's and R's about what in the world is happening in the Caribbean. This, by the way, after the defense secretary greenlit 3 more strikes. They blew up 3 more boats. They say killing 8 men. Southern Command referring to them as narco-terrorists. Now, this comes with pretty important news here that the Trump administration is going to be showing the video of the double tap, I guess the second tap in the double tap strike. To all members of the Senate and House Armed Services Committees, Hegseth today saying it will not go public. So you'll need to wait for the leaks. It has only been shown so far to the gang of 8 top members of Armed Services and Defense Appropriations panels. We want to go around the world on this one, or at least both ends of Pennsylvania Avenue, because we're hearing obviously from the White House on this, and today you've got the briefing on Capitol Hill with a war powers vote, at least one of them, maybe more, set up for the end of this week. Bloomberg Washington correspondent Tyler Kendall is with us right now in studio. Tyler, it's great to see you. What is the White House willing to share with lawmakers today? I guess it looks like it will include this video, but only for certain eyes.
Right, exactly. And we should say, while only certain eyes have already viewed it, we are expecting tomorrow the full House and Senate Armed Services Committee to be able to review this footage that you're discussing about that attack on September 2nd, that strike on September 2nd, where we saw that second strike that went after these survivors that were still on the boat. President Trump had previously indicated that he would be fine with this footage being released. So this does seem to be a sort of shift in policy when it comes to the administration. So we'll have to see what other sorts of information we ultimately do get out. As you're mentioning, the U.S. conducted additional strikes overnight. And then we have some pretty incredible reporting from Bloomberg News that an armada of 4 super tankers originally headed for Venezuela have actually now reversed course following, of course, that similar seizure that we saw last week, as sources tell us that this really has begun a new phase of the administration's approach to Venezuela, and it's designed at cutting off oil revenue in a bid to get Nicolas Maduro, the leader there, to relinquish power.
President, just as recently as yesterday, again with the land strikes, he's promised his land, where he says the land is next, and has been saying this for days now. Do we have any sense that this is being planned?
That would be a significant escalation. Yeah. Of course, I would encourage everybody to go look at Bloomberg Economics. Our analysts have actually put forward exactly how this could escalate. Land strikes, of course, would be on the high end there, and they break down what sort of areas we could see be targeted. Very likely this would be infrastructure strikes if it were to happen. But again, that would be a really significant escalation, and it appears that at the moment the administration is really zeroing in on this oil revenue. And keep in mind, this is going to impact China, Joe, and I know that we often bring the connection back to China, but it's really important here because more than half of Venezuelan crude that hits the market ends up going to Beijing.
Remarkable. Some of the reporting that we've seen here about the tanker ships, like the Skipper, as you mentioned, that was seized, would suggest that we're going to see a number of seizures in the immediate term. The White House has told people to prepare for that, right? This was the beginning of a new effort.
Right, exactly. Also keep in mind the context here. The U.S. hadn't seized a foreign oil tanker like this since 2014. So it's been a really long time. We also have reporting that Venezuela's state-run oil company has already been preparing for alternate routes to maybe go into effect to, again, make sure that their barrels can get to market. Important to note that this tanker that was originally seized last week was part of what we call the dark fleet that has been supporting not just Venezuelan oil exports, but also sanctioned Iranian oil exports. So clearly part of a broader effort here that can have a really big impact.
Anything on the public schedule today? Are we going to hear from President Trump?
I believe he does have an event a little bit later today. We've already heard from some members of the administration, of course. It's a delayed jobs day today, but then Vice President J.D. Vance, I know you've been discussing this, already out there in Pennsylvania talking about the administration's economic policies, and of course that has to do with trying to drive down oil prices, which connects us right back to the story.
Maybe you'll have something to say at the Hanukkah reception tonight. I know they're going to let the pool in there for a while. Tyler, thank you as always. With us here in the Bureau, Tyler Kendall reporting from Washington on Bloomberg. Aides have reportedly presented the president with a series of plans on where to go here in Venezuela. Tyler was referring to the Bloomberg economics take here. Options to escalate by striking drug labs, they say, deep in the jungles of Venezuela, drug warehouses, and there are anti-aircraft military installations there in Venezuela that would likely be first to be targeted. Jonathan Tamari is carrying this story on the other end of Pennsylvania Avenue for us, and we want to go live to Capitol Hill where these briefings are taking place. In fact, producer James telling us he's got eyes on Senate Democrats here briefing reporters following their briefing with the administration. Jonathan is Bloomberg government senior Congress reporter, and it's been too long, Mr. Tamari. Welcome back. We've got our eyes on what's taking place in the briefing room right now with Senator Amy Klobuchar talking with reporters. Has this all wrapped up for the day in terms of their briefings from the administration, and what did they learn?
Yeah, I believe that there are still maybe briefings occurring with the House, on the House side of things with the administration. You know, we heard some of the pushback from Pete Hegseth, as you guys were just discussing, about releasing the full video. We've certainly heard from Republicans included who say that they would be okay with the video going out publicly. And there are still questions about what is the end goal here. What are they trying to do? What's the final the final outcome that the administration wants? And I think there are some senators in both parties that are still asking that.
Well, it sure sounds like it. We heard just a couple of days ago from Congressman Jim McGovern, the Democrat from Massachusetts, has a war powers resolution expected to hit the floor this week. We know that Senator Ruben Gallego has his own in the Senate. There could be others, Jonathan. Will we see a war powers vote before everyone leaves for the holidays?
I'm not sure that we'll actually see a vote. I think we'll see an attempt. Senator Adam Schiff has said that he's going to attempt to get unanimous consent in the Senate for a vote to kind of skip past the normal procedures that are required. I expect that would be blocked by somebody because it only takes one person to block it. But Democrats are definitely trying to put this issue front and center and to make Republicans take a public position on this, which I think there's, you know, split opinions within the Republican Party about not necessarily the actions in Venezuela, but whether the Congress should be involved at this stage.
Yeah. Reporting that the administration will show video of the second strike on the double tap on the 2nd of September to members of the Senate and House Armed Services Committees. That'll take place later this week. Jonathan, do we know anything more about it?
Not yet at this point, or at least not to my knowledge at this point. But I think that's something that a lot of these senators have been looking for, and you will see, you know, I think the wider the circle gets, the harder it gets to kind of keep something like that kind of secret.
Isn't that the truth? I want to ask you about healthcare. This is the other matter at hand this week on Capitol Hill, and we might actually see some voting, but apparently not on a bill to extend Obamacare subsidies that are set to expire at the end of the year. What did we learn from Speaker Johnson today?
Well, they're not going to allow the amendment that a group of moderate House Republicans wanted to have a vote on that would at least give them a chance to say, hey, we tried something. We voted for something to extend some of these subsidies. Now, as we talk right now, Some of those moderates are meeting with the speaker again to see if maybe there might be another different option that might be possible. So it is still a pretty fluid situation right now. There's some committee votes later today, floor votes, that could tell us kind of how this is going to shake out. The bottom line is it does not look like there's any chance of anybody actually solving this problem between now and the end of this year. They may try to attempt it in January, but there are different Republicans who are trying to find a path forward or at least show that they're working on the issue, and it's unclear if their leadership will allow them even that kind of vote.
Well, we know there's a discharge petition that Hakeem Jeffries is pointing Republicans to here. I don't know if it has a chance. Jonathan, you can tell us. I believe it's got 214 Democratic signatures here, would force a 3-year extension on Obamacare subsidies. Does it stand a chance?
So it kind of depends, I think, on where these moderates, where they get with Johnson, and if they feel backed into a corner or not. They feel like they need to show their constituents in their districts that they're doing something. If Johnson gives them a vote, that might be that thing that they can show them. But if he doesn't allow them a vote, then maybe they need to sign the petition to say, hey, we did all that we possibly could. So I think that's what Hakeem Jeffries is counting on. I don't know yet, though, that they're going to cross their party in that way. That would be a really big step to cross their leadership.
That would be huge. But they're meeting with Jeffries right now, Jonathan? Is that the idea?
Johnson right
with
now.
Johnson.
They're meeting with Speaker Johnson. So if they can get something else to vote on, maybe that gives them a chance, and then they probably would not sign that discharge petition in that case.
Well, this meeting's going to be awfully important then, I suppose. You know, it's the first day I saw somebody put a number of days until a possible government shutdown in one of the Washington tip sheets. It's 45. If you want to start the clock here, Producer James, and I don't think we're at that point yet. Jonathan, everyone was saying this was a ridiculous question to ask even a couple of days ago, that after a record-setting shutdown, no one would have the appetite for it. Now it's getting a real thought that if this falls apart when it comes to health care, the government may not be funded at the end of January. That's when we run out of money. What do you think?
Yeah, I mean, I think I would still bet against it, but the odds are increasing, as you point out. It's a little less implausible than it was a little while ago. The Senate was supposed to try to get some spending bills moving through here before the end of the year to kind of tee them up for the start of next year. They haven't been able to do that yet. So already they're kind of falling behind where they hope to be. And some of the Democrats who crossed lines to end the shutdown that we saw in November are saying, listen, if we don't get the healthcare vote, the healthcare extended, they might not be as favorable to funding the government in January. So it's certainly a risk right now, and a rising risk.
Either way, everyone's leaving Friday no matter what happens, right?
That's for sure. That's the one thing. There's a lot of unpredictable things, but Congress making it out on time for their vacations, there's no doubt about that one.
We can have faith in some things still in Washington. Jonathan, great to see you. Jonathan Tamari, Bloomberg Government, live on Capitol Hill. There you see him in the halls of power as we wait for something to happen. We'll keep tabs on that meeting with Johnson and a looming Rules Committee hearing that's coming up in the House that'll likely set the map for the rest of the week. Prepare to be disappointed. That's what we do around here these days in Washington. We'll assemble our political panel next. Susie Wiles is speaking. Vanity Fair is listening. This is Blue.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. Jobs Tuesday, stocks lower. NASDAQ Composite Index just dipping below 22,994 right now. NASDAQ is down 62, a drop there of 0.3%. Keeping it all in context, right now the S&P 500 Index is down 36, down 0.5%. Dow Industrials down 309, lower by 0.6%. The Bloomberg Mag 7 Index just turning negative as well. 10-year yield is at 4.15%, with a 2-year 3.47%. Gold flat on the day, 43.04 the ounce. West Texas Intermediate crude 55.38 a barrel, down 2.5%. Brent, the global benchmark, just above 59 now, down 2.5%. And Bitcoin is up 1.2%, 87,275 on a Bitcoin. A noisy reading reflecting some of the impacts of the longest government shutdown in U.S. history is being received by traders with caution. Administration reaction to the jobs report from Pierre Yared, the acting chair of the White House Council of Economic Advisors.
If you look at the unemployment rate, it's true that the unemployment rate did tick up. That uptick, though, is statistically insignificant. And if you dig into the numbers and look at what caused it to go up, it's entirely driven by re-entry into the labor force. And that's consistent with the fact that when you look at the labor force participation rate, that labor force participation rate also went up.
Pierre Yared, the acting chair of the White House Council of Economic Advisors. Visa is opening its U.S. network to stablecoin settlement, expanding crypto-linked products and services enabled by the relaxed regulatory environment under the second Trump administration. Visa shares, they're down today, down by 0.2%. Rival MasterCard also lower, down now by 0.4%. Recapping, the S&P down 0.6, the 10-year 4.15%, Bitcoin up 1.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. And back we go to Washington. Once again, your host here is Joe Matthew.
All right, Charlie, many thanks. Charlie Pellet will be back at the top of the hour, 1 p.m. Eastern Time, with his read on Wall Street. It's only Tuesday on the early edition here of Balance of Power. Thanks for joining us on Bloomberg Radio. Unless you're watching us on YouTube, we'll welcome our global television audience to the conversation coming up at the top of the hour when Charlie checks the markets for us. And I will let you know that we're going to have a conversation coming up with the chairman of the Ways and Means Committee. You'll want to be with us around 1:20 p.m. Eastern Time when Republican Congressman Jason Smith joins. Big questions today, and maybe he can give us a readout of that meeting we just talked to Jonathan Tamari about. Lawmakers sitting down with Speaker of the House right now to figure out exactly what's going to happen when it comes to health care this week. It is looking like that amendment to extend Obamacare subsidies is not going to hit the floor, at least not in that form. So will moderates be pushed by the Speaker into the arms of Hakeem Jeffries is the question right now. With a discharge petition, only needs, what, 4 signatures, 5 signatures? Just a handful, literally, of Republicans to force a vote on extending Obamacare subsidies by 3 years. Now, of course, maybe that happens. Call that a miracle if you will. Maybe you don't want it to happen. But then, of course, you've got that chamber next door called the Senate, and they're getting ready to leave town. So we're probably going over the cliff one way or the other. That's what you've been hearing on this broadcast. That's all we're hearing every day. Whether that can be saved in the new year is the question, and whether the government will be funded through the end of January or beyond, I should say, is maybe a bigger question right now. It's not getting any easier around here, and Susie Wiles does not appear to be helping. Well, this is a story today, isn't it? I woke up to this having been emailed to me from multiple people. The chief of staff at the White House, known widely as having the second most important job, the second most powerful person in Washington politics, Susie Wiles, the one who never gives a speech. Remember when Donald Trump called her up to the microphone the night he won the election? Even Dana White got up there, not Susie Wiles. She is said to be in the background, disciplined, keeping the core group together after getting Donald Trump reelected. Fast forward to Vanity Fair magazine. People do still read magazines. Vanity Fair Daily exclusive. Susie Wiles speaks her mind. What could go wrong here? Remembering, of course, that Friday, a couple days from now, Friday is the day that the Epstein files are supposed to come out. Speaking openly about a range of controversial topics, including the aforementioned Epstein files. Susie Wiles, speaking to Vanity Fair. Wiles told me she'd read what she calls the Epstein file. Check this out. And she said, Trump is in the file. And we know he's in the file, she said. And he's not in the file doing anything awful. Wiles said Trump was on Epstein's plane. He's on the manifest. They were, she says, you know, sort of young, single, whatever. I know it's passé, but sort of young, single playboys together. Trump started dating Melania, just as a reminder, whom he married in 2005, sometime in 1998. So how does she think Pam Bondi is doing with this whole thing? You might have just seen it on the screen. If you're with us on YouTube, Susie Wiles talking about the Epstein files and specifically the Attorney General. Quote, I think she completely whiffed on appreciating that that was the very targeted group that cared about this, Wiles said of Bondi, remembering the binders that went out to the MAGA influencers and included nothing new. So everybody's saying, what's going on here? Is this the exit interview? I mean, what's Susie Wiles thinking talking out of school? There's way more where this came from, about tariffs, comparing Donald Trump's personality to that of an alcoholic. Well, maybe not. On Twitter, Susie Wiles this morning. The article published early this morning is a disingenuously framed hit piece on me and the finest president, White House staff, and cabinet in history. Significant context was disregarded, and much of what I and others said about the team and the president was left out of the story. I assume after reading it, this was done to paint an overwhelmingly chaotic and negative narrative about the president and our team. Jeannie Shanzano, Maura Gillespie, been reading this all morning, and they're with us now. Our political panel today, Bloomberg Politics contributor Jeannie Shanzano is Democracy Visiting Fellow at Harvard Kennedy School's Ash Center. Republican strategist Maura Gillespie is founder of BlueStack Strategies. Great to see you both here. Maura, was this an exit interview, or did Susie Wiles not know they were recording?
It's really fascinating to read through this and to hear now, too, Susie Wiles defending herself and attacking the Vanity Fair. She let unprecedented access to herself for the better part of a year. And so I don't know what she was thinking. I'm not sure of the strategy behind this because it is telling two different stories, both what we read in Vanity Fair versus what she's saying on Twitter now, calling it a hit piece. It's not as though she didn't know they were talking to her. She was talking to them pretty frequently by the sounds of it. So perhaps she's looking at aspirations beyond the Trump White House. There are plenty of off-ramps we're watching play out for Republicans to be taking to get away from Donald Trump and the chaos that he has been creating, especially these last few months. But I don't know that this is one of them.
Well, you know, Jeannie, throughout the first year, it says, of Donald Trump's second administration, Vanity Fair writer Chris Whipple has interviewed Wiles amid each moment of crisis. These guys were even doing laundry together at one point, according to the Insider's account joins a portfolio of portraits for an unflinching up-close look at power and peril. Is this a hit piece, Jeannie? Because these are all direct quotes, aren't they?
Chris Whipple is the new Bob Woodward. Every administration, we say, why did you talk to Bob Woodward? Why let him in? Now it's Chris Whipple. You know, they not only spoke about 11 times, as you mentioned, they also all sat for a big glossy photo spread. She apparently was well aware, as were most journalists in D.C., at least by yesterday, that this was coming out. She gave incredible access, according to the New York Times. This is all on tape. Even when she pushes back on social media today, she doesn't deny saying things. She says they were taken out of context. So, Joe, I don't know if you've ever, Joe, I guess maybe you haven't, being a guy, you haven't seen Mean Girls, but in Mean Girls, Maura and I have probably seen it. There's a burn book. This reads to me like a burn book, and it's fascinating. And we thought Epstein was going to be our week, and now Susie Wiles delivering. It's incredible.
Wow, you know, you saw the photograph there, Jeannie. As they're all sitting on the desk, you know, or leaning on the bookcase. They're brooding. There's sort of dramatic lighting. Can we get a shot like that for the show, James? I mean, like when Kaylee comes back, I feel like the whole team, we could have Jeannie and more, those sort of leaning, brooding, no one's smiling, looking very serious about what we do. What's the push and pull here? Yeah, James is working on it. Maura, when it comes to, you worked for a Speaker of the House. Everybody wants to have that cover shot. They want Annie Leibovitz to come by and take their picture. And they want to be a big shot sometimes in the interview. And I'm not suggesting that's what Susie Wiles did, but politicians have a history of doing this only to be shocked and outraged when it's published. What is that syndrome in Washington?
I would say, just to caveat that, it's not every member, it's not every leader that wants that big splashy profile piece. I'll just speak on in my experience. We had to more or less, not beg John Boehner to do interviews, but it was not something that he was primarily focused on. While I think James was going to deliver for you, I don't know that I could have ever gotten John Boehner to do a brooding, leaning on the bookcase style photography.
Smoking a cigarette. I would have loved that. Elizabeth says it's main
he would have
character
loved it.
syndrome, but of course
He would
John
not
Boehner was a main character. So does it have to do with their background or their taste for celebrity? What is it?
Well, and I think in this case, what I would say is that Susie Wiles, she has been so behind the scenes, right? She is the first female chief of staff, and I think as she's looking at, really, I will say, what's happening with Donald Trump, he is lame duck. She knows that this is kind of the swan song, or it's supposed to be at least, and she is looking to make her own mark. She has been behind the scenes during these, cabinet meetings. She's not featured. She's not usually within sight of the cameras. And maybe she thought that this was her way to tell her side of things and to share her experience and to play a more pivotal role in getting people behind the scenes of what it's like to be the first female chief of staff. If that was her intentions, I don't know that it came out that way, but I think that may have been part of her agreeing to do it and wanting to make her mark in a legacy kind of style.
What do you think about this, Jeannie? Do we look back at this as a major revealing moment, or is maybe Susie Wiles reinventing the role of chief of staff? Maybe she could say whatever she wants.
Yeah, I think we look at it as disorienting. I mean, that's the word that comes to mind, because Susie Wiles is well beloved, well known, and was supposed to be the grown-up in this White House, keeping the president on track. And all the while, Joe Matthew, she was giving interviews that were not secret to Chris Whipple from Vanity Fair, posing for glossy photo spreads. So I think disorienting is the word that comes to mind. And if she was doing this to sort of give us a behind the scenes look at what it's like to be a chief of staff, female or otherwise, I'm not so sure the words that she used to describe the president: alcoholic personality, Elon Musk, the world's wealthiest man, taking drugs, sleeping in sleeping bags in the White House, the vice president, a conspiracy theorist. I mean, the list goes on. And so, again, disorienting, because that's not a very controlled message. And then, we're talking personality. Look at the policy issues. She says on the Venezuela boat issue, well, he's just trying to get Maduro to cry uncle. That's what we all knew. It's regime change, but that's not what they've been saying. So this is a disaster from a perspective of controlling and managing your message at a time when the president needs anything but. And so I am curious to see what Donald Trump says about all of this.
Well, boy, yes, I am as well. That's why I had to ask Tyler if we have anything public on the schedule today. Whipple writes, Maura, when I asked her what she thought about Elon Musk reposting a tweet about public sector workers killing millions under Hitler, Stalin, and Mao, she replied, quote, "I think that's when he's microdosing," unquote. Is this kind of honesty good for the executive or not?
In the case of Elon Musk, I really don't know. I mean, I don't think it is just across the board for a chief of staff of the White House to be that flippant in her remarks, but in her comments to a member of the press.
That's true.
But what I also took from that segment of talking about Elon Musk, it also showed, again, if we're looking at this, or if I'm looking at this as her attempt to have a profile piece of what it's like to be the chief of staff to the White House, in the White House, first female. She starts off talking about Elon Musk and his cuts to PEPFAR and to USAID, saying that she didn't know that he was doing it and that he just did it. That shows a complete lack of control, a complete abdication of keeping the team unified and having the president be in charge of decision-making that makes such a massive impact. But when she went on to talk about that with Chris Whipple, she said she didn't know, one, that he was doing it, and two, she didn't necessarily agree with it, but she didn't know how bad it was going to be. I mean, that's really stark, and I almost couldn't believe that she would be so cavalier in saying that.
Yeah, well, she calls it a disingenuous hit piece now. Pretty remarkable. Guys, we could do 5 hours on this. We barely scratched the surface. It's 2 parts long. You'll have to read for yourself at Vanity Fair. Jeannie Shanzano and Maura Gillespie will stay with us in our second hour of Balance of Power. Our great panel will be back as we welcome our global television audience to the conversation and bring you a conversation as well with the chairman of the House Ways and Means Committee, Republican Congressman Jason Smith, is on the way in next on the fastest show in politics. This is Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew.
Unemployment hits a 4-year high, but the White House predicts an economic boom. Welcome to the Tuesday edition as the government drops monthly jobs data today for November, reinforcing the Fed's decision to cut rates this month. And we're going to talk about the White House reaction when we sit down with Bloomberg Washington correspondent Tyler Kendall, and as Vice President J.D. Vance heads to Pennsylvania to talk affordability following in the footsteps of President Trump. We'll consider the political impact with our panel and more when we talk with Republican Congressman Jason Smith, the chairman of the House Ways and Means Committee, with us on affordability, health care, and government funding, all after a look at Wall Street. Let's get up to date on the Tuesday trade with Charlie Pellet. He's at World Headquarters in New York. Hey, Charlie.
Hi, thank you very much. Jobs Tuesday, the trade, lower Joe Matthew. Right now, we are at the lows of the session with the Dow, the S&P, NASDAQ. They're all declining, looking at a 50-point drop right now on the S&P 500 index, down by about 0.7%. We're at 67.65. Dow Industrials just above 48,000, 48,006, lower now by 0.9%. NASDAQ is down 116, drop there of 0.5%. The Bloomberg Mag 7 index have been up for much of the morning, turning lower as well, down 0.3%. The 10-year 4.15%, with the 2-year 3.47%. Gold is down $2.50 the ounce to $43.02, a drop there of just under 0.1%. West Texas Intermediate crude down 2.5%. WTI now at 55.38 a barrel, and Brent crude just above 59 right now. Brent, of course, the global benchmark. It is down 2.5%. Bitcoin up 1%, 87,070 on Bitcoin. Signs that the job market is sluggish but not rapidly deteriorating saw traders refraining from boosting bets on near-term Fed rate cuts, sending stocks lower and bonds wavered. Pfizer is forecasting little to no sales growth next year as the drug maker undertakes an effort to refresh its pipeline of hit drugs with a series of pricey acquisitions. PFE on the ticker, and right now Pfizer shares, they're down by 5%. Recapping here, the Dow, the S&P, NASDAQ, all in the red, lows of the day. And for on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And Balance of Power continues right now. Back we go to Washington. Once again, your host, Joe Matthew.
Well, tough session so far. Charlie, thank you so much. We'll get back to Charlie Pellet for more in about 20 minutes' time as we keep tabs on the markets for you every day here. Live from Washington, welcome to the early edition of Balance of Power on this Tuesday. I'm Joe Matthew. The 16th of December, as we count the ways here, and coming up, an important conversation a short time from now with the chairman of the House Ways and Means Committee. 4 legislative days left this year to figure out some fix to health care premiums that are set to skyrocket following the end of this month. Lawmakers are done work this week, however, and so we've got a close watch on this for you with the remaining work left to be done here in this congressional year, if you will. Job growth, though, is the headline this morning, or lack thereof. It depends on what your expectation was. We did see an increase in payrolls, 64,000 in November, and that topped some forecasts. It also fell shy of some whisper numbers. But the unemployment rate marched higher to a 4-year high, 4.6%. When we consider the impact of higher participation, this is the way the White House is framing the bump in unemployment. And we heard earlier from the acting chief of the Council of Economic Advisors at the White House, Pierre Yared. Listen to what he told Bloomberg.
If you look at the unemployment rate, it's true that the unemployment rate did tick up. That uptick, though, is statistically insignificant. And if you dig into the numbers and look at what caused it to go up, it's entirely driven by re-entry into the labor force. And that's consistent with the fact that when you look at the labor force participation rate, that labor force participation rate also went up.
Participation up as people get off the couch and look for a job. And it might have to do with rising prices. It might have to do with any number of reasons why we're seeing participation increase here. The fact of the matter is, though, the number of people who are long-term unemployed, out of work for 27 weeks or more, went to the highest levels we've seen since the end of COVID, since the end of 2021. Unemployment for Black Americans jumping to 8.3%, the highest as well since, yes, 2021. But an aggressive take on the jobs report from the press secretary, Caroline Leavitt, who points to an economic boom in the new year. And that's where we start with Bloomberg Washington correspondent Tyler Kendall, who's made her way over from the White House to talk to us about this. The reaction that we're hearing from the White House here as Vice President J.D. Vance heads to Pennsylvania to talk about affordability is striking. It's I guess, wait till next year.
Right, exactly. Have this patience when it comes to the administration's policies. But as we just outlined, we heard from the administration earlier when it comes to their defense of that uptick in the unemployment rate. Yared saying to Bloomberg Television earlier that it's statistically insignificant. And then you're really seeing these other advisors, including the White House Press Secretary Caroline Leavitt, in this statement that was put out. The NEC Director Kevin Hassett, of course, in the running to be Fed chair, in an interview earlier today, focusing on the private sector. Private payrolls increased by $69,000 in November. And the administration had also been trying to hearken any shift when it comes to consumer sentiment on the economy, link that with the government shutdown. We should say that the BLS wasn't able to quantify the impact of the government shutdown in these numbers. So that wasn't really something that the White House could pull on when it does come to the response in these numbers. But you're exactly right. The administration has really been threading this needle when it comes to being on the defense over the cost of living. J.D. Vance out on the campaign trail, hitting Pennsylvania again, following in the footsteps of President Trump last week. But Joe, this is heightening for the White House because we know that one affordability issue is really reaching a pitch, and that's on Capitol Hill over the future of health care, as it appears very likely that we are going to go over that so-called Obamacare cliff. As we heard from House Speaker Mike Johnson earlier today, the House isn't going to tack on an extension to those expiring Affordable Care Act tax subsidies.
It's really interesting how these two have such a different approach. President Trump calls it a Democrat hoax. J.D. Vance is asking for patience. We should note the S&P 500 down to its low of the session here. We're down almost 1% right now, which has turned into a pretty ugly session, having actually seen some green shoots this morning. You know, when this jobs report came out, futures turned positive, seemed to reinforce the idea of lower interest rates, but we, I guess, decided that bad news can, in fact, be bad news. I need to ask you about an important breaker. This just went red on the terminal thanks to the reporting of Tyler Kendall. You know this more than us, Tyler, because it's your story. The U.S. threatening to retaliate against EU companies over a digital tax. What can you tell us?
Right. So the top U.S. trade negotiator, Jameson Greer, threatening retaliation against the European Union in response to the bloc's efforts to regulate American tech companies. And these are regulations governing digital commerce, and they've hit some of the biggest U.S. tech giants. We're talking about Amazon, Meta, Google, companies like this. Now, if we have his post, in his post, the USTR is writing that, quote, if the EU and EU member states insist on continuing to restrict, limit, and deter the competitiveness of U.S. service providers through what he's calling discriminatory means, the U.S. will have no choice but to begin to use every tool at its disposal. Now, he goes on to talk about this idea that we could see fees or restrictions. You'll recall back in February, actually, President Trump had issued this memorandum that instructed the USTR to look into what they are calling unfair trade practices related to digital services taxes. In fact, they renewed a Section 301 investigation into them. And DSTs have really been at the center of many tariff negotiations, particularly with the EU, though when that agreement was reached to lower tariffs on the trading bloc down to 15%, we didn't really see much progress when it came to digital trade. So it does appear that the U.S. is now re-upping its threats. It wants to see this ultimately addressed, and this could really heighten tensions between the U.S. and the EU, because as we've been covering right now, many of these countries are working together to try to push forward what could be a fragile proposal to end the war in Ukraine.
Then again, after that defense strategy review that we saw come out of the White House last week, Tyler, this is coming against the backdrop of deteriorating relations with Europe.
Right, and we should say that we did have the EU's trade chief on Bloomberg Television yesterday who actually defended the bloc's policies when it does come to digital trade. He told us, quote, that the EU will protect our tech sovereignty. So really expect this to keep coming up, because it doesn't really seem like either side is budging. We're going to, of course, watch what the U.S. does when it comes to EU-based service providers, potential companies being named Accenture, Spotify, these other private sector companies that the U.S. has alleged has had unfettered market access to the U.S. for the past few years, and the U.S. is arguing they want to see that for our big tech companies.
Really interesting, Tyler. Great job, and you can read a lot more about this breaking story on the terminal or online. It just went red with Tyler Kendall reporting from Washington. I'm Joe Matthew. Thanks for being with us here on Balance of Power in Washington, D.C. as we keep the beat here on the story of affordability. The White House certainly is. As we just mentioned, J.D. Vance being dispatched to the same state that Donald Trump visited, even the same area of the same state in Pennsylvania. The president was there last week as we went through this idea of affordability as a Democrat con job. He even said that Susie Wiles told him not to say that, put him out on the road to make the case. J.D. Vance tends to have a more empathetic ear, and we'll be listening closely to the way he frames this today on his travel outside of the bubble. We spoke about the issue earlier on Bloomberg TV and radio with none other than Ken Griffin. He spoke to the issue of inflation in Paris. Listen.
Just 12 months ago, President Trump and the Republicans swept into office on the issue of inflation. And the Democrats have rebranded the problem of inflation as the issue of affordability, and they are now well poised to return to control of the House. And there's even discussion of them retaking the Senate on the back of how the affordability issue strikes a chord with the American public.
Enter J.D. Vance with a rallying cry on making America affordable again. A week to the day after President Trump held the big rally there, remembering as well that this will be a very important stop on the road if J.D. Vance is, in fact, going to be the 2028 Republican nominee for president. It's where we start with our political panel today. Bloomberg Politics contributor Jeannie Shanzano is with us, democracy visiting fellow at Harvard Kennedy School's Ash Center, alongside Republican strategist Maura Gillespie, the founder of Blue Stack Strategies, who spent many years working in a former Speaker of the House's office. It's great to have both of you with us. Jeannie, we've been talking about this issue of affordability for so long that it goes back to another president here. Striking to hear from Ken Griffin, who described this exactly the same way President Trump does. We had the issue of inflation that got him into office, and Democrats created this idea. He says Democrats rebranded the problem as an issue of affordability. Is this just about semantics?
No, it's not. I mean, the reality is when you look at the polls and what people are saying, whether it's straight on polling or consumer sentiment, that data shows that people are very, very concerned about the cost of living, everything from healthcare to housing to electricity to energy. That's all real. And then you look at the numbers, just the jobs numbers out today. You look at inflation. It is the same now as it was in September, same now as it was when Joe Biden was in office. So, you know, you look at all of these things and it remains a real problem. And you have J.D. Vance out on the stump, and he is saying Democrats complaining about affordability is like Charles Manson complaining about violent crime. He's supposed to be the more empathetic of the two. And he's saying, just wait, folks, things are going to get better. Except once again, you look at the bank rate, 1/3 of people saying the economy is going to get worse next year. So the messaging is out of sync, but the messaging is out of sync because it doesn't reflect how people are feeling or what the numbers on the economy show. And the White House is struggling in the same way the Biden White House was.
Caroline Levitt, the press secretary, Maura Gillespie, speaking to the jobs report this morning, saying workers' wages are rising, prices are falling, and I'm not sure which metric she's looking at there. Trillions of dollars in investments are pouring into our country. And importantly here, Maura, she says the American economy is primed to boom in 2026. What if it doesn't?
I mean, that's going to be replayed, I think, in every ad for the midterms, but every local election across 2026, and rightfully so, because if the Trump administration can't deliver on this golden age of America that they've promised, right now it seems to be only the Trump-only world. The Trump world is the people who are benefiting from the tariff policies and the striking deals with companies like NVIDIA and otherwise. Everyday Americans and largely the people who voted for Donald Trump, they have not been feeling that boom that they've been talking about. And so I do think there is a lot of pressure on the Trump administration to deliver, but it's also an opportunity for Republicans in Congress to separate themselves a little bit, because the tariff situation has been so hard for, I think, many Republicans in Congress, since it's really not a conservative principle or value or a type of policy that anyone who is a Republican would have been behind. And so they could take an opportunity here to separate themselves and look towards policies in Congress that can get the economy going.
How much is J.D. Vance going to be speaking for Donald Trump today, Jeannie, versus himself? Everybody's looking at this Quinnipiac poll that shows Josh Shapiro beating Vance in a hypothetical head-to-head in Pennsylvania by 10 points. He's got to have that in the back of his mind today, right?
Oh, you better believe it. And that's what makes it so curious that they keep going back to Pennsylvania, where you have Josh Shapiro just sitting there with, you know, his eye on 2028, just waiting to say something. And so they keep going back. JD Vance is certainly thinking about 2028. It's the top of his mind, just like it is for Josh Shapiro and so many of these other folks out here. And they are trying to have him sort of play cleanup as he follows Donald Trump down the line. But as Kamala Harris can tell any of us, it is hard when you've got to defend the actions of somebody else in office and you have your eye on running. And that's the position JD Vance is going to be in as he moves towards 2028. And we're already seeing this very disjointed message out of the White House. JD Vance saying that, you know, it's a real crisis brought on by the Biden administration, and Donald Trump's calling it a hoax. Well, it can't be both. Either we've got an affordability problem or we don't. And what neither of them is doing is so perplexing to me, is getting themselves to Congress to deal with the biggest issue regarding, or one of the biggest issues regarding affordability, which is healthcare. The Republicans have basically thrown up their hands on healthcare. We heard that from Mike Johnson today. The only person that can move that is the president or the vice president. They're out in Pennsylvania saying either this is a hoax or, you know, we feel your pain, but it'll get better. The messaging and the reality is all wrong for JD Vance, for Donald Trump and the White House.
Maura, if affordability really is President Trump's biggest problem right now, and he would tell you it's not, as he does on a regular basis, he would tell you what Caroline Levitt said, that they've brought prices dramatically lower. And in some cases, he points to eggs and gas. That is, in fact, true. But could the Supreme Court be the best thing that happened to Donald Trump if it struck down the tariff regime and elevate this affordability crisis to something he could solve?
It would be the best thing for Republicans and the Republican Party. I think that, to Jeannie's point, talking about the messaging, you know, that's been really all over the place. You can't say that the economy, or people who are feeling that the economy is not going well, that it's because of Joe Biden, and then in the same breath say that the economy is booming and things are going great. It can't be both things at the same time. And so which is it? And what are you doing about it? And so for Republicans, they're hoping the Supreme Court steps in and saves them. And I also think that Speaker Johnson is also looking at this healthcare subsidy situation and thinking, I'm not going to put my Republican conservatives on the line here, but the moderates who are going to vote for this, they can go over to Jeffries, and then we kind of can wipe our hands of it, at least here in the House. It's not a very strong strategy, but I think it's one that he's going to play out this week. And so, unfortunately, that doesn't address the issues. It doesn't address the affordability factor. But I think that, by and large, Republicans need to remind their constituents that they understand that affordability is not a hoax and that it is what got them elected, and that they are working towards a solution.
Where does JD Vance stand in the mainstream media right now, Jeannie? We've got 30 seconds left. Does he get coverage tonight, or does Trump need to be there for the cameras to show up?
Nobody gets as much coverage as Donald Trump. I think he will get coverage. I think it depends on what he says. He's already been blaming immigrants. So in addition to the Biden administration, it's immigrants are being blamed for high costs. So he might get some coverage for these outlandish claims.
Well, we're always listening. You know that. When it comes to policy, when it comes to the administration's take on the economy, we'll give it to you straight. Jeannie Shanzano and Maura Gillespie, great conversation. Thanks to you both for our great panel. Congressman Jason Smith is on the way in next. This is Bloomberg.
9:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks lower across the board, very close to session lows. S&P 500 index falling after a noisy jobs report this morning. Jobs Tuesday, stocks selling off. S&P down 52 at 67.63, a decline of about 0.8%. Dow Industrials down 0.9 now, looking at a loss of 440 points on the Dow, while the Nasdaq Composite Index is down 119 on Nasdaq, a decline of 0.5%. The 10-year at 4.15%, with the 2-year 3.47%. The jobs market sluggish but not rapidly deteriorating. We've got spot gold down $6 the ounce, little change, down 0.1%, $42.98 the ounce. West Texas Intermediate crude oil down 2.5%, $55.38 a barrel. Bitcoin right now at 87,295. Bitcoin higher by 1.3%. On a down day for much of the market, Kraft Heinz shares are up, little change, but up by about 0.4%. Kraft Heinz is replacing its CEO with former Kellanova CEO Steve Cahillane. He's set to take over from Carlos Abrams Rivera on January 1st. This move does follow a difficult period for the food company, which did announce in September that it will be splitting into two separate entities. Again, Kraft Heinz down now by about 0.4%. Again, recapping here, it is a down day for the Dow, the S&P, and Nasdaq. S&P down 53, drop there of 0.8%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And Balance of Power continues right now. Back we go to Washington. Once again, your host, here is Joe Matthew.
All right, Charlie, thank you so much. The voice of Wall Street and the New York subway. You ever notice that? That's Charlie Pellet. You hear when you get off the train, you get on the train. He'll be back in 20 minutes with his take on the Tuesday trade, which, boy, is not getting any better here. These are pretty ugly numbers. So we'll stay close to Charlie for the rest of the broadcast. He'll have another update coming up about 1:40 p.m. Eastern time. We're also keeping tabs on what's happening in the House of Representatives today with a very important Republican conference meeting with the Speaker of the House. We discussed this earlier with Jonathan Tamari as we try to figure out exactly how leaders are going to fill up the next 4 days. That's going to be it here. As we told you, we've got 4 legislative days left to go. And there will likely be a vote to some extent on health care. It's not going to be a vote on extending Obamacare premium subsidies, which have been all the talk recently here. And of course, the debate surrounding them led to a government shutdown. No, the Speaker of the House has put forth a Republican plan that would take a very different approach here. We saw the legislation first on Friday, and now that we understand, Bloomberg is reporting that moderate lawmakers will not be voting on the Obamacare premium subsidies before the end of the year. Some thought that would be the case in the form of an amendment. And we're joined right now to talk about this and a lot more by the chair of the House Ways and Means Committee, Republican Congressman Jason Smith of Missouri. It's great to see you, Mr. Chairman. Welcome back to Bloomberg TV and radio. Do you expect there will be a vote then on a standalone Republican plan before this week is over?
You know, what we have been working on for some time is how can we lower the cost of health care and how can we lower premiums for all Americans. That's 347 million Americans. When people talk about the premium tax credit subsidies, that is 7% of the entire population, but every American's facing high cost of health care. And what we are doing today in the Rules Committee and tomorrow on the floor are just different examples of healthcare policies and changes that we can do that will lower the cost and lower the premiums for all Americans, whether it's PBM reforms, creating more transparency, or whether it is codifying choice accounts to allow small businesses to give their employees give their employees money so they can purchase their own healthcare option at tax-free.
I know that, of course, the bills that hit the floor are the purview of the majority, and when it comes down to it, the Speaker. But we've seen some swing district Republicans bristle at this idea of not allowing a vote on the Obamacare extension amendment. Mike Lawler, your colleague from New York, called it idiotic, Mr. Chairman. Why not just allow both and see where the chips fall?
I'll just say that we all have different opinions, but what the Democrats have been pushing. In fact, there was a vote last Thursday in the United States Senate that failed 51 to 48, I believe, is what it was, on a 3-year current extension. The waste, fraud, and abuse within the Obamacare exchanges just in the last 2 weeks was highlighted by the GAO report that said 59,000 dead people were being subsidized. One Social Security number had 127 different policies attached to it. And the GAO also attempted with fake identities and fake Social Security numbers to enroll in the program, and 100% of them were accepted, and 90% were still being subsidized a year later this year. These reforms have to be addressed. You cannot just extend it. And you know, the worst statistic that people should be paying attention to, of the 24 million people on the exchanges, last year alone, nearly 12 million never even filed a medical claim. You cannot tell me that they didn't have a medical claim. They simply were automatically enrolled and didn't even know they have it. But guess what? Those insurance companies, they were still subsidized.
You know, of course, and I hear you, Congressman, and we've heard a lot of your Republican colleagues make these arguments, but what do you say when somebody calls from Missouri and you've got a constituent on the line and they say, how can you help me out? My premiums are going to double next month.
That's exactly the case. Is the person who would be calling me from Missouri would be someone on employer-sponsored health care. And everything the Democrats is talking about has nothing to do with lowering the cost of premiums for people who are on employee-sponsored health care. And that's 164 million Americans. All that they're talking about is the 24 million people on exchanges. We need to lower the cost of health care for every single American, not just the people on ACA.
Are you not hearing from people on Obamacare, Mr. Chairman, or am I misunderstanding you?
Look at my congressional district. We have roughly 800,000 people in it. We have less than 5% that are on Obamacare. And we're the 9th poorest congressional district out of 435. So it is a very, very small population. In fact, even the people on the exchanges, 99.7% of the people in my congressional district that are on the exchanges will have generous subsidies to help them with their payments.
You know, we just got word from the president, Mr. Chairman, and this is just breaking. I'll share it with you as I read it from Truth Social. I will be giving an address to the nation tomorrow night, live from the White House, 9 p.m. Eastern. I look forward to seeing you then. It's been a great year for our country, and the best is yet to come. So we've got a presidential address. Primetime address tomorrow night. It's been a while. Chairman Smith, do you suspect that he'll provide some guidance when it comes to health care reform?
You know, I'm thankful that we have a president who, in fact, communicates with the general public on a nonstop basis. Having an address tomorrow is just another example for the president to talk and speak to the American public directly of the accomplishments that's been happening over the last 11 months of his presidency. And will he be announcing other new initiatives and new ideas? It wouldn't surprise me, because this man's working all the time.
I know that there was another meeting this morning. Mr. Chairman, I don't know if you were in this briefing with the Secretary of Defense, the Secretary of State, and the Chairman of the Joint Chiefs about the president's policy, his strategy in the Caribbean. We understand from the Secretary of Defense that it will, the footage of the double tap strike will never made public. Do you agree that that's a smart move? And have you received enough information to make a judgment here?
I have not been part of any of those briefings. We've been today, the last couple days, focused on the healthcare legislation that's moving off the House floor and working with that and meeting with members and colleagues to make sure that the votes are there. But I haven't been a part of any of those briefings or those discussions.
Understood. Do you then, because of your focus on the healthcare legislation, have a sense of when we will see a vote this week?
I think you'll see a vote tomorrow. On the healthcare items that we suggested today at 2 o'clock. Right after this, in fact, I will be presenting before the House Rules Committee, and that is the first step before it goes to the floor.
The House of Representatives, I was reading, will set a non-COVID record for fewest roll call votes on record in this session. Of course, that was exacerbated by the longest government shutdown in history. I just wonder if Speaker Johnson deserves some criticism for this and if you expect a more productive year ahead.
You know, President Trump shows us that we can always do more and work harder. If you look at just the Ways and Means Committee, which I'm chairman of and that we've been pushing through, this year we've passed 123 different pieces of legislation out of our committee. That beats the numbers of any prior Congress by far in recent history. So we've been working hard. We did deliver on the largest tax cut in U.S. history, the largest investment in border security in U.S. history, the most significant welfare reforms in U.S. history, all within the big, beautiful bill, which affected 103 different tax chapters.
Well, you know, we keep hearing very quietly, and I'm sure that you're reading and hearing the same stuff that I am, that if the discord continues in the House, Congressman, that we could have a funding problem again at the end of January. As chairman of the Ways and Means Committee, point us forward here. What's going to happen when we creep up on that deadline? I know that we won't have a full-blown budget with regular order, but will there be a plan to avert another shutdown?
I'll tell you, it's been very difficult cooperating with the Democrats. We've had bipartisan markups within our committee, and you're talking about bipartisan pieces of legislation. For example, we had 9 bills last week that it took 10 hours for 9 bipartisan bills, and if you counted up the votes, it was 347 yes votes and 19 no votes over 19 bills. So super bipartisan, but the obstruction has been real and the delay has been real. And so the negotiations within the government funding is a huge, huge issue. And I hope that the Democrats have learned from their lesson that they're not going to shut down government like what they did last time. They shut down government last time and they were very clear. They wanted to spend $1.5 trillion in new money, including providing health care for illegals.
It's good to have you back, Congressman Jason Smith. He's chair of the House Ways and Means Committee, and we appreciate your insights, Mr. Chairman. As we get closer to voting, he said, as early as tomorrow, important news there for you here on Bloomberg TV and radio that you have not heard anywhere else yet. The chairman pointing us to tomorrow would be the 17th of December for a vote on a Republican-led health care plan, that same bill that was unveiled late Friday. I'm Joe Matthew in Washington. Thanks for joining us today on Balance of Power as we cover a lot of bases this hour. We're going to get to geopolitics coming up next in conversation with Jane Harmon, who will join us from World Headquarters in New York. And as we track these markets heading lower, it's not just stocks. Oil is also sharply lower today. West Texas Intermediate slipping below $56 a barrel. Pretty amazing, down more than 2%. Mike McGlone will speak with us about that coming up as we also watch Bitcoin move today. That is one of the few things that we see rising, as a matter of fact, up about 2%. For the broad market, though, it has become a major loser. The S&P 500 is now down 42 points. The Dow's losing 360, and the NASDAQ is down 78 points. Sub 1% losses, but still pretty stubborn after we saw some green shoots this morning following the jobs report in hopes that that would help to reinforce the idea of lower interest rates. It does seem that the sellers are taking over here. We're going to get an update on the markets coming up from Charlie Pellet. We'll also talk, as I mentioned, with Mike McGlone about the commodities, Bitcoin and oil, all risk off today in New York. I'm Joe Matthew in the nation's capital. We'll have much more ahead.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ. They're all declining right now. Stocks very close to session lows. Jobs Tuesday, that is correct. We got the employment report this morning. It was a noisy one. Stocks lower right now with the S&P down 34, looking at a drop of 0.5%. The S&P at 67.83. Dow Industrials down 305. On the Dow, a decline there of 0.6%. The NASDAQ Composite Index down 35 right now. That is a drop of just about 0.2%. On a down day for much of the market, the Bloomberg Mag 7 Index is pushing higher, holding on to a gain barely up under 0.1%. 10-year at 4.15% with a 2-year 3.48%. We've got gold up $3 the ounce now, up by about 0.1%. Precious metal now at 43.08. Bitcoin up 1.9%, 87,810. Cannot ignore the move in crude oil today to the downside. West Texas Intermediate crude back with a $55 handle. WTI 55.60 right now. It is down 2.1%. Brent, the global benchmark, with a $59 handle. Barrel of Brent down now by 2.2%. Some of the other stories that we're following: Apollo Global Management said to be exploring a potential sale of its aviation company, and that is Atlas Air Worldwide Holdings. Again, this according to sources. And sources tell Bloomberg China's Luckin Coffee is considering making a bid for Nestlé's Blue Bottle Coffee to boost its brand. Right now, we do have shares of Luckin trading lower by 8%. Nestle, the $80 down 0.8%. Down day clean sweep for coffee companies. Starbucks down by 0.4%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And back we go to Washington. Once again, your host. Here he is, Joe Matthew.
Charlie, thank you so much. And thank you for being with us on the Tuesday edition of Balance of Power on Bloomberg TV and radio. We just got breaking news from the White House. If you didn't hear us break this in our conversation with the chairman of the Ways and Means Committee, the president has just scheduled a primetime national address. Writing on Truth Social, my fellow Americans, I will be giving an address to the nation tomorrow night, live from the White House at 9 p.m. Eastern, okay? 9 o'clock. Set your clocks. We'll, of course, be watching so you don't have to. I look forward to seeing you then, he says. It has been a great year for our country, and the best is yet to come. The president speaking in the throes of Hanukkah here with so many issues that he could touch upon, including the health care debate that we were just talking about with Congressman Jason Smith, the future of his economic agenda. Maybe does he announce a pick for Fed, James, we think, tomorrow night? Unclear what he might bring forward, if not some reassuring words for the holidays. He talks a lot about the price of gas these days. In fact, yesterday said it was $1.99 in a bunch of different places in the country, and we're having a little trouble finding those, but indeed, the gas prices have been lower. And as Charlie Pellet just said, we've got a 55 handle once again on crude. West Texas Intermediate. Yeah, look at that. 55.55, down a little more than 2%. Just like Mike McGlone said it was going to happen. He's a great American, and he's with us right now. Bloomberg Intelligence senior commodities strategist live from Miami. Mike, you said it was going to go down maybe to 40, as a matter of fact, and I'm wondering if you can remind us of the trends that we're seeing here, because this is supposed to be winter season. Isn't oil more expensive?
Yeah, it's nice to get a few right. Well, if you want to talk about winter season, natural gas has absolutely collapsed from where it was just 3 weeks ago. It was up 40% in the year. Now it's only 5%. Let's tilt over, like you started with crude oil. $55 a barrel, just made a new low for the year today. I think it's more likely to be towards 40 next year than above 70. That's just a trend of oversupply and superabundance. And the key thing to get it much lower, Joe, is just a little bit of what people would call a healthy correction in the stock market, which might have started.
What does oversupply and healthy abundance mean for drill baby drill in the new year?
Well, that's the significance. It's not just crude oil. It's natural gas. It's corn. It's soybeans. It's wheat. It's the whole space. And that's the timing of Mr. Trump's presidency. He came in at a perfect time to say these kind of things and have them happen, just because we had that big spike up to the peak in 2022 that brought in all the supply. It kicked in the technology and shifted over to EVs, and now they're heading lower. So Superabundance is just a great book I read, and I enjoy what the proponent of it shows, that when you have humans like us who create more with less every day, we want to embrace that technology, but not the price. And the price continues to decline in crude oils, corn, soybeans, wheat, natural gas, and I don't know what stops it, other than lower prices.
Looking at the understood. AAA's got the national average at $2.90 right now, so we are decidedly below $3. Where's the president seeing $1.99 or lower? Is that real?
Well, they can see that in some places. I've heard anecdotal, but I think the national average price at $2.90 is going to head towards $2 by this time next year. And a key catalyst for that, Joe, is, we haven't had a down year for the S&P 500 total return. We've only had 2 since 2008. Maybe we're due for a little bit of that, and that's every single time that gas has got to above 4, it got to 5 a couple years ago, it's always bottomed there too. And I asked myself, what stops that? To me, it's accelerating. Now the U.S. is a net exporter of crude oil, liquid fuels, natural gas. We're just a net exporter of almost most of those commodities we really need, which means we're dependent on exports. So it's a good sign that prices will all go down. But it's also the classic example of post-inflation deflation. And the question is, how long can that stay away from things like the stock market? Because it certainly is hitting cryptocurrencies.
Boy, it sure is, and I guess I need to ask you about that. It is remarkable, by the way. I'm going to be talking to Jane Harmon in just a moment, Mike McGlone, that all the saber rattling down around Venezuela is doing nothing to elevate the price of oil, but I guess that tells us a lot about Venezuela's contribution to your points earlier. What's Bitcoin doing? It's one of the only green things on the screen. Is this just a little bit of bottom fishing here or something else going on?
The biggest rallies typically happen in bear markets, and Bitcoin and cryptos are clearly in a bear market. The Bloomberg Galaxy Crypto Index is now down about 20% on the year. It was up over 20%. That wasn't supposed to happen. Bitcoin is down about 6% in the year. It was up about 30% in the year. But it put in a key peak top that I think is going to resonate for a long time. So I think Bitcoin is going to head initially towards 50,000. I don't know what makes it go higher, but key thing is it's the leading indicator factor, Joe, that I think that's matter. I mean, it's the tip of the iceberg of risk assets, and it's heading downward. And I think it's the de-risking that's probably hitting the stock market today that might continue into year end. So I'm really worried that this is all going to trickle down into the stock market as we head to year end. And by the way, the S&P 500 did drop about 5% in the last couple of weeks of 2024, but had a lot of good things to look forward to. Now everything it's looking forward to is rolling over, particularly crypto.
Just wondering when Santa Claus is going to show up. Aren't we running out of days here? Mike, it's good to see you. Come back again before the end of the year. The great Mike McGlone, live in Miami. Bloomberg Intelligence, our senior commodities strategist. With crude oil now at a 55 handle, it's just like he told us it was going to happen. When that thing hits 40, you'll know to call Mike McGlone. News from Capitol Hill today from the Secretary of Defense. Forget the video. It's not going public. Pete Hegseth on the Hill to brief lawmakers today about the administration's overall strategy in the Caribbean, never mind the double tap strike in the waters off Venezuela. Here's what Hegseth said earlier.
In keeping with long-standing Department of War policy, Department of Defense policy, of course, we're not going to release a top-secret, full, unedited video of that to the general public. Hask and Sask and appropriate committees will see it, but not the general public.
Which is important because the President of the United States, the Commander-in-Chief himself, had said that he was fine with it going public when reporters asked him. When they followed up, I believe it was Rachel Scott at ABC, he claimed to have never said that. With us now, live from World Headquarters in New York, bringing her voice of experience to our conversation today is Jane Harmon, the former Democratic Congresswoman from California, former ranking member of the House Intelligence Committee and author of Insanity Defense, Why Our Failure to Confront Hard National Security Problems Makes Us Less Safe. Jane, it's great to see you. I'm sorry you're not with us in person, but I'm just wondering first what you think of this decision because, well, the president had already said it would be made public, didn't he?
Well, first of all, Joe, next time in person, I promise. As for this, well, today it won't be made public. Tomorrow, maybe it'll be made public. It'll consume a lot of attention, which should be paid on a lot of other things. First of all, we're doing those boat strikes again, and I'm with Laura Loomer. I think they're unimportant in terms of achieving the objection the president had or said he had, which is to stop fentanyl coming into the United States. They have nothing to do with that. But I think that now that we may have a healthcare strategy, I still think we need a national security strategy that is meaningful, especially a rise of ISIS strategy, because while all this is going on, to remind, ISIS killed a few of our soldiers in Syria, and the president is vowing revenge. I hope he is going to be talked off the cliff, because bombing or doing some kind of action in Syria will undermine the regime we're trying to support and will probably promote ISIS rather than hurt ISIS. So ISIS is elsewhere. ISIS is in Australia. Maybe ISIS is in the United States. And we need a much better strategy worldwide against the rise of radical Islamic groups.
It's really interesting you take the conversation there after what we did see in Australia, knowing that they had apparently been radicalized, at least the thought is, in the Philippines. Jane Harman, I had that same thought. The president had a lot to be upset about last weekend with 2 mass shootings. He was upset about the Reiner killings. He's upset about a lot of things. So one place to take that out would be in Syria. He has promised heavy damage and a concerted response. Where would he target in response to ISIS?
Well, I don't know, but I'm sure we have good intel on where ISIS is organizing in Syria. We should have had a lot better intel on the fact
and you
that
don't
those
think we should
attacks
strike?
No, I don't think we should attack. I think we should have a counter-ISIS strategy, which includes Syria. Of course I do. But I think attacking the country we are hoping has changed its ways. Remember, the new president of Syria was formerly a terrorist himself. And President Trump stepped up, to his credit, I think, and recognized him and his new country. He was in New York being lauded during the UN General Assembly, and he's trying to put a fragile government together. It ain't perfect, but certainly bombing his country while he is trying to right-size his country makes absolutely no sense. And it points out that we really don't have an effective strategy. This new NSS, I think, is extremely polemic and ineffective. And oh, by the way, we've also just announced, according to the Washington Post, a unified command structure. I think this means taking the power away from the heads of European Command, Central Command, which has jurisdiction over Syria, and others, very experienced 4-stars, will now lose some traction to some central thing at the Pentagon, which, according to everything I read, has decimated its top leadership, and we're making mistakes there, and it's amateur hour. And unfortunately, we need our best brains and best experienced military and civilians on problems like the rise of ISIS.
Well, that reorg is a big story that you referred to. And, you know, all the while, the president says he's planning land strikes in Venezuela, Jane Harman, a new phase that will include additional seizures of oil tankers and land strikes, potentially targeting drug labs somewhere deep in the jungle of Venezuela. What would be the international reaction to such a move?
I don't think that would play well internationally. I think there would be a claim of declaring war. Again, back to Laura Loomer, whom I seldom agree with. She says 8% of the drug trade coming to the U.S. has anything to do with Venezuela, and it's not it's not fentanyl, and that's what Trump has said we wanted to do. Of course, we haven't said we're for regime change. In fact, his foreign policy strategy is for strategy, which is for sovereignty, which seems to me not for regime change. But why else would we be in Venezuela at this point? So I think there's a little chaos going on. And for my 2 cents, let me say it again, the rise of terrorism should concern us much more than it does. And our focus should be worldwide on finding ways, using our best talent to combat it.
It's been historically wise to listen to Jane Harman when she points you to a point of concern more than once in an interview. Jane, I've got about a minute left. President Trump says he's delivering a national address tomorrow night. This just happened on social media, live from the White House at 9 p.m. Eastern. Does an announcement like that make you nervous?
No, I would like the president to offer leadership and explain to the American people what he's doing. I hope he stays focused on whatever the topic is. I'm imagining the topic is health care and the need to find, again, some resolution there. The Republican suggestions are sounding more sensible now, but an ACA extension seems to me the easiest thing we could do. The ACA ain't perfect, but if something doesn't happen in the next 4 days, a whole bunch of Americans, many of whom voted for this president in the last election, are going to be miserable, and that's going to play out in the 2026 elections, and I don't think that's going to be a good look for him.
The former Democratic Congresswoman from California, top Democrat on the House Intel Committee. That's Jane Harman. There's only one. Jane, thank you so much. We'll see you back here in the nation's capital, and I'll meet you on the late edition of Balance of Power, only here on Bloomberg.
Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. It is a Jobs Tuesday. No, you're not like screwed around with your calendar. What?
The Twilight Zone.
It is the Twilight Zone. Very good afternoon across Bloomberg platforms. This is Bloomberg Business Week Daily. Carol Master, Tim Stanovic. Yeah, we've got those stocks. They're down, but they're coming off their worst levels of the session. I look at the S&P 500. More names are lower today. We've got the Treasury trade kind of bouncing around a little bit, but we're going to get into some of the data that we got today. Sluggish U.S. jobs growth, resilient consumer spending. We got our own Mike McKee and also the Labor Department's chief economist, Julia Pollack. She's going to be here.
Yeah, also the macro and micro, from private credit to cryptocurrencies to banking and Fannie and Freddie. A deep dive with Chris Whalen. He's going to be joining us in just a few minutes.
And Bitcoin fatigue, you know all about it. We've seen Bitcoin
it's on
retrench.
30% from all-time highs.
Yeah, on track for a down year, the fourth down year it would be in its history. We're going to talk with Fred Thiel, CEO of Mara, see what he has to say about that. We've got a lot of questions coming his way.
All that over the next hour right here on Bloomberg Business Week Daily. First up, though, a check of the day's trade and top business stories. Here he is, Charlie.
All right, I thank you very much, and happy Jobs Tuesday, a phrase we never say here at Bloomberg. We have got stocks very much in the red, but as Carol set us up, well off session lows right now. 31-point drop on the S&P, 67.84, drop right now of roughly 0.4%. Dow Industrials down 320, a drop there of 0.7. The Nasdaq Composite Index down 22. On Nasdaq, that is a drop now of 0.1%. Interestingly, the Mag 7 Index holding on to a gain of 0.2%. The Russell 2000 Index of small cap shares down 0.6%. The American jobs market, though, sluggish but not rapidly deteriorating. Non-farm payrolls increased 64,000 in November. The unemployment rate at 4.6%. Our Michael McKee's going to have a whole lot more coming up on Bloomberg Business Week. 10-year, 4.15%, with the 2-year right now, 3.48%. Gold, little changed, up 0.1%, 43.10 the ounce. But in the oil market, seeing quite the move for West Texas Intermediate. 55 handle today, 55.41. WTI down 2.5%. Bitcoin up 1.8%, 87,732 on Bitcoin. Pfizer is forecasting little to no sales growth next year as the drug maker undertakes an effort to refresh its pipeline of hit drugs with a series of pricey acquisitions. Pfizer shares, they're down today by 5.2%. So again, recapping here, the Dow, the S&P, NASDAQ, all in the red right now. S&P down by 0.5%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. It's a Bloomberg Business Flash.
All right, got it, Charlie. Thank you so much. All right, we did get a bunch of economic news today. We did have the U.S. government dropping Labor Day for the past 2 months. U.S. job growth remains sluggish in November. The unemployment rate, Tim, though, rose to a 4-year high, so pointing to a continued cooling in the labor market after a weak October.
Well, with what you need to know, Bloomberg TV and Radio, international economics and policy correspondent Michael McKee, he joins us here in the Bloomberg Business Week studio. The jobs data, did it tell us what we already knew?
Basically, low fire, low hire economy seems to be the story here. We had a really bad October. Now, we only got the establishment figures, the ones that include how many jobs were created. For October, we didn't get anything on the household side, the unemployment rate, but we did get both for November. What it looks like in terms of job creation is October was terrible, in part because 162,000 government employees who had been fired by DOGE fell off the payrolls. They were getting severance and they fell off the payrolls. But there were also job losses in just about every category in October. And then we got a bit of a rebound in November. Most of those jobs, health and welfare workers, the people who've been propping up the job market for quite a while, but it was something. But it tells you that we're not seeing much hiring, at least at the end of November. We weren't seeing much hiring. But we're not seeing a lot of people getting fired either. Hard to tell from the unemployment numbers because we didn't get October, but we did see it tick up to almost 4.6%, rounded up to 4.6%.
All right, so that's the case when it comes to the labor market. U.S. retail sales showing a resilient consumer spending beyond cars. So how do we cross that?
Well, they take the cars out, and you look at the cars, building materials, gasoline. Gasoline always goes up and down because of prices.
Right.
And what you had was a reasonably strong core rate, what they call the core rate of retail sales. It's basically the stuff that does go into GDP directly, and that was a significant turnaround from what we had seen in September. Again, this is October data, but we're just getting it now.
Right.
So it isn't clear how important that's going to be, because a lot of it was at department stores, which may have been the tail end of back to school, or it may have been really early Black Friday or whatever you want to call it, Christmas stuff. And so we're going to have to get a couple more months of that. The same with the jobs data before the Fed will have any kind of idea of where we really are. Brings us sort of up to date, but not statistically valid, as they like to say.
Sort of, but not quite yet. Is basically. All right. Mike, thank you so much. Bloomberg TV and Radio International Economics and Policy correspondent Michael McKee. We're going to stay on the macro with a financial sector emphasis. And great to have back with us Chris Whalen, chairman of Whalen Global Advisors. He worked at the New York Fed in the 80s. He's testified before Congress and the SEC, worked on Wall Street. I forgot that you worked at Bear Stearns and some other written many books, and also served on the Economic Advisory Committee of FINRA for over a decade. And you also were a consultant to Billions, was that right?
Yes, it was great fun. They were buying a bank.
They were buying a bank, and they wanted to know?
Yeah, they were trying to, finagle the regulators. It was a typical Billions kind of script.
Well, out of the entire resume that Carol just mentioned, was that the most fun, working on Billions?
No, I think the most fun was early days working at Bear Stearns in London, selling bonds. That was a lot of fun. We had a blast.
Well, tell us about, it's funny, I love talking with someone like you because you have seen just kind of how the financial sector has changed a lot, Chris, right? And the stress points that we've seen, certainly the financial crisis and elsewhere. When you look at, we just talked with Mike about some of the macro backdrop, and we've talked with you about specific risks, but does it feel comfortable today, kind of the environment, in your view, compared to what we've seen in the past?
No, I was going through the third quarter numbers for the big bank holding companies, which the Fed just released.
Yeah.
Day 75 after the quarter close. That's the best that they can do. And it's eerie. The credit costs are trending down. Asset returns, thank God, are getting back to normal, about 1.5%. But there's a lot we don't see. And that's what's worrying people. Whether you talk about Oracle or you talk about private credit, what people are worried about today is what they don't see in the data, because they know that a lot of this is being fudged. And that's what worries me as well.
What do you think is being fudged?
Things like loan losses. There's a lot of forbearance here in New York City for multifamily apartments. Our new mayor is threatening to start taking over buildings that landlords are not keeping up to his standards. Well, the city of New York can't afford to take care of them either. And so we have this accumulation of pressures, mostly caused by inflation, mostly caused by our friends at the Fed. But in their defense, why did they do that? Because we told everybody they didn't have to pay their loans and their rent for 2 years during COVID. People forget that in the mortgage industry in March of 2020, we were all looking at one another going, what are we going to do? This is after President Trump declared the emergency and said, you don't have to pay your bills.
Yeah.
Well, the Fed came to the rescue. By dropping rates to zero, we caused a surge of home lending activity, record volumes, and that float was borrowed to help everybody pay their bills.
So why aren't we seeing more stress in the credit markets? And why are we seeing records on Wall Street? And it sounds like then some disconnect.
I think part of the reason that the street has been doing well, listed stocks, is because you have a lot of liquidity coming out of private markets, going back into more liquid markets. Makes sense, right? Private equity, private credit is a mess. And we all know this. Something like 15% of private equity companies in the U.S. are paying in kind rather than in cash.
Right.
So you notice...
We keep waiting for the year to the exits and for things to move on.
There's a lack of demand from banks for loans, except in one category, non-depository financial companies, which is another way of saying private equity funds, credit shops like Ares and Apollo. They're the ones that have been aggressively expanding their business, using money in part from banks. So the banks are now the facilitators. And what does this remind us of, Carol? The 2000s.
Right. Right.
It's the same thing. You have non-bank intermediation relying on the bond market, equity markets, and bank credit. And the thing is, eventually they're going to stumble. And that's what everybody's worried about, I think.
So what does that stumble look like? What is the shoe that drops?
It looks like First Brands. Hello, we're defaulting. And most people had never focused on that company. It was a private, totally institutional play. The same thing with Tricolor, auto lender that, you know, half of their customers were illegal aliens. Nobody had ever focused on this. It was an institutional story that suddenly surged.
So you think those
consciousness.
you think those two instances are canaries in the coal mine?
I think they are typical of what we're going to see more in the future, which is you're going to see more of the missteps in the institutional non-public market, which was supposedly better. Remember, everybody was selling us the idea that private was better than public? No, we have public markets because they're open and relatively liquid.
Chris, you know, after the Jamie Dimon cockroach comment, that there were many members in the private world that came out, or a few, I should say, that came on our air, and that seemed to say, hey, listen, things are fine. And I understand many would say they're talking their book, but, you know, are they systemic risks? Like, what's the exposure with the traditional financial sector when it comes to the private markets? Because I think that's what we care most about, right?
No, I think the private players can fail tomorrow. It will cause a bit of kerfluffle and volatility in the markets, but are they systemic like a big bank? No, but the big banks will take their lumps too, because they are lending indirectly into these structures. They tend to take the most senior positions, but that may not save them. You see, the assumption that, okay, I'm senior and 3/4 of the stack is below me, and therefore I'm okay, that may not work this time around because you have leverage on leverage on leverage in some of these deals.
So when like the big banks report again, we're getting ready for another earnings cycle, right? You know, we'll get that, you know, in early January. So what do we look for things like that? Like, what do you look for?
The numbers are going to be wonderful. That's what worries me. You know, just as an analyst, we were supposed to have a recession last year. Credit losses largely peaked last year, third, fourth quarter.
Yeah.
They've been coming down since then. So if you look at the picture, you say, God, everything is great. You don't see a lot of utilization. You don't see a lot of demand from the banks for credit. They've got a ton of unused credit out there that they wish people would use. But so you don't see stress in the published numbers. Where you see stress is when you talk to professionals, when you read the really interesting media like Bloomberg and others that cover some of these stories. There was a great piece in the FT over the last week talking about Altus, a company that Jamie Dimon came to the rescue of, paid off their most restrictive loans so that they could go out and borrow more money.
So like,
and all the credit guys that you're talking about looked at Jamie Dimon and they're going, hello, what are you doing?
Yeah.
So he's an enabler of bad behavior because Jamie has to go out and make money too in a market where there isn't a lot of, you know, what I would call quality demand.
Which reminds me of what would happen in the great financial crisis, of people saying, I know it's getting messy and ugly, but there was the CEO of Citi at the time, I think, who like came out and made some comment about, like, I got to be in it. Like,
oh, no, that's right. Yeah, that was the
I can't think of
the temporary CEO who would, you know, replaced John Reed.
But I'm just saying, like, this idea of like feeling like you have to be in it, the pressure of it.
Yes and no. I think that some institutions have the common sense to pull back and say no.
Yeah.
Others don't. I'll give you an example. PNC. PNC has the lowest loss rate in the top 7 banks. They've also got one of the lowest funding costs. That's a fairly well-run $500 billion bank that has managed to avoid risk, I think often by saying no. The street wanted them to get more involved in certain things like prime brokerage, dealing with private equity funds, that sort of thing.
Right.
And they said no. So I think there are institutions that are very well run in this market, but again, the banks are underutilized because the non-bank financial companies have stolen their march, and they're going to the customer, and they're using wholesale funding from the big banks, and they're in turn disintermediating them at the same time.
Chris, we want to talk a little bit about AI, too, in the time that we have left. We've talked about it with you before. Circular financing, we're not sure how it all plays out in the economy and what it has to do with productivity and with economic growth. Weighing in on AI and its potential economic impact, Ken Griffin of Citadel, speaking with Bloomberg's Danny Berger a little earlier today at a conference in Paris. Check out what he said.
I think there is some chance that we will see meaningful progress in this field that will change the calculus that I'm setting forth. Like, there are so many bright people in their 20s and 30s trying to unlock true intelligence, that this does create the environment in which a breakthrough may happen. But I think that generative AI, as we know it today, will have a very pointed but relatively limited impact on the broader economy.
A pointed but relatively limited impact on the broader economy. Ken Griffin of Citadel earlier today. What, in your view, is the impact of AI on this economy?
I think it's incremental, better search tools. You know, we're writers.
So is he right?
I think he is right. And frankly, I read a lot of the long-haired stuff on AI, some of the people in the scientific community, and they tell you the same thing, because this is a third or fourth, fifth time that we have talked about AI. You go back to the 70s and the 80s.
It's not new.
Remember Watson, IBM, which was a fiasco. But it was their way of showing what new technology could do. But is it creating general intelligence? No.
So is all this a waste? Is all this a waste?
No, it's marketing. You know, never.
Yeah, but that's a lot to spend on marketing.
But the spend, yeah.
But that's, look, everything in the U.S. economy is about marketing, okay? Doesn't matter what it is. And if it's attached to a stock, then you know it's marketing. NVIDIA. I've made a ton of money on NVIDIA. I'm very grateful to Mr. Wang. But is he going to change the world? No. What we're doing is building a lot of infrastructure. We're spending a ton of money, not so much on building AI, but preparing to have the capacity to do it, mostly by studying the past. To me, that's not AI. AI is when a machine can start to observe what's around it and react and determine what to do next based on what it sees, not because of, you know, it's studied our language for the last 50 years.
So you're like the whole idea of AI is all the data that's put in from the past. You think that, okay, that's your take.
It's all we have.
Well, are you still in NVIDIA?
No, I got out. I wrote it up, it split. I wrote it up again, it split. When it gets to be a third of my portfolio, I've got to take the money and run. You know, with all due respect to Jim Cramer, who I'm very grateful to for getting me into that stock.
But it sounds like you're saying that we're in a bubble, with at least with the spend.
Of course we are. That's what humans do. That's what markets are.
So what happens when this bubble?
We follow the shiny object.
What happens when the bubble pops?
We're going to see that a lot of the spend for AI will not be compensated with revenue growth that's going to help to pay it off. And Oracle, I think, unfortunately, a great company, is the poster child for this. They were following the crowd. They decided to double down and do even more. And the truth of the matter is, one large language model, if all of the tech companies had gotten together and said, look, let's do this together.
Right.
Right? But the other problem, I think, is the metaphors that we use in this conversation, this race with China. The Chinese don't use metaphors like that. When you listen to them talk about AI, it's part of a broader range of initiatives that they're trying to use to give them an advantage in the global economy. They don't see it as a race. This is all marketing hype. And we have to differentiate between the technology and the sell, okay?
Yeah.
It's like we used to say about IBM, never mistake sales with, you know, delivery. No.
All right, we got to leave it there. Thank you. Really appreciate it.
My pleasure.
Chris Whalen, chairman of Whalen Global Advisors, joining us here in studio. Coming up next, we didn't get to talk crypto with him.
No, that's okay. We're gonna have Chris back very soon. We are talking crypto next, though. Not its year, at least Bitcoin's year, on track for its 4th annual decline in its history. And this year's a little different because there was no sort of catalyst for that decline. The CEO of the crypto miner Mara stops by next. This is Bloomberg.
Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ, all lower. S&P, in fact, trading very close to session lows. Jobs Tuesday, S&P down for a third day today. Right now, lower by 46 at 67.70. That is a drop of just about 0.7%. S&P lower as a noisy jobs report leaves bonds wavering. The 10-year currently yielding 4.15% with the 2-year 3.47%. Gold higher, little changed, up 0.1%. Spot gold up $4 the ounce, 43.09 where we stand now. Silver down 0.7%, heading in the other direction at 63.73. West Texas Intermediate crude oil 55.33 a barrel. Right now, WTI down 2.6%. Brent, the global benchmark, just below $59 a barrel, down 2.6%. And Bitcoin currently higher by 1.4%, 87,409. So oil extending its declines today. Brent dropping below 60 for the first time since May as indications grow that supply is outpacing demand against the backdrop of efforts to end the war in Ukraine. Among some of the oil majors, ExxonMobil down 2.5%. BP, the ADR is particularly hard hit, down 4.1%. Chevron right now is down by 1.9%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar, along with Tim Stanovic, live here at Bloomberg headquarters in New York City. Hey, we talked about this at the top. Bitcoin not having a great year. It's headed for its 4th annual decline in its history, and the first one that didn't coincide with a major scandal or industry meltdown. So we're talking about cryptocurrencies, the Bitcoin specifically, now nearly 7% lower for the year. It's down around 30% from its October 6th all-time high. Volumes low and investors, Tim, bailing on Bitcoin ETFs. You know about this. You do a weekly Bitcoin show. You know.
Yeah, I mean, the bear market means that Bitcoin has decoupled from stocks. The S&P 500 closing in at a record earlier this month, up 16% for the year. Bitcoin struggled to find footing. The Bitcoin miner and accumulator, Mara Holdings, knows all too well about the drop. Its own stock down more than 36% so far this year. Nearly 28% of the float is shorted. With more, we head to Paris and to Fred Thiel. He's chairman and CEO of Mara. Fred, good to have you on the program. The decline in the asset price this year, certainly, $126,000. That was a major high earlier this year. That was a big moment for the cryptocurrency, but down close to 30 or more than 30% from that. How much lower does Bitcoin go?
I think Bitcoin at this level is finding support in the kind of 84,000 range, which is just about where the break-even point is on most ETF purchases, Bitcoin ETF purchases, and that seems to be a level of support where essentially people, large investors who are trying to defend their positions, if you would, want to keep it above that level, which if it falls below that, you'd see more sales most probably out of the ETFs back into liquidity. Bitcoin, it's very much driven by global liquidity. You had expectations of more from the Fed and more clarity around market structure. But I think what you really have to look at is there was a huge run-up in the kind of August through September into October period. And, a number of us felt the market was frothy in the beginning of Q3 and things were getting a little bit overheated. And, now we've seen some of that come off. You've also seen a lot of money that rotated into AI, now rotating out of AI and starting to rotate into more Dow stocks. And so I think you're generally seeing a risk-off environment. Risk-off tends to drive people out of Bitcoin. But the liquidity that the federal government is going to inject in the marketplace, now that quantitative tightening is over, we're starting to see easing again. We believe that will bode well. The dollar's down, which also bodes well for Bitcoin. And I think you're going to continue to see Bitcoin appreciate. But you've got to realize it's a very large asset class. It's a couple $1 trillion in size, and it takes a lot to move the price. And I think what we're seeing now is just some healthy retracement.
Hey, if I may, just jump in for a moment. I am wondering, Fred, you say that it's a risk-off environment, and yet I'm looking at an S&P 500 that's still near its all-time high. You know, we've seen quite a bounce back when it comes to the S&P 500, also a very big market. So I'm just curious, you know, how do you square that if we're seeing investors still willing to move into the equity markets but not crypto? That disconnect.
Well, I think you have to, in regards to crypto, you have to look at the derivatives market, which is much bigger than the actual spot Bitcoin market. And you have to see the sheer amount of leverage and positions that have come off since the peak. You know, you've gone from the $90 billion-ish range down to the $30 billion range of open positions. And so that's a huge amount of leverage that comes off, which essentially sucks wind out of the marketplace. And people have been moving their money out of Bitcoin and into other things. I think you've also seen, look at the AI stocks. Most of the second-tier AI stocks have all seen a pretty large come down since the peak. Even stocks such as Oracle, look at CoreWeave, you know, look at these stocks and how they've performed. And I think what you're seeing is a rotation out of some of those and into other stocks. And Bitcoin is associated with technology. It's associated with the risk on assets, and it's very associated with liquidity.
So having said that, and you talked about the run-up that we saw earlier in terms of crypto, that where it got to maybe like frothy levels, we're now at what, 87,000 and 87,302 and change. So what do you think should be the level of crypto that makes more sense?
Well, I think you have to look at the long-term trend, but more importantly, go back a little over a year ago, go 14, 15 months ago, no U.S. Money center bank would deal with crypto-related companies, nor would they take crypto deposits, nor would they let you trade crypto, nor would they let you wire money to crypto exchanges almost. And today, you have every bank, including JP Morgan, now moving ahead and doing all sorts of things with crypto. You're seeing tokenization of assets. DTCC has now gotten a no-action letter from the SEC around tokenizing assets. You're seeing all sorts of activities around the traditional finance environment where they're embracing crypto. And I believe that, you know, what part of the effect of that is you're now going to see all sorts of things wrapped around crypto, which will make the space much more relevant. But it takes time for those products to take effect, get launched. And I think, again, Bitcoin has had a great run. You know, over the past 15 years, it's been one of the best performing assets on record. And I think that we're going to continue to see great performance out of Bitcoin over the coming years.
So, Fred, you're a Bitcoin miner. You're also a Bitcoin accumulator. We've spoken to Eric Trump of American Bitcoin. And I'm curious, he's also a miner, also an accumulator. What makes your company different than American Bitcoin?
Well, any company that mines Bitcoin is performing the exact same service for the Bitcoin network, which is essentially assembling transactions into blocks and then competing to win the right to essentially add that block to the blockchain. What differentiates Mara from American Bitcoin, we own all our, we own about 70% of our hosting operations. We're fully vertically integrated. We own power generation. We generate energy off of wind farms, off of flare gas and oil fields. We operate on 4 continents. We also are fully vertically integrated from a technology perspective. We operate our own pool. We co-founded the only U.S. ASIC manufacturer for Bitcoin mining ASICs. The rest of the market is all dominated by Chinese companies. And we have been very proactive in helping drive a lot of the growth of crypto around partnerships with energy companies. And I think, you know, we're still considerably larger than American Bitcoin, not just in our mining operations, but also in the amount of Bitcoin that we hold on our balance sheet.
On the identity part of this, trying to understand what the company looks like, you guys issued a statement this week saying you're not a digital asset treasury firm. You should not be excluded from MSCI, whereas the company said it has been adopting a Bitcoin treasury strategy by holding its mined coins. What is the difference between being a treasury company versus a company that adopts the treasury strategy? Help us with the nuance there.
Sure. So a Bitcoin treasury company, for example, like Strategy or MicroStrategy, as it's formerly known as, has acquired all of its Bitcoin by purchasing it. Mara has mined the majority of its Bitcoin. We've also purchased Bitcoin in the market, but most of our Bitcoin is the product of our mining operations. We have chosen to hold our liquid assets in Bitcoin because we believe, again, better to hold our cash in the best performing asset class over the past 15 years than to hold it in fiat, which is continually losing its value, or just to hold it in treasuries, which will only, pay a dividend of, low single-digit percentage points. So Bitcoin has been an excellent place for us to hold our cash, and will continue to be so, we believe, over the long run. But we generate Bitcoin by mining Bitcoin. We're not out in the market buying Bitcoin on a regular basis like MicroStrategy. We have from time to time gone into the market and bought it when we think it's very opportune. Last year, there was an opportunity to buy Bitcoin when it was in the $60,000-ish dollar range, and we bought Bitcoin because we had a feeling, it was a belief rather, that it was going to go up, which it did. And there are times where we're opportunistic like that. But we sell Bitcoin that we produce to fund our operating expenses. So, we are not a company that holds our Bitcoin, every single Bitcoin that we have. We actually sell Bitcoin from production to fund our business. So we're an operating business. Bitcoin mining is our primary business. And Bitcoin just happens to be how we hold our funds.
Fred, one thing I'm just curious, though, going back to what we've seen in terms of the fatigue in the price and Bitcoin coming down, what's interesting is, and I'm just looking at some of our reporting and commentary, you've got a White House that's very much favored or favoring the digital currency world. You have the president declaring crypto a national priority. U.S. Congress has passed a landmark stablecoin legislation, and Bitcoin exchange traded funds were raking in billions of dollars. We've seen acquisitions. We've seen so much movement. And again, I'm going back to the decline that we've seen in crypto. It's a pretty favorable environment. So, is all of the good expectations in terms of news already priced in and it can't get much better?
No, I think like anything, any asset will revert to mean, and Bitcoin has simply reverted to mean. It has most probably overcorrected. But you had, in the past 6 months, a huge amount of accumulation by the plethora of digital asset treasury companies that were formed. You go back not too long ago, it was basically MicroStrategy was the only real one. You had MetaPlanet to a lesser extent. Semler Scientific was a smaller one. And we were a large holder of Bitcoin. That was kind of it. And then all of a sudden you had all sorts of companies come out of the woodwork. What did they do? They raised cash. They went and bought a bunch of Bitcoin, which drives the price up.
Right.
Price comes up. People start putting money into ETFs. You start getting bigger derivative positions.
Okay.
And it's a flywheel effect. And if you just draw a trend line over the past number of years, you'll see Bitcoin has just reverted to mean.
Got to run. Fred, thank you so much. Fred Thiel, Chairman and CEO of Mara. Just want to mention real quickly, Wall Street Journal reporting that the president said to interview Fed's Christopher Waller for chair.
on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks in the red. S&P 500 index lower for a third straight session. Right now looking at a loss of 34 points at 67.82 on the S&P. A decline right now of 0.5%. Your Dow Industrials, they're down as well right now, lower by 376 points. The Dow at 48,041, down 0.8%. NASDAQ Composite Index down 33. On NASDAQ, a decline of 0.1%. On a down day for much of the market, we are looking at gains right now for the Bloomberg Mag 7 Index, up by 0.2%. The 10-year on this Jobs Tuesday, 4.15%, with the 2-year currently yielding 3.48%. Gold, little changed, up $2 the ounce, 43.07. That's an advance of just about 0.1%. West Texas Intermediate crude down 2.6%, 55.33 a barrel, and Bitcoin now up 1.4%. Bitcoin 87,433 on Bitcoin. Visa is opening its U.S. network to stablecoin settlement, expanding crypto-linked products and services enabled by a relaxed regulatory environment under the second Trump administration. Visa shares down today, down 0.7%. Rival MasterCard also trading lower. A MasterCard right now down 0.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, so appreciate it. We'll be back to Charlie for another update a little bit later on. Hey, we talked about the market, the U.S. jobs market earlier with Michael McKee. It's sluggish, not rapidly deteriorating, and we did see that data that came out, saw traders refraining from boosting bets on near-term Fed rate cuts, setting stocks lower and bonds wavering. So we're not, it's not like all of a sudden traders are saying, okay, we're going to get more rate cuts because of that labor data we got this morning.
Yeah, a reduction is fully priced in by mid next year. Yeah. We should know, but we're not seeing those bets go up.
No, exactly. Curious to see what our next guest has to say specifically about the U.S. labor market. Let's head to the Bloomberg News Bureau in D.C. to someone well known to our Bloomberg audience. She was formerly chief economist over at ZipRecruiter. She is Julia Pollack, and she's chief economist for the U.S. Department of Labor. Julia, good to have you back here on Bloomberg. How worried are you about rising unemployment?
I'm not. So this report understates the strength of the labor market right now because there are two huge temporary distortions at play in the data here. The first is 100,000 or more federal workers who took the fork and came off payrolls, and some of them have gone into temporary frictional unemployment. And the second big distortion in this report is the Schumer shutdown, which forced 900,000 federal workers off the job, but it also led to weakness in the private sector because it forced work stoppages for federal contractors and led to temporary layoffs there. So I expect the unemployment rate to jump back down very soon.
What about the youth unemployment rate, the rising youth unemployment? Are you concerned about that?
So, the unemployment rate is exactly where it was when President Trump first took office in his first term, and he has a track record of bringing it all the way down to 3.5%. We have a bigger challenge this time because of the Biden inflation hangover, which forced the Fed to slam the brakes on the economy, and that has hurt marginal workers the most. But we are setting the stage for a huge comeback in 2026 and beyond with the One Big Beautiful Bill Act, which has hugely stimulative policies, and you'll see those macro stimulative effects build into 2026. They are things like expensing, fast and accelerated, full and accelerated expensing for business investments, no tax on tips, no tax on overtime, no tax on Social Security.
So, Julia, if I may just jump in, just because we only have about 5 minutes left here. So it sounds to you like that there's, and we've heard this certainly from guests here on Bloomberg, more liquidity coming into the market, things to support economic growth. It sounds like you said that the labor picture is actually better than what the data showed. So it sounds to me then that the Fed is correct, Jay Powell is correct in being, actually, forgive me, what you're sounding like you're saying is that maybe the Fed doesn't need then ultimately to be cutting rates, that things actually look pretty rosy for 2026.
So I think the reason that employment growth, the job growth slowed so dramatically between mid-2022 and mid-2024 is that rates were high, and the longer rates stay restrictive, the more of the economy gets hurt. The more businesses have to refinance at double the rate, the more families go out there and try to buy a home and find that it's just unaffordable. So rates right now are still restrictive, and they are still a problem for much of the economy.
But you said you weren't concerned about rising unemployment, so I'm a little confused.
Well, the Fed has a dual mandate: full employment on the one hand and price stability. And this president has shown that his policies deliver both. In the first Trump administration, we had non-inflationary growth. And you can do that with policies that don't, throw fuel on the fire of demand and restrict supply, but do the exact opposite. So through deregulation, through reshoring incentives, we're going to see this labor market take off again, and in a non-inflationary way.
Well, on the reshoring part of this, a motivation for reshoring, onshoring, imposing tariffs to bring back the Midwest, to revitalize what many consider the American dream. Secretary Bessent has said it's been harmed by global trade. The manufacturing industry, though, it keeps shedding workers. When can we expect the data to reflect progress that the administration is trying to make in restoring that American dream?
So the economy shed manufacturing jobs for about 2 years before President Trump took office again. This latest report shows the largest increase in construction jobs in over a year. And that's really the front end of those investments in mining, in energy, and manufacturing. And they're a signal that manufacturing job growth will pick up.
So, okay, you look at the labor market, I mean, in terms of initiatives that will potentially help the U.S. labor market. The conversation around artificial intelligence. Chair Jay Powell even addressed it in saying it hasn't impacted U.S. jobs yet. So I'm just curious, how are you factoring that into as you look at some of the upcoming moves? The president ramping up in terms of hiring people to really focus on technology, AI specifically in the administration. So looking to make more investments so that the U.S. certainly has a dominant role. I'm just curious how then you factor that into your estimates for the impact on the U.S. labor market.
Well, the AI boom is driving huge demand for workers in the skilled trades, in advanced manufacturing, and of course, workers with AI skills. And it is our job at the Labor Department to ensure that U.S. workers are prepared for those jobs of the future. For the first time, labor policy and education policy are pulling in the same direction. We've aligned labor and education for the first time ever, and we are now focusing very heavily on getting workers access to job-connected training that sets them up for in-demand jobs and that doesn't push them to expensive degrees that leave them with nowhere to go.
Let's talk personnel a little bit. We're curious about why it's taking so long to make another nomination as BLS commissioner. Is your name in the ring? Is your hat in the ring?
I have no idea. You'd have to ask the president that.
Would you, if you were asked, would you serve as that?
Well, I think there is a tremendous amount of work to do there, tracking AI's labor impact, improving the timeliness, the granularity, the